Good
Hello.
morning. How you doing? Here we are.
Doing good. How are you, Lou?
I'm all right. I'm all right. Fools World, Happy New Year. It's the first day of the baseball season. That's what we're going to talk about for the next hour, right, Rachel? Yeah.
Yes,
Yes. Okay.
absolutely.
All right.
Ball is life.
We can do that. We can talk other things. As always, fools, let's start it out with the customary beginning. We're here to talk. We're here to give our opinions. We're not here to give personalized financial advice. The Motley Fool is Motley. We don't all have the same thoughts. We're not here to speak for the Motley Fool. We can't speak for the Motley Fool. We can't give you personal advice. We can talk about stocks. We can talk about companies. We can talk about the big macro. We can talk about whatever you want. So get your questions into Slido. Fool24 is the keyword. Love to talk about that. Love to talk about like kind of what's going on today, Rachel. So how you doing this? Well, it's not this morning for you. It's this afternoon. But how? See,
It's 1 p.m. It's all good.
Rachel can preview our days because she is talking to us from the future where it isn't morning, and so she can tell us whether or not it has been a good day. Has it been a good day, Rachel?
It has been a good day. We're going to say it's been a good day so far, although the markets haven't quite woken up yet. Maybe one of the things we could talk about because we had sort of different news coming in over the last few days, and particularly last night, something I had mentioned on one of the shows I was on was we were waiting announcements about a really surprise announcement about tariffs on automobiles and foreign auto parts being brought into the U.S. We have known that, April 2nd has been seen as the official day on which tariffs would be announced, and we got
Liberation Day.
We got a bit of a treat. We got an early announcement for some auto tariffs. So as you might imagine, stocks of companies like Ford, General Motors, Stellantis responded quite differently. Some were trading down after hours, but there are still a lot of details that are not clear about this. But I think it's important to talk about, just given that, of course, it does impact a range of different companies, including publicly traded ones that are widely followed here at the Motley Fool. So late on Wednesday, there was the announcement of sort of a series of sweeping tariffs on foreign-made cars and auto parts, a prelude to the April 2nd duties that are expected to, broadly speaking, be retaliatory tariffs on a range of goods that are made by many of the largest trading partners of the U.S. There's still a lot of details that are unclear about these new auto tariffs, and we've seen a range of responses, particularly from European partners over here on this side of the pond, as there's just still quite a bit of uncertainty. So when he spoke from the Oval Office yesterday, President Trump initially said he was imposing a 25% tariff on all cars coming into the U.S. Later, the White House clarified that foreign auto parts would also be taxed at the 25% rate, even if the cars they go into are assembled in the U.S. However, companies that import vehicles under the United States-Mexico-Canada Agreement, or the USMCA as it's known, are expected to get special consideration until the Commerce Department establishes a process for levying those additional 25% duties. It's also worth noting that USMCA compliant auto parts will remain tariff-free until the Commerce Secretary and U.S. Customs and Border Protection establish a process to apply tariffs to what is, not from the U.S., the non-U.S. content of these automobiles. The president said that he expects auto companies to relocate to the U.S. and build new sites or expand existing ones. And so that is part of what we're seeing. Yesterday, after the announcement, shares of top U.S. automakers fell sharply, as you might imagine. General Motors was down more than 7% in after-hours trading, Ford off 4.6%, Stellantis lower by 4%. There were also shares of automakers in Asia that were trading down after hours, like Nissan, Toyota, and Honda, as well as Hyundai and Kia. There have been some comments from different governments and members of the auto industry talking about the impact of what this will be. Now, it's obviously worth noting we've seen tariffs that have been announced and then quickly shifted, or there's been exemptions announced. So I have a feeling this will be a somewhat dynamic landscape in the coming days. But there was a comment from the CEO of Auto Drives America saying that the tariffs imposed will make it more expensive to produce and sell cars in the U.S. That could lead to higher prices, fewer options for consumers, and fewer manufacturing jobs. It's worth noting that 8 of the top 10 most American, quote, vehicles whose parts are sourced and assembled, in the U.S. are actually foreign-owned companies. So it often, that is something that was from a study by Cars.com. Cars.com had also said it always surprises car shoppers that the badge on the hood doesn't always reveal a vehicle's economic contributions. In fact, 66% of vehicles on Cars.com's 2024 American-Made Index actually came from foreign automakers that support communities in states like Alabama, Indiana, Michigan, and Ohio. Half of all vehicles sold in the U.S. in 2023 were imports. There's some early estimates that have shown that if a 25% tariff is imposed, prices could increase by as much as $12,000 for some car models, as little as $4,000 for others. But the consensus seems to be that the cost will certainly be passed on to U.S. buyers. Obviously, how much of the cost is passed on is, ultimately something that these companies will decide. But historically speaking, we've seen that a lot of these businesses do end up passing those costs on to the consumer. That's usually, an inevitability of how these things process and function. So that's the updates we have. There's a lot of questions still to come in terms of, is that the final number? What is that going to look like? And then, of course, the breakdown of how that actually impacts these companies on a company by company basis. That will also take time to decipher.
Yeah. One thing you said, and it's so interesting, and it's so, I think, unappreciated. And of course, it's not across the board, but Toyota manufactures in Indiana, Texas, Kentucky, Mississippi. They have a parts facility. I believe they make their engines in Alabama. Honda has 2 huge plants in Ohio. They've really attacked the Rust Belt. They also, they make the Pilot in Alabama. They have an Indiana facility. Ford, on the other hand, just from back a few years ago when I was working with them, they had a ton of their capacity in Mexico. So it's be careful what you wish for here. Here's the thing, just kind of economics 101, and I don't think we should need to say this, but I think it's worth saying, is that tariffs can be an effective way to ensure capacity if that existing capacity is there. If we had plants that were just sitting idle, that you could just flip the switch and turn them on, then yes, you could have a temporary disruption and move on. But what this would require at face value, if you want all of these companies to boost manufacturing of a very, very complex supply chain and a very, very complex manufacturing process, autos, it is going to require a ton of capital investment. So that's why, Rachel, you talk about the stock prices. The fact that we are making moves right now that is causing the cost of capital to go up for these companies, at the same time, we are demanding that they spend billions in CapEx going forward on top of everything they're trying to do with the electrification and just the technology. The most likely, at least in the not just near term, but near to medium term, is just less production or higher prices, because those are the only levers you can turn now. You don't have just a pop-up factory that you can go to. So we'll see. Like I say, it's always, I tend to be of the opinion that these are more sticky than they were 4 years ago. This is less about leverage and more about just a grand plan to reshape the U.S. economy over time. So they may be more stubborn, but it's hard to imagine things going as smooth as sort of the rhetoric surrounding it. And it is hard to imagine the impact being temporary.
And I think it's interesting. And as that article pointed out, and we've been seeing statements coming in from different segments of the auto industry already, I'm sure we'll see more today, that the fact that even vehicles that are broadly seen as being American made because of maybe the plants in which a huge part of their, their parts are actually assembled, are often traced back to foreign companies that are operating in the US. So that would seem to undermine the idea of what this is designed to achieve. And then there's, of course, also the reality that it seems as though that these 25% tariffs will also apply to vehicles where maybe some of the parts are American made, some of them are foreign sourced, but it would apply to those foreign sourced parts. So it becomes a very, very complex process. And I think that this is something that even the most organized of operations, these big automakers that we talk about, are going to struggle to realign and adjust to. I'm not saying that they can't, but it is a very, very complicated process in practice.
And do they want to? That's I mean that's the harder question. If I'm a Ford, I might make incremental investment in the U.S., but I think it's going to be based more on long-term planning and just demand curves and not based on reaction. I think for now I'm at least tempted to either wait out. I mean, look, if you put shovel to ground on a new auto manufacturing plant right now, like today, you would be lucky to have vehicles coming off the line before the next U.S. presidential election.
Right.
So, of all of the variables that I have in front of me, I think as a management team, I would be weighing, all right, let's see how much price we can pass along since this is everyone involved. How much do we really look? If I am projecting I need a plant 3 years out, maybe I do start, maybe the calculus shifts towards, all right, I was going to do Mexico to save 3 cents on the dollar, but maybe I won't, so there are some incremental movement, but I don't think if I'm the manufacturer, Ford, GM, whomever, I don't think my gut reaction here, my impulse move is, okay, let's just start building. I think let's see if we can pass this along. Let's see if we can wait this out, because if anything, and we went through this in Europe in the last decade, there is a real risk to overcapacity in this sector, and we have finally sort of right-sized global automotive production capacity. It's been a really difficult path, but we're kind of there now. And I don't think the knee-jerk is going to be, all right, well, let's just shutter all of our facilities elsewhere that we put a lot of money into to quickly build in the US. That seems the least likely, especially near-term option for me, which I don't know if that's fully calculated into the plans here.
Yeah, and the estimate is that this could raise as much as $100 billion in tax revenues, for the U.S. Treasury. And one of the things that I think is also worth noting is just the way and function in which automakers operate on a global basis, whether these are U.S. companies or foreign companies. It is a global supply chain that goes into the construction manufacturing of every single finished vehicle. That is essentially how these operations are in the modern day and age. And where, automakers, both from the US as well as abroad, they source their components from around the world. These auto parts are, again, part of a global supply chain. And so that is essentially how it operates. And even if you are to grant that is a ridiculous or inefficient process, that is still how these global supply chains operate, and completely shifting the way in which they operate is not something that's going to happen in 6 to 12 months, as you underscore. So this is one of those things where it could take years for companies to design, build, and open the new factories upon which the idea of these tariffs are predicated, as hopefully that those are going to be built. But that's something that could take a very, very long time to actually come to fruition, if indeed it happens. And we're seeing already quite a few comments from over here in Europe, as like the European Commission president. We've seen comments from Canadian trade partners. So we'll have to see how this actually impacts the bottom lines of businesses. But ultimately, these companies have the ability to pass that on. They're not going to take on all the cost of this involved. I don't think they even could, no matter how efficient an organization or fiscally responsible that you are. So there's a lot that's happening right now that I think, if these remain in place, are going to impact a lot of the businesses we talk about, for many years. Now, again, we've seen situations where within days, there's certain exemptions that are announced. So is this the final iteration of these tariffs? I doubt that, but I do think that this is something important to watch for anyone that, not just as a consumer, but also understanding how this impacts some of the companies that we might, invest in this space.
Mm-hmm. Yeah, and the other thing too is, as you say, I mean, autos make a big part of some of the inflation readings. And the St. Louis Fed president said the other day, because Jerome Powell said a bad word last week. He said transitory when he talked about the inflation. Right. And last time he said that, it not only wasn't a transitory, it was during COVID, but it ended up the highest consumer prices spiked to four decade highs.
Yes.
So, I mean, look, in the long run, everything is transitory, right? But that it's not
transitory in the context of a decade. It's not helping us sleep better. Yeah.
Right. But we did get comments from the St. Louis Fed said, quote, "I would be wary of assuming the impact of tariff increase on inflation will be entirely temporary." And that's exactly what we're talking about, that the path of least resistance, especially with just kind of the blanket way this is done, is to not invest, not to do what the government wants the companies to do, but just to see, all right, let's see if everyone's facing this. Let's see how much pricing power we have here. I mean, it's not, and yeah, we'll see. I was on the bold prediction show the other night saying that I still think we end up green this year, because I do believe that we are still in a pretty good place in the economy. And it's just, we need the dust to settle and certainty and animal spirit, because, I think businesses are okay. Too many things like this, if sustained, is going to blow that prediction, because we are, there's other YouTube channels that can debate the politics of it and whether or not for the good 10 years or so down the line for this country, it should happen. That's, good, bad, and different. There is no way this happens quickly. And if they stay true to this, it will cause a slowdown, extended slowdown in economic activity and higher prices. That's called stagflation, and that is the worst of all worlds. So, yeah. What a happy way to start our day.
Happy Thursday, all.
Did I mention it's opening day, fools? It is.
It really is. One final note I'll make, because I get a lot of questions on this as it relates to tariffs and the healthcare industry. We've also been seeing a lot of conversation from the administration, but not clear numbers as of yet about potential pharmaceutical tariffs. It's worth noting that there's surveys that have found that nearly 90% of U.S. biotech companies rely on some imported materials for at least half of their FDA-approved products. There was a survey that was conducted by Bio, which polled emerging drug makers all the way up to commercial companies with $1 billion or more in annual revenue. That was essentially gauging views of how tariffs could impact the industry. We've obviously seen conversation about 25% or higher tariffs on pharmaceuticals as sort of a broad blanket statement. That's something that has been reiterated through the weeks, but we still don't have clarity on. According to the findings of this survey, which again talked with drug makers of that are smaller orders of magnitude all the way up to commercial companies with $1 billion or more in annual revenue, 94% of the companies polled said that they expect tariffs on the EU to drive up manufacturing costs. 82% figure tariffs on Canada will increase production costs, compared to 70% of respondents on China tariffs and 56% on India tariffs. Manufacturing seems to be the most consistent concern, But there's also biotechs that are flagging fears about how tariffs on different countries and regions could impact things like regulatory filings, partnerships with contractors such as CROs and CDMOs, research and development, and also just raw material sourcing. And this is already based on the tariffs we've seen announced, not the new potential ones we might see on the pharmaceutical industry, which again, it's still unclear, exactly what that's going to look like. Some companies, the survey noted, they might obviously seek to modify their operations to avoid some of the burdens associated. Some of the companies polled said they expect proposed tariffs on the EU would force them to search for new research and manufacturing partners. On the question of how much time companies expect it would take to alter their supply chains in light of the tariff threat. And again, this is very specific to the pharma and biotech industry from this survey. 44% of respondents said the process is likely to take more than 2 years. 36% of respondents said they expect those changes will take between 1 and 2 years to implement. 21% said they think they could get that work done in less than 12 months. And again, some of these are smaller businesses and operations as well. We have seen news from major drug manufacturers like Eli Lilly that said they will invest $27 billion to kick off construction on 4 new production facilities in the U.S. That's more than doubling the sum that they had earmarked for American production since 2020. Johnson & Johnson has talked about plans to spend $55 billion in the U.S. over the next 4 years, with a good chunk of that going towards the construction of 3 new manufacturing sites, as well as other facilities in their existing pharma and medtech network. I think, as always, the bigger organizations with the broadest market footprint are going to be most well poised to adjust their operations. And again, we'll have to see, what, if anything, these pharmaceutical tariffs actually look like, in practice, and the impact of that above and beyond the sweeping tariffs we've already seen announced that will almost certainly impact things like material sourcing and supply chains, and how that impacts many industries, including the pharmaceutical and biotech space. So still probably a lot to come there, but I get a lot of questions with regards to these in the pharma space. And I hadn't seen a lot of surveys that actually, polled companies in this space, obviously anonymously, but giving a little bit of insight into how some of these pharmas and biotechs are thinking right now. Pfizer is obviously another major pharma company that has talked about their expansion and building of new plants in the U.S. In addition to big names like Eli Lilly and Johnson & Johnson. So wanted to highlight that before we switched gears.
Yeah, it's another example of an industry they can, but again, just there's such cost to what we want. It won't happen quick, right?
Mm-hmm.
So fools, good morning. It's good to see you. And into questions, repopulating our Slido, because the Slido is got emptied. So a full 24 is where you want to go. A couple of questions kind of about our discussion. Steve Jam said, with auto profit margins about 5% and the cost of labor many times higher in the US, why would anyone put up the capital to build plants? Well, look, Steve, over time, if tariffs could have the effect of minimizing some of that economic difference, not in an efficient way, but it could just kind of even the playing field. But the huge emphasis there is on over time. And in the near term, I agree with you. Like I say, I think if I was a management team, I would be focused on either selling less and waiting this out, or seeing how much pricing power they have, since it's applied to everyone. But yeah, I don't think, this is a very blunt instrument to change things that have been brewing really over 50, 60 years. We are trying to reverse 60 years of U.S. economic policy, which is mostly lifted boats. In aggregate, it has been a positive for the U.S. But if we go down this route, it can't happen quick. Ed asked, how does this affect auto parts stores, which usually do well during inflationary and recessionary times? And I think there's a much clearer case that you can pass those on to consumers here.
Yeah, I agree.
It might come down to whether or not individual brands want to try to gain market share, but they all have decent market share. I would think that they would, to some extent, maybe swallow it in marketing, but for the most part, just across the board, I don't think it necessarily affects the thesis on any of those companies, just because you need parts. No, we're Americans. We don't walk places, and right. Well, I mean, but
It's true.
So I
True.
think they are less exposed to this than some of the others.
Yeah. Well, Pro Shop Guy was saying if a quality company has navigated the past challenges like the pandemic, high interest rates, and technological advancement, then will tariffs make a quality company a bigger winner? I think over the long run, that's true. But I think the ways in which companies will be able to adjust and right size is going to be very, very dependent to the industry and to the individual company. Also, how exposed are they to global supply chains? Obviously, we've talked a lot about automakers today, talked about pharmaceutical and biotech companies. These are companies that are highly reliant on the dynamics of global trade. But there are certainly businesses that are less so, that have more agility. But I do think the bigger operations, the companies that have navigated overall in an optimal way through these past periods will be able to do so again. I for example, going back to the healthcare space, I talked about two major companies just now that are already working, to streamline some of their manufacturing capabilities. And because they have such a broad network of manufacturing, they are able to do so in a way that perhaps is more agile than companies, smaller enterprises in the same or other industries. We've had conversations from, for example, the CEO of Pfizer, Albert Bourla. He was saying at the TD Cowen Healthcare Conference that they're preparing to move overseas manufacturing to existing plants in the U.S. if tariffs are imposed. They've said we have the capabilities and the capacity to handle this shift with multiple manufacturing sites and distribution centers in the U.S. This was at the healthcare conference in early March of this year. And this is also a company that has been working to reduce their manufacturing costs through their manufacturing optimization program, which is broadly part of their cost-cutting, maneuvers that they have been making over the last few years as they really look to the next stage of growth post-COVID. That's an example of a company that already has such a broad range of manufacturing capabilities in so many different regions, and particularly within the U.S., that they are able and agile within this type of backdrop. But it really depends. And, often it comes down to when you're looking at a company by company basis, looking at some of these companies' annual reports and scrolling down to where they talk about their supply chain. If this is a company that's involved in the business of, manufacturing actual physical products, and seeing what their exposure is. And a lot of the times these companies will talk about the different regions in which they manufacture and source products from. And I think ultimately it's going to be very, very specific to these businesses. Completely different industry. You think about a company like Elf. I've had a lot of questions about that because they are known for their price accessible makeup. They don't own and operate their own stores. And so they have some agility there, but they have historically sourced a ton of their products from trusted suppliers in China. And that's something where they're going to potentially have to work and expand to a more broad supplier bases, perhaps within Asia, but outside of China. You think of a company like Warby Parker that's been talking about how they source, at one point, they sourced something like 20% of the raw materials for their eyewear from China. And that has been integral to their direct-to-consumer model, where they're able to offer eyewear at a quality eyewear to customers at a much lower than average cost, because they source so much of the materials from these suppliers at a lower than average cost. Now, they even said in their most recent earnings call that is a major risk for them, but they are also working to decrease their reliance on having their supplier base be so concentrated in one area. And now that they have been able to decrease that concentration of sourcing of their raw materials to less than 20%, I think I read it was something more like 17%, and maybe going down. But I think that these are examples of companies across diverse industries. And I think it's going to really ultimately come down to the specific business when we talk about the impact of some of these tariffs. It's not going to be uniform across industries. It's going to be very company specific. in my opinion.
Yeah, I think, and Pro Shop Guy, I love the question because it makes the broader point too.
Yeah.
And that is, it doesn't matter whether it's pandemic, tariffs, recession, whatever. We are here to talk about long-term focused investing, not quarter to quarter investing.
Right.
And the reason that I do this, the reason that I don't just throw everything into an index fund is that I do believe that good management teams over time can win games, whatever the rules are. And I think that is the point. That yes, I mean, you could take your question and make it tariffs. You could make it whatever you want. That over time, winners win because good management teams can figure things out. My whole thesis for this year is that if they just give these companies rules and stick to it, they'll figure out how to win. And
I think that's true. Yeah.
Yeah, and I think that's true. The nice thing is that, and again, this is maybe back to what the autos do from here, is that tariffs are pretty indiscriminate, right? So a good management team has the same rules as the others in their industry. Now, you're right that it could near-term impact, industries differently based on where they source, how much they source, et cetera, et cetera. But basically across the board, these tariffs will hit the entire industry the same. So you have all the companies playing by the same set of rules, and the best companies will likely win because they are the best companies. So I think it is good to keep in mind, even if we do have down days from this, is that over the long term, David Gardner used to love to say this, that if capitalism doesn't survive, if these companies don't survive, we've got bigger problems than our than our portfolio. So kind of to keep the big picture. Ed says tariffs can cause Canada to lose good paying jobs. I guess they won't have to worry about boycotting vacations in the U.S. since they won't be able to afford it. Yeah, I mean that's fair, but I mean this is bad for everyone doesn't seem like a very good argument for doing something to me. Okay. But yes, I mean, there's some truth to that. And I will note to you that the US is about a quarter of the global economy. US GDP is about a quarter of global GDP. There are a lot of parts of the world that are growing faster. It's going to take time. But I do think that if we play this out to its natural conclusion, or this Fantasyland conclusion where we just are insular and doing everything on our own, and the rest of the world is trading around us. I don't know if that works out well for us in the long term. But yeah, in the near term, this, if it plays out, will be crummy for Canada. It'll be crummy for Europe. It'll be crummy for everybody, including us. So if that makes it okay, then okay, I don't know. It doesn't really seem to be an argument in the in favor of it for me personally. But I don't know. I mean, there is an argument to be made that 10, 15 years from now, if we do have a thriving auto industry, maybe we will say it's all worth it. We can watch a million academic papers about whether or not those we downshifted in terms of affluence by bringing those jobs back. But look, it's not necessarily a bad thing long term. I don't see how it doesn't cause a lot more than very, very temporary disruption and downside for now, both here and in Canada.
Yeah, absolutely. Should we talk about GameStop?
Yeah, sure. or just real quick, since you had mentioned Warby Parker, Matt asked me.
Do it,
Matt. I don't want to correct you because the customer's never wrong, but I don't think you have my nearest store location correct. So, but anyway, thank you for trying. But would I ever go to? I guess I would. I've bought glasses from Warby Parker. I will say that the ones that I spent more on, I like a lot better. But yeah, I have nothing against Warby Parker. I love them for sunglasses and stuff. And yeah, thanks for the geolocation. But I think that's wrong. But anyway, let's move on to GameStop.
Well, I thought this would be fun to sort of offset the the somewhat damper that tariffs might put on the morning mood here. Well, people remember GameStop from its famous short squeeze as well in early 2021. There was this surge in retail investor demand coordinated through social media threads like Reddit's Wall Street Bets, drove up the stock price of GameStop, forcing short selling hedge funds to cover their positions. That led to a significant price increase where GameStop experienced really an unprecedented surge. It reached a pre-market high of over $500 a share. There were brokerages like Robinhood that temporarily restricted trading against GameStop and other securities because they were not able to post sufficient collateral to execute their clients' orders. And the event also had significant, financial consequences for certain hedge funds. And obviously, the stock price eventually retreated, but the event, sparked broader discussions about regulatory oversight, market manipulation, and the role of social media in financial markets. For anyone that hasn't paid a lot of attention to GameStop since that time a few years ago, the company is still in operation. They have continued to struggle from, the basis of having their extensive, brick and mortar collection of stores, which are slowly, winnowing down. GameStop closed about a quarter of its locations within the last year. They shuttered about 1,000 stores across the world. And they are continuing to close more stores, but they revealed in a regulatory filing on Tuesday, they expect to close, quote, a significant number of additional locations in the coming months, a majority of closures occurring in its biggest market, the US, with 590 locations shutting down, and also other locations being closed across Europe, Canada, and Australia. They have been one of many retailers that have been afflicted by the shifts in customer buying habits. We've been seeing retailers like Forever 21, which recently filed for bankruptcy yet again. Kohl's has been struggling, Macy's, and many other of these older brick and mortar retailers. But as part of GameStop's pivot away from retail, the company also said that it is getting into Bitcoin as a treasury reserve asset, announcing that a portion of our cash or future debt and equity issuances might be invested in the digital currency. Now, there have been some interesting responses to this pivot since that time. There was a quote from an analyst at Global Data Retail that told CNN the pivot to Bitcoin is really a defense against irrelevance, saying it's an odd thing, as it's basically saying the strategy is not retail, but to act as some kind of a cryptocurrency investment vehicle. There was some positive response from the stock and pre-market trading yesterday, although shares slid this morning in pre-market trading, as GameStop is saying it's attempting to raise $1.3 billion to buy Bitcoin. And then the company will attempt to raise the funds via convertible senior notes. And again, this is after they said in their release earlier this week that the board has unanimously approved an update to its investment policy to add Bitcoin as a treasury reserve asset. The planned investment also comes about a month after CNBC first reported that GameStop was exploring cryptocurrency investments. There was a post on February 8th by the CEO, Ryan Cohen, that had sparked speculation over their interest in cryptocurrency. Cohen had posted a picture on X with the CEO of strategy, Michael Saylor, who has famously hitched his company to Bitcoin and holds more than 447,000 tokens per a filing in February. The strategy has worked out well for Saylor's company. The stock is up a significant amount over the last year. There's an analyst that said GameStop strategy, which has changed about 6 times in 3 years, is that they're going to buy cryptocurrency and be just like MicroStrategy. This analyst said the problem with that thinking is that MicroStrategy trades at about 2 times their Bitcoin holdings. If GameStop were to buy all Bitcoin with their $4.6 billion in cash and trade at 2 times their Bitcoin holdings, the stock would drop $5. This is an interesting. I don't know why, but this caught my attention, and I thought it was at least worth talking about. I mean, we know that Strategy, formerly MicroStrategy, Michael Saylor's business, they've leveraged about $33 billion to amass over 500,000 Bitcoins using instruments like convertible bonds and preferred stock to fuel their corporate Bitcoin treasury, and that in so doing, engineering a self-sustaining price escalation cycle. Can GameStop do the same? I have doubts. But it's interesting that we're seeing this now from a second, I don't know, widely followed company, a different industry, obviously. Back in February, president and CEO of Strategy, again, formerly MicroStrategy, said we've completed 20 billion of our 42 billion capital plan. They hold, again, about 471,000 Bitcoins on their balance sheet, which is about 2% of the total Bitcoin supply. So now GameStop wants to pivot into that vertical. Thoughts, Lou?
I mean, I can't beat the analyst line about, but yeah, look, I mean, who isn't just kind of saying, let's just throw everything into Bitcoin right now? NVIDIA. You know who isn't just saying, let's throw everything into Bitcoin right now? Alphabet. I mean, I do think, and how many more? I mean, you see, I might quibble with you a bit of it won't work because, why not? I mean, I wouldn't have thought it would work the first time, so maybe. But I don't think, it's kind of sad because, years and years ago back, and, famously Jim Gillies, of all people, the Mr. Value recommended GameStop right before the meme happened, just based on the fundamentals of the business. And this was a retailer who had a niche, who can probably generate cash. And, and that was basically Roaring Kitty back in the day too, saying the same. And we've gone from that, where kind of a real business that might have been a turnaround story that had potential, to, you know what, screw it, close the stores and buy Bitcoin. It's actually kind of sad to me in a weird way.
Yeah.
But I don't know. I mean, fools beware. I mean, if I know some of you, like Vanguard customers, can't buy Bitcoin ETFs. And Vanguard, shame on you for that. But that's a whole separate rant. I mean, a product exists. You should not be keeping it from your customers, but there are ways, and certain others of retirement plans can't. So in a way, Strategy is filling that hole. But I think your point is right, is that why should this work? Because the world doesn't need this, and it probably says more about the business that this is where they're going. But other than that, I mean, God bless, guys. Go forward. I will not personally be adding this one to my portfolio, I don't think. But
no, neither will I. This is not a situation that I'm finding compelling at this point in time. I thought it was kind of an interesting, I don't want to say a turnaround for the business, because that would indicate positive growth that I am yet unconvinced that they will be able to achieve. But I do think that this pivot to investing in Bitcoin is, I found that surprising. I mean, maybe this works, maybe this injects some much needed growth into the business, but I have some doubts, to put it mildly. So I have some doubts.
So I need inputs at, hey Lou, what are some stocks and businesses that would benefit from the onshoring theme in the next decade or so? I want, instead of me answering it, and I will try and answer it, but fools, if you if you're interested in this topic, I think it was this past weekend, Motley Fool Money ran a really great interview with Richard Bernstein, who is about the smartest person around, and kind of talked about some of these things. But some of the things I think about thematically, for one, if it does cause the chaos that we sort of think, I do like REITs as just a inflation hedge and things like that. I mean, I think to some extent, retail REITs, if they're diversified enough. And also, we have a lot of industrial REITs, warehousing REITs, things like that are going to have to, I think, be a beneficiary of us loading up supply chains in the U.S. Another area to look, and what Richard kind of focused in on, is small to mid-sized U.S. industrial companies. Because if we are in a world where we are going to have to build all this stuff, someone is going to have to physically build it. And I think Richard even called it like a better opportunity right now than the Mag 7, which we'll see about that. But I do think, if you kind of think of that way, is that if this plays out, if onshoring, and I do think onshoring is going to happen to some extent, I think what we learned in the pandemic is that our supply chains have gotten a little too cute and a little too just in time. So this was already sort of a trend prior to this administration, and tariffs, if anything, are only going to accelerate that. I do think that it's the way your mind should go is like, okay, if this is going to happen, what needs to happen? What kind of just construction needs to happen? What infrastructure needs to be built? What will companies have to do? And I do think kind of the US focused industrials, which tend to be the smaller and mid-sized companies, I do think that's an intriguing place to look. It's hard to pick winners. They can try. There's a lot of big name construction companies. Sterling Infrastructure is one that I know gets a lot of attention for good reason. But there's also ETFs and products you can just buy based on that theme. Since this will play out over time and since it is kind of uneven, I think maybe a basket or an ETF is a decent approach. But yeah, I do think there are companies that will benefit. I wouldn't just look for me personally and say like, well, Lululemon manufactures in the US, so Lululemon's a winner. I wouldn't look at it that baseline because for one, I think that's baked in. And for two, you then get into questions about what's going on with the economy and what people are affording there. I would look more for the picks and shovels, but I think there will be some if this does play out.
There was an interesting question that came in from Mike. Hello, Rachel. Merck faces Keytruda patent cliff and IRA price negotiation in the next 2 to 3 years. Hypothesis: Merck buys Exelis in the next 18 months. Thoughts? Thanks. It's an interesting idea. I'm not sure if they would necessarily want to acquire this business, although it could certainly make sense as part of their overall oncology business. So Exelixis, they're an oncology company. They're focused on discovering, developing, and commercializing new medicines for difficult to treat cancers. They have a really strong focus on small molecules, antibody drug conjugates, and other biotherapeutics. They're most known for a handful of medicines, including a drug called Cabometyx, which is a medication for the treatment of advanced renal cell carcinoma. And as well as hepatocellular carcinoma. They have another drug that treats progressive and metastatic medullary thyroid cancer. They also have another more newly approved drug called Cotellic, which is an MEK inhibitor and treats specific forms of advanced melanoma. And then they also have a pretty, robust and promising pipeline. So it's interesting. It's an interesting idea. We are obviously seeing M&A activity pick up a little bit. But Merck has been preparing for the loss of patent exclusivity on key patents for Keytruda for many years. So Keytruda is an immunotherapy. It is one of their top selling products. It boosts the immune system to fight cancer. It's usually given as an intravenous infusion every 3 to 6 weeks, depending on the dose and the cancer being treated. It is a class of therapies known as immune checkpoint inhibitors. So it blocks a protein that can prevent T cells from attacking cancer cells. And that allows the immune system to recognize and attack cancer cells more effectively. Keytruda, there's a few things that the company's doing. First is getting new indications for the drug. And that can extend patent exclusivity through mechanisms like new clinical investigation exclusivity, or NCI, and that can grant a 3-year period of exclusivity for a new use, formulation, or strength. They do face a key patent expiration in 2028, but there are other patents that go into the 2030s. But Merck is actively preparing and has been for many years for this loss of exclusivity. For example, they're working on developing a subcutaneous version of Keytruda that could provide a competitive advantage over generic versions of the intravenous form. They're also exploring and developing combination therapies that pair Keytruda with other immunotherapies to potentially maintain market share. One of the things that I've been watching is their program that they have with Moderna, which is the Interpath program that evaluates the combination of Moderna's candidate V940 mRNA 4157. It's a neoantigen therapy, and that is combined with Merck's Keytruda. And they're studying essentially Moderna's cancer vaccine with Merck's Keytruda for various cancer types, including melanoma and non-small cell lung cancer. That is one example of an interesting study that I'm watching. As you mentioned, Mike, they have a key patent expiration date in 2028. There are others that go into the 2030s. But aside from the subcutaneous version of Keytruda, which they're looking into to help stem the tide of that patent cliff, they are also looking at their new pulmonary hypertension therapy, Winrevair. Winrevair was just approved last year. It's a first-in-class treatment for adults with pulmonary arterial hypertension. This was a pretty breakthrough drug and landmark approval just across the industry as well as for the business. This is expected to broadly help replace some of the loss of sales that they will inevitably experience when patent exclusivity runs out on Keytruda, although, as I mentioned, they are looking at numerous additional indications, including a subcutaneous version to help extend the life cycle of their patents. But there's analysts who think that Winrevair could achieve almost $5 billion in annual sales by 2029, which is right around the time that the company would start to be feeling the impact of perhaps waning sales of Keytruda. So those are also a few things to watch with this business. They do have plenty of other irons in the fire beyond Keytruda. But, an acquisition, that could be interesting for the business as well. Who knows if this is something that management would entertain, but definitely a fascinating idea, I think.
All right, we're coming up on it. And you know what? It's interesting. The futures are improving. Or so I did. It's all, who knows, right? This is the analysis you're paying for, fools.
Yes.
Who knows, right? Yeah.
Who knows?
Grumpy old man thinking about baseball is screaming, who knows? Yeah. There we go. There was a Robin Hood question. Ed, what does Robin Hood have in their hands right now? What are they looking to get into in the future? Is it overvalued? Is the future as bright? Robin Hood, to their credit, has done a pretty good job mainstreaming. Are they overvalued? They are basically, I think they're maybe a bit more valued than Schwab. It's hard to get an apples to apples. The one thing about Robin Hood that, I personally am not the core audience, I don't think, but they have done a decent job trying to court me as the core audience. They have moved on past 20-year-olds in the pandemic who are gamifying trading and actually getting into, retirement plans, kind of growing up, which I think is a positive for them. They still are very, very willing to push the envelope, what they tried to do with the Super Bowl futures account, which is basically just trying to compete with DraftKings. I mean, if we're honest, it's gambling. You can have a debate all day, and I'm kind of sympathetic to the idea of why are we allowed to gamble on stock prices and not footballs? But for now at least, that they are the ones trying new things and getting slapped back. We're all trading for free because they tried something and it didn't get slapped back. I think in general, I don't want to own Robinhood or Schwab because these companies tend to be volatile based on just trading volumes, and I prefer a more diversified financial service company personally. But I do think that they have come a long way towards just kind of growing up and becoming a real business, and kudos to them for that. And it's not crazily priced anymore. So if you do want exposure to brokerage and brokerage only, which is basically what they do, they are the quote unquote innovator in the space. So it may be something that's interesting. You just know there's a lot of risks because they are trying to transition up the food chain. They're not there yet. And they do like to experiment, which we'll see. All right, Rachel, we have a few more minutes left. Anything else you really needed to get to or as we run out?
This kind of related to another story I had found. Ed was saying, why is it when China talks about AI that it rattles the U.S. market? it's DeepSeek or the CEOs of Chinese companies. I mean, I think broadly speaking, as an emerging, fast-growing market, this is one of the biggest, if not the biggest, competitors we see to the US's advances in a wide range of technological areas, including as it pertains to AI. And so I think that when we see news come out about that, it sort of rattles some of the concepts about American exceptionalism in these areas. I think a competitive market is a great thing, but at the same time, it's also the reality when we saw things like DeepSeek come out, at a much more affordable and accessible way than some of these other models we've been seeing in the US. I think that rattles investors and rattles the markets. I think these things can coexist. I think that this trajectory of news and updates is something that we should be used to and accustomed to as investors. But I think broadly speaking, it's seen as, sometimes a threat to some of the innovation that we have in the US. And so I think that continues to be the case. This is, again, one of the biggest, competitive markets in relation to our own. There was news just yesterday that Alibaba had launched a new open source AI model for cost-effective AI agents. It's called the Qwen 2.5 Omni 7B. It's a multimodal model that can process texts, images, audio, and videos while generating real-time text and natural speech responses. We've obviously seen huge fervor there as it relates to DeepSeek, and Alibaba and other generative AI competitors have been releasing new cost-effective models and products at a really unprecedented pace. Competition is heating up, not just internationally, but also regionally within China, as an example. Over the past years, Alibaba Cloud says it has open sourced over 200 generative AI models. They've said that they plan to invest $53 billion in cloud computing and AI infrastructure, which rivals the type of spending as well that we're seeing by big companies like Alphabet, like Microsoft, like Amazon. I think this is just also, broadly speaking, part of the strategy for these businesses to remain competitive in a highly evolving and fast-paced AI landscape. So I think that we should continue to expect to see, as this news comes out, sometimes businesses are rattled. It doesn't mean Amazon or Microsoft or Alphabet's AI strategy is going anywhere. But I do think that we should expect to see more and more of these major players on every spectrum of the international stage step up with their own models. And sometimes that might also rattle the markets domestically.
The other thing, too, to consider, and whether or not, this is oversimplified, but I do think it's just kind of part of the market move is that technically China can't access the high-end NVIDIA chips. And so with every piece of progress that they make, I think there is sort of this worry in the market that they are doing it just kind of with 5-year-old chips or second generation technology. And then that's questions about the just the thesis on growth there. I think that's oversimplified, but I do think that sort of plays into kind of some of the moves. And yeah, you're right. I mean, it comes down to, we kind of priced in the fact that just the companies we know are going to dominate this, and any threat to that, I think has a pretty natural reaction. Right or wrong, we'll see. All right, Rachel, we're coming up on it, but Cyber Mikey had asked me one directly, so I wanted to get to that. Applied Industrial Technologies, AIT is the tickers. It's up 17.7% versus the industry, 8.8% free cash flow growth, 15% return on invested capital, decent dividend. Is this a cautious barbell stock? So, and those are Cyber Mikey's numbers. I didn't fact check them, but that sounds about right to me. This is what they do, is they kind of make all of the parts that go into industrial automation. And this is a trend that I really, really believe in through supply chains and stuff. Just the factories are getting smarter, right? And so this is a real growth trend I'd like to get behind. This is an intriguing company. The one thing I'd say, though, Cyber Mikey, if you kind of look underneath the hood, they've done a lot of acquisitions. Organic growth is actually negative to flatlined. That could be temporary. And I'm not saying that that's just a disqualifier, but for me, that's something I'm watching very, very close here, because I don't mind a good roll-up story. I like roll-up stories. I've done very well in those, but key to a good roll-up story is that the assets that you are acquiring, you can then grow from here. We need to make sure that organic growth number, that's not just a temporary thing, or that it is a temporary thing and it's not just a sign of the execution going on there. So for me, not a safety stock until we really see progress there, but an intriguing stock. I will definitely say that. All right. Speaking of intriguing, we have Andy, we have Bill, and we have Asit coming on.
Hello, Lou. Hi, Rachel.
Hello.
Happy opening day, everybody.
Good morning, guys.
Yes.
Yeah.
Happy
All
opening
right.
day. Thank you all for a great hour.
Well, have a great show.
Thank you.
Thanks.
Hi, Bill. Hi, Asit.
Morning,
Hello,
Andy.
fools.
Morning,
Welcome
guys.
To welcome to the morning show. Bill Barker, Andy Cross, Asit Sharma here with you to take you through the next hour. Welcome to the Motley Fool on Fool 24, whether you're streaming it live on our YouTube channel or watching us from fool.com. And of course, opening day is the least of our news here, Bill. I don't know. Who do the Yankees have?
What do you think of when you think of opening day in the Motley Fool? Seriously.
I think of one of our old colleagues who used to every day dress in a Boston Red Sox outfit every opening day.
Every opening day.
Full on cleats and everything. He would dress, bring the bat, his glove every day. So Bob Butler, wherever you are,
hope you're watching.
That was always a lot of fun to see him dress full head to toe and come in opening day. Love baseball. So outstanding. Really a lot of fun to see that. But of course, team, we have so much news going on in the world of investing. We had the tariffs last night, but we do have earnings. We have earnings that are still rolling through. I know for me, Lululemon reports later tonight, so I'll be very interested to see what that team has to say just about what they are seeing in the marketplace. Also, I know it's one that we both follow. Bill, Winnebago reported earnings, which I think is always just an interesting. I don't know if it's a bellwether when it comes to RVs, but it is just an interesting company to follow and think through when it comes to industrial capacity here in the U.S. So I thought Winnebago was very interesting also.
Yeah, it could be a little bit of a bellwether for something larger. It reduced its guidance for the full year by quite a bit, and it had mildly surpassed expectations for revenue, $620 million for the quarter versus $616 million expected. Adjusted earnings per share was a slight beat to 19 cents, over 16 cents, excuse me. That's adjusted EPS, and there's some significant adjustments there, but it really dropped its guidance rather significantly by 5% for the year, and I think that is a reflection, and it dropped its earnings per share guidance by more because the increased costs of steel and aluminum are going to flow through apparently this year based on the tariffs. They're lowering sales guidance for the year based on macroeconomic factors. I mean, there is very specific cyclicality to the RV market, and in particular to Winnebago. So the RV market, for those that don't follow it closely, which is almost all of you, has two major segments: the towable, where you have the living space pulled behind anything with a good tow hitch, truck or significant car, SUV, and then the motorhome, the full, drive, like a bus kind of thing. And Winnebago, the brand, is really for the motorhomes, and that segment of the RV market sort of lagged because of certain COVID things and sort of peaked later and is now sort of more toward the trough of the cyclicality than the towable segment, which Winnebago has done a good job by getting Grand Design and making a bigger splash in that part of the market. And the towables are improving over last year. This time, you can get the monthly numbers from the recreational vehicle association every month, and those are up a little bit for the year so far. But motorhomes are still lagging, and I think that while tariffs are not as big a deal for RVs, I mean, it's mostly a North American market. There aren't many RVs being exported to Europe, but Canada is a significant chunk of the market, and so there are going to be issues there with whatever tariffs arrive regarding Canada.
Bill, it was a $75 stock just like, a year ago or so, and now it's cut in half. So it's now in the, 35 or so.
I know. Well, I confess this is a recommendation, not even all that long ago for the small cap service firecrackers, but it has not done well. And there's a cyclicality to RVs, unquestionably. I certainly am surprised that it's hit as hard. Look, it's trading for about 10 times adjusted earnings right now. So, and this is not like inflated earnings, right? So you get it like, oh, it's only 10 times, but earnings are at the high point of the cycle. That's a mistake to invest at 10 times, a highly cyclical stock when the earnings are great. But the earnings are much closer to bottoming than being at the top of the cycle.
Yeah, I mean, a few years ago during COVID, right? This was a business that was making $200-300 million, in net earnings, and now it's running like barely kind of like that, break even, slight loss as you said. So it's not like just based on the trailing numbers and probably even the expectations. It's not like we're looking to expecting to get back to those halcyon days of $400 million or $300 million of earnings.
Right. The notion that there was going to be a sort of fundamental reorientation of how people experienced vacations, and whether people would be comfortable flying. So this you could bring all your stuff and contained, and so there was some juice to that, and really it was the pull forward of a lot of sales, and it's still experiencing some hangover from that, of all the pull forward on the motorhome segment, and then there's this third segment. So you've got the towable, you've got the motorhome, and then you've got marine, to diversify the business a little bit. They went out and acquired some marine brands, and that those are there's backlog there, but marine improved year over year. So it's got some diversification. It's absolutely beholden. It's a very, very discretionary purchase. I would say a motorhome is about the most discretionary purchase, or one of. So if the economy is slowing, if people are worried, if there's consumer hesitation, that is going to be a tough sell, and to go out and buy an RV, and especially with interest rates being higher than they were in the sort of the COVID days. I mean, you could go out and buy one of these things and finance it for next to nothing. So that's not the case anymore.
Here's my three quick hit questions for this. Then Asit, let's get to whatever you want to discuss. And by the way, thank you again, welcoming some great questions in there. Investment vertigo. Sorry, we had to juggle some of the schedules, so we don't have the Canada Power Hour this morning. So Asit and I are stepping in to join Bill here. So on Full 24. Bill, is a dividend safe at more than 3% yield, do you think? Is this a bellwether for other companies? Does it say anything about other companies, not just in the RV space, but just kind of in general to the discretionary space? And they probably don't have a lot of flexibility on passing on costs, or do they?
Yes, and let's talk about it.
Yes.
So the first,
so dividend safe. The dividend is safe.
I think the dividend is safe.
It does speak a little bit to the wider discretionary market.
I mean, the dividend is, as you say, 3, almost 4%, because of the major hit to the stock. There is some debt, but their cash flow, the last quarter is a very weak quarter, seasonally for them. The of course, the bulk of the sales are done in the spring and summer and fall. But I think the dividend is safe. Yes.
Okay.
Now don't bank on that, but it's so low because of the degree to which the stock has been hit. I think that it is a bellwether for some things. I think it's coming out right now in the tariffs, the economy's consumer confidence. I think this is a moment where it makes sense to say we're lowering guidance, and I think that is going to be something. They're going to be far from the only company over the next month that is giving that story.
Yeah.
So I think that it's absolutely a bellwether for the RVs and the
Sure.
recreational, including marine category. And then can they pass on costs? I mean, the suppliers of the parts, the chassis, all that, they have built in. They do pass on the costs to Winnebago. How much pricing power does Winnebago have to pass it on to the purchaser? I mean, I think in the category of motorhomes, which is weak right now, they're still the category leader, and people want a Winnebago to have a Winnebago. So I think they've got some pricing power in a sort of normal market. Right now, one of the problems that they are also having in terms of deliveries is that the RV dealers have adjusted and are keeping much lower stock. If you drive on I-95 and sometimes you go by like an RV dealer and you see like there must be a million RVs over in that lot that I'm passing by. How is that possible? And I think that the dealers have adjusted and are no longer stocking nearly as many. So the pricing power and the passing on costs, they're going to have to take a little bit of a hit on their margins. Their suppliers are going to take a little bit of hit on the components, and the consumer is going to everybody's going to suffer in a world of steel and aluminum tariffs.
Yeah, it takes a village. Well, the stock's up a little bit today, so the expectations must have been low. Asit, follow-up question for Bill.
Yeah, Bill. Funnily enough, I used to follow this industry quite a few years ago. Thor Industries and Winnebago were the leaders back then. I think still prominent companies today, to say the least. My question for you was years ago, just before the pandemic, and actually a couple of years after the pandemic, Winnebago exhibited just a nice control of inventory. You know, they would overshoot, but management really had a good feel for how to keep inventory sort of tight with supply and demand. Is that something that they're still very good at and maybe can favor them going forward as, at some point these pressures relieve, demand picks back up? Will they be positioned pretty well vis-a-vis inventory and also even backlog, which you alluded to earlier?
Yeah, I haven't seen what the backlog numbers are off of they're not doing their earnings call until 10 o'clock. So some of the details are still to come out. But Winnebago, Thor, Forest River, which is owned by Berkshire Hathaway and is the other major player in the industry. They've been through these cycles enough times now that they're the really major mistakes that they made in, what was it, like 15, 16, I can't remember the exact year when the numbers spiked in a way and everybody got too excited about some sort of fundamental shift.
Right.
And
those dealer lots filled up in that era.
And certainly in COVID, they just couldn't make them fast enough. And especially Winnebago was unable to take full advantage of the situation because the number of chips involved in the motorhome, and they couldn't get their hands on the chips, and so people moved down to the towables who would otherwise maybe have bought a motorhome, and the motorhome, once the chip supply chain loosened up and they got their hands on the chips, they were able to catch up and sort of worked off some of that backlog. But cyclicality of this industry is inevitable, and management has been through it enough times, and I think they get better with each repetition. But the cyclicality of things causes pain on this side of the cycle. And I would think that they're managing their costs, their debt reasonably well, but I don't know that we've hit bottom here for the actual company. The stock, maybe, as we're seeing from a little bounce today, even though they cut guidance for the year, the stock is up a little bit. So there really was a lot of pessimism built into at least the before market action for the stock. Once the market opens, it might be different.
Awesome. Let's move on to Asit. If you want to talk a little bit about paychecks, I'm just going to say welcome to all the fools out there. Wendy, good morning, fools. Happy Friday, Junior. Berlin Simon, good morning. Good afternoon. Lovely Lily, good morning. Thank you all, fools, for joining us here on Fool 24 for the morning show, whether fool.com or on our streaming site over on YouTube. Asit, paychecks, did they report earnings this morning? Did they report did they report already?
They reported yesterday, actually.
Okay.
But this is very much in keeping with my appearances on the morning show, because I am a night owl, as many of you know. So I am a sub on the morning show. And it's funny, sometimes I will be just having my coffee and I'll see, not all the time, rarely, but sometimes I'll see Andy and Emily in a Slack back and forth at 7:30, sort of doing the work of the day before the day starts. And I'll think, maybe I should just get up a little earlier, maybe sleep a little earlier. And so in that spirit, Andy, I'm talking about a stock that reported yesterday before the markets opened.
That's okay, Asit, right? It's Fool 24. So, we have aspirations.
Exactly.
And we're on a lot. So we have a lot of analysts looking all over the world for lots of different companies.
Great.
At different times.
Very much so. So I wanted to talk a little bit about paychecks. Now, this isn't a company that I spend a lot of time with, Andy, as you know. It is, though, a business I'm familiar with. I've written about it in years past. One of the things that I keep circling back on is, well, what a bellwether company this is, and how boring stocks tend to make money if they have just a built-in total addressable market and a great position in that market. And Paychex is one of these. Looking at earnings, so this was one of the few companies that was up yesterday. Another sort of down day in the markets. I'm going to read some figures out and ask you guys for some observations. Okay, this is from the news release yesterday. For the 3 months ended February 28th, 2025, revenue increased by 5%, operating income increased by 6%, diluted earnings per share increased by 4%, adjusted diluted earnings per share increased by 8%. And the numbers aren't that different for the 9 months that ended February of 2025. So just out of curiosity, any observations from what I just read out?
Bill, what do you got? What are your needs?
So
we're talking Paychex, Payx is
adjusted was 8%.
Yeah.
And what was the
bit of
raw number? It's a little bit
Yeah,
of stock compensation built in there that they're like not counting in the adjusted. Is a 4-5% numbers. That's GDP. That's what the economy grew at for the last 9 months. 2.5% real plus 2.5%, 2.75% inflation. That's what it looks to me like. That's just the economy.
Yeah. Andy, any thoughts after Bill aced that quiz?
Well, in general, I was thinking about this, and I know Cena put a question about Cintas, and we saw this yesterday. I saw this yesterday when I looked at Cintas, which has been an absolutely outstanding company in stock for so many years. So companies that can grow decently, call it mid-single digits, Asit. You and I have talked about this before, but they have a little bit of leverage throughout the system, so they can eke out a little bit here and there. They're efficient operators taking advantage of different cost structures. And so you have revenues grow like 1% like this. Operating income jumps a little bit like this. They buy back some stock, so share counts go down. So EPS jumps a little bit higher. And if you just do that over many, many years, even if it is at GDP levels, and you're paying a fairly decent multiple. Now, Cintas probably looks a little bit after this. It's done very well. It still looks a little bit elevated in the multiple for me to kind of get too excited about it. But those kinds of performers bought at the right price can just be wonderful stocks to have in a long-term portfolio. And paychecks, that's what I think about when I think about the numbers that you kind of laid out.
Right. And both of those are great answers. So this is a company that's a slow growth company. It's indexed to the US economy. I look at it because it may tell me something about where the economy is going, but it's also a reminder every few years to see if I can go to yoga class so I can kick myself in the rear. It's really hard unless you're very flexible and limber. Literally, I think it was 7-8 years ago, I wrote about what a great total return proposition this company was, simply because they're very forward with their technology. And in this business, customer service is very important. You're dealing with people who are under pressure. I used to be in this game where you've got to make payroll. And so you need good advice, good customer service if you've got an issue. And the way Paychex grows, the way ADP grows, is really through acquisition of smaller companies that bring in tech pieces that they can then offer to their customers. They're not native tech innovators themselves, but they do a good job of stitching together these little additions to the portfolio that they offer. They have a very stable PEO business. So this is a business where you're essentially acting as employee of record for companies, and you're doing a lot of the functions. It's a way for some companies to save money on those overhead costs. But the bulk of this business is still running payrolls, helping businesses cut checks, and that's not a fast growth business. So as the economy grows, if you can tack on a couple of percentage points above that or stay even, then it begs the question, okay, how are you going to produce anything for shareholders? And the answer is just you get to a certain scale as Paychex is like a perennial number 2 to ADP, where those numbers are really big. And there may be some of you have heard me talk in other venues about my love for businesses like Amazon.com, which has such a big top line, or Walmart, which can really benefit from very small changes in operating margin. And that's what Paychex has been able to do over a few years. It's just little tweaks in operating efficiency and the slow growth, but with a relatively big funnel for its size, produces pretty interesting results. I'm looking at the last 10 years. This company's returned 206% on a per share or a price basis, but it's returned 314%, so 50% more on a total return basis. So we often overlook the power of a very substantial and growing dividend. This is a company that exhibits that power. So yeah, just a idea here that as the market becomes turbulent and we are looking at our own portfolios and trying to understand what's the impact of tariffs, what's the impact maybe of slower growth if we're heading to a world that is more regionalistic in its approach to trade. What could we do to have some very easy, perhaps, fuel for our portfolios? And companies like this might be interesting. Just also wanted to touch on that macro aspect. The CEO, his name is John Gibson, said yesterday that this U.S. job growth, which had been sort of strong, and Bill, you alluded to this. I think last year we were up pushing 3% growth. We're somewhere in the we were in the 3 to 4% range. We're going to be in probably the 2 to 3% range, or the 1.5 to 2% range. Basically, the CEO said that it's a stable environment. Looking at the past year, they really haven't seen any whole-scale changes yet from the things that most of us are focused on. So economic volatility, tariffs, et cetera. And they look at checks. They count checks as sort of a metric. And their count of payrolls and checks shows that the labor market is still pretty stable. I myself feel that perhaps some of the layoffs that we're seeing, I think I've read something this morning that now the federal health department is going to cut another 10,000 positions. Yeah. I think at the federal level, we're going to start to see the impact in these overall numbers. And I think we'll continue to see, Andy, some tech trimming as companies perhaps try to optimize for a slower growth period. But so far, if you just look at the data, the message is things are still stable. out there in the macro picture.
Well, yeah, they have been in the employment picture so far, and to be determined every month how long that continues. There are definitely fewer jobs being added over the last 4, 5, 6 months than there were most of the last post-COVID recovery period by far. So if they don't have the federal contract, right, for creating the paychecks and all that, then these are people who are now going to be entering the non-federal pool, possibly some additional employee services that they're providing there. That's pretty marginal, I would say, for the total business for paychecks. But yeah, you're going to see different takes on, is the economy headed toward recession? You'll see a clump of pro and con, I think, going forward for a while until there's any real clarity.
Just very quickly, from an educational perspective, back to paychecks, Asit. So this is an exceptionally profitable company. It generates great returns on capital, whether you're looking at our Moneyball scores of our return on unlevered net tangible asset, which Tom likes to use and repeatedly as one of Warren Buffett's favorite metrics. So return on capital business, we're talking like 30 to 40%, even higher on a round. They don't have a lot of goodwill on the balance sheet, although they are acquiring Paycor, I think for around $4 billion. So they'll add probably a little bit of goodwill onto that. It's very profitable. It's not an expensive stock, really. And the growth rate is somewhere, mid to high kind of single digits. So when you just think about those numbers that I laid out and all we talked about around paychecks from an investing perspective, is that like attractive? Is it how do you think about that as an investor when you see those numbers that you kicked off with, and then just thinking about, I mean, this again, very steady. It pays that dividend. It's the payout ratio is a little bit elevated, I think, but probably on a cash flow basis, not quite as elevated. And a payout ratio is comparing the earnings a company earns in a given quarter or year relative to the dividend they pay out. And the lower that payout ratio is, it's on a percentage basis, the more a company could potentially increase the dividend over time. When it starts to get close to all the earnings or all the cash flow, like more of like a REIT, which they legally have to pay out all in distributions, that starts to get a little bit concerning. But anyway, reflections on just from the investing perspective with paychecks. Sorry, not Paycom.
Sure, Andy. So the first thing, the goodwill number that you mentioned, isn't all that great compared to the total asset base. I think it's like 1.8 billion of goodwill, but you have almost 11 billion or 11 billion plus in total assets. So what that shows us is sort of over time, a slow bolt-on acquisition strategy. They haven't made any huge acquisitions to change the business. And this goes back to the tech piece that I was talking about earlier, is how to acquire things that you can then offer to your clients. They're not in the game of now trying to bust open new market share. They see themselves as a very organic company, a company that grows organically, as Bill said, by the number of employees that its customers add. And that's really to your advantage as a shareholder if you own the company. It has, as you said, a high payout ratio for its dividend. And what it's doing here is getting around something that's really hard with businesses like this. I think Paycom is an exception, smaller competitor, which has a tech edge, is a growth company. So let's stick with the ADPs of the world. These types of companies have a perennial cloud over them. They're hard to buy in any environment. Why? Because we're always worried about recessions. And this is sort of, if you think about premium in the stock market, this is a discount in the market. There are certain staffing companies that have been subject to this for a while. It's been a long time since I've heard anyone talk about great staffing companies, executive staffing companies to buy. The reason is people are always worried that if a recession rolled around, they would get hit first. So I think this really bears on management strategy of how it's going to allocate that excess capital. Looking at the free cash flow they generated, I believe it's rough numbers, 1.8 billion over the last trailing 12 months. 1.7 billion of that again, rough numbers, went to dividends and some share repurchases, they tilt towards the dividend. Why? Because with share repurchases in a business like this, you might get caught buying it on the wrong end of the cycle. You want to be shareholder friendly because you're throwing off excess returns, but it may be a little bit more difficult to time those purchases. And I think investors might take issue with that. Actually, it's interesting you asked this, because now I'm thinking I should go back and look at ADP's strategy vis-a-vis share buybacks. But instead, they give a dividend, which is pretty rich. It's fueled that delta between the price return and that great return if you simply reinvested those dividends. And I think this is, a fine strategy. They signal to the market that we're almost annuity-like. We're stable. You are going to pay not a screaming multiple for our business. And yes, if we hit a recession, the stock is going down, folks. I mean, this is everything that I'm saying is pointing to this. But that's the price of being an investor in these companies. But it's also the benefit for those who can invest, let's say, even beyond a typical foolish period where we say at least 5 years. If you can be in a business like Paychex for 10 years or 15 years, the returns can be tremendous. And, I'm going to come back in a second. I know we're going to move on to other topics, but I'm going to pull up ADP's chart, because I remember looking at ADP when I was in college, Andy, and thinking it's too boring a business. I went with my dad to see his broker, and his broker recommended a few companies. Total, the French energy company, was one. I can't remember what happened to that. But there were some other solid companies. IBM was one. One, though, ADP, just seemed like, why would you want to invest in that business? But I'm going to, in a few minutes, I'm going to come back and let's see what it's done since 1990 or so.
I was going to say, in college, that was just like a few years ago. Your dad was still going to his broker. Wow, that's commitment.
Yeah, it's it helps a little bit of hair coloring, etc. Actually, I don't color my hair, and I'm so angry because here I am. I made the effort to get on the morning show. The sun rises in the east. It's highlighting the clump of white that I have in my hair and making me look 10 years older. Anyway, we should move on. But
no. Tenured. Yeah, well, yeah. Good morning. So we're on the morning show. Andy, Karl, Bill Barker, Asit, Sharma. Thank you for joining us. The stock market just opened up this morning on a day that has some more and more continued tariff news. A little bit less on the earnings side, but we still covered a little bit about Winnebago. And we just talked a little bit about Paychex. We have Lululemon reporting tonight. We have so many great questions coming in. Just some very quick ones I'll hit. Matt, Andy, will any of the Motley Fool's quants ever appear on Fool 24? Matt, I know you've asked us a few times. I don't know. They're welcome to. It's just a matter of what they will talk about. There are quantitative, the quants meaning are quantitative analysts. They tend to be much more holistic portfolio thinkers and creators, less stock individual. And so I think that's the real approach. So we just have to find the right venue for that. Of course, not opposed from them at all. Stefan from MUC, good afternoon, fools. Thank you for joining us. Investment Vertigo asks about Serve Robotics. Yeah, we are talking to the Serve CEO later today on Fool 24 Live. So that will be great. A very innovative, young upstart, still finding its roots robotics company trying to solve the last mile delivery with their robots. So that would be very interesting for those interested in robotics. You don't want to miss that. Team, any questions you want to take quickly, not quickly, take that we can jump on to. Dave says, any thoughts about my popular MF stock KD being down? It's down, I think, now about 9%. I don't see any major news other than they had structured a partnership with Google Cloud, but I don't. So I have to look more into KD, which does IT infrastructure, the spinoff from IBM. Very interesting because of how they are repositioning their contracts as they are kind of escaping the shadow of Big Blue. This is a very integrated company through lots of different parts of both businesses as well as agencies and other entities. And as these companies are trying to kind of modernize that very mainframe kind of tech infrastructure, Kyndryl is trying to do that. And as they are redoing those contracts, that hopefully will help both the revenues and the cash flows. The stock had done very well, I think, over the past since it's over the past 18 months or so, as it is trying to redo some of the contracts. But I don't know about how that news would affect them today. other team, Asit, do you want to
Yeah.
jump in with a comment there?
Yeah, I just wanted to say, the more I study this business, the more I find to like about it. This is a business which, and if you've read our recommendations and our guidance across a few services, you already understand that it's improving its margins as it re-ups contracts out of IBM's shadow. But I was just poring over it for something that I was writing up for Stock Advisor and realized I had missed a fun part of the thesis, which is this company. We often talk, Andy and Bill, about businesses that inherit debt when they're spun off, because the great opportunity for the parent business to take a little debt off of its own balance sheet, and they've got some debt. But they also inherited a really complex deferred liabilities and deferred tax asset structure from IBM. So they have essentially, in the year of spinoff, a negative tax rate. So they're paying taxes even though they weren't profitable. So Kyndryl just approached or passed into GAAP profitability this year, and analysts expect them to be much more profitable going forward. But they still have a really high effective tax rate, something like 33%. So a little bit of earnings, a few $100 million of earnings as it becomes GAAP profitable, and the kind of tax rate that a business that size you would associate with much stronger earnings. So what's going to happen is now things are going to normalize with that tax structure. Both the deferred tax liabilities and the deferred tax assets, there's a little bit of a complicated interplay between them. They're winding down, and they should see a step down all the way to like 20% on their effective tax rate. And I looked at something that we have access to, a database and an information service, CapIQ. Some analysts see that going to 15% by 2028. So management is talking about tripling free cash flow from fiscal 2024 to fiscal 2028. In 4 years, they're going to triple that free cash flow. And this is one of the elements in how they put that puzzle together. So what this means is, on the books, when they record their income tax provisioning, as that becomes less complex each year, we'll see like net income get a small benefit from that. But maybe more importantly, on the all-important cash paid for taxes, so what they actually have to fork over in cash to the federal government each year, that's going to decrease in the coming years. And that's one of the pieces that's going to push that projection of tripling cash flow in 4 years. So the near-term factors, to me, yeah, they're significant because it's had a run up. We have uncertainty in the economy. It is a tech consultant. And by the way, tech consulting is only 20% of this business. I often talk like it's like 70% of the business, but it's not. Services is the brunt of this business. But as you stretch out that time frame, I think shareholders can feel at ease that really the path of least resistance for this company is greater earnings and greater free cash flow.
Yeah.
And they're pretty stable because they're so specialized in terms of those cash flows. So, yeah, I just like this company the more I read about it and study it. And I think of so many businesses that we recommend, this one has a little bit, maybe more of that safety element tied to it for a tech company.
Yeah, it's interesting because they are pushing their consulting services, Asit. Consulting services, as we've seen with Accenture and we've talked about with some of the digital consultants, they're just in a little bit of a delicate spot right now. They're ones that I haven't really been really emphasizing across our rankings, just kind of being a little bit more patient with, because as companies and agencies, and especially at the federal level, so it is interesting as they are continuing to build that part of their business out. I think it's 20 or 25% of the business more true. And IBM has a massive consulting business. In fact, IBM is really pushing that whole envelope. It is an interesting spot as companies are thinking about how to use all the various generative AI tooling that we now have at our fingertips for very reasonable costs. Now, for them, it's for those AI providers, it's very expensive, but very reasonable for the users. And this is the age of users, really, for Gen AI, I think. So those companies are kind of navigating all of those, that market, and Katie is inside there.
Yeah, totally.
So, the short report out this morning seems to be the impetus for the 10, 11% decline. And I think I mentioned this to somebody, that it would be of service to create some sort of methodology that we could agree on to help people determine the value of a short report, because there are some that you read and you think, this is ridiculous. Just the way that this is written, I can tell that it should not be taken as seriously as some other. And there are some you're like, this is very thorough. I have questions that I didn't have before. You almost always have questions that you didn't have before reading a short report, but they're not always ones that are as tough to answer as others. And there are short reports which are very sensationalistic and rely on, broad accusations of fraud and have unnamed sources and write in a way that is obviously meant to gain headlines and effectively hit a stock in a short period of time. And there are others that you have to really take your time considering how much, even if you are somebody that has recommended the stock or owned the stock, you have to take a few steps and really think about. And they run the full gamut. And I have no idea where this one lands. I pulled it up and read through it. It doesn't look that sensational on first read, although it does say the stock might be worth zero. So, there is that element of, the stock is definitely worth somewhere between, an 80 and 100% decline, right? That's pretty sensational. But I've seen that presented in even more hard to stomach packaging than the 8 seconds that I took to read the very beginning of this one.
Okay, well,
I
thank you.
missed that,
Yes,
Bill.
Yeah,
actually,
so did I. So we'll
Yeah.
have to dig into that, Asit.
Yeah, and I want to
It
say
might be important. It might have no importance, right?
Yeah.
And that's the thing. I've only read them, on an individual basis, and I have a feel, for which ones, I'd better pay more attention to this one, and which ones I can dismiss relatively quickly. And I have no idea, Gotham City Research or whoever did this one. I don't know what their track record is. There are places you have to respect the work of, and there are places you have to not respect the work of. And if we had some sort of team knowledge that was shareable in a way that would help people, that would be a useful thing that we could do someday.
Yeah, I agree, and I actually enjoy reading short reports. I think it's part of an investor's due diligence. Due diligence doesn't stop once you purchase shares. If you have something that flags investment thesis, the first thing I like to do is to read it. And I think, Bill, you have a very good way of instructing viewers on how you handle these, which is to try to understand is how much is sensationalistic, how much of it seems to you like it could be something that you missed or something that is amiss at the company. So they play an important role. And you're right, some short sellers have more of a track record and they do really great research, and sometimes they uncover things which are unfortunate, and others, it ranges on the spectrum. But I'm actually a reader of them, so I'll enjoy looking through this, hearing that it could be worth zero. I would have to say, on the face of that, given the management team, which it came over from IBM and the contracts with a lot of great businesses and partnerships, I'd be extremely skeptical of that. But we'll take a read.
Awesome. What else do you want to hit other questions? A few questions in there about tariffs and the impact of those tariffs, if anybody wants to jump on those. Any thoughts there? Jimmy G asked about PayPal. I still like PayPal. Obviously, very competitive space, Asit, but I still think they're in a good spot as they are trying to continue to deliver on some of the expectations when he joined over from Intuit. So I still think PayPal, PYPL, I think is still interesting and kind of the granddaddy of consumer electronic payments and a little bit of buy now, pay later.
Yeah, I agree, Andy. And I think that Alex Chris still wants to shock the world, but I don't think he ever meant he was going to do it in 2 minutes. And this phase is sort of the hard work of paying attention to some assets, which I think may on the surface look like they have challenges like Braintree, which is one of their payment processing engines. They had acquired that years ago, and really making those assets better, working on conversion and checkout, which is a big part of their story going forward. And again, operating as a scale business. This is another business that I like because they're an amazing free cash flow generator and have a lot of scale both on the merchant and the user side. So I think there's a certain taste you have to have for turnarounds because you don't have control over when the turnaround is. So, I guess anyone could objectively call it complete. So as a shareholder, your rewards could come quickly. They could take some time, but PayPal is one of the stories that I gravitate towards too. It's another thing that it has in its favor is just a really great balance sheet and a focus from management on higher value customers, which at the margins, drops off some of the growth, but should be a convincing strategy if you are looking at those cash flows in the future. And again, you have a holding period that's, I would say, 3 to 5 years from today.
I'll take a quick crack. Maybe we can, I don't know how far we want to go down this rabbit hole on some of the tariff stuff, but there's a question. A supposed goal of tariff seems to be to bring principally blue collar jobs to the U.S. at the same time white collar jobs are going. Am I missing something? Everybody is entitled to be confused about what the purpose of the tariffs are, because at times it's to stop fentanyl, at times it's to bring in cash, from I think the 25% car tariffs are immediately announced by Trump as being worth $100 billion in income for the U.S. That, of course, is not true, and it's not meant to be true. That is, if the purpose of tariffs is to make imported goods so expensive that American goods sell better, then you're not bringing in as much money. You can't just take the raw number of cars that are being brought in, slap the 25% on it, and say, voila, there will simultaneously be no change in the number of cars that are brought in under this tariff regime, and we will accomplish more U.S. jobs, right? It's just complete intellectual hogwash. And nobody takes, a lot of what comes out of the salesman's mouth seriously. But I don't know that anybody knows from day to day what the point of the tariffs really is. You would need an intellectually honest presentation that stuck to the numbers and was consistent from day to day. So I don't know what the point of the tariffs is, except you can do them from the administration's point of view without working with anybody. You don't need Congress. You can just do all of it on your own. And the courts can't stop you, right? I mean, a lot of the things that the administration has done unilaterally are illegal and are being held up by the courts. The courts don't have any play here. So this is the dream, where you can just say one day, 10% these countries. No one can stop that. You could say 30% these items. No, there is no check or balance.
Yeah, I think, Bill, I think my perspective on this is that even people who study this inside and out, there's still lots of questions about how it's all going to impact. For me, I'm just trying to find companies that when I think perhaps about the impact, they can navigate that. They've done it before. They have some kind of ability to either pass on those prices, absorb the prices because of margins, or their business is not as directly impacted. Because you're right, how it ultimately shakes out is still going to be a question. But like a company like Trex makes almost all of their stuff, all of their sourcing of their deck composite material from the U.S., right? So it's all coming, kind of around all the recycling facilities they have in the U.S. So in some way they are maybe not as impacted. Now there are other, exogenous factors impacting a company like Trex, Asit, but that's kind of what I'm looking for. Williams-Sonoma, WSM, they have been really adjusting how they are sourcing different products from around the globe to diversify their impact just on China. So they've done that, and they continue. They talked about how they continue to do that, and they also have a lot of sourcing from internally. So because there's so many question marks, I'm just trying to look at businesses and say who can navigate these and who has competitive strengths, depending on, because I don't know how they're all ultimately going to shake out. Not just even like right now, but even just down the line. I mean, within a few months, they could all change and go the other way.
Right.
Yeah, I mean, it's a very hard thing for anybody to analyze. There are too many variables, and not only can you say 30% for whatever country or whatever category you want, but then you can make exceptions to that as well. And if somebody comes in and makes a deal or says we're going to announce that we're building a plant, and over the next 5 years, the exchange for here's some good press for the administration is, oh, here's an exception to the tariff within the subcategory. We'll create an exception. So it from a deal maker's perspective, it's an infinitely valuable tool to have, because you can make deals with absolutely everybody, and you can make the deal differently 2 days later. There's an unending amount of power that you don't have to share. There's no checker balance, and everybody is affected. You get to move the entire value of the world's wealth every day. If that gives you satisfaction, this is a tool that allows you to watch just a few words out of your mouth move trillions of dollars up and down every day. If that entertains you, if that's part of your worldview, this is the thing you have always dreamed of being able to do.
Yeah, I'm gonna have to push back on that a bit, Bill. Just in the spirit of not making this a overtly or a sub rosa political argument. My own opinions aside, I do want to pick up on a few things that you said, though, which is, if Congress cedes the authority to implement tariffs, which was their purview, as they did a few years ago, then you will end up with what is more like an executive function, which is not necessarily a policy-driven implementation of tariffs, but, as you're saying, a one-off, and maybe even dealing with, in some instances, what seems like quid pro quo. So for the investor, it's difficult. I mean, I'll be honest. Nike has been trying to pull its supply chain out of a concentration in China since like 2002. That's when the first articles about sweatshops came out. Then we had the pandemic, and so many companies have been trying to reorient their supply chains since then, since the pandemic. You can't do this quickly. So in answer to Berlin Simon's question, it's very difficult on companies that find themselves on the wrong side of a tariff. A US automaker, for example, which has, because these supply chains are so interconnected, lots of parts coming from Canada, from Mexico, from China, from Germany. Even if they have substantial production in the US, I mean, look at GM. It's not like they're totally outsourced. They have domestic consumption. It takes years to reorient the supply chain. So, and here's where I'm going to, again, just try to stay on the side of being not political, but also agree with Bill. How do you then, say that this is going to help blue collar workers? It's not that easy. And how this makes it difficult for us as investors is you get into a sort of research mode where you're looking for companies like Trex, Andy, which doesn't have any exposure because those composites are in a North America supply chain. And so I think what I've come to figure out for myself is that uncertainty is a feature going forward, and tariffs are going to be a feature. So we have to try to analyze on the fly and as we go along. again, to Bill's point, if you don't have a consistent message, then as investors, what we try to do is just try to figure out which companies might be able to roll with the punches, maybe have the least bit of exposure if that's what we want. And in some cases, you might go right towards that volatility. You aggressive investors out there with even a trading bent, this might be a good environment for you because a great company could be knocked about because of the uncertainty. And so you get a chance to pick up a wonderful company on the fly. All right, I've said my piece, gentlemen. We can continue.
There's probably more, if you like doing scenario analysis, is more to do because the scenarios are broader today around tariffs as we see their announcements of intent to do something, and then it changes, and then the numbers change. So, if you can run and you have a very limited sector that you're looking at, just say cars, and you can just start running like, well, what if the 25% tariffs last X number of months, or apply to these countries, or some country. There are so many different scenarios that you can run and throw odds on different ones and come up with a fair value for any one of the automakers around that. And that's sort of what the function of the market is to try to do that, because you have differing opinions on how long any of the tariffs might last, or what the ultimate purpose of them is. And the market in a perfect world will weigh that better than any one individual will.
Team, as we wrap up here on the morning show here on Full 24, and I believe the Canadian team is coming up next, the Canada Power Hour. I do want to take the question from Cena about Autodesk. It says, Andy Asit, thoughts on ADSK, which is Autodesk Starboard Value tussle. Now, Starboard Value is an activist investor, has different successes over the years, working with different boards. They've nominated, I think, 3 members for the Autodesk board. I own Autodesk. I think they have some evolving, improving IP, intellectual property in a lot of their computer-aided design software. They're very integrated into the AEC market, the architecture, engineering, and construction market. And Starboard Value, here's the question I have for Bill and for us, as you're thinking not so much about Autodesk, although happy to take your thoughts there, but just when you see things, we talked about a little bit when we see a short report come out, when you see like activist investors getting involved, is that something that, like, how do you think about that? Starboard Value, I think, is one of the better ones when it comes to activists and working with companies. And they've said they've had constructive conversations about how to unlock value. And I think Autodesk has left some of that value on the table as they've made this shift in their terms and how they are handling their billings. But thoughts about Autodesk and Starboard Value getting involved. I'll start with Asit, then Bill, if you want to jump in.
Yeah, just a general thought. I think Starboard is a company that has a track record, maybe on the balance, slightly more positive in my estimation than some of their missteps. So I take them seriously. And I used to hate the presence of activist investors. Over time, I've realized that they have their function and value. And again, something to pay attention to. So guys, they're saying, and Cena, who's asked this question, is a ticker guide for Autodesk, and he wrote up a great summary on the boards. And I just had a chance to skim over it this morning. But basically, the idea is that Autodesk has announced, some productivity measures. Starboard is saying, look, that's not enough. If we run the numbers, you should be getting more of a yield out of that. And so I think that they serve a function to sharpen up companies, but where they can be destructive is when they get in the way of what you as a shareholder might view as a perfectly good strategic plan. Sometimes I've seen it work out that way. So I think it's situational, and I do think it depends on track record. Bill, what are your thoughts on that? I don't know if you had a chance to take a look at this one.
Haven't had a chance to take a look at it, but I agree that I think there's a net positive. Certainly not in every case, but I think Starboard has a track record that has to be more respected, and so that's how I would look at it.
I agree, and I wrote this and talked about this before. I think in this case, Andrew Agnos, the CEO, the long-serving CEO of Autodesk, I hope is engaging and truly thinking from both a shareholder perspective as well as a client perspective about how their actions can partner together to help all shareholders, of which now Starboard Value is of Autodesk. So I see this as a positive catalyst. I think sometimes it's helpful to have outsiders come in and say, hey, have you thought about this, mixing things up? Because especially if you've been there, and it's not like Andrew Agnos owns 10% of Autodesk, so it's not like an owner founder kind of operator, different than something like from the likes of maybe Shopify or some other companies where you have that situation. So I think it is good and healthy to have some mix up, and hopefully we'll see some good things from Autodesk. Bill Barker and Asit Sharma, thank you for joining everybody here at the morning show on Full 24, and thank you, Fools, for joining us for the past hour. We covered a range of topics, and we'll have our next team come in from the Canadian side and talk a little bit about all of things Canada. Wow, you have a full house today. I love that. That is fantastic to get some international experience, and I'm sure it will be enlightening, guys. Have a great hour. And Bill and Asit, thanks so much. Fools, have a great day.
Guys.
Thank you,
Cheers.
gentlemen.
Thanks, guys. Yep.
Okay, I believe in the absence of Nick today, I lost the competition for saying not it, who gets to play host. So welcome everyone.
That's why you have the captain jersey on.
I was going to say, anyone get the reference? No, they won't. This is a, there you go. It's a Nick Suzuki, captain of the Montreal Canadiens jersey, but it's the reverse retro, the powder blue, which is the ugliest jersey. I freaking hate them, but my kids like them, so I bought them. What can I say?
They only work for the Chargers.
Well, Iain will remember growing up, the Toronto Blue Jays liked to wear their powder blue uniforms, and I always thought they were the kind of strange looking. But baseball is strange looking, but
I remember
not usually. Yeah, not usually hockey, but also Nick Suzuki, the captain of the Canadiens, is he played his junior hockey in Guelph for my local team. So anyway, with that said, we've got a lot of, we'll say, macro and politically tinged stories that could affect.
Let's keep talking hockey.
I was going to say it's probably better. It's probably a really bad idea, but they don't pay us to talk hockey, so that's okay. We are full on. I'm going to steal one of Ian's bits. We are full on in politicians making worthless promises season, and we're certainly seeing that out of well, I won't call them worthless. Right now, I think in Canada we are having an election, April 28th, right, Iain?
Yeah.
We should probably check that. See, guys, we don't do it for 2 years like you do, and then start all over again. We like to get in and get out in like 5 weeks. But the election is.
I'm all for that, by the way.
I was going to say every American in the room is like, we want some of that. The heck with this 51st state thing. We'll be the 11th province. Yeah, because we're in, we're out. Really, there are two parties that have a chance of forming a government, whether that be majority or minority. I know that what a few Americans were listening have just dropped off with a minority government. It's not that scary. It just means two parties have to work together in order to advance legislation, and no one has a majority or more than 50% of the seats. It's not impossible. Frankly, it works quite well some of the time. Anyway, there's really two parties that have a chance of leading things, and that's the Conservative Party and the Liberal Party. And they are essentially competing with us to give back more of our money to us at this moment in time. Is that fair, Iain?
As I understand, yeah, I think tax cuts have been the primary thrust of their campaign promises, as I understand.
Yeah, really tax cuts to the middle tax bracket. So, fair enough. Everyone gets that, or everyone who's in there higher gets it, I suppose. As well, there's been competing visions for how to increased retirement. Well, first of all, for retirement, the Conservatives, I don't like this. The Conservatives are giving extra cookies to the seniors, or I call them the olds. And I will argue that a lot of Canada's economic problems of the past decade has been because we favor, and I'm closer to the olds than not. So believe me, I understand I'm advocating against myself here, but it's, guaranteeing extra credits for seniors and what have you. And really, we have a small problem of getting younger people onto the housing ladder and getting them, frankly, started saving. So I'm not crazy about what the Conservative did yesterday, but they threw out something that was interesting today that has investing implications. And I want to throw it out there to see what people think. But so in Canada, the two major retirement savings vehicles are RRSPs, Registered Retirement Savings Plans, which are basically like 401ks. You put in after-tax dollars, grows and compounds tax-free. When you take it out, you're taxed at your then hopefully lower marginal rate. Put RRSPs over on the side. The other one is the TFSA, tax-free savings account. You put in after-tax dollars, so no tax credit for that. It grows and compounds tax-free, and you can withdraw it tax-free sometime in the future when, you need to spend it or what have you. But so it's like a Roth IRA for the Americans in the room. Right now we have $7,000. It's indexed to inflation, sort of, kind of, but it goes up only in $500 increments every few years. But it's $7,000 a year you can put to a TFSA, which I believe is similar to what a Roth is, if I'm not mistaken. But the Conservative Party this morning has just come out and said another $5,000 of TFSA room, so 12 total. But this incremental $5,000, if we are elected, this incremental $5,000 can only be invested in Canadian stocks. So again, Canada's 2%, 3% maybe of world equity markets. Diversification is important. We've heard that from how many people over the years, but not from the Conservative Party of Canada this morning. They want you to invest in Canada. So gentlemen, I want to go around the horn. How can we circumvent this new law if and when the Conservatives come to power? No one's going to take my bait.
As we said in our internal discussion, I don't know how this will be enforced. I just bought a U.S. company yesterday, and it's listed on a Canadian exchange, so it's traded in Canadian dollars. I have a position in Google. It traded in Canadian dollars, so I don't know how this comes to be. Frankly, I think it's. I mean, great to open up the room, and I think what was it? 3 or 4 or 5 at some point in the history of the TFSA, weren't they going to double the capacity of it? And they quickly backpedaled on that.
Harper in his last year doubled it to 10,000 a year, and then Justin in his first Justin Trudeau, the most recent prime minister before Mark Carney, versus Harper, the guy before him. And for people who don't know, Harper was on the Conservative side, Justin was on the Liberal side, Carney's a Liberal. Blah, blah, blah. They doubled it to 10,000. And then thank you for teeing up one of my favorite softballs. Justin came in, dropped it back to 5,500 where it had been at the time, saying only rich people can afford $10,000 a year, as opposed to being, I would argue aspirational, because the TFSA is the best vehicle for Canadians, and especially young Canadians, to save. It is absolutely the best vehicle. Like if I've run these numbers, and I told to my son is 20 years old. I said, and we've done this since he was 18. If you contribute nothing but to your TFSA, and he started at 7,000 a year, and it'll at some point it'll go to 7,500, and it'll go to, and I said, if it just tracks inflation at 2% until you're 65, and you contribute the max, so $7,000 a year, and when it goes to 7,500, do so, and assuming your wages can keep up with it, if you contribute the max to your TFSA every year from age 18 to 65, the holdings get an average of 10%, which is the long run average of the market. Inflation is at 2%, which is what guides up your the contribution limit. If you do nothing else at age 65, you'll have about $8.6 million. But people don't think like that. So, but anyway, so Justin said, nope, only rich people can afford this. Cut it back to $5,500 at the time, and then a few years later brought out the first home savings account, which is basically the amalgamation of both an RRSP and a TFSA. You put in before tax dollars, you get a tax credit for it. In other words, it grows tax free, and then you can take it out without tax implication, which is it's wonderful. Justin brought that in and said it was to help young Canadians. And I'm like, well, just the same thing as the TFSA, except on steroids. And you got rid of that because you said only rich people could afford it. But whatever.
So
when have politicians ever made sense, gentlemen? So anyway,
I would say you lost me when you said two parties working together for the good of
I thought you would like that.
no, I tuned out. That sounds like kind of fairyland to me,
Pie in
but
the sky, yeah.
yes, you lost me there. I'm on the Motley Fool's 401k committee. I was a kind of founder. There's three of us there that kind of founded that committee over 20 years ago. And what I've learned about people is they're pretty rational in general.
We know different people.
And, I don't think Canadians are different from Americans. So if they allow them to contribute more, people probably will on average. More people will contribute more. And I don't think it's really ever a bad thing for more young people to save more.
Oh, 100% agree. The problem is
buy Canadian or whatever, like kind of things you want to put on there. Personally, I think that's a silly thing. I think there's probably other things that would maybe be more important to do if you wanted people to buy, Canadian goods and services during this time. I think there's some incentives that you could do would make a lot of sense there. But as far as like the amount that they're putting in their TFSA and just having them buy certain stocks, you're just trying to make those stocks go up or something on it. But I would say the other thing is just this is a longer term issue. I think that folks need to think about. We did a Roth here in the US, and we allowed years ago for people to convert their traditional IRAs to a Roth. And some of those people took advantage of it. My wife did as well. She had a 401k that she rolled over into an IRA, and they gave you like 3 years to pay all those taxes. Because if you had a lot of money in there, it was a pretty big tax bill. But what it did was it brought a lot of taxes forward for the government, right? But then those people are long gone. Like they're long out of office now. And the more that you have in those Roth IRAs and those kind of things, now we have Roth 401ks, is that later on down the road, when people start withdrawing from these and not paying taxes,
no taxes,
there's not going to be any taxes, right? And so it's a short-term play. I think
tariffs will take care of that.
Well, yeah, I mean, that's the situation. So I would say, like, on balance, it's better for people to save. I'm for that stuff, whether it's just Canadian or not. And I think people are generally rational if you give them incentives, which this may sound funny coming from an American these days, but I prefer incentives to kind of like the carrot to the stick. I like the carrot more than the stick. And give people the right incentives, and they generally would kind of do the right thing. But so anyhow, that's my take.
I agree with that. And I think if you look at the old versus the young, we do it backwards in the US as well, I'd argue, in that we allow our older citizens to make catch-up payments to their retirement accounts. They can contribute more than the young. Probably what you want to do is incentivize the young by allowing them to contribute more, or giving them some other kind of an incentive, as opposed to limiting it to just people who are closer to retirement. Get people contributing when they're younger, so that they build up that nest egg and they don't need to worry when they're old about catching up.
Yep.
Looks like Jim's having some technical difficulties.
Yep.
You guys see that?
Spinning wheel.
Yeah, spinning wheel and disappeared. Yeah. It's I'm just, I mean, on the whole political climate, I'm feeling entirely overwhelmed, frankly. I far prefer to be able to focus on a company and decide whether or not I like what that company is doing. And these political actions that are occurring are completely random and unpredictable, and who knows their duration. And it's really it's very, very much impacting my ability to make decisions these days. I'm finding. Are you guys finding the same?
Yeah. Well, not really. But I'll tell you why. Iain.
Mm-hmm.
Any company I buy today, I'm anticipating holding for many years, well beyond the current term of who's ever in office or any actions that they take. And I want that company to be kind of resilient. Now, one thing I would say that's happened when we saw interest rates go up to fight inflation here in the US, but also around the world. I mean, they were at 0%. And I said back then that there's kind of a new world order for companies that we're looking at. And what I'm saying is even sketchy companies could borrow at very cheap rates for a pretty long period of time following COVID-19.
Some of them did.
And when rates went up here in the US, they went up 5% in 14 months or so. I said, it hasn't adjusted yet, but the companies with strength of balance sheets companies with good capital allocators and companies that earn good returns on capital, this is their world. This is where they're going to prosper. It doesn't matter if they're Canadian or US or English, or it doesn't matter. And we're starting to see that happen now. So I would say ignoring the noise that's in the news, and I kind of tune that out for the most part. I'm forced to read it when we come here, but I'm looking at individual companies. I think out 5 to 10 years. But I would say I would focus on those types of businesses.
It's fair. And Jim, I just brought up that I was just I'm feeling somewhat overwhelmed these days by the news flow and the unpredictability of the headlines that we're seeing on a daily basis.
Yeah, wouldn't it be nice to go back to boring again?
Yeah. I mean, and this is something that it's recurring though. It's never boring. There's always something that it's going to be noisy and loud and sort of distracting from the message that Buck just conveyed. It's a real talent to be able to just tune all of this out and focus on that long-term company trajectories.
Yeah, which I will argue. Sorry, I don't know what happened to my internet there for a minute, but I was like, there are some people working out in the street today, so I'm like, it wouldn't be the first time they've cut a wire like that way. Yeah. So, but no, yeah, you've got to tune it out. You've got to have the long term. And again, I know I mentioned on the morning show and the podcast earlier this week, so I'll be brief on it. But like the headline in Globe and Mail on, I think it was Monday or Tuesday morning. I think it was Monday morning. Basically said Berkshire Hathaway has tripled in the past 5 years. Now, Berkshire Hathaway is my largest personal holding, and it is my oldest. I've never sold a share, and I've held it since. I've held it since before my first marriage. We'll put it that way, which has been a while. Until I read that on the other, I hadn't clued into it. I hadn't clued in. Like I just like, oh yeah, it's Berkshire, and I really think there's some merit to, again, buy good companies run by good people with all the green flags that Buck has described.
And they hold over $300 billion in cash.
Yeah, but that's now, right? But when you've got almost 3 decades of with it, like
that should be an anchor on your performance. Now that's relatively recent. They were holding over 150 billion, 130 billion
all the way,
the whole way along there, which should have been an anchor on performance. But guess what? It's an opportunity fund. It hasn't been so much of an anchor on performance, and they're set up to do pretty well. And I'd say they were up 25% last year for $1 trillion company to go up 25%. And when you look at the operating earnings, the results, exclude investments in the sale of Apple and all that kind of stuff. There's a good argument to be made that Berkshire probably performed better than their stock did. And they were up 25%. Now, the difference wasn't as vast as it was just a couple of years ago, where the business was performing very well and the stock wasn't doing as well, particularly when you took into account how Apple had moved up. But so good, strong companies do fine throughout cycles.
Yeah, and that's what we want, and and then we'll all channel our Iain Butler Zen, and we'll tune out on the news cycle and go play pickleball.
And I want to put one more. Since we're talking about tariffs and things like that, and somebody asked here, I don't have it, I saw it on Slido, but somebody asked about different companies. One of those was Nelnet, which is a company that Jim has recommended, and during the last administration,
and Stock Advisor as well, and Stock Advisor Canada
as well. Yep. In the last administration here in the U.S., they had basically forgiven student loans, and part of that started when COVID happened, and they kept forgiving them, and there's a whole bunch of stuff, and that really hurt one of the divisions within Nelnet. They had to lay off lots of people, and then they had to hire them back and train them up again, and then they had to lay them off again, and it was literally an ongoing saga back and forth. And my only point about this is I was buying Nelnet stock. We were getting it at $90 or below 90, and it's now at 114. They're doing very well. And so I would say I wouldn't tune out companies that are hurt temporarily by any of these administrative changes, as long as they're well-run, good companies, solid balance sheets. They're going to get through this, and it could be a buying opportunity for certainly some of those businesses. So just think longer term, think beyond today's headlines.
The one that I flagged this morning was Magna. Magna's the Canadian.
We have a question about that. I was going to punt that to you next.
Yeah, I mean, Canadian-based, but international footprint auto parts manufacturer. And I mean, the stock, when I looked after it was down 7% or something like that, it's trading I think it's at historically low multiples, historically high dividend yield, historically great company. But just this global uncertainty or tariff
pays their executives too much.
Historically, I've kind of lost track. I mean, Frank Stronach.
Frank got paid.
Yeah. I don't know what the payment practices offhand right now, but
nowadays,
that was legendary pay packages for a Canadian executive. But anyway, that's the one that has me sort of wondering and trying to think with a 5 to 10 year horizon. And does Magna get past this? And probably does a much better down the line.
Well, and similarly, you've got Linamar here in Guelph, the largest employer in Guelph and larger than the next 9. And if you took the top 10 employers, it's larger than the next 9 combined, and one of the 9 is a large university. So, as Linamar goes, so goes Guelph. Linamar is falling not as much as Magna today, but they're basically falling in line because the question here was from Irritable Investor. Which I had there. What does Magna actually do? They seem to make or be involved with every automobile part imaginable. You've just said what they do.
That's what they do.
That's what they do.
Yeah.
And basically that's Linamar as well. They're all, if you're making, you're making the cover plate for this crankcase. I don't even know if a crankcase needs a cover plate. But
Johnson rods. They make Johnson rods.
Yeah, there you go. Chances are it's probably made by one subsidiary of one of Magna or Linamar. And they're both getting smacked today because, as anyone who knows the Canadian auto or the auto industry, forget the Canadian auto industry, parts are made in all 3 countries of the USMCA, formerly known as NAFTA. They cross the border for various assemblies back and forth. I think the one thing I read was, basically things cross the border 7 times. I don't know how you measure that, but on your way to getting up to full finished vehicle. What do tariffs mean? I don't know. It's above my pay grade.
Right. To me, this does not seem like a footprint that's easily replicable in any amount of time, really, for any amount of dollars.
No, I was going to say that the tariffs on autos are a very clumsy tool for a very complicated problem that requires a complicated solution, probably. And the market's saying that because there's another auto stock that's down 7% today. GM.
I was going to say it's one of the big guys.
Yeah, which tells you how interconnected everything is and how difficult this is going to be and how painful it's going to be. And unfortunately, I'd argue unnecessarily painful. I think there are ways to arrive at more U.S. manufacturing jobs. I assume that's what the goal here is.
That has to be the goal because it doesn't.
The long-term goal.
Question. I mean, I
without doing what we're doing.
That's the headline, or maybe it's take me seriously, come to the bargaining table. We'll get some concessions and move on, right? But here's the thing: like
we already did that. It's called the USMCA.
Right? Yeah, you're right. And
who negotiated that? Oh wait,
and do we look at Apple phones, right? Apple doesn't make any of those phones. We technically import those, right? Because they're assembled by somebody else. But who captures almost all the value from selling an Apple phone? It's Apple, but they don't assemble them and everything else. And so I think, I'll go back to 2008 and 2009, and I was in Pasadena at a meeting, and Charlie Munger was running that for an insurance company that was 80% owned by Berkshire and now is all wholly owned by them. And there's a question about bailouts for U.S. auto companies at that time, right? Because they were all in trouble. They were all kind of going under, and we bailed them out. And the cost was really high per job paid. I'm talking about millions of dollars per job saved. And Charlie Munger made an interesting point, and I think it's relevant today. He said, in the world that I see, the future that I see coming, not only the American car companies all in big, big trouble, even the ones that lead the world today, and he was talking about the Japanese specifically, they're in trouble too. And I think the company he was referring to was BYD.
BYD, yeah.
Wang Chanfu was actually at that meeting, and he asked him to come up and say a few things, but he didn't specifically come out and name them. And I'm just like, okay, so what are we willing to forgo to save or prop up this industry, and how many jobs are really associated with it, and what are we doing? So I would just say it's. I don't think many economists would say it makes a whole lot of sense. That's what I would say.
But
Go ahead,
incentivize
Nate.
them to compete. That's
Yeah.
what I think you do. Putting tariffs up and actually incentivizing them not to compete, to be kind of lazy and let some fee make you competitive.
Right.
Long term, it makes things worse, I think.
Yeah. Well, and also too, to go back to Nate's point about what's the goal here is to rehome U.S. manufacturing jobs. Whether we agree with that or not, that seems to be at least one of the drivers that at least is stated out in the open. So we can do that tomorrow, right? We can pick up a multi-billion-dollar plant located in Mexico or Canada and put it in Dearborn, Michigan.
You can give incentives for all that stuff to happen, right? Like
I get it, but my point, Buck, is that
building a plant, we're going to do all this. It happens all the time. You don't.
It happens in Canada all the time. Canada was very famously, giving tax breaks to battery makers. What looks like what's at the top, but I'm not too sure what's going to happen with those now. But they made for a good photo optic. But no, like even if you were successful and the stated goal, move manufacturing jobs into the U.S. from outside the U.S., if that is the stated goal and that's for real, it can't happen tomorrow, can't happen next year, probably can't happen 5 years from now.
Definitely not happening before the midterm elections.
It's if you like to move your life in cycles, presidential cycles and what have you, like this is just chaos in the industry, and it's going to mean higher prices for consumers. Are you willing to spend another $12,000 on your car if that's what the impact of tariff from going across the border 5 or 6 different times for various assemblies? Are you willing to pay that? And I suspect most people won't be. But then again, I also saw this morning that there's a proposal to make interest on car loans tax deductible. So what do I know? Because I'm just like, I'm sure no one will take a larger loan now because it's tax deductible, right? Anyway, that's just, to me, is crazy. Anyway, maybe let's get to some questions here, unless anyone else has any more political talk, so we can get rid of that.
I remain overwhelmed. Nothing has.
Yeah, I would say remain overwhelmed and prefer carrots to sticks.
Well,
there we go.
my neighbor across the street, they've got a red Liberal Party sign on their Americans. The colors are reversed up here. The left wing party is the red one, and the right wing party is the blue one. So I got a red sign across the street from me. I got a blue sign right beside me. I'm thinking of seeing if I can dig out a sign from the old satire spoof rhinoceros party. I'm going to put it on my lawn, and I think that'll summarize my opinion on politics right there. Okay. Moving on to some real questions that hopefully can be, be interesting. Here we go.
If we just want to quickly stick with Magna, there's a question at the top just that
Please,
I can
take
hit. I can do my best. So I don't fully understand the intricacy of the North American auto supply chain, but I do know that Magna does, when a new vehicle is coming to production, I'm looking at our Hyundai Palisade. So the Palisade model that's sitting in the driveway has, say, a 10-year run to it. And they go and find the suppliers for that Palisade, and those suppliers go along for the 10-year run. So immediately, no, Magna is not replaceable because it's part of the production process of every vehicle that it touches. Over time, it could be, but you just can't fire up another Magna. I mean, you can't build that footprint in any amount of time. So I would say that largely, yes, it is irreplaceable in the auto part supply chain.
That's a big part of what makes all these businesses so attractive, is that for each part, there's usually 1 or 2 companies that are given the contract for, say, a 3-year period. Then it's up for renewal, and there's different parts of the contract that move. But that's why, companies that are considered so plain and boring, like auto parts manufacturers, can make 15-20% returns on invested capital because they know they've got the deal locked up and they know what their costs are and they can plan. Right now, it's a little harder to plan.
Yeah, and even like because I have a few auto parts companies recommended in GEMS. I've owned a couple more. The one I always like to look at, I've owned it for 20 years, is Autoliv, which is the they make seat belts and airbags. Autoliv, haha, Swedish humor. Swedish company, global presence. A decade ago, there were really only 3 airbag manufacturers worldwide. It was them, TRW. The third one escapes me. But then one of the other 2 competitors in the space, and at the time, Autoliv had about a 35% market share, which, 3 companies, that's reasonable.
The Japanese one blew up.
I was going to say, and the Japanese one went boom. And so today, something about something cartel behavior, something. And so today, Autoliv, I think, is, for a time there, I think they had like something like 50% supply. And that's not 50% of going into Chevrolet cars or 50% going into Fords. It was 50% of cars. And that's what a lot of these things, whether it's an Autoliv, a Garrett Motion, a Magna, a Linamar, like they're in everyone globally. And so when Iain and Nate and Buck talk about the complexity and not fully understanding the complexity of these, like, it is a real problem. No one understands how complex this is. And, now you have to deal with a tariff expectation that comes into effect today. I don't think they're waiting for April 2nd. I don't even know. Yeah. But like, and again, things are made all over the globe. They're made, they transfer across borders. Like this is chaos. And but the one thing I do know, I don't know how it's going to unfold, but the one thing I do know is it's not going to be, near-term positive for car prices. Positive meaning going down. So it's, thankfully I don't need a car, knock wood.
So do companies, and beyond the auto sector, just companies in general, I wonder if we see a pause on capital allocation and if we see a change in, if we get more stock buybacks, if we get dividends, if they direct that capital rather than reinvesting it in themselves, they just ship it back to shareholders. I wonder if we see that sort of start to emerge in quarters ahead.
I mean, are you going to start a long-term investment cycle? Are you going to say, hey, we're going to start a plant that's going to take 5 years to build without even knowing what's happening next month?
Exactly.
This has been the argument with energy companies for so long, because so much of the infrastructure that's required for these things takes literally a decade or more to kind of build out and do. And when policy shifts with each incoming administration and back and forth, and they're like saying, this is ridiculous. Like, we need an long-term energy policy, which we've never had here in the US. And I just say, like, the lack of stability certainly impacts capital allocation decisions. Mm-hmm. And you would be irrational as a CEO or a CFO to take on any of those long-range things without knowing what's happening in the next month or 2 or 3 years. So absolutely, I think it does impact it in a negative way. Yeah.
We'll probably start to see comments along these lines in upcoming conference calls, right? Quarterly conference calls.
Assuming these tariffs aren't just thrown on the ash heap in 2 days, which
which is possible.
Yeah.
Which is possible. And let's move on to something other than tariff and tax talk, because we've got 3 people left watching and 2 of them fell asleep. Okay. From Michael Fathead Calgary. Oh, don't run Calgary down that way, Michael. This one I'm going to direct at Iain because I don't want to answer it. Any thoughts on Andlauer Healthcare and their ability to grow in the U.S. given the current administration, as this seems core to their strategy? Let's get Michael Andlauer on the phone.
Right. I mean, it's been part of their strategy since we started following it to grow in the U.S. I don't remember what I said about being overwhelmed. I don't see Andlauer as a issue. I don't know if issue is the right word. I don't see them being heavily impacted. It's not one that I've sort of flagged, certainly not along the lines of Magna. So I think I consider it to be a status quo situation for whatever that's worth.
So I own Andlauer, and it's a recommendation in both Stock Advisor and Gems, I believe. You never sold it, right, Iain?
No, it's still in there. Yeah, and I own it too personally. Yeah.
Yeah, Andlauer, it's a weird place to be with Andlauer because it's such a controlled company. Michael Andlauer's got that thing just sewn up. Like I think he's still got like 65% of the voting power or shares or whatever. But it's kind of, you guys have seen those memes where there's like a guy poking something on the ground with a stick and says, "Come on, do something." I feel you could put Andlauer's logo on the ground at the end of the stick and just, come on, do something, because it's done nothing for years.
It came out of the gates very nicely from a stock perspective.
Yeah.
And I mean, just kind of still trades it. It's not too expensive. It's not too cheap. It just, you're right. It just kind of is there. Yeah.
And their allocation policies are interesting. They bought back. They did a substantial issuer bid last year, which is basically a tender offer, and they bought a bunch of shares back at $45, which I think the stock at the time was barely over 40. So it was kind of like, oh, good deal. But and I believe Andlauer sold. I think Andlauer filled half of the demand by himself. But like, it's absent that, the growth is gone. It seems like the 3 years in a row growth is like their results have basically been static. And Andlauer seems like he's more interested in getting a new arena for the Ottawa Senators than running his legacy business. So I really do kind of, it's not expensive, but it's not cheap, and it's not growing, and the CEO who controls it seems to be distracted. Not really making a great case for it here. Let's move along. Sorry, it's just, I wrote this last week too in Gems. So, but okay, another one from Michael Fathead Calgary. This is your 2. There is no 3. Thoughts on the TerraVest's valuation today with the recent acquisition? Do we feel that valuation is justified for future growth? Anyone besides me look at it?
Haven't looked at it recently.
Where it lives in my head is it probably skews expensive on a valuation standpoint, but I think they've just made a platform acquisition that could turn out very nicely for them.
Are you saying it's expensive because it's been a 6-bagger in the past 2 years?
That's part of the reason.
For a company that makes waste oil tanks,
right,
among other things.
Yeah. Right.
Well, yeah, except it's not really a waste oil tank and other things. It has purchased, I'm going to read off the screen here. It's purchased N-Trans International, a premier, I prefer they say the premier, but a premier North American manufacturer of tank trailers and transportation solutions. And they paid 7 times trailing EBITDA for it, which is not terribly expensive. It is the largest acquisition they've made ever. I do tend to skew a little bit in Iain's direction that, the valuation certainly more expensive than when we got associated with it.
Right.
The valuations are at 10-year highs pretty much for everything. And when I say 10-year highs, double what the 10-year average is what they're really trading at. So valuation. Yeah.
There is some jockey there is some jockey envy here, or some basically that it's gone from a reasonably priced, if not cheaply priced, maker of essential but boring goods to, hey, that CEO is both A, young, and B, good at capital allocation. And I think there's probably, I'm blanking on his name, it's Dustin Haw, I think it is. But it's Dustin Haw. There's definitely some jockey enthusiasm that's, I think, leaked into the company. Again, it's up 6-fold in 2 years, or 2.5 years. That's going to happen. And not because of results, because, as Buck has said, valuation ratios are high. Now, there's going to be a little bit skewed as well too, because the stock did jump heavily upon the news of the N-Trans acquisition. So, you'd probably want to do a pro forma, take legacy TerraVest, and you'd want to add in N-Trans if you could even get that, which I don't think you can because it's not public. But, the pro forma numbers might look a little bit better, but I would suggest you probably want to let this one integrate and give it a few quarters after that and see what the combined results being, just kind of look at the present valuation and go, yeah, it's probably rich. I'm not personally considering adding, but other people can of course, come to different conclusions. But, like it, no intention to sell it. but boy, I'd like that $25 price we got a couple years ago.
Big return. I mean, but like the company is like, it's been kind of the two-pronged return, right? The company has grown and the multiples expanded. So that's a happy scenario when we find those.
Yeah, we'll take it.
Yeah.
Okay, we'll throw this one out here from Jimmy G. This is not me. I don't know if anyone knows. Well, it's just it drew my eye. Right, I'm looking for things that are not, that I'm looking for tickers that aren't mine, frankly. So I don't know if it's any of y'all's, but it ain't mine. Is Paychex a worthy buy at this time? Has anyone ever looked at Paychex? I have not.
Paychex is a wonderful business.
Yeah,
and I've looked at it. I used to own it long ago, and we're talking about a stock that's it's a wonderful business, and it's also trading like that. It's at 31 times earnings, so it's well above a market multiple. Has a 2.6% dividend yield, which they have a history. I know Nate knows this because he follows dividend payers of paying out a good chunk of their earnings in dividends. And my only question, I haven't looked at them recently in a short bit, would be the question of how does technology and the cloud and all those things, how are they impacting their business? And I don't know. I mean, it's been a very sticky service that they provide. So I'd say Paychex started doing smaller companies, and then the one that served the really big companies with ADP, and then Paychex has kind of grown up. And I think when you have such a dominant position for so long, I always get a little worried at some point to say, hey, what's it going to take for kind of a startup to come in and kind of upgrade their system and do all the things with the cloud and everything and make it easier to switch than what it has been in the past. But I'd say in general, this has been a really good company for a long time. It looks to be a little bit on the expensive side right now to me.
Is that startup, and not necessarily a startup, but that kind of the disruptor in that space? Is that Paycom? I know Paycom's
that's one of them.
Okay.
There are more now. The cloud has definitely allowed some of them to gain traction more quickly than they would have in the past. There have always been a lot of mom and pop kind of local competitors for Paychex and ADP, but Paycom, I want to say there's PayGo or something like that, and others. The cloud and being able to market over the internet and everything, the last 15 years or so, the industry has changed a bit compared to what it used to be. Still great businesses.
I would just add one thing. So if you look at a company that's at 30 times earnings, you have to compare that to what their growth rate is, and say, okay, do I expect multiple expansion from 30 times earnings for a company that's pretty darn mature, is serving an area where there's not a ton of new jobs and everything being created? In other words, in order to grow, they got to eat somebody else's lunch, right? They got to say, I'm coming in here and I'm better than you, and somebody has to switch or whatever else. And so I would say my personal guess would be I wouldn't be expecting multiple expansion on this particular investment. So then I go, well, I'm getting whatever the growth rate is, and what is that? You compare it, and plus you get the dividend. And does that look like a market beating winning formula? That's the math I think one needs to do.
That applies to every company. It's actually it's not that hard to, when you break it into the three buckets: company growth, multiple expansion or contraction, and then dividend yield is the other component that can be thrown in. There's your total return on a stock, and if you sort of think of companies in that regard, it kind of makes life a little easier. I've found.
When you put it that way, Ian, it just doesn't sound sexy at all.
I know, that's right. Yeah.
This is what we do all day.
Yeah, I know. Anyway, throwing it out again.
Sounds. I mean, really, it is.
Trying to again keep you guys talking rather than things directed at me, but I will throw this out for discussion from Cena NYC. Thoughts on HCal relative to the current tumult or whatever pronunciation I should be using. HCal, of course, is basically an ETF or a traded vehicle that has equal weights of the big six Canadian banks that used to be trying to follow a mean reversion strategy, and I think they got no love for that, so they just said, to heck with it, we'll do equal weights in all six, equal weights in all six Canadian big banks, with a kicker of 25% simple leverage. So if there's, say, they got $1 million in there, they $1 million contributed, they get their $1 million, they all go borrow $250,000 from just a straight up line of credit and then invest that in the same things, and hopefully the dividend yield and capital appreciation outpaces the cost of that leverage. But given all of this, what's going on, tariffs and uncertainty and chaos and whatever, and impacting Canadian big banks, do we have any thoughts on HCAL as a vehicle today?
I mean, my take is that the Canadian banks have weathered a heck of a lot of storms over the years, and they're proven very resilient. I suspect this will be no different, and I would be keen if they were to cheapen. I would definitely lean to adding and buying Canadian bank exposure.
And this is an easy way to do it as well. Just as a follow-on, there's a couple. It's probably more than a couple, but there's a couple that I know of. Not only are there these types of bank stocks or bank vehicles, ways to invest in bank stock, HCAL, but there are things like ZEB, which I think is bank BMOs or whatever. There's covered call funds specifically dedicated to the Canadian banks. Anyone have any feelings, dire or otherwise, on those?
You're the option guy.
I mean, I have an opinion on them, but I'm just kind of curious of you. No, okay. Well, I've seen them a bunch of times, and all the banks are all down modestly today. But my opinion is with what the Canadian banks is the same as Iain's. It's some of these companies predate Confederation. I don't think this week's bad news is going to be the thing that knocks them off their perch. As the covered call thing, I will say that because I've had a few people ask me over the years about covered calls on banks. I'm just like, covered calls on dividend payers are bad ideas generally, because a dividend payout lowers the call premium. So when you sell a call against your shares, you're arguably getting less than you should be getting. And the argument is, but you'll get the dividend. And the problem is when the underlying goes above the strike price, and it's on the ex-dividend date, you can see early assignment as the counterparty steals your shares from you, thus meaning you got paid less than you should have been, and you didn't get the dividend. But other than that, I'm sure there's no problem. I'm generally not a fan of those things, but I do have a few that popped up in my thing and thought I'd throw it into the question that was asked by Sina as well. BG asks, how is KD different from numerous other similar service providers? I'm assuming he's not asking about Kraft Dinner. K Dinner, that's Kendall, I think?
Or Kevin Durant.
Yeah.
Kevin Durant.
Yeah.
Is Kevin Durant a service provider, though, really?
No. Well, I don't know.
He's a locker room leader. Okay. Does anyone follow? I believe it's Kendall. Does anyone follow Kendall? Or
I don't know it.
Nope.
Nor do I.
Okay, well, that's 4 strikes. Okay, yeah, it was Kendall.
one.
Okay, sorry. It's down 12% today, which I imagine is why the question. Sorry, we can't help you.
Was this a spin out of?
It's a little different from the stocks. This is from Carlos, who asked a while ago, but it got some upvotes. Is your cash position bigger than usual today in your portfolio?
Round the horn. Go ahead, Buck.
Okay, I'll say yes, but I'll also add that it's not because of what's happening now. It's a function of the fact that the stock market was up 25% 2 years in a row. And when I start seeing things get a little bit frothy in some places, I'll tend to trim some things. So, but my cash position is higher. I'd say the other thing that has impacted that a little bit is the fact that you can be in a money market today and earn 4% or a little bit more. And so it doesn't hurt at all to hold a little bit more cash than you normally would. Because, generally, if the market goes up 25% a year for 2 years in a row, you might have some chances where things would correct a little bit. So yes, my cash position is a little bit more. And I will throw out one more thing. Robert Brokamp and I were on Full 24, a week or so ago, and he threw out the thing that I thought was pretty interesting. He said he likes a 10% cash position. And he said, what happens is if stocks perform very well, so you do have a year where stocks go up 25% or 30%, your cash position falls below 10% of that portfolio. So it kind of forces you to trim some of those holdings to get it kind of back up there again. And once again, when stocks get cheaper, right, all of a sudden that cash position rises, so you can put some of that cash to work, naturally keeping it around that 10%. And I thought, hey, that's a pretty good system for those that might find it hard to buy when times are scary, or hard to sell because your things keep moving up and you don't want to miss out on further gains. But if you have that rough guide, you can pick whatever's right for you. But he threw out the 10% rule, and I thought that was a pretty good one.
That's pretty good. Iain?
Cash position is higher than normal, but lower than it was. How's that fit?
Translation, you've been buying the last little week.
I found a few things to throw some existing holdings that I've sort of topped up, and one or two new positions that I've taken that I'm probably just still inside the window that can't be disclosed.
Yeah.
But
fair enough.
Yeah.
Nate?
Yeah, very, very similar. Higher than normal, but partly because of some selling more towards the end of last year than now. And then just putting money to work, but slowly. It's probably piling up between dividends and contributions going in on a regular basis than it is being put to work at the moment. But there's still some being put to work.
Yeah, and I'll complete the circle and say 4 for 4. I am higher than usual. I do like Bro's suggestion brought to us by Buck. I'll say the only kicker, or the one caveat I have with, and I, much like what Buck said, 2 years back-to-back 25%, things getting stretched, that's a time to start raising a little bit of cash, which is what I did. The other kicker is I got a kid in university. I just, given the uncertainty in his, and I've got another kid who's going to be starting in 2 years, but I got one kid who's about halfway through, and I just monetized things that had been invested. It's now in a money market fund. I sold, and it's now in a money market fund. So the remainder of his school is paid for, and I don't need to worry about any volatility aside from, I'm assuming a money market fund will be good, which we learned in the global financial crisis wasn't always true. But, barring that, I'm sure we'll be okay.
Hey, can I add one more on here? Because this got a lot of upvotes. We haven't addressed it.
Sure.
This comes from Miss Melanie. It says, thoughts on Stella Jones relative to U.S. tariffs. And I'll start it off by saying I was driving out in very Western Virginia to go to a resort, very rural area. And I came around the corner, and there's all this stacks of lumber. I mean, as far as you can see, it's giant. And I drive by the sign, and it says Stella Jones. And so to me, that says, and you guys know more about Stella Jones than I do, that operation was in the U.S., right? So it's across the border. It's not that they're shipping things over here,
I was going to say those are
telephone poles and that kind of stuff. And so I think that's a good thing, because I think companies that are interested, and somebody else asked about this, that if you have operations and you have a lot of your cost base in Canada, some of those like your headquarters and that kind of stuff, but you're earning revenues in US dollars or other currencies, that can be a nice thing. So I would say Stella Jones, I don't think is that subject to the tariffs, but you guys can weigh in because you know more.
You've confirmed.
Correct.
Yeah. Just confirm what you just said. Yeah.
There's a lot of interesting companies out there actually like that, where they're not impacted by tariffs, at least not directly. Their customers might be, their suppliers might be, or both. But yeah, they are not, which I think is pretty interesting.
Well, and one company, I'll say Trisura, because that's not a company that was asked about, but we've talked about from time to time. This is a really good Canadian insurer who expanded to the US, and now they earn a lot of their revenues in US dollars, but most of their costs are paid in Canadian dollars for people. So most of their costs and things like that. So like those types of businesses, and they mentioned it on the most recent conference call, was that, hey, most of our costs are in Canadian, and we're earning a greater proportion of our revenues in US dollars. So the strong dollar doesn't really hurt us. It actually is a little bit of a tailwind for us.
Yep.
And I think, and that's Trisura. I think there's other companies like that. And I think that's kind of a smart place to look right now, because we've talked about this before, folks. It doesn't matter where you're domiciled, right? Coca-Cola is a US company, but who cares? They probably earn 70% of their revenues outside of the United States, right? Like, it doesn't matter where you're domiciled. It's more importantly, it's kind of where you earn those revenues.
And where are your costs?
Yep, where are your cost
Yeah.
base?
I said I wasn't going to do this. You only got two, but here's a third question from Michael Fathead Calgary. Be real quick here.
A little biased here, I think.
I might be in Calgary at the end of in the second half of April because it depends on how the spring skiing conditions look. Any thoughts on the most recent quarter from Decisive Dividend? What should we be looking for in coming quarters to measure success? I am going to punt on answering this for what I hope is a reasonably decent reason. I will be talking to the CEO of Decisive Dividend on Tuesday. We will be talking about this among a few other things. I suspect I know what he's going to say. If you've read the letter, particularly the letter from Q4 from the CEO, it's excellent, explaining their, I'm going to say, disappointing 2024, at least the first half. They seem quite excited about as they exited and came into 2025. I think it's still over an 8% yield today, and
8.6.
8.6.
Yep.
Thank you. Okay, yeah, I was pretty sure it was over there. And the dividends, I mean, dividends reasonably well covered, and a lot of enthusiasm, I could say, coming out of 2024 while acknowledging the first half sucked. And they do a reasonable job, I think, in the letter. I would push you to that, Michael, the annual letter, and then tune in. We'll have that interview content on in the various foolish services where it's appropriate soon after. So, Iain?
Did they reach out to us out of interest?
There is a member who played matchmaker.
Okay, interesting.
And I did set my because I'm an angry old man who likes to shout at clouds. I did set my expectations with them. I gave them my standard version, which is like, I don't like talking to management, because management will sell you a story, and it's never a bad story. They'll never focus on what's wrong unless their name is Buffett, and his isn't. They'll never focus on what's wrong. So they're going to try to tell you a story. That's problem number one. And problem number two is I like people. And I know I shouldn't, but I do. And so when you sell me a story and we're commiserating, I want to like you and I want to believe you, and that has caused me problems in the past. Where the executive of the company might have been overly enthusiastic, bordering on misleading. How's that? And
in there.
Yeah. So you kind of go, I'll talk to you, but you should regard me as the enemy, and I will we'll move from there. I do have fond memories of the time. I'm not going to say who it was and what the company was, but the CFO of the company dropping material non-public information in my lap while I was talking to her one time at a social event, and I'm like, I'm the enemy, right? You can't say that to me. I'm going to pretend we didn't have this conversation. It's like 2006 or 2007 or something.
So, hey, Jim, I want to jump in here. This is somebody, Vins190 said, just saw that KD was hit by a short report.
Oh, okay.
Gotham Research. And it says, Motley Fool has a good track record of recommending a stock and be hit with a short report. LOL. And I just add some comments, because this will happen to anybody. If you're going to be an investor for any period of time, there is going to be a short report out about one of your companies.
Yeah.
And I'll just add, I don't know anything about Kyndryl, so I'm not.
I'm not sure that's one that we can lay any claim to.
Right. I would say that some of the best investments that I've had in my life have been targets of short reporters, and some of them been targeted multiple times. Mm-hmm. And the best
Shopify.
Yeah, the best defense against that.
Shopify 15 bags ago.
Yeah, the best defense about that is to know your company. Yeah. And in the most cases, if you know your company, you feel good about it, those are wonderful buying opportunities, because the shorts have a very limited time frame. They need to get stuff out there. I'm most skeptical of when I see short reports come in blackout periods for companies. So like right before they report earnings, when they can't talk, and they'll lay them down and it'll move the stock, and they can't really reply, and they have to talk to legal and all this kind of stuff. And they usually dump a report that's 190 slides long with stuff that everybody already knows. And the company has to dig through this, and it takes them time to do it. So I would just say, like, know your companies, feel good about them. Even Berkshire Hathaway has been shorted, not on a short report, but different people have shorted that from time to time and things. So like, just know your companies and recognize that Usually
your timeline and the
business-
short timeline
yeah.
might not be aligned.
Right. Exactly. Yes. Okay.
Yeah, no, I'm more of a fan of shorts than Buck is. I think Buck tends to dismiss most, if not all of them.
I don't read them.
Yeah, there you go. Not only dismissing them.
Not only do I dismiss them, Jim, and I just want to be clear
I
about
don't
this.
read them.
I don't ever
No,
read them.
And that's fair
No,
enough.
I know my company. And
Well,
so
and I was going to say,
right
I
wrong, I don't need somebody to say, hey, here's 160 pages, Buck, for you to understand what's wrong with your company. I should know the good sides and the bad sides.
You should.
Yeah. So I don't ever read them. I'll admit to that. I don't spend a minute.
But my
you
my
shouldn't
take
need
on
that
it.
many pages to tell anybody what's
No,
wrong.
you should be able to illustrate it on a paper
most.
that large.
Yeah.
But my thing, just as we're wrapping up here, is there are shorts you should listen to. There are shorts who give you additional information. But recognize, as Buck has said, shorting is as I said, no pun intended, a short time horizon play most of the time, and they're trying to catalyze something. But I've found some really excellent short reports, and I've found some short reports that are, you just don't understand the company. You're trying to be histrionic. And I think as we move to our next to our next show, I think my all-time favorite short report was the guys trying to take down, and I'm not a big fan of Fairfax, but Muddy Waters coming out, Carson Block, who actually is a short report I do respect, going after Fairfax when it was completely irrational to do, and there was much merriment in the Team Canada offices because we were making fun of their thesis because it was just flat wrong. We could all see it. Anyway, with that said, we are at the top of our hour. We're going to be kicked out in favor of the next non-Canadian show. So thank you for spending the last hour with us. It's Jason and Lou. Okay, well, we'll get back to talking.
Please.
I'm ready to move to Canada. I'm ready to especially my Orioles are up there to hopefully batter the Blue Jays in the next over the next 4 days. So
we would invite you, but we are welcoming everyone in Canada right now. But there's a hook. Apologies to who I'm about to insult. You have to spend the first 3 years in rural Saskatchewan. My family's from rural Saskatchewan. You can't hit me too.
That actually sounds pretty amazing in the summer. I don't know about
the winters. I've been to Saskatchewan in February. About as good as you think it is.
We won't bore the audience. I know I've told Jim my story about how when I was detained by customs because it is so hot in Toronto in the summer. But anyway, I'll stick to Toronto in the summer.
I'm not leaving my 30-year mortgage on this side of the border.
There you go. Okay. Anyway,
right,
gentlemen, have a good show.
Thank you.
See you next time.
See you, folks.
See you.
Morning, Lou.
That's a true story, by the way. Detained by customs.
I am not surprised in the least.
We don't need to go there. It's just kind of,
No, I am not surprised in the very least. But no, well, I mean, this is the Ask Us Anything hour, Lou.
Yeah, okay, that's true. If people ask about it, but no, it's I was innocent, I swear.
Okay.
But,
no, you were not innocent. You were just not guilty.
Fair.
There you go. There you go. Love the. I'm tempted to put my Braves hat on, being that it is opening day for most of the Major League Baseball world. My Braves have their first game tomorrow. Wait, today's Thursday, isn't it? They do have their first game today, 4 p.m. Eastern. They'll be in San Diego, so I probably won't be on a live stream at 4 p.m. Eastern today, but I will be watching a live stream of that game. So
This is the last work I'm. No, I shouldn't say
that.
All right.
So let's get the questions in, right, Lou? How do people get questions to us?
Well, all they have to do is go to Slido and enter Fool24. That's our keyword. You can get the questions in whether you are a member on our live stream or over YouTube. Talk to us. Of course, we are not here to give you individualized personal advice. We can't do that. We can't give you individualized relationship advice, but please tempt us. We're going to keep going with that. Yeah. What we're going to do is give you our opinions, our thoughts on various stocks, and your mileage may vary. So, take that along with everything else you read. Speaking of that Kindle short report, with not a grain of salt, but don't take anyone. Make your own decisions, whether it's from us or from a short seller.
Absolutely. And I will say this too. I am no Buck Hartzell. I actually do take a look at short reports when they come out because I might be wrong. I might be wrong about something.
Hey, in general, shorts are a real positive for long-term investors because they are a good filter. But there are there are people I see on other streams, not this stream, but ones that I can get on my cable, that are unapologetically long a company. And in my mind, at times, I don't want to say disingenuous, but overly optimistic in what they call as fact. That can happen on the downside as well. It happens, but there can be kernels of truth, or if nothing else, it can point out to a management team areas of weakness that a good management team can improve on. I think, they are worth, there's no better feeling than to read a short report and say, oh my gosh, I know this company better than they do, and dismiss it, because then, that can be a positive too, assuming you're right. But it is always good. Ralph Waldo Emerson said, a foolish consistency is a hobgoblin of a simple mind. You want to challenge your beliefs, and if you come out the other side of those beliefs challenged where you still believe in them, all the more powerful. So
I have a question for you. I'm not sure how much depth did they get to on the short report in the prior hour?
I don't know. I just heard them at the end of it.
Yeah, same.
So
I'm not sure. Yeah, I wasn't sure if you were logged on early, because we do have a lot of questions coming in about the Kyndryl short report. So I haven't looked at it. I don't own Kyndryl, so I can't really weigh in.
I just started. I gave it a quick look in like the last 20 minutes for something else. It is available. One thing it is, if you go to GothamCityResearch.com, it's right there. If you want the gist, okay. So what are they saying? They're saying that Kyndryl has artificially inflated its adjusted EBITDA and free cash flow figures. They say there's actually a cash burn. They're critical of Kyndryl's disclosures with its former parent, IBM, and they predict that the company will encounter higher costs for IBM services in the years to come. I would note, the first thing, is someone who I don't own. I have no position here, pro or con, for it. I don't own this stock, but I've spent a lot of time looking at this stock. Kyndryl's been pretty honest in their earnings call about the changing relation, and even putting some numbers into it, the changing relationship with IBM over the years. So that sort of rang hollow to me. Some of the accounting stuff I didn't have time to get into and, just kind of dig in, because I only had 15 minutes. I think you're seeing, and it's come back some. I think the stock was down 15. It's now down 10. Gotham City is not being subtle here. They estimate 67 to 100% downside from current levels. So they are not just saying there's a dent here. They are saying it's broken. Let me
say this. Yeah. With short reports, when they're estimating their downside for the stock, a lot of that is part of the noise and the fear that's being created to, and again, I don't know anything about this particular outfit, what their MO is, what their track record is in terms of covering companies that, once they release their whatever their short thesis and their story is, have we seen any meaningful permanent or sustained decline in stock prices? Or is it just temporary bumps down that create profit for shorts who shorted before that, take advantage of that opportunity to close that short, and then they've made their money, and then the business has gone on to be fine after? I don't know any of those things about Gotham City. So I think that's an important thing to start. But to me, Lou, it's what I always see is when there's call outs on financial shenanigans, which to me, it sounds like what it is the short report providing clarity to something complex, or are they making something sound more complex to support their argument, their short argument? Because fear, uncertainty, and doubt are the tools in trade of a lot of shorts, creating more fear, uncertainty, and doubt to create a profit, to drive stock prices down. I lean more towards the Jim Gillies, for those that were on at the end of the last hour and heard him say, shorts create value. And Lou, you've talked about it as well, particularly when they point out like actual real material weaknesses and problems in the businesses we own. If we all spent more time trying to disprove our bull theses versus just trying to prove why we're going to be right, we would all do better as investors. And part of that would be doing less worse, right? By investing in problems where we thought there were opportunities. So I always take these with a grain of salt when they have these. We estimate the stock is worth 60%, 70% less than it is today, because that's just a good way to throw a number out there to scare people and cause them to sell. Because there's a lot of people, Lou, that their MO, they have a rule. If I see a short report about a company I own, I just move on. And shorts love that, right? They love that.
Yeah. And, I mean, the big thing is, I would say, and this is, again, long or short, whatever you do, beware of hyperbole, or just, and maybe sometimes hyperbole is appropriate, but just be aware that it's out there. Gotham City, if it's the same one I'm thinking of, they've been around forever. They're mostly European, but they aren't a fly-by-night, unless it's a fun name. Maybe this is a different version of the same thing, but they've been around a long time if they're who I'm thinking of, even back the last decade. So, but yeah, I mean, there is, and rules are changing on this. Some have gotten in trouble, but and look, again, I mean, I don't want to paint too broad of a brush. There are people that Motley Fool is very good about this, as Jason knows all too well. We just said the word Kyndryl. We can't trade on Kyndryl for what, two trade days,
Yeah, two market days. Yep.
Yeah. But there aren't rules across the board. There are people who go on networks and say, I think the widget factory is going to go to the moon, get a 10% jump, and then get on their phone and sell the widget factory. And short sellers will definitely do that too. Arguably, shorting is very dangerous. If you are short a company, even if you think it's going to zero, but you have in one day a 15% return, why wouldn't you cover? So it's not even like, they're just trying to trade, it's complicated, but it's,
the opportunity, it's the inverse of the opportunity and risk with stocks, because the opportunity is to make 100% profit. The risk is unlimited losses, right? Theoretical. So it's the inverse of going long on a stock, because again, the way that, you can use options, right, to short, but that can compound the losses, but essentially it's still kind of the same thing. If you sell the stock short, what you're doing is you're selling. So let's say the stock's $100 today and you think it's worth 50. You sell it short. You're borrowing somebody else's shares to sell them for $100. And the way you're going to make money is when the stock price falls, you buy it back, right? So you sell it for 100, it falls to 50. You've made $50 a share. Okay. So that's theoretically, that's kind of your maximum return based on what your estimate is. But let's say you sell that stock at 100, you shorted it at 100, and the company reports earnings or a new product that the market loves, or an acquisition, and this stock goes up to 110, and then it goes up to 115. You have a couple of choices here. You can continue to hold if you believe your thesis, but there's going to be some money you have to spend along the way. You've borrowed somebody else's shares to do that. That comes at a cost. You can't do that for free, right? So there's a cost there. So that starts to chip away at your potential earnings. And at some point, you may have to exit. And let's say you bought that, you shorted that stock at 100, and something weird happens and the stock goes to $225. You have to buy the shares for $225 to close your short and return them to the person that you borrowed them for. So guess what? You lost more than it's that inverse, right? So,
Right.
you got 100, but you had to pay $225 to buy that $100 back.
Yeah. Basically, yeah. If you were long a stock, your downside is capped at 100%. You could only lose what you put in. Your upside is theoretically unlimited. A stock can go from 100 to a gazillion, right? Shorting is the opposite. If you short a stock, your upside is limited to 100%, and your downside is theoretically infinite. because if you're wrong, and that if you were long that $100 stock and it goes to zero, you've lost $100.
Right. Just imagine having shorted AMC theaters, or what's GameStop at kind of that low point before the meme stock mania sent those stocks up 3x, 4x, or more in a matter of months. Right. That's like a worst case scenario for being a short.
Yeah. Yeah. And just a note, I mean, public service, it doesn't always go like this. And this is not individual advice or an endorsement, but there can be opportunities. Hold Long and Prosper notes the Transmedic short from a while ago. The short report on Transmedic a few months ago presented us with a smorgasbord of opportunity. I made a pig of myself and enjoying great returns. Yeah. If it turns out that this is overstated, it could be a buying opportunity. I mean, you better know the company well before you say that, or just not assume. There's just as much risk as just assuming all shorts are evil. So therefore this must be wrong. And this is obviously a buying opportunity, as assuming that someone going on CNBC and saying a $10 stock is going to $1 trillion I mean, it's just, it could turn out to be a buying opportunity, but just do some homework or give Kyndryl a day to address it, things like that, et cetera, before you go. Yeah. All right. I don't know. Anything else on IBM mainframe? Who knew we'd be sitting here in 2025 talking about IBM's mainframe business, which is what Kyndryl is at its heart. I know it's more than that, but yeah.
Yeah. No, I think that's good enough.
All right. So 24 on the Slido, fools. Get in there. Get us your questions about Kyndryl. Anyone else? If you have read this short report, we can talk about that more. They do a nice summary, and all these short sellers do summaries, but click on the PDF because, again, hyperbole is not your friend in investing, whether it's to the upside or downside. Yeah. And the last thing I would want to do is make a buy or sell decision based on somebody who has a strong opinion on the stocks, their bullet point summary without much of a deep dive of that opinion. Fair?
I've got a question here that I want to answer that was actually from the previous hour, but just by a few minutes. So hopefully lovely Lily is watching. If not, somebody pass a note to her in the next class that you have with her to make sure she knows to go back to this in the replay. But I think this is a useful question for investors of all stripes. As we've seen interest rates move up, there's more opportunity with cash, and there's different ways that you can turn your cash into a safe source of yield. So lovely Lily's question, is money market fund different than CD market? And so is a money market rate better than a CD interest rate? So yeah, very, very different things. But directionally, they serve the same purpose. So let's start with money market fund. What a money market fund is broadly, Lou, and I'd like for you to weigh in on the nuance here. Generally, you're investing in treasuries. That's usually the thing, right? That's underpinning the value of a money market fund. So it's very, very liquid, but you're turning your cash into short-term federal government debt. Right. And the money market fund is a mechanism where they take everybody's cash and they invest it in treasuries. So again, you're participating in the money market. Right. So that's the way that it works. And the funds make a little bit of money on a fee to operate the fund. But the bulk of the interest rate that's paid on those short-term treasuries does flow through and yield to you as an investor. The benefit of the money market fund is that it's instantaneously accessible, I guess is the best way to think about it. It's as close to dollars as you can get in a secure way to get a little bit higher yield. It's where, for example, me and my Fidelity brokerage, it's where I keep my cash, is in a money market account. Now, the downside is that money markets, it's not FDIC insured. So I don't want to say it is a downside because it's not 100%, right? It's not 100% guaranteed, right? So that is a reality. So it's not 100% guaranteed, which a cash savings is. Securities, certificates of deposit, Lou, are FDIC insured as well, right? Money markets are not, right? So you are taking on a little bit more risk. But again, you're investing in an asset that's backed by the full faith and credit of the U.S. government. However, you're invested in a fund. You're not directly invested in those assets. So there is a little bit of less safeness to them, that I don't know that there's ever been a case of it really blowing up in a big way and undermining investors, but consider that it is a risk. Now,
there's definitely been times when we've come close to that. I think
Yeah.
only isolated, but not in the big ones. But yeah, go ahead.
Yeah, so it's a risk that's there. Now, CDs is a certificate of deposit. So what you're doing is you're trading your flexibility to get your money now with an agreement with the counterparty, the bank, to leave your money in the deposit for a set period of time, 3 months, 6 months, a year, up to 5 years. I've seen CDs that can go up to 10 years, but generally they're 5 years or less, right? As a general rule of thumb. And the idea is that by agreeing to leave the money in the bank now has a little more line of sight to their liquidity to be able to turn that money that you've deposited into loans so that they can profit. And the return for that is the longer you agree to leave it in the CD, when the CD matures, the higher interest rate you should be able to get. Doesn't always play out that way, Lou, right? Because of
Right. Yeah.
what the market is expecting will happen with interest rates over the long term. Sometimes those longer term yields might actually be lower than shorter term yields. So that's why you might see like the 3 month yield or even the 6 month might be higher than the 5 year, right? Because the market is saying, we think interest rates are going to be lower in a few years. So we're not going to commit to paying a higher yield on those longer term notes. But again, you don't have the flex. You can't just go get that money tomorrow without paying a fee, a penalty for cashing out that CD early. And typically that fee is onerous enough that you end up with less money than you would have if you had just left it alone. They want that penalty to be onerous enough that you look for other sources of capital before you take capital that they've already lent out to another borrower, right? So that's how CDs are different than money markets. So you're taking on some risk with money markets to get above average market yield. With CDs, you're trading in your access to your capital to get above average yield versus just making a deposit in savings. What did I miss?
No, I think you summed it up pretty good. I mean, the big things are, FDIC insurance shouldn't matter, or not. Hopefully, it doesn't matter, but it's good to know.
Yeah.
You do tend. The other thing is, and I think you said it's money market is more of a variable rate. So look, I mean, I'll give you the example. I think of it as short-term money versus long-term money.
Yeah,
kind of is the way you say it because you're locking it up. I have a very complex CD ladder system, Jason. I have 60.
I don't think it's complex.
Well, it's 60 CDs. I have 60 CDs.
So that's for 5 years, right?
All 5-year CDs. So every month another one rolls over. And honestly,
it takes you what, 20 minutes a month to figure out what to do?
They're actually all on autopilot, so I don't even have to do that. But the interesting thing is, right now I am rolling 1.5% CDs into 4% money. So it's a good thing. A few years ago, I was losing money. It is sort of a hedge against insurance, against investment rates. I mean, right now, it's a different look than a few years ago when interest rates were at zero in the savings account, and this ladder system I have was making 2.5%. I was a genius. Now I'm making under market rates on the whole collection because the savings rates are higher and I'm stuck in CDs that I bought in a zero interest environment.
But your goal, Lou, and I think this is the most important thing, your goal when you built that was not to capture the optimal yield.
Right.
You're protecting the downside.
It's a long-term hedge. Yeah. So I think of CDs as a decent instrument for just long-term cash, just kind of whatever it is, the cash that you just want to have but not accessible, and then money market along with the savings rate. I mean, I think it really depends. Right now, a lot of money markets will get you what a good online savings account will get you. So it's the money market versus savings account issue is a little more apples to apples comparison there, where, you know, in one you're getting the FDIC insurance, you might get a little less of a rate. Money market can tend to be more variable, but not necessarily. But those are more like for like products, and CDs are more kind of for a different
right. So yeah, the way I think about it is cash and money markets are for money that you want to be able to deploy at need, which could be tomorrow, or it could be in 6 months from now. CDs are a great tool for, in your case, money that you might not need for 2, 3, 4, 5 years down the road. You want to optimize as much yield as you can get on it, but you're not worried about being able to touch that money tomorrow. Anything beyond that, 5+ years, money isn't what you should be optimizing for. You should be optimizing for long-term return. And that's, again, where you start shifting into stocks or maybe some bonds, bond funds, that sort of thing, where you're able to get above average returns or a probability of better returns than you would be getting on a cash type instrument, right?
Yeah.
And now we're talking about asset allocation, which I don't want to talk about that anymore. It's boring.
And you know, there's plenty of options out there. BFO of Rick M says, what about using short-term treasuries to hold your cash? 4.89%, no expense ratio. Not 9% of your money it's liquid daily. Yeah, that's another option. I would say until recently, it was such a pain to buy short-term treasuries. They have finally modernized it. It's not really even more work, but there's a lot of different ways. But yeah, I would lump those in with money markets, and all that is cash that is at least somewhat accessible, and you're kind of getting the current day's rate at all times.
So looks like Lovely Lily is with us and watching. I'm very glad to hear that. So
lovely.
Yeah, that is lovely. Thank you so much. So your CD, you should be able to get through a bank. Some brokerages that are also banks, you can invest in CDs as well. Fidelity actually has a primary and secondary market for CDs that they offer for banks that maybe don't have a big enough deposit base where they operate, where you may be able to buy CDs. I actually have bought CDs in my 401k from a bank in Louisiana through Fidelity on Fidelity's CD market. So there's lots of ways that you can get it. Money markets, typically you're going to be looking at a brokerage, right, to be able to invest in.
Yeah, not necessarily. I mean, I know some banks. Ally Bank has a money market. The funny thing to me about that is it has been, because
they're often garbage yield.
Well, so the funny thing about the Ally Bank money market, Ally, I have both, and they have had lockstep the same interest rate for I want to say going back 3 years now. Today, it's 3.7% on both, so it's a little low on the money market side. But yeah, you can get that through a lot of banks. You can get it through your brokerages. You can get it wherever you want. But apologies, my screen just went crazy for a second. But yeah, and CDs, I'm going to be.
Well, so let me tell you.
Go ahead. Or just real quick, overly. There's two ways to buy CDs. Either do it from an online bank or do it from a very, very local community bank that is trying to run a special, because those are the only times I see rates that work. The online banks, and then there's one in Atlanta that just came into Atlanta from the Mid-South that are offering a just crazy, like 5.2% 12-month CD right now, just trying to make a name for themselves. You're going to do a lot better than that than you are at the big banks where just like your savings rates don't pay anything. So, broad advice. I'm sure there's exceptions to the rule, but that's where if you want CDs, look online or look for community banks that are offering very, very specific short-time specials.
Yeah, and your mileage may vary greatly. Exactly what you were talking about there, Lou. But just for example, so I use Capital One. I bank with Capital One for some of our banking, particularly for savings, online savings. This is Capital One's 360 money market disclosure as of February 19th. 0.8% APR, APY, annual percentage yield 0.8% on their money market. In Fidelity, the SPAX, SPAXX, which is the money market fund, I'm getting 4%.
Mm-hmm.
So,
now, Capital One does have a 3.6% because I have
depends
that
on the
too.
product. That's the key, right?
Yeah. I spread my money around a lot, so I actually have the Capital One account too. But 3.6% on their savings account right now, I think.
Well, that's their exactly. That's their savings. That's their savings. I think it's actually 3.7 now, and that's what we use Capital One for, is for our cash savings, for that exact reason. So, it's really important to read the fine print, know what the yield is, know what the deposit limit, the average daily deposit limit is they require to get that yield. It's really important to understand where all of those things. So this is one, I don't know the answer to this. CDs and money market funds, taxable at federal and state level, whereas treasuries are taxable at the federal level. I will say that when it comes to the state level, that number one, it's going to depend on your state, right?
No.
Okay, I'm listening.
U.S. treasuries are exempt from state and local taxes, I'm pretty sure.
Okay. Yeah. I think.
Yeah. I mean, the rest of it is, it depends by the state, but your CD and money market accounts are going to fall under normal tax laws, whatever your state is. But I am pretty sure. Please, Rose, look this up before you do it. This is not it's personal advice, but U.S. treasuries are exempt from local and state taxes.
Okay. Yeah. So that's the question, is saying treasuries are taxable only at federal level.
Yeah.
Not at state and local. Okay.
Right.
Yeah.
I
think that's actually codified in law.
Right. Yeah. That's what I'm saying. That's just how it works.
I'm pretty sure that is correct too. So again, you're talking to Jason and Lou here. You're not talking to Bro and Cap. So, but I'm pretty sure that is correct. So, all right. So, since this is AMA, I love
Rose. Rose, another question. Just while we're on cash, so I'm trying to figure out the best way to articulate this, because I don't know. Rose asked Lou, what % of your overall cash position outside of brokerage is in CDs? Right now, that would be about half of my cash is in CDs, I think. Rose, I'll tell you that just as a general rule, I mean, I am right now, I've said this on here before, because my daughter is getting ready to go off to a very, very, very expensive 4-year education. And I am endeavoring.
I think that's all of them.
Yeah. Well, she's so special. She managed to pick out even one that I feel is more, but so I am endeavoring to put aside the 4 years as quickly as I can in cash. So that is going to, I doubt that'll go into CDs, so that'll change. But for the most part, I tend to have about half of my cash in CDs, but I tend to keep an obnoxious amount of cash that no financial advisor would ever tell me is the right amount in cash, just because I like that. I like to sleep well at night. So do you think that helps you make your other long-term financial decisions? Do you think you make better decisions otherwise because of that safety net that you've built? I mean, for one thing, Jason, as I think you're aware, I'm a contractor. And, so I don't have, I mean, nobody has steady employment in a world where there's reductions in force everywhere, but it kind of helps me sleep at night with that, because my income is highly variable and, even more so than normal. So I think it probably influences all aspects of my relationship with money, just knowing you have that security blanket. I can't imagine it doesn't, but really it's just, Morgan Housel has said all this better than me, but my goal in this isn't to just brag about the size of the pile I'm sitting on top of it when it's all coming. My goal is to have enough money to live the life the way I want. And part of that is the security blanket of having cash, but part and parcel of that, the reason I bring it up is because a lot of that cash is that I hope not to use. I hope to just keep rolling it over perpetually. And so that's the part that's just in CDs. And like I say, just let it grow at the pace that it's growing, and hopefully just never use. It's my perpetual motion machine. So my percentage of overall cash is probably higher than most, but it's set up almost intentionally not to be touched, hopefully.
Yeah. I mean, that's a smart way, depending on how you're wired as an individual. A lot of times those automatic things that just happen to money that's not easy for you to get to are ideal, because it makes you more likely to let your emotion take the wheel and drive you right off of a financial cliff, right?
Yeah.
And I think that's really, really important. I want to share tax accountant's comment here, because
because better to hear from someone. I mean, for all we know, tax accountant is Jason, but let's assume tax accountant is a tax accountant, and you'd much rather hear this answer from him or her.
Yeah, this is an important caveat, because again, what we're talking about are the direct instruments. If you buy treasuries, right? If you invest in these things directly, but tax accountant points out that some ETFs that invest in U.S. treasuries might not be exempt for state taxes, or only partially exempt. This depends on the fund and the state. So again, your mileage may vary. It's important to just be aware of those caveats. I'm going to grab Vihan's question here just briefly about Outset Medical. It's Lou. I'll roll and hey.
Well, no, sorry. All sorts of gremlins today. Tax accountant. By the way, I was just messing with you. Obviously I don't know your credentials, but tax accountant is around here enough to know.
Tax accountant's body of work demonstrates competence.
He or she is smart. Yeah. So I'd rather
absolutely,
Jason.
Yeah. Just thank you for being clear with that. So Vihan asks current thoughts on Outset Medical. So first of all, Outset Medical's market cap is barely back above a couple of $100 million. And we try, from the perspective of making sure that we don't move markets, we try to not talk a lot about companies when the market caps get very, very small. And Outset Medical's stock price not that long ago was in penny stock territory.
Yeah.
Because
they solved that.
What's that?
They
did. They solved it. They're brilliant. They're brilliant. Absolute brilliance.
Yeah.
They did a reverse stock split, or as I like to call, it cut up the stocks into little tiny pieces, and then glue them back together. So they did a 10 for 1. I believe it was a 1 for 10. 1 for 10. They took
1 for 10.
If you had 10 shares, now you have 1 share. So they've glued the pieces of pizza together. I guess if the ownership of the company is one big piece of pizza, for every 100 slices before, it's now a 10 slice pizza is the best way to think about it. So that $11.43 a share that we're seeing today, a few weeks ago, that was 10 shares that would have been worth about $1.43 each. Outset Medical is really struggling with market penetration. It's been a real challenge to see adoption ramp up at the rates that the company and many investors had expected to happen. It's the biggest, hardest thing to do in healthcare, is to disrupt the entrenched incumbents, change the way people do things like medical treatment. So for Outset, their business is trying to get dialysis closer to the patient in their home with their small dialysis machine to allow dialysis to happen in the home. Patients have to be trained well, right? There's a lot of reasons why this is challenging. And simply put, they've really struggled to get the level of market traction that we would have expected. So, I mean, things are looking a little better than they were a few months ago. But the business still faces a lot of potential pressure. I haven't looked at the stock in a minute. So I can't really weigh in much more than that, but I know it's been a tough journey, right?
Yeah, I don't know it well at all. I missed that one. Sorry to say.
You didn't miss anything.
Yeah.
Excuse me. It was a 1 for 15.
Oh, okay.
1 for 15. Yeah, that was about a week ago. So, but I mean, for the business, I don't think we've heard from business results. When February, late February. So it's been about 6 weeks. So there's not really any new news that's come out more recently. So a lot of risk here. Honestly, I would not be surprised to see the company be acquired at all, because the balance sheet is a concern. Raising capital further, again, it's a $200 million stock. If you want to raise $20 million, you're going to further dilute shareholders another 10%. and this is a business that certainly is going to run into some potential liquidity challenges if business doesn't pick up. But I could see this being a great product that's part of some other company's portfolio. The question is whether anybody's willing to pay a premium to do that, or wait for the business just to completely go off the rails and buy it off the scrap heap. So, I mean, that's a tough quandary as investors that we have to face with this. Is the risk is if the company doesn't remain a going interest and we don't have a white knight come in to buy it at a premium, you know, we're the ones picking up the scraps after the scrap heap's been completely cleared by those above us on the capital stack. So there's potential, but I still think there's a tremendous amount of risk here.
Yeah, that makes sense. Lovely Lily is talking about cash. My mom is old fashioned, has her cash in a safety deposit box. Yeah, Lily, I will tell you, and I mean, you know, this again, I don't do personalized financial advice, but Jason, this is sort of relationship advice. I will say that after my father died and trying to talk to my mom about what to do with money, and she's very much the same way. And I am just, I don't mean this to be condescending at all. I didn't have to do any talk or work at all. And now she is zooming around ally.com. She bought her own Chromebook just for her bank. Talk to mom about it. Because it's, yeah, you can earn decent money on that right now. And a lot of times with our parents, it's just not what they're used to. And they just kind of need to be told, oh, this is here. And then it takes off. So yeah, see what mom has to say. I like that.
Yeah. The problem with putting money in a safety deposit box is, number one, you're not, like I said, you're not earning anything on it, right? You're actually losing value to inflation. Two, you have to pay for the safety deposit box.
Right.
And if you're putting it in a safety deposit box because of institutional untrust, the last I checked, safety deposit boxes are at banks, right?
But it is so good if you want to film a music video and you need the cash in the air.
Oh yeah. Yeah. There you go.
Anyway, that's true.
You could just go to an ATM, Lou. Come on.
That's a different live stream too, right?
Ed points out Marcus by Goldman, 4.5% CDs and a 3.75% money market. Shop around. Take an hour or two and shop around. There's money out there that you can find. That's that's the thing.
We could talk for the next 20 minutes about inverted yield curves too, and reasons and what all that means. I don't know the length of that CD, but we'll just but definitely shop around and think about what you're using the money for. That back to the original question, CDs versus like I say, for me, CDs is almost just it's self-insurance, just the stuff that's there if I really need it, but I hope not to touch. And so I don't care if it's locked up for 5 years.
Right. Well, and again, there's the arbitrage you were talking about too. You put that money in and lock in that higher rate today, and in 2 years, you're getting 2.5%, right? Or 3%. And the cash in that 5-year CD is now yielding more because the market was right and expected rates would fall. So your short-term money is getting less than what you committed to for the long term. So that's one of the reasons I think over the long term, your strategy is going to work out, Lou.
So there's probably too much information to share to screen in it, but I'm just looking at my little spreadsheet I keep. Right now, I have as low as 0.85% I got a few years ago, and as high as 4.7%. And it all blends out to an average right now of 2.95. So I am losing money relative to having it in that 3.7% savings account there. But a few years ago, I was still at high twos when even the online savings account was under 2%, well under. So that's just kind of how it is. I'm dumb now and I was smart then, and somehow the world keeps spinning.
I want to Matt was asking about McDonald's, and Lou, you and I both do some of the scoreboard episodes that Anand Chakavalu runs, and asks how I would rate McDonald's across some of the categories that we rate, like business, management, financials. And Matt, so I would say McDonald's is a challenging one for me because it's a business that I've never been that compelled or interested in owning. So I've never really done the deep dive that it would deserve if I was going to be discussing it on Scoreboard. But my guess is that I probably would rate it pretty highly. But at the end of the day, I would probably come down on it being a high floor, low ceiling investment in terms of the returns that you would expect to be able to generate. There's a lot of quality there, but I'm not sure how that quality would necessarily translate to shareholder returns. So that's where McDonald's, we'll see. I do encourage people watching, check out Scoreboard videos. Motley Fool members, you get the first taste of these. Those of you that are watching on the YouTube
First taste. I see what you did there.
Yeah, right. That's pretty good. The McDonald's one, that would first taste. See, for those of you watching on the YouTube live stream, look on the YouTube channel, Motley Fool YouTube channel, and you'll see you can watch some of the Scoreboard episodes too. They're less than 10 minutes long. They're quick. You get two different analysts' take on these objective categories, so it's worth checking out. They're pretty good, especially the ones that Lou and I are in. Those are the best ones.
Yeah, definitely. And usually that 3-second clip at the end of it is the only thing worth watching, if we're honest. But I didn't say that. This is turning into the personal finance hour. Jeff asks, hey, won't I use the cash and CDs at some point in my retirement? Probably. But you know what I love about it? The longer I kick the can on not using it, the bigger they grow over time. So, but yes, obviously, the nice thing about this setup is that I have a monthly option on that. I can just turn off auto renew on my entire thing and get a chunk of cash every month for the next 60 months, basically. So if I come to a point in time where I want to do that, absolutely. But in the meantime, just kind of set it and forget it. And like I say, it is a long-term play because I'm losing money right now. I made money a few years ago, and it is what it is, right?
There you go.
Do we want to talk geopolitics for a second?
Heck no. Let's do it.
All right. Because, the tariffs have been in the news today, and Rachel and I got into it some in the 8:00 hour, but Ed was asking, it sounds like the White House will play hardball with Canada regarding its auto tariffs. What can Canada do? Is the relationship gone too far to fix? Now, I definitely can't,
we're not going to go into the lane of trying to give our punditry perspectives on the political thing.
And I'll tell you what, Mark Carney, the new prime minister, is a lot smarter than definitely me. I think even Jason, and I wouldn't begin to give Mark advice. I might have given Trudeau advice, but he wouldn't know listen either.
No, but he was listening to Carney on some things. So
yes, yeah, and Carney is really, really smart. But one, I would note that. And, if we play this out to its logical conclusion, which I don't think we necessarily need to do that, but if we are moving to a world where the U.S. is insular and self-sufficient and doesn't want to do business, the U.S. GDP is only about 20-something% of global GDP. So I think that is what can Canada do? I do think that
there's another 75% of the world economy
right.
for Canada to go fishing in. Yeah.
Right. And why do I go there? Because look, again, I think we're far from this being inevitable, and I don't think you should make investment decisions based on this, but I do think we should always be long-term game planning. And in that environment, the old adage that has gotten me through my entire investing career is don't worry about international investing because US companies have so much exposure to international, it doesn't matter. There may come a point in time where that doesn't work for me as well as it has in the past. We are well ahead of that. I don't want to get ahead of myself, but that is one of these thoughts that's creeping into my mind that, frankly, I took that as conventional wisdom up until now. So,
yeah, and I think over the long term it works out. I mean, we're talking about 6 weeks of noise here and a little bit of signal and action that's happened, and I think that looking back through history, as an investor, and just as a citizen, as a person of a citizen of the world, when we go through these rattling moments like this, and then we fast forward a year or 2 or 5 years, we can almost never pinpoint a single day. Where were you on that day? Right? Those where were you on that day moments are extremely, even like the global financial crisis, which is, I think, probably the most impactful financial event that most of us have lived through as adults and invested through, even that event, that period of time where the market took 5.5 years from the October 2007 peak to fully recover in 2012, even during that period, there's not a where were you on that day moment, right? So I think that's the important thing to remember, is that I think we're more likely to look back at this as just a period of turbulence, and what has always worked will continue to work, right? And that is companies and the leaders, companies that have great products and market share and moats generally remain such, right? And they find ways to navigate the waters, right? And if we focus on finding those businesses internally on the companies and less on the externalities that are shaking the world, generally that's where we find strength, and that's how we profit as investors, right? Now, with that said, anybody that's looking at the automotive industry as an opportunity for profit, how many investors have touched that hot stove over the past decade, looking for the next Tesla?
Last half century, yes, but yes.
But I mean, that's the thing, that Tesla has been this rare unicorn of a car stock that's made a lot of investors money. It's lost a lot of investors money over the past 3.5 years, right? So finding those sorts of stocks are extremely rare. But when we do find the durable ones across industries that transcend, focusing on finding more of those is more important than trying to figure out how to navigate these sorts of environments. That way lies danger. So that's the way I think about it.
Yeah.
Can I talk technology a little bit here?
Yeah, real quick. I don't have anything to add, but I love Ed and Rose talking about how hard it is to kind of deal with local banks, because you actually
you have to go see people and sit behind desks, and
Ed,
I'm being
Rose,
a little glib, but it is a pain. It's a pain.
So I am actually on the board of a credit union, and we're constantly having this conversation. And tell them that, please, because this whole industry doesn't listen to people.
No,
but yes, no, you're definitely right. But go ahead, yes, please. Something.
Yeah, no, it's so true, Ed. You guys are absolutely spot on. So, BG asked. This was close to the beginning of the show, and I noted it, and we've got sidetracked on this great conversation about money, like talking more about money than stocks today. And I want to say that because here's one of my mental tricks that helped me as an investor more than anything, is that the moment I buy a stock, I no longer have money, right? I have a stock. I own part of a company, and making that mental transition has helped me more than anything get through the volatility of the market. And at some point, these companies, I need to turn these companies, I do need to turn them back into money. But I know my money goals are, my son will start college or his post high school life in a decade. My wife and I will be hopefully in a position to retire sometime around that period within the next 4 to 6 years, depending on his post-secondary decisions.
I'll tell you, some of them are really expensive. Anyway, did I mention that? Yeah.
Yeah, I've got a buddy that's mentioned it once or twice here recently. But that's when I'll need money from my stocks. So right now they're not money. I value them in money, in dollars, right? But they're not money now. I own companies. So that's helped me kind of get through some of these periods, just thinking about them that way. But BG asked, thoughts on this Fool.com article on Intel. So the link is in Slido for anybody that's watching that wants to check it out. I will screen share it here. Bart, if you can be ready to launch out this screen share. So this is the headline. If you're watching the replay, if you want to search for it, Intel stock could soar if this NVIDIA rumor is true. Lou, our pal Tim Green wrote this. Tim Green does stuff for Motley Fool members behind the paywall and writes for Fool.com. But the short version is that there's it's probably more than a rumor. I'm sure it's substantiated to some degree. But a prominent analyst from UBS that covers Intel says that Intel's close to reaching a deal with NVIDIA as a foundry customer. This is a massive potential story because Intel's business is facing so many pressures. They have split their foundry business. It's a standalone, wholly owned subsidiary of Intel. And then there's Intel Products, which is the company that owns the x86 architecture, or I shouldn't say owns, but all of Intel's IP and designs on that x86 architecture, designs all of their products that then go to the consumer market and the server market, et cetera, et cetera. So Intel Foundry actually has to win Intel Products' business to make Intel chips now. They have some other customers where they're starting their 18As is their kind of it's their newest architecture that they're bringing. I think it's like close to like the 5 nanometer that you hear from TSMC. So it's their latest architecture. They've had a couple of wins, but they're burning billions and billions of dollars, and they're saying they're not going to be even EBITDA break even until 2027, Lou. So massive pressure on the company to start getting some clients. So getting NVIDIA as a foundry customer would be huge. Why? Why would NVIDIA want to use Intel as a foundry customer? Because they're making so many GPUs at TSMC for the AI market, their Blackwell and their Hopper series. There's no capacity to make enough of their GPUs for actual video cards, for gaming video cards, which is, I mean, that's what their business was founded on and doing. So because of supply tightness and the focus for TSMC needing to be on the highest end stuff, that's where TSMC should be operating, letting Intel make some of the other consumer focused products. So there's the headline, there's the story, and then there's the implications. And I think I've talked on here that I did buy some leaps, some very long-term, like 2-year calls on Intel over the past month or so, because I do think we're going to see some sort of an inflection point with Intel where either they break it up and we find some acquirers for the foundry business, or they actually figure out how to start getting some traction like this with Intel. I would say that this would be a momentous thing if it happens. I don't think there's any downside for TSMC, at least in the near term, but it could really start establishing some credibility for Intel. But this is not a game changer. It's just a step forward for Intel. And we would need to see like 3 or 4 more of these with companies committing to build on x86, design on x86, and commit to x86 for their applications for multiple years. Those are big decisions for companies to make those decisions, because you can't just say, you know what, Intel, we tried you for 6 months. We're just going to move over to TSMC or Samsung or whatever. You have to completely rebuild the architecture, all of the supply chain for those semiconductors, rewrite the software. Like, you have to change basically everything. So it's a big deal. So I think this is a notable step forward, but it's just a step forward.
Yeah. Breaking news on Intel. Just looking at it when you're answering the question, they are continuing the new CEO. It looks like 3 people stepping down from their board as of this morning. So they are reshaping it for the future. Not really related to what you said, but I just found that interesting. Would note it would shrink the board to 11, which sounds more reasonable to me. The former head of Medtronics is stepping down, and looks like a couple of college researchers. So anyway, I don't know how that changes the investment thesis, but it is actually news. So Matt said, what short publisher do you think is the most reputable? I actually think there's a lot of like, not everyone's got a great track record, but Hindenburg has been right before. A lot of them. So one thing about
if you look at Hindenburg's, like the percentage of their short reports that have led to a sustained lower stock price, it's a pretty high percentage. It's a pretty high percentage. I'm gonna give Hindenburg a little bit of credit.
Yeah, I mean, Jim Chanos. Yeah, he doesn't do it much anymore. Bill Ackman used to be good at it. I mean, I don't think Carson Block is bad, but the funny thing to me is, in the SEC, this really bugs them, is that you see a lot of in these reports, we and us and the firm and stuff like that. Mostly, it's just people in their basement. It's just, it's just a one-person thing. But look, there are some really bad ones, but yeah. Anyway,
yeah,
we only have another minute or two, Jason. Can I end on a different note? Is there anything else you need to get to? Can I tell you part of my biggest fear of Fool 24?
Oh boy, I don't know. Can you? I mean, I know you can, but can you? Okay, do it. Let's do it.
I say something stupid, and I get called on it after, and I never see it in the Slido, and then for hours and hours later, our bosses get to see just what a moron I am. All right, that is the world I live in. Davis, I think we need to get to Davis's question and Rose's retort real quick, because it's actually, I don't know, I don't need this hanging in Slido forever. Davis said, "Are we really gone this whole hour without Lou explaining why he was arrested?" And
so good, so good.
Rose qualifying it. Did he say arrested? I thought I heard detained. Yeah. So it's actually a pretty innocent story. Toronto is gorgeous in the summer. Okay. It is absolutely beautiful. I can't speak for it, being there in December, but if you've never been, there's a beautiful harbor. The islands are amazing. You've got to get there in the summer. There's kayaking on beautiful islands. I went there. My wife was at a conference. I had a wonderful couple of days just kayaking around, got terribly sunburned. When I got back to the US, we're trying to get in, and the custom agents were convinced that I had done that thing that Americans used to do where you fly to Toronto to go to Havana and vacation in Havana, because my sunburn was so bad. And it just, this customs person could not get over the idea that someone could get a sunburn in Canada. So it was just that we had to pull out all of our hotel receipts and all of that. It was fine, but it was just some person was sitting there saying, like, "You've got a sunburn. You didn't just come from Canada. There's no sun in Canada." And that's the story. I was not arrested, just a half hour, 45 minutes of my life. And the fact that, my passport doesn't say born in the USA, I don't know, maybe that probably made it worse. But anyway.
That's awesome. That's awesome. I just want to point out, Lou, that in our green room, our studio chat, we had multiple people behind the scenes pushing to get the answer out of this. So thank you for sharing that.
It's probably better I clear the record on that, right? And then
one last thing. I want to say this. Jeff M, I kind of poo-pooed McDonald's a little bit. Jeff M replied that they have a cost basis of $60 and a 500% return. So we're not buying the stock in 2010. We're talking about buying McDonald's in 2025. Okay. Want to remind you, awesome investment, but we're talking about looking forward. Again, wonderful business, smart buying it in 2010, coming out of the financial crisis. Excellent long-term hold there. All right. But we need to stop holding on here, Lou, and bring Danny and
I see Danny and Jeremy. I will say, and I don't, these are not forward-looking statements, but with the amount of McDonald's my daughter, the athlete, has been eating, I would be bullish on first quarter results. All right.
Fair enough. I'm bullish on the real estate, but we'll leave it there.
And let me just say, I couldn't have let this hour go by without finding out what happened to Lou. So
I really needed to get that off of the Slido queue before I ask. Okay.
I've been arrested. I'll see you guys later.
Have a good show, guys. We went to two of my favorite convicts, Jason, Jeremy, and Danny. Take it away, guys.
Jeez. Welcome to another hour of Fool 24. My name is Danny Vena. I am a Hawaiian shirt enthusiast and Fool contributor. I generally write about tech, but I also dabble in consumer and fintech and e-commerce and cloud computing and AI and what have you. And I am joined by fellow tech writer and Fool enthusiast, Jeremy Bowman. Jeremy, how's it going?
Pretty good, Danny. I think I need to start tracking your Hawaiian shirts on the show.
I think we're going to need, we're going to need an exchange traded fund that tracks my shirts.
Yeah, I like that idea. I think we cover most of the same things. Consumer and tech. With maybe a few other stocks thrown in. But yeah, happy to take your questions on anything there.
So just as a reminder, we cannot give personalized investing advice. If you have a question, please go to slido.com and enter the code #Fool24. Remember, this is for educational purposes only and does not constitute personalized investing advice. That said, this was a theme that I had done once before, and it seemed like there was a lot of response to it. So we thought maybe we would do this again. And I think once in a while it doesn't hurt because we don't always have all of the same viewers. And what we want to talk about is the path to multi-baggers. You hear a lot about multi-baggers or a stock that goes up multiple times its original cost basis or what you or I as an investor pays for it. And you hear a lot about, particularly in Slido, I hear a lot of people say, what stock do you think is going to be the next multi-bagger? Tell me what stocks in your portfolio you think are going to be the next 10 baggers. And it got me thinking, that's only one part of the process. And it's actually the easiest part of the process. It gets harder later on when you have to hold through the inevitable ups and downs that come with stock ownership. Now, many of you know I am a long time, stockholder of Netflix stock, which is a multi-bagger for me. I've held NVIDIA for years, multi-bagger for me. But this time, I thought what I would do is focus on, in my portfolio, some of the stocks that I haven't held very long that have at least doubled since I got them. And so we can look at the charts for them and maybe talk about the hardest part of having or getting to multi-baggers, and that is the inevitable downturns that happen to every single stock holding. I've never had one go straight up. I've always had them, mine at least, have always, excuse me, mine tend to go down at least 50, 60, 70% at some point when I own them before they become multi-baggers. And the two that I'm going to bring to the table today fall into that category. What are your thoughts on multi-baggers there, Jeremy?
Yeah, I think this is a good topic and a good theme because I think it allows us as investors. It's both backward looking and forward looking. And I think it's one of those areas where the lessons that you can learn from previous multi-baggers you can apply to the future. I think some of the market conditions and certainly technology. I mean, some things change, but I think the general kind of things that we're looking for in a multi-bagger kind of stay the same. I mean, yeah, Netflix is a great example, and I think a lot of these stocks too have gone through substantial drawdowns. Certainly, if you're in the tech sector, that's kind of the nature of the tech industry. So, part of it is sort of being patient and having the I guess the willpower or something like that to hold for the long term.
Yeah, that's absolutely right. So let's start with one. What I wanted to do is I started at the top of my portfolio and I worked my way down to stocks that have at least doubled since I owned them. And two of them stood right out because one of them has only been public since 2019, and one of them has only been public since 2021. Now, they are stocks that I have talked about before, but not ones that I've talked about in the context of being multi-baggers. Now, I wanted to start very low on the totem pole, as it were, because these stocks have about doubled or more for me. Excuse me. Yeah, this winter cough is killing me. And because they've already shown the characteristics of stocks that could be multi-baggers in the future, even though they've only just doubled since I owned them. So the first thing that I want to do is I want to pull up the first one. I have it on Y charts here. So give me just a minute. I'm going to pull this Y charts up. I'm going to share my screen here. And the first one that we are going to talk about is CrowdStrike Holdings. Now, you may recall it wasn't too terribly long ago where CrowdStrike had a very public faux pas. And you can see that probably right here in the middle of 2024. But before that, I mean, let's go back. CrowdStrike as a stock only went public back in June the 12th of 2019. June the 12th of 2019. Now, I did not buy it immediately when it went public because I generally don't. I generally look at the stocks and I give them a few quarters to marinate. I want to know if they're going to be able to hold up their end of the bargain, if they're going to be able to do the things that, you know, made them attractive enough to go public in the first place. Now, as you can see from this, they went public in 2019. The market was doing okay, and it wasn't terribly long before we got to, you know, the end of 2021, beginning of 2022, and the stock market got a little dicey. And between 2022 and 2023, we had, you know, rampant inflation. And look what happened to CrowdStrike Holdings stock. You can see down here, right around the beginning of 2023, the stock was down almost 60%. Now I'm going to change this chart here so that you can see how many times the stock was off its high. Bring that a little bit closer here so you can see better. And these dips here, you can see the stock here was down more than 20%, down more than 25%, down almost 50%, down more than 50%, down 67%. It hit a new all-time high here. It stayed within the range of that all-time high. And then in mid-2024, when CrowdStrike essentially broke Microsoft, and you had, you know, cybersecurity breaking, you know, servers and systems around the world, the stock dropped again, in this case, about 45%. So, and I wanted to use this one because you can see look how many times and how far down this stock has gone multiple times since I bought it in April of 2021. So I've owned this stock for less than 4 years, and it looks like, oh my gosh, what was I thinking when I bought this stock? Yet if you go and look and see what it has done overall, the stock is up. Well, it's showing 72% from when I bought it. Now, I bought it multiple times. I bought it in August of 2021, but I also bought it. Oh, sorry. You know what? I've got the wrong data now. I don't know how that happened. Let me just change this date here. 08/18/2021. And that one's not the right date either. I do this so it keeps me humble. I set these charts up ahead of time, but I was doing them. So this is how much the stock is up since I bought it the second time. I bought it twice. One time it's up more than 70%. One time it's up 121%. So in all, since I bought the stock, you know, my position has more than doubled. And again, you can see that, you know, the number of times that stock fell and fell precipitously, you know, really does help to illustrate, you know, look at that. I mean, it's ridiculous how many times that stock has fallen, multiple times. So that's one of the key parts for me. I'm going to stop sharing the screen for now, is the fact that, you know, you can have a portfolio full of potential multi-baggers. The hard part, even if you have them in your portfolio, is hanging on to them through the inevitable volatility that comes with owning stocks that could potentially be doubles or, in the extreme, 10 or 20 or 200 baggers. Jeremy?
Yeah, I think you have to be able to separate, your belief or your feelings or your thoughts about the business from, how the stock price might be affecting you. Your emotions, or if you're losing money. I mean a lot of your feelings about the stock price might, it's price anchoring, right? How is it doing in reference to when you bought it, or the price you bought it at. But that I think certainly with finding multi-baggers and holding them, and just in general, you want to take a step back and separate from that, because you might have bought a good business at a high price, and it just might be down, and then it's coming back up. I mean, that's not always true. But I wanted to say as well, I think for me, what I look for, to find multi-baggers, and I think some of the stocks we talk, or certainly Netflix, or a company like Amazon, these sort of classic, real sort of top performing. If you'd bought them early on, you'd be doing pretty well right now, and held. What I look for, I think, are three, maybe four things. First is revenue growth. Any business, any growth stock, it's going to need to show, and preferably, consistent revenue growth. Profits, I think, can come later. The market has shown, willingness to be patient with profits, especially with a disruptive tech company like those two. But revenue growth really needs to be there to show that customer adoption is increasing, or even if you're not gaining new individual customers, the customers that you have are spending more money with the company. So that's one. The second thing is a large addressable market, which I think both of those companies are good examples of. Because I think we've seen other stocks grow well, but seem to have hit. There've been a few of these incidents with the pandemic. I think these companies just sort of hit a ceiling faster than I think the market anticipated. One we were talking about on here yesterday is Chewy. I think Chewy's done very well in the pet e-commerce sector. They're clearly the market leader there, but their growth has slowed down quite a bit, because I think that, first of all, that market is pretty mature, right? Pet products, and then they seem to have reached a sort of terminal value, or they're still growing, but they're just not growing too fast. And I think Zoom too, to throw another one out there, is a good example of a company like that. So, what stage are they at in that addressable market? And if you look at those two companies, Netflix, I mean, video entertainment, huge market. And certainly Netflix, I think, has expanded it with the transition to streaming around the world. And Amazon, starting with e-commerce and then expanding beyond. Also, I mean, I think you could argue between e-commerce, cloud computing, and the other things that they do. They might have a bigger addressable market.
And they started as a humble online bookstore.
Yeah, exactly. Yeah, and I think. Another point there, which Amazon I think ties into, is optionality, which I know is something David Gardner looks for. That ability to, either through innovation or just expansion, to tap into new markets or introduce a new product that really the market, at a time that the market isn't valuing the stock based on that. I mean, at one point in time, right, nobody knew that Amazon was going to become basically invent the cloud infrastructure business. But so if you're in some ways that goes back to betting on the leadership or the culture of the company, or their ability to take some risks. So I think I don't think that's required, but it's a good thing to have. And then I think some kind of disruption is good. I think oftentimes, and those two stocks are good examples of this as well, the market kind of undervalues what the potential is in the kind of disruption. Or you see, I think both Netflix and Amazon, one stage in their lifetime sort of paled in comparison to, say, Walmart or an HBO or even Blockbuster in Netflix's earlier iteration. So I think there's that, kind of skepticism about, all right, can this company really, disrupt a, large industry, and if they can, that's going to be pretty big returns.
Indeed. So the next one that I wanted to share out of my own personal portfolio is a company that I have talked about on and off, and I'll go ahead and share my screen again. And investors and our viewers may remember that this is one I've talked about, is a company called Dutch Brothers. Dutch Brothers is a company that is taking on Starbucks. They are a small regional coffee company, and they are of a small niche market right now. They focus, rather than just coffee, they focus on fun beverages. They have a secret menu. They have limited time only offerings. They have their own line of afternoon drinks, like energy drinks. So there's a lot of focus on their culture, on their employees, on having fun with customers. And so this is one that, I was kind of intrigued about early on. I bought the stock a while after. It looks like, let's see, Dutch Brothers went public in September of 2021. And I bought it in May of 2022 for the first time, which you can see here in the date range. And now the other thing that I wanted to point out of this chart, I mean, this is another one. It's up 171% right now from when I bought it, and that is an impressive range. But if you, I'm going to change the chart here and look at how many times the stock has been down. For most of the time that I've owned it, it was down more than 20%. For a good chunk of the time that I owned it, it was down as much as 50%. And it's only recently regained those highs. I had to hold the stock for 2.5 years before it got back to what I paid for it. And now the stock is up 171%. So again, this kind of helps to illustrate, what you're dealing with here. And the toughest thing about investing for me is emotions. I start looking at some of the stocks that I own, and they're down 50 or 60 or 70%. I start to doubt myself. I start to doubt my thesis, particularly if it's not just the broader market. Now, we've been, over the past couple of years, the market has been extremely volatile. You don't necessarily know if a stock's falling because the market's down, or in the case of Dutch Brothers, we've got rampant inflation and customer adoption is just not happening as much as it needs to for the company to be wildly successful. So this is another case where, I've had to hold this stock for a long time just for it to get where it is today. And it's not because, I didn't doubt myself along the way. I certainly did. Multiple times I thought, what was I doing buying this stock? Oh, yeah, right there before inflation hit. Now what am I going to do? I guess I'm just going to have to wait it out. And sure enough, when inflation stopped growing as quickly, and people started being a little bit willing to spend a little more of that discretionary income, we started seeing Dutch Brothers results improve. And from those results improving, we saw the stock price improve pretty dramatically. I don't know. Is this one that you followed, Jeremy?
Yeah, I like Dutch Brothers. And that I'll segue into a stock I in the same industry that I wanted to talk about. And maybe I'll follow you into the screen share here,
Sure.
which is Sweetgreen. Another fast casual a salad company. All right, there we go. So Sweetgreen, I think there's a couple things that I like about it in particular. First of all, they're a leader in this niche in the restaurant industry, and I think we've seen certainly Chipotle is a good example, and we've seen other fast casual companies or Dutch Brothers in coffee. I think Cava is another one with a lot of potential. So I think there's a lot of growth in these kind of niche, parts of the restaurant industry, and no one's really doing. I mean, they're the largest fast casual salad chain. They have a little over 250 locations now, and I think it's a unique offering in the market. So I think there's a lot of growth potential there. Certainly, I mean, a large addressable market. I mean, anybody who eats lunch or at least is willing to eat a salad, and I mean, I think their food's very good in my opinion. And I'm not even. I don't think personally I'm the kind of person who might normally eat a salad for lunch, but I've always enjoyed Sweetgreen. So I think the business numbers have been pretty good. Growth has been maybe unsteady at times, but they have their average unit volumes or the average sales they generate from restaurants is about 3 million, which is pretty good for that industry. That's about on par with Chipotle. And then the other thing that is exciting about them, I think, is they're have this technology called the Infinite Kitchen, which is basically like a robotic or automated system in the kitchen that helps expedite orders. And they're rolling this out to more restaurants this year. So they kind of tested it in a couple locations, and they said, well, they found faster throughput, lower costs, higher average tickets, all these kind of benefits. So I think as far as certainly a company with exposure, restaurant company with exposure to technology, that's a new thing. And I think that has the potential to certainly drive their profitability and the ability of the individual restaurants to bring in more sales. So I'm excited to see how that plays out. So I think, Sweetgreen, you can see on the chart here, it was similar experience to Dutch Brothers, I think, with they went public right at the tail end of the pandemic boom in the stock market. So, I think bad timing there. And stock was even in, single digits for a brief period. And it's been a bit up and down over the last year, where I think it's a good example of. I think they do have disruptive potential there for the two reasons I mentioned, but I think the market isn't quite sold on it, so the valuation is still pretty reasonable. So I think they need those things I mentioned to go right for them. But I think if they do, it's certainly I think it's market cap around $2.5 billion or something. So reaching a valuation of 5 or 10 times that is certainly within reason in the restaurant industry.
Yeah, so there's a couple of there's a comment and a question in the queue here that I wanted to address. We'll knock those out pretty quickly here. The first is a comment that comes from Jeff M from about 19 minutes ago. Hey, Danny, I'm from Hawaii. Love your shirts, but technically they're called Aloha shirts. Jeff is absolutely right. I call them Hawaiian shirts because that's what they are primarily called here on the mainland. But yeah, I actually lived in Hawaii for 2 separate stints. One from 1982 to 1985, and another from 1991 to 1994. I lived on the island of Oahu, which is where I developed my love for Aloha attire. So thanks, Jeff, for the gentle correction, and I appreciate that you love the shirts. There's one from Let It Ride here from about 28 minutes ago. And I don't know if you've heard about this, Jeremy, but if you have, feel free to chime in. Danny, what is your take on the short report on KD? Let's see. So ticker KD is, let's see. I don't remember the name of the company, but I want to talk a little bit about short reports in general. So ticker KD is a company called, I believe it's pronounced Kyndryl Holdings, KD. And let's see. So Kyndryl Holdings, well, the stock is down about 11% right now. It's a company that operates a technology services company, IT infrastructure services provider worldwide, offers cloud services, core enterprises, AI, etc. So the reason I wanted to address this is not because I follow Kyndryl necessarily, but because I have followed short sellers. And so the first thing that I did when I heard there was a short report was I looked up who was the short report by. And what I came across was this short report was a company called Gotham Research. Now, Gotham Research is a company that I've heard of before. In fact, if you go back earlier this year, Gotham City posted a short report about a company called Grifols, which is based in Europe. And as soon as they published the short report, the stock dropped 43%, and Gotham turned around and covered its short position almost immediately. So when I see stuff like that, the first thing that I think of is that this is a money grab. But I wanted to do a little bit more research. Now, if you go back a couple of years ago, the United States Department of Justice did a probe on a number of short selling businesses. And one of the businesses, excuse me, one of the businesses that they investigated was Gotham City Research. They said that now there's an old saying that even a blind squirrel finds a nut every now and again. And Gotham City Research is best known for its takedown of a British country club that turned into an insurtech company called Quindel. Quindel shares crashed after, and the company ended up filing for bankruptcy after Gotham City published what was at the time called a bombshell report questioning the company's stated profits. Now, after that happened, Quindel filed a suit against Gotham City Research and ended up winning a libel case against Gotham City Research because they neglected to put up a defense in court. So what? Now, I am not saying that all short reports are dubious. And I am not saying that all short reports by Gotham Research are dubious. What I am saying is when you see a short report, what's generally happening is the person that published this short report, and the reason it's called a short report is the entity that published the report generally has already shorted the stock. They find all of these red flags that they say are indications of why investors shouldn't invest in the stock. The stock price plunges precipitously, is down 25 or 30 or 40 or 50%. And then they turn around and cover that short report and they're short position and they end up making a lot of money on this. When I go back and look, this seems to be what Gotham City Research's modus operandi is. They short a stock, they publish a report, and they turn around and buy back the shares to cover the short. So in most cases, not all, and generally speaking, most of these short reports are caca, let me say. It's a way for these companies to come out and make a quick buck. Now, having said that, I think that every investor, when a short report comes out on a company that you're invested in, avoid the temptation for the knee-jerk reaction and immediately selling the shares, thinking, oh my gosh, this company is fraudulent, or this company is engaging in dubious accounting practices, this company is fill in the blank. Do your research. Look at what the short report says, because a lot of times what you'll see is excuse me, you'll see inflammatory language and not much to back it up. The next thing that I do is I look at what the financial news media has to say about the short report. Analysts do this for a living. They will come out and they will read the short report. They will look at the company's financials. You don't have to be an expert to do this. As you look at what the analysts are saying. And many times the analysts will come out and say, yeah, this doesn't make any sense. This is a bunch of hooey. You know, I don't know what the percentages are. But I will say that there's a very low percentage of these short reports end up being, bombshell company breakers. Luck and Coffee is one that I remember that actually had some degree of truth to it. And the company ended up having to restate its financials, and there was a lot of trouble, and the stock fell, and the company almost went under, but it was a Chinese company. It had the backing of the government, etc. So my take, having not read the short report, is don't panic. Look and see what the short report says. Look at what the analysts are saying, and then make a decision after you're an educated investor. Is this a excuse me? Is this a company that you follow at all, Jeremy?
I don't. But I'll want to add a one or 2 points of what you were saying, and I definitely agree with your discussion there of short sellers. Yeah, I'm not familiar with Gotham City Research, but yeah, often the knowing the short seller, the track record of the short seller is more important than the company involved. We saw. I think it was maybe in August, with the super microcomputer, Hindenburg Research came out with a short report, and then shortly after, I think Supermicro delayed its filings. I think they did finally get them out, in February, and they didn't have to restate anything. But that, oddly enough, that short seller, they quit after that. I mean, I think they had some success, but it was, I think they found the stress or the pressure of the that business to be, enough for them. But I think so. I think it's worth considering the company involved, and I think Luck and Coffee. A small Chinese, small cap Chinese stock to me is more likely, I think, to be, maybe, doing some unseemly accounting rather than, Kyndryl, which is, a spinoff of IBM. I mean, it's possible to find, often we see these sort of undisclosed cost problem or undisclosed third party, related party transactions. And often they're the similar set of accusations. So that makes me more skeptical. I remember Shopify was hit with a short report as well, which, turned out to be nothing. So yeah, and I'm not familiar with Gotham City Research, but yeah, based on what you said, it is, right, and it's the short sellers are incentivized by making the stock go down. So right, yeah, maybe if they do just buy it back after a double-digit sell-off. I mean, I guess that's a good business for them, but it seems pretty dishonest, at least if you do if they do believe that there's some fraud going on or something to that effect.
Yeah, so to take it with a grain of salt and make sure you do your homework before you panic sell, because that is what the company is counting on. They're counting on investors to sell first and ask questions later, and that's how they make their money. So I would try to stay away from making any decisions based on a short seller's report. So we've got a question from Jorby here, and I think we probably both will have an opinion on this, and perhaps they are different. Jorby says 2 minutes ago, when hunting for multi-baggers, how important is capitalization size to you? Do you approach micro cap companies differently when evaluating? I generally don't necessarily look at investments as saying, I want to buy this because I think it's going to be a multi-bagger. I generally look at an investment saying, I want to buy this because I think it's going to be a successful investment over time. And interestingly, market cap, as much as you think a market cap might come into it, think about Apple as an example. I remember the first time that Apple hit $1 trillion market cap. I believe that was in 2018, if I'm not mistaken. But I remember there was some market commentary saying it might be time to sell Apple. It hit $1 trillion market cap. There's not much further it can go from here. The company's growth is slowing. It's not going to gain any more market share, et cetera, ad nauseum. And today, Apple has a market cap of 3.3 trillion. So investors who bought Apple when it was $1 trillion company have tripled their money, essentially. So now, mind you, it takes buying the right companies, and that's what I try to focus on. When I'm buying investments, is buying the right companies. Now, sometimes, Dutch Brothers was an example on the lower end of the spectrum. I bought it because I thought that Dutch Brothers had a really good opportunity to be a good investment, because I liked what management's doing. I like the company's focus. I like the culture. I like how they're carving out a niche in an already crowded market and doing it successfully. And I was able to buy shares, excuse me, between $24 and $30 a share. And this is a very small company still. So I do think this has the potential to be a multi-bagger. But that's not why I bought the stock. I bought the stock because I think it will be a successful investment. What about you, Jeremy? Do you focus much on market cap?
Yeah, I think this is a good question. And I did, when I was talking about Sweetgreen earlier, I did mention the market cap. But yeah, I think it's a bit of a trap to get too caught up in the market cap. It's very easy, I think, to sort of look at a small company and say, oh, well, this could be a much bigger company. Because it comes down to the elements of the business, and what we've seen. I mean, I think 5 years ago, or I don't know what was Apple, the first $1 trillion company, that was 5 or 6 years ago. But I think if you would ask investors around that time if we would have three, I guess, 3 trillion companies by now, most people would not have thought that would have happened. So I think there's this upper limit, certainly with AI technology now, on stock growth seems, or on market cap size seems to keep going up. So I don't, would I expect Apple to be a 10 bagger or 5 bagger from here? No, but no. It's, the business is still growing. And I think, I mean, look at NVIDIA. Went from 300 billion to 3 trillion, 10 bagger in less than 2 years, I think. So don't underestimate the growth of large companies, certainly, especially when that optionality, of a new technology in the case of NVIDIA, comes into play. I mean, having said that, I do think, a company like Sweetgreen and this a company that size, there's more risk involved. I mean, I think there's more downside, risk for it as if the argument I made doesn't pan out. But I do think, just based on that size, if for a company to say, be a 10 bagger or even more, getting in a small size is more helpful for the runway. Another thing that I think is sometimes helpful is if you're looking at a smaller company, look around that industry. So what's the biggest restaurant market cap? And I think, Starbucks and McDonald's have been, well over $100 billion at, probably are now, but it's certainly at various stages. And not, I don't expect Sweetgreen to be that big, but what's the room for growth in that market? I think is a good way of looking at it as well.
So yeah, I was actually taking a look to see. So I guess Starbucks now has a market cap of 113 billion. And Dutch Brothers, let's say, just so we can have an apples to apples comparison here. Mm-hmm. Let's see, Dutch Brothers has a market cap of, drum roll please, waiting for my chart to load, 7.86 billion. So if Dutch Brothers gets even anywhere near the size of Starbucks, and mind you, it doesn't even have to get that big. It could get to 787 billion and still be a 10 bagger from here. No, that's not right. I'm doing math in my head.
You're saying it would be, if it got to 78.7 billion, that would be a
78.6 billion. It would still be much smaller than the 113 billion that Starbucks is, and still be a 10 bagger from here. So from 7.86 billion to 78.6 billion. There we go. So I've got another one in here. This is just a comment from Zaxafool. He says, I have been finding value in using large language models to quickly locate various analyst reactions and commentary on short reports targeting the companies they follow. Your mileage may vary. That sounds like a shortcut to exactly what we were talking about here. Doing your homework. So kudos to you, Zaxafool, for finding an easier way to get the information. Good job.
Yeah, those are very useful tools. Certainly if you're trying to learn about investing or new companies or any of that stuff, I recommend ChatGPT or whatever you have. Danny, I had a follow-up question from your commentary earlier. If I thought might be informative to the audience, but you talked about drawdowns with your multi-baggers. So how do you differentiate between say a stock that you now sell after something like that versus holding on for the hopeful comeback?
A lot of it has to do with the environment and the reason the stock is falling. It's well known around Fooldom that I generally buy my stocks on the way up. I buy a stock, the price goes up, I buy some more, the price goes up, I buy some more. And that works until it doesn't. I wanted to throw an example of when that didn't work out. For example, I was a big proponent of 3D printer stocks back in the day, and I owned 3D printing, and I owned Stratasys, and I owned there's a third one I don't remember the name of, and I thought hey, 3D printing stocks are going to go mainstream, and my stocks are going to be worth a lot. And that thesis turned out to be incorrect. So I lost quite a bit of money on that situation, but it was not a lot of money in terms of my overall portfolio. It was a lot of money in terms of a large percentage of what I had initially invested in that small corner of the market. When I am looking at a stock that has fallen 40 or 50 or 60%, 70%, the first question I want to know is, what is the broader market doing? And for instance, if you go back to the recession that happened between 2007 and 2009, because there's some numbers in there that I know off the top of my head. The S&P 500 fell 47% at its trough. And I had learned by then that when the market goes down overall, it takes down good stocks and bad stocks alike. So when I'm looking at companies that before the recession happened had been growing their revenue, they were increasing their earnings per share. Their earnings per share was growing faster than revenue. They had a large total addressable market. They had a competent management team. They had, they're expanding into new markets. They had optionality, like Jeremy was talking about earlier. If all of these things are true and the stock has fallen because the broader market's falling, I see that as an opportunity. And even as late as when the pandemic first struck, stocks were falling in unison. Advertising stocks were falling faster because people thought, well, if there's going to be a recession, businesses are going to slash their ad spending so that they can save money. And for a short time, that turned out to be true. And the trade desk stock fell like a rock. And I turned around and bought that stock because it wasn't falling because of business specific issues. It was falling because of broader market issues. And that's just one example of many. But generally speaking, I look at that. Now, if you're having a company specific issue, for example, when Supermicro Computer got hit with a short report, my first instinct was to just hang on to my shares and not do anything. And the stock fell, and the stock fell, and the stock fell. And I might have added to my position back then had it not been for the fact that then management delayed their financial filings. Then they missed or they were at risk of being delisted. Then their auditor quit in mid-audit. To me, those are things that are red flags as an accountant. I see stuff like that and I go, okay, this is not necessarily a stock that I want to add to right now, even though it may be an opportunity. It may also be a trap. And so I did not add to Supermicro Computer. The stock has more than doubled from its bottom, but I stand by that decision because it was the right decision to make.
Yeah, good points there. Do you have any? Did you have anything else you want to add? I wasn't sure if you're muting.
Oh no, I was done.
Yeah. Yeah, well, I think I definitely agree with you. Yeah, market sell-offs. Yeah, like you said, they tend to wipe out good companies and bad companies. So they're good buying opportunities for a stock business that's doing well or stock that you like. I'll take well, you know what I wanted to address since we're on. We've been talking about short reports. I'll address this question quickly. DIF, I don't know if I'm saying that right. Says how when we're talking about short reports, that says, however, the short report on ELF in 2024 had better timing than the previous stock advisor buy, though it was likely another short research outfit. Yeah, I believe you're talking about the Muddy Waters report in November. Yeah. Yeah, I think that that sometimes I think with the short reports too, often they target companies that that have high valuations and sort of look
Indeed.
overvalued. So I think this is an example of a report that didn't really uncover anything, any sort of financial shenanigans, but the timing with the broader market sell off, and certainly Elf had already been they kind of soared on very strong growth, and it seems like there was the stock got a little overbought and has come down since then, but I think it's still a strong business, and it seems like the valuation has normalized since then. So I think sometimes the timing for a short report might work out, but I don't that doesn't mean that the underlying accusations are necessarily correct. And then I'll grab one more. Yeah, so Jeff M about an hour ago, and similar to what you're talking about just now, Danny. What the heck happened to Broadcom? Very disappointing. Yeah, I assume you're talking about that drawdown as well, which again, I understand. If you bought Broadcom in its peak, and I didn't actually realize that it pulled back this much, but it's down. I think it's down about a third or 30%.
It's down about 31%.
Yeah. So that we've actually seen this across the semiconductor sector. I mean, if you look at NVIDIA or Taiwan Semi, or there's other kind of flagship semiconductor bellwether semiconductor stocks. They've kind of all moved the same. One semiconductor ETF I like to follow is the VanEck semiconductor ETF, which is a ticker SMH. It looks like that's down about 23% from its high. So this is a sector-wide sell-off. I don't really have any concerns about Broadcom. Based on that, again, the stock, I think it had tripled or even more in the last year or two. So it had gone up a lot. But the company, they reported earnings earlier in March. Very strong numbers. Overall revenue growth up 25%. They said AI revenue in the quarter was up 77% to 4.1 billion. So I think they're I don't have any concerns about the business. I think they're performing pretty well. So that could be one of those opportunistic buys, depending on where it goes from here in the valuation.
And here's a chart just to back up what you just said, Jeremy. So this chart that I'm sharing right now shows the three of the stocks that we just talked about. Broadcom is down 31%, Taiwan Semiconductor is down 25%, NVIDIA is down 25%. And I'll go one more, Palantir Technologies, which is a company that had a pretty high valuation, and it's also down 26%. So that kind of shows that. I mean, look at they're all marching in unison on the way down, which shows that Jeremy's like right on the money. This is like the whole semiconductor space. So I don't see anything wrong with Broadcom. In fact, Broadcom's one of the ones that I let get away, and I have been considering buying. I just need to not talk about it.
Oh, well, sorry for bringing it up in that case.
No, you're good. That's why we're here. Let's see.
Yeah, that's a tough one. We got about 3 minutes left.
So Indy Farm D says, can you comment on ASML's current valuation and how much you think tariffs may impact its stock price? I think we need to take a step back from the tariffs for a minute and just maybe, look at, what the company does. ASML is a company that provides the ultraviolet lithography machines that are used in, making semiconductors. Taiwan Semiconductor Manufacturing that we just talked about is one of ASML's biggest customers. And actually, ASML is actually, over the past year, it's down about 37% off its peak. So this is, another one of those that has been adversely affected by the semiconductor industry drawdown. I'm pulling up the valuation right now to look at it because it's not something I knew off the top of my head. Now, ASML is kind of a cyclical business because the machines that it sells are, millions and millions of dollars. And so there's going to be lumpy sales of these machines. But looking at it's got a PE ratio right now of 33, which is a little bit of a premium to the market. It's got a forward PE of 26. I don't see that as being very unreasonable, considering that ASML, basically, they're the toll gate keeper for the AI revolution. You cannot make semiconductors without Taiwan Semiconductor Manufacturing, and Taiwan Semiconductor Manufacturing cannot make these chips without the machines that it gets from ASML. Now, we're not going to see the same kind of expansive adoption, but what we will see is a bigger market opportunity. I don't know, Jeremy, do you have thoughts on ASML's valuation in the last minute that we have?
Yeah, I think, so the ASML has had a bit of a tough time, over the last year or so. So, it's a semiconductor equipment sector is on a bit of a different cycle than the chips, which have really boomed. So there's been, slowdowns in China, headwinds in China. I think other delays elsewhere that have led the business to, underperform expectations a bit. But yeah, I mean, I think the valuation is pretty attractive right now. And this is, I think, one of the companies. I mean, I'm seeing a price to earnings ratio of 33. I mean, I think this is one of the companies with an all-time competitive advantage when it's the only maker of those extreme ultraviolet lithography machines that are used to make the advanced chips that TSM and other companies that are required for so much of what makes the world work nowadays. So they have that asset. They can't necessarily control other elements of the market dynamics, but they put out pretty solid growth guidance for 2030. And I think, given that position, I'm less concerned about tariffs than for ASML than I would be about a lot of other companies out there. And we just saw, President Trump roll out the red carpet for Taiwan Semi to build foundries in the U.S. So I think, ASML might be granted a similar, exception or whatever you want to call it to those kind of policies. So that some of that China pressure has affected them, but I think their competitive position is makes them an attractive stock at at the valuation right now.
And we are past our time. We've got Jason Hall and looks like Tyler Crowe waiting in the wings to join us.
Tyler Crowe does look like Tyler Crowe.
He does.
He does. Danny, Jeremy,
most of the time.
Most of the time, that's true. All right, great hour, guys. We'll see you. We'll see you next time.
Thanks.
Hold on, guys.
Hey, Tyler.
Hi, Jason.
It's I feel like we were just together.
Hey, well, we do these a lot, and we do some off-camera things together. Yeah, we see each other's beautiful and less beautiful faces on and off throughout the day.
That's true. That's true. All right, everybody watching, whether you're a YouTuber watching on the Motley Fool's live stream on the YouTube app, or you're a Motley Fool member watching behind the paywall, we're here to answer your questions. This is another Ask Us Anything hour. And we don't mean anything. I mean, ideally, it'll be about stocks and investment in the economy and finance and all that kind of stuff. But throw it out there. You never know. We might just answer other stuff too. Go to slido.com. The event code is Fool24. Wherever you're watching us, that's where we take your questions, get them to us. Just remember, when we answer your question, we're not telling you what to do. We're not here to provide anybody with individual or personalized financial advice. We know stuff, and we're happy to share our expertise and opinions, but we don't know you or your situation. So please don't think we're telling anybody what to do or providing individual or personalized advice. That's not what we do in this format. Tyler, have you had a chance to take a look at any of the questions in the queue and pick out one to start with?
I've seen one or two, but you know what? Let It Ride actually had a nice little like amuse-bouche to start us off here with a question that just came in. And it says, how can a company make claims in a short report that can't be easily supported or refuted? Do they have access to information that the public doesn't? And my short answer is it depends.
That was punny what you did right there, by the way. Your short answer
to a short report
question.
Yes.
Yeah.
Look, dude, we're going to make a bunch of bad dad jokes all night. Afternoon for you. It's 9 p.m. for me. I'm a little, a little punchy at the end of the day. So
that happens. So Tyler, just in case you're not aware, Kyndryl, short report has dropped against Kyndryl, which is getting a lot of attention right now, a lot of focus on that. So I think that might be what's happening, driving Let It Ride's question. But broadly, this is a great learning opportunity to talk about short reports and what they can and can't do and what they do and how to read and interpret and learn from them.
Sure. Well, I can't make any claims on Kyndryl's short report. I haven't read the short report. I don't know who published it. And to be honest, I don't know anything about Kyndryl. So I'm going to kind of stay away from that. But when it comes to short reports, in the thing that it can't be easily supported or refuted, depending on the person doing the report, sometimes they do have information that the public doesn't. Sometimes they do speak with current and former employees. Probably they go to the disgruntled ones. So, perhaps a little bit of a bias in the opinions that they're getting from the employees with whom they speak. And yeah, sometimes they're not easily supported or refuted because they could be interviews with employees. They could be talks with vendors or customers or things like that would require a little bit more digging than what you will typically find in the publicly traded publicly disclosed information with the SEC. And so to the short answer to the question of whether they can make those claims, sometimes they do dig up other things. It's really not a whole lot different in my opinion than the hedge fund or the asset manager that does really, really deep research on a company that say, like, I don't know, they hire a satellite to monitor the parking lots of Walmart. That's not publicly disclosed information, but they will use that to their advantage. There's a lot of the proprietary trading firms, the Citadels and the Millenniums of the world that get massive amounts of information that we as the public do not have. And they make trades based on a lot of that information. So I don't think it's out of the question that a short report company has information to that. Some do, some don't. I know Hindenburg Research is I think they're rolling up shop. I actually kind of thought they did a relatively decent job with their short reports. Yes, the whole point is to use bombastic language in a short report. The whole point is to move a stock based on what you're saying, and typically in a relatively short amount of time. But there are some that have done much better than others. Hindenburg had good examples. I mean, they shorted Nikola. Look what happened there. There's some other examples of
you can look beyond the anecdote with Hindenburg and their public record pretty high percentage. I think it's still a solid majority of the companies that they reported short reports on. Their stocks are still down from when they released that initial short report. And that means that there was something there. Obviously something was there, whether some of it was just timing with a few of them that they called out when the stocks were at peaky highs that might've been driven by a little bit of market mania. Nonetheless, you know, if the stocks are still down years after the fact, you know, they were onto something. So I do agree with you there. So Gotham City Research is the one that dropped the release on Kyndryl, and essentially what they're doing is drawing lines between Kyndryl and its continued relationship with IBM and costs that, again, this is from what I've read, I haven't dug in, drawing lines between costs that Kyndryl is not maybe properly disclosing, that it will eventually have to realize based on the supplier relationship that it still has with IBM. So like you said, especially when it comes to the opinion things, when it comes to the in our view things, those things are protected by the First Amendment in the United States, right? That's protected speech. When you're saying this is my analysis, this is the conclusion that I'm drawing, you can be wrong all day, but it's protected speech. So that's the important thing to remember. And that's, I think, the main thing. And I want to kind of invert Let It Ride's question here a little bit. How can a company make claims that can't be easily supported or refuted? I think it's two things that we as investors have to acknowledge. Number one, we will never know anything about any business that we ever invest in. There's no way that we can. Companies have confidential agreements all the time that, sure, we own a part of the company, but we're common shareholders. We're not executives or board members that have a fiduciary responsibility to all of the shareholders that can see everything. It's just not feasible, right? And it's not legally required. And there's times that those things should be kept private from somebody that might own a few $1,000s worth of stock, right? So that is a reality that we have to accept, but we should also strive to understand those companies as best as we can, the industries they operate in, the competitors that they deal with, their suppliers. Like, being able to draw those conclusions, I think, helps inoculate us in the situation where we do get these short reports that come out of nowhere. And, you know, from the moment they release, knock a double-digit percentage of the value of that company out of our portfolios, right? So having that starting foundation of understanding what you own, that's how you keep from making bad, quick decisions based on what somebody else has said, right? So that you have to start there. I also, and our Motley Fool Candidates were on, they had an hour earlier today. Buck Hartzell, Motley Fool analyst, said he gives short reports no credence and gives them zero of his attention, doesn't even read them. Jim Gillies gives them more credence. I acknowledge that I'm not a Buck Hartzell that has the level of knowledge and confidence about the concentrated companies that I follow that Buck has. My view is, since I'm trying to disprove my thesis most of the time, Tyler, and somebody says, hey, here's a problem, then I should at least take a little bit of a look, right? Despite the language, despite the damning conclusions that they may have reached, whether I agree with them or disagree with them, I should focus on the facts of whatever they're saying. Throw all of the language out the door and try to focus on the facts of what they're claiming and try to determine what level of validity does that have, and does it change the thesis for me? That's how I think about it.
Yeah, I think just like in, you know, very bullish, optimistic outlooks from other people that have small kernels of truth in them, there is likely small kernels of truth in short reports too. Like, they're not based on completely fabricated lies or, untruths or bombastic language. There are typically some kernels of truth to it. Now, if you know if you know the company you've invested in well enough, and you can see like, oh yeah, they're making a lot of business about, like you said, a customer or vendor relationship that I knew about going in, then, it's probably, and you've made that assessment that that wasn't a big deal, then, carry on your day. But if it's something that you hadn't initially considered, it's something to give thought to. Anybody who, it does these sort of analysis, I kind of bristle at the idea of people will, completely disregard short reports, but then you see these like CNBC talking heads with the most like ambitious price targets on stocks that, out there that are saying like these companies will double, triple, 5x in a few years, and we will lap that up as like, a pure truth, but then short report people have like a biased agenda. They're both cut from the same cloth. It's the same idea that that is made to get headlines and attention, and that's kind of the biggest component for a lot of these. It doesn't mean you should wholly ignore them. They all have information. They all have kernels of truth, and you should, in my opinion, you should go into any sort of short report with one, eyes wide open to realize that you could learn something, and two, probably take a lot of what they say with a grain of salt. And I think if you have that attitude with a lot of short reports, I think you'll actually be a little bit better off. You maybe discover some new things. There's always information out there that we know and we don't know. And there's, to use the Donald Rumsfeld line, there's known unknowns and unknown unknowns.
That's right.
And sometimes the unknown unknowns are we need to at least keep digging to find them out. And as maybe like unpleasant as a short report may be, it's worth reading.
Yeah, no, I think that's right. And I think one of the natural reactions when these sorts of things happen, we own a company, we're bullish in it, we believe in it, we want it to succeed, we have a financial interest in it succeeding. A natural human reaction when we see a short report is to try to find information that discredits the reporting body, the entity behind the short. I see this all of the time. And I just want to tell you guys, looking back through history, I thought Gotham City sounded familiar. And I've gone back and I can tell you why it sounds familiar is that they and Hindenburg about the same time were both shorting Ebix, the insurance company that did some other stuff too. Ebix ended up going bankrupt, right? A lot of the allegations proved directionally correct. Shorted Tile Shop, pointing out some related party transactions that were being hidden between executives and family members that had close relationships with Chinese tile suppliers. Tile Shop struggled for other reasons, but they pointed out things for businesses that have struggled. So they've pointed out some things. So I worry less about the credibility, trying to undermine the credibility of whoever generated the report, and more about the credibility of the claims, right? The credibility of the claims is the most important thing. A liar tells the truth every once in a while, right?
Yeah, I mean, if you start digging into everyone's skeletons, you'll find people both on the bullish and bearish side can have some disreputable things involved in them. It's not the messenger, it's the message.
As I said at the very end of the prior hour, a couple of hours ago when I was on with Lou Whiteman, I've been to jail. I've been in jail before. So,
mine's not in the US though.
Those things are out there. Those things are out there if you look hard enough about everybody. So, all right. You see one you want to grab here?
Yeah, this one it looks like it was during the morning show. I'm surprised that you guys, you mustn't have had it during your hour, because I know you and Lou would have hit this, because Aaron asked about 3 hours ago, any changes to the Transocean thesis? And are you still holding? I'm guessing this is related. Are you still holding? I'm going to have to leave that part out because I think that was more specific to the people on the hour that they asked this question, because I don't hold any more Transocean stock. Do you, Jason?
I have some leaps. I have
You
some,
have some leaps.
long dated
Okay.
calls. They're deep in the money, $1 calls that don't expire for about a year or so.
Okay. So Jason has a financial position in Transocean. I do not any longer have a position in Transocean. But what I would say is, are there changes to the thesis? I don't think so. I mean, one of the Transocean was the one fortunate, I guess it's both fortunate and unfortunate. It was fortunate that it didn't go bankrupt.
Well, so shareholders were fortunate that it didn't go bankrupt, because it would have wiped out a rounding error from 100% of your equity value. The business is, as a result, encumbered with probably the worst balance sheet in the industry.
That's the unfortunate part,
Yeah.
is that it has been trying to, it didn't go bankrupt, but
So
it has still
the
been
background for everybody else that's watching that doesn't know, if you look at the 2014 through 2019 period, like late 2019 period, it was a brutal period for the oil industry broadly. And the ones that suffered the worst were the offshore companies, because nobody really had the capital to deploy to develop offshore oil and gas, particularly oil, for these projects that take billions of dollars and decades to develop. Everybody was focused on shale, driving the cost down on shale. So this was kind of the orphan of the industry with all of these resources. And as a result, the industry was in tough shape coming into the pandemic. Some had made some improvements. We had already seen some merger and acquisition, M&A activity to try to strengthen the industry. But basically, they all had a bunch of old vessels that they were trying to hang on to before they were ready to completely write them off. And they had burned through their balance sheets. And then the pandemic happened and global oil demand crashed by 25 or 30% for multiple months. And we saw the entire industry go bankrupt, the entire publicly traded industry, literally all of the major players, with the one exception being Seadrill. Everybody else, there was a large player. Transocean. I'm sorry, not Seadrill. Transocean was the only one of the large players that did not go bankrupt. And now, as a result, it's the laggard, because the others have better balance sheets.
Yeah, the others have had, clean balance sheets that were restructured debt that were, allowed them to continue with mergers and acquisitions, to, actually pass on free cash flow that they had, because they didn't have to make, onerous debt payments. And while Transocean is still mired in a relatively large amount of debt that they have been chipping away at for a long time. And this is going to continue to be the case for this company for quite a while. Now, it eked out some free cash flow this particular year because of asset write-down charges and, high amounts of depreciation. So its debt is coming down, but the amount that it is chipping away at is still so slow that it's kind of like, I don't know, I feel like we've been waiting for the acceleration for Transocean has been like the waiting for Godot kind of like absurdist moment of you just keep waiting and waiting and waiting, and it never quite arrives. So I've been, I used to own Transocean, and I did believe in that thesis that they were going to be the ones that get through. And I was right about that. The only problem is like, well, it's a Pyrrhic victory because the stock is so far down that like it didn't matter. And it would have been better to kind of sell out of oil and gas offshore companies to, bet on the ones that reemerged from bankruptcy. The long term, I guess you could say the bullish thesis on Transocean today is, yes, it's encumbered by lots of debt, but people or drillers or producers are actually employing their rigs. There's not a lot of new builds going on, so people, the market is tightening, meaning like there's less spare capacity from these rigs, so pricing should improve a little. And as it chips away at that debt, and it's going to slowly get better. And this is a company that trades for 0.3 times its tangible book value. And so there's like this idea of being like, if the oil and gas market doesn't go sideways and it can continue to just kind of chip away slowly, eventually the market will realize like, hey, look, I know this isn't the best business, but it shouldn't trade for 30 cents on the dollar for its assets. That's like yard sale prices. And so that's I guess that's the most bullish thesis. I think the challenge being is like the debt reduction period is going to be so cumbersome that we could be sitting around here in 2028, 2029, still being like, well, they retired 300 million this year, and now it's only down to 6.1 instead of 6.7 billion in total debt. So that's kind of my thesis is like, yeah, it could work, but it's going to take so long to play out that I wonder if investors are going to have the patience to hang on to something like Transocean while they watch the rest of the industry, spit out free cash flow and have clean balance sheets and return cash to shareholders. That can be a challenging thing to watch.
Yeah. This is important. I think the idea behind an investing thesis is important because an investing thesis isn't always, here's how I'm going to make money, here's how I'm going to profit. It can be, here is the most probable outcome for this investment. And you should develop an investing thesis on the ideas that you decide not to invest in too, because the conclusion of that in that analysis process should be some sort of a thesis. And that thesis should be, this is the most probable outcome for this investment, right? So that in the case of Transocean, I think you're right broadly. I don't know that the thesis has been one that it should be able to deliver market beating results for years because of that reality. It's definitely in that the stock is cheap, but it's cheap for a reason, and it's not a good reason kind of bucket of stocks to put it in. Compared to its peers, it's certainly going to have the hardest path to profits, which takes me to the reason that I decided to use options in this case. What I chose to do is buy call options that expire in January of 2027. So I bought them a number of months ago. The idea is that potentially gets through multiple parts of an oil cycle, and potentially somewhere along the way, the oil cycle would be bullish. Oil prices would be moving up. And the stock at the time that I bought it was, call it $3.50 a share, round prices. So round numbers. So I bought $1 call options, which means that in January 2027, when that call option expires, I will have the right to buy Transocean shares for $1 each and lots of 100. Now, I'm looking at my brokerage screen right now, and I paid $2.82 for the right to buy the stock for $1, which means to profit, the stock has to be more than $3.82 a share. Right now, it trades for $3.27 a share. So right now, those options are losing money. They're about 21% underwater. If I wanted to sell those options to somebody else today, I would have to sell them for what would be the premium plus the current stock price or premium plus $1 would roughly equal the current stock price. There's time value in there too. I'm not going to bog anybody down with that, but I don't expect Transocean to be a market beating investment. But if it can get to $4 a share, $4.50 a share, this could be a profitable investment on this particular option trade. I went into it fully acknowledging that $2.82 a share that I paid could be worth nothing, right? I could see the vast majority of that as a loss. Even if I get to a position to execute and buy those shares for $1, if the stock's trading for $2.50, I will have lost about half of my investment to make it. So even if I exercise the trade and then turn around and sell the stock at the current market value, it's still a losing investment. So even when there's ways to make money, there's always more ways to lose money, right, Tyler?
Yeah, I mean, that's adding the extra layer of complexity to that. So Jason, I feel like we're in Godfather Part 3. We keep trying to get out, but they keep pulling us back in because Sanjar asked about construction. And I know that you and I love talking about construction and home building. And I'm sure that people who are frequent listeners are now, having playing their bingo card or drinking game about us talking about housing and construction. Because Sanjar asked 2 hours ago, thoughts for someone just beginning to explore investing in stocks in the construction sector.
Yeah.
So
I was on
begin, or do you?
I was on. So I was on with Lou Whiteman when this question came in, and I was thinking, this is going to be a fun one to answer in a couple of hours.
You left it for me.
Well, we had a lot of other questions we were engaged in talking. We spent most of the hour talking about money and CDs and money markets, and a little bit talking about stocks. So we just ran out of time. But I do remember thinking this is going to be a fun one to talk about later in the day if we don't get to it. So I want to say one thing first about this particular industry before I hand it over to you. And that one thing is the most important thing to learn if you're looking at investing in the construction industry is it's time to learn about cyclical businesses. Understand that, get that deep in your investor bones. And that is the first step to avoiding losses and finding ways to generate return.
And a continuation of the learning how to invest in cyclical stocks, as somebody who's invested in a lot of cyclicals, it's like the lessons you get when you first learn to box. You have to learn to take a punch.
Yeah.
Because cyclical industries are going to punch back at you hard.
Right. The losses compound in the near term, and developing thick enough investor skin to take that punch, to not see those downturns as reasons to sell, but reasons to hold and opportunities to add, right? That's the key.
Yeah. And that's what I was hinting at here, is that you are in cyclical industries, you are going to go through periods of, 52-week high, 52-week low, all within a couple of, sometimes with a year of each other. Sometimes you're going to, see a 40-50% draw while the rest of the market is absolutely ripping and just it's kind of sitting around what the heck happened here? It's, it's like getting hit with a haymaker and trying to figure out what's going on here. But one of the things that I have found is cyclical industries can be incredibly, incredibly valuable when you can invest in them when they are the least popular thing.
Yeah.
When everybody is running for the exits and giving up and saying, this is the dumbest investment I've ever made. Why did I ever invest in copper or construction or oil and gas or, name your semiconductors? It is a cyclical industry. As much as everybody has been riding this mega growth trend, it is going to go through a cyclical downturn eventually. Yeah. I don't know when, but it will.
Right.
Solar panels is a notoriously cyclical industry that people, kind of think is a growth industry.
Banking.
And insurance. We could go on and on about things that are cyclical industries, and construction kind of falls into that realm.
And it falls into the realm that's most important to understand, because these are cyclical businesses often that have pretty thin margins and also have large capital requirements, right? It's like the holy trinity of things that can absolutely destroy value, but also when you have really good operators with really good businesses, can be enormously, enormously value creative.
Construction as a business has a lot of fixed costs.
Right.
They're going to have excavators and all this moving equipment that they have to have at any given moment, and they're typically going to keep their contractors or their employees on the books.
because when the salad days come, they don't want to keep hiring, firing on all that stuff. For a lot of those things, they need to keep a certain amount of capacity, especially when you start getting into like the more specialized things like electricians and plumbers and things like that, like trying to rehire and fire all those people is a pain in the butt. So you have that like high fixed cost. And so during bad times, you can have incredibly thin to negative margins. But when the costs are fixed and you're in those salad days, all of a sudden something that's like a 1 to 2% net income margin company all of a sudden becomes a 12% net income company. And all of a sudden its earnings 10x in like 2 years. And that's kind of the beauty of cyclical industries, is if you can like identify like when these businesses are doing tragically awful and be like, it's going to get better, because most cyclicals like construction are related to things like shelter, which everybody needs in some way. It's a business that I think can do incredibly well. There's a lot of secular long-term trends when it comes to construction that I think are always favorable. Look, like we have an incredibly old housing stock in America. We have to keep building because we have a growing population. We're seeing a lot of nearshoring trends that kind of suggest that there is a multi-year good run for construction. How long that lasts, it can come to a screeching halt pretty soon, but based on current trends, it looks like it's going to stick around for a while. And so I think in terms of construction, yeah, it looks good and you could have a few more years, but don't go into these businesses like I'm going to put all of my money into it now and then, sit on it for the rest of my life. These are kind of like add slowly. Dollar cost averaging. I don't know. It's more like a pick your spots sort of industry. I know that maybe not be the best advice, especially for somebody getting started. But it's definitely the most important lessons I've learned over the 10, 15 years of doing this. Yeah, I think that's right. And again, I want to say this too. This probably sounds a lot like trying to time the market. And to a certain extent, maybe that's fair. But the difference here is Tyler and I, neither one, I know I can speak for both of us on this. We're not talking about trying to buy the bottom and sell the top. What we're talking about is directionally understand where in the stage of the cycle these different industries may be, directionally, and to invest and act accordingly when it comes to adding that risk. Maybe at times thinking about trimming a position, reducing a little bit of exposure, but more around finding good long-term, good opportunities to buy or add to companies that have those secular tailwinds behind them. But from cyclical perspectives, the market has turned very disfavorably on those businesses. We could look in companies that are directly or tangentially exposed to construction. You could look at steel makers like Nucor Corporation as an example. Nucor makes a lot of steel that goes into infrastructure, some into the auto industry, but a lot of it's used in construction. So that's an end market that's important to a company like Nucor. So what you can say is thinking about getting exposure to that, the modernization of the U.S. infrastructure, expansion in the Southeast, the Sun Belt, where we have lots of people moving and businesses are building. The most opportune time to buy a Nucor is when demand gets weak for steel overall, and the trend is pretty obvious that demand has weakened. And what happens? The stock price will fall. Like you were saying, the earnings are going to get cut. And at some point, the stock's going to be down a pretty good bit, but it's going to look expensive because their earnings are down. The cash flows have come down, because as much as a Nucor has big advantages over a lot of steel makers with its operations that are more variable, it's still a big capital intensive business that has high fixed costs compared to, say, a real estate brokerage, right? Where they have some office locations and then they have a bunch of employees and contractors that essentially just make a living off of commissions, right? So their cost structure is extremely variable, versus a Nucor that they still have their plants and they still have the majority of their employees that they're that they're relying on and their basic infrastructure and their supply chain that they own and operate, but they have more variability in it, right? But anyway, their earnings might fall more than the stock does, even though the stock's down a lot. But you can find those opportunities to add or to open or to build out a position, knowing that eventually the cycle is going to turn. And you may buy these businesses at a price that 6 months later looks terrible because the cycle is still going through its protracted, inexorable periods where demand is weaker. But eventually that demand is going to recover and it's going to return. And when it does, you're going to look back in 2 or 3 or 5 or 10 years, and Nucor is going to be, the business is going to be the profits will have recovered, the cash flows will be very strong, and they'll be well up from that cyclical bottom, but they're also going to be above where they were from the prior peak, right? So that's the goal with these businesses, is what the best ones do is not only are they really good at what they do and they're good capital allocators, but they go into those downturns where their operations may be weak, but they have strong balance sheets. And what does that mean? When everybody else, Tyler, is just cutting every cost they can to keep the lights on, Nucor's opening up the checkbook and going shopping and buying distressed competitors that create value for Nucor, that they can bolt on and integrate and emerge a more profitable and stronger business.
You know, I feel like we had a discussion about how to find multi-baggers and how we didn't mention Nucor. I don't know. I feel like we might have been a little negligent.
It was a failure. I mean, but let's be honest. We were there's so many like that we could talk about. You know?
Oh, I know. We could go on for a long time.
So MCOR's one. Since we're talking about construction, let's talk about MCOR just for a moment. It's one that's getting a lot of attention right now because of AI.
Actually, you know what? I'm gonna pivot instead of doing MCOR, because we do MCOR a lot, and I'm sure we'll get MCOR questions on MCOR again. Besties did ask a question about a construction company, and I've spent a little bit more time reading up on it, so I can give a slightly more intelligent answer than I have previously. Because Besties asked, concrete pouring Sterling infrastructure, is it cyclical? Yep. Where are we in the cycle thesis for Sterling? So Sterling infrastructure, as mentioned, it is concrete pouring. They are the kind of the earthenworks.
More than that now, but that's their core original business. Yeah.
Site work, concrete pouring. They did a lot of like infrastructure related concrete work for like, especially like government contract work. So like roads, bridges, ports, things like that. They've moved into more commercial lines of, earthenworks, site development, things like that. So they've become one of the premier site development companies for home builders, because home builders don't typically do a lot of their own bulldozing and leveling grade and pouring slab foundations and things like that. So they've expanded there, and they call it their something or other, like infrastructure or something like that. It's a catchy name, but I forgot what it was. But basically,
I was looking over the company recently too, and that one kind of, I didn't love that. I didn't love it either. But you know what?
It's basically the same idea as we're going to take this earthenworks site prep, pouring foundations, kind of the early work to do for commercial buildings, warehouses, data centers, a lot of kind of reaching back into my civil engineering degree. I would say a little bit on the simpler side, simple pour slabs, maybe a single basement. We're not talking about 200-story buildings that have a 15-story basement with all the groundwork associated with that. So
it's infrastructure, and essentially what they're talking about is, you think about e-commerce, you think about AI with data centers and all that kind of stuff. It's the infrastructure that's tied to, it's like the modern infrastructure for logistics and telecommunications, data.
So to answer the questions, is it cyclical? Yes, it's cyclical. It's actually probably one of the more cyclical businesses in this industry, because there isn't a lot of repair, maintenance, and service related to pouring concrete and doing site prep. This is very much like a new construction related sort of business. It's diversified across multiple constructions types, but it is, all new construction
vast majority of new construction. Where are we in the cycle? We're in a pretty good part of the cycle. Commercial construction is at some of its highest rates in a long time. Not, we talk about AI data centers, we talk about logistics warehouses, as well as, new manufacturing lines for automotives, for semiconductors. These are a lot of I would call them simple slab kind of jobs that are more indicative of maybe not semiconductors, because there's a lot of vibration dampening built into the foundation and things like that. So a little bit more complex, probably a little bit more money, but again, not 100-story skyscraper type of slab or a nuclear power plant slab. Two very different things. These are all cycles. It's in a good cycle. Residential housing's been chugging along steadily, 1.3, 1.4 million new starts. Multifamily was good. It's down. But, there's enough touch points across different parts of the construction cycle that perhaps it might even itself out, because some will be doing really well, some others. So the thesis for them is basically they have been a consolidator in this industry. There aren't a lot of publicly traded concrete pouring slab site prep type of businesses. You get the home builders, you get large construction, diversified construction. You don't get this specific niche very much. So the thesis being
an example of a business where consolidation generally, if you're a good buyer and a good integrator, can make a lot of sense and can be really value accretive.
Yeah. Buying mom and pops, buying regional companies that are, can trade for penny on the dollars, and it's easy to integrate them because they don't have competing big bureaucratic systems that you have to tie together. It's their aunt was
they've got Joe in accounting, right? They've got
exactly.
Yeah. Right,
so
right.
Things like that, those can be very value creative. There's tons of multi-baggers out there that have that sort of position. So that's kind of the thesis is look, they're in a cyclical industry that has access to good capital because they're publicly traded and they can roll up a previously unrolled up business. I think the CEO that came in at the time the company was near bankruptcy has used that model really well in both bidding for contracts that are profitable and at the same time rolling up other businesses and then using this profitable contract model to very well. Here's the downside. If we were to go through an economic recession, or we were to go through some contraction in the construction cycle, this is going to be one of the businesses that gets hurt pretty hard. Because like I said, it's all new construction. There's not any repair. There's no maintenance. And there's a lot of overhead costs because it is site prep. Site prep requires a lot of heavy equipment. And they say in their 10K, we own all of our equipment. We don't go to United Rentals and lease bulldozers and excavators to do a job. We own our equipment. That's a lot of fixed cost. If you have to go down and you have low capacity utilization, that can really hurt margins. I don't know when that's going to happen. We could go 3, 4, 5 more years of construction boom in the United States, and everything could look hunky dory. But in the event of a severe contraction in the construction market, this is one of the businesses that I think could be one of the ones that struggles a little bit more. And that's been my knee-jerk reaction when I read through it. I could be wrong, but that's kind of where I've landed as I look at Sterling Infrastructure.
Then the key with these, though, if you look at them over the very longest term, so let's go back 25 plus years for all of them. The worst performer of a group that I'm going to give that are all infrastructure focused to some level, Quanta Services, MCore, and Sterling Infrastructure, the worst performer of those over the past 26 or 27 years has delivered 14% annualized returns. That's the worst performer of that group. So over very long periods of time, they can do well. The thing to remember is that the past quarter century, all three of these are perfect examples. There's a lot of selection bias here. These are the ones that not just survived, but figured out the business models to thrive, to do those bolt-on acquisitions, to expand geographically, to manage their balance sheet well. Can they deliver those same sorts of returns going forward? For example, Sterling's delivered over 19% CAGR. MCore's done incredibly well, over 17% CAGR, turning every dollar you invested over that period into $8 or $9, right? It's just incredible kinds of returns, or excuse me, $70 or $80. It's incredible returns that they've generated, but they're larger. They're at a much, much bigger scale right now. And as much as they can keep growing, right? We just saw MCOR bolt on a business that will probably add 6 or 7% EBITDA roughly to it. It's a pretty nice big bolt-on acquisition. That's far shy of 17% a year earnings per share growth that it takes to deliver those sorts of total returns, right? So the way you do it with these businesses, to Tyler's point, is to not fall in love with them at a place in the cycle where it's difficult to value them, right? It's to maybe take a starter position so you pay closer attention, with the reality that if we do go through a tough period in the cycle sooner rather than later, the downside is going to weigh on your returns. But to be countercyclical and to realize that when the stock is down a lot, if its entire peer group is also down, and the news on the TV is, new construction is coming to a halt, there's no spending, like all of the negative things that we see on the news around the economy and these sectors, be countercyclical and see that as what it is. And it's probably a buy signal for long-term investments in these businesses. That's in their current state, that's the best time to buy them, is when everybody else is afraid. Tyler? What's next here?
I have nothing else to add.
Thanks, Charlie.
Okay, I'll do this really quick. Kamal asks, would love to learn the nomadic part of Tyler. I've been in this apartment I've been in for 3.5 years, and it's the longest I've been in any single place since I left my parents' house for college. So 20 to 23 years since, and 3 years is the longest tenure I've had anywhere. Lived some life in various parts of sub-Saharan Africa. I'm currently in the Republic of Georgia, former part of the Soviet Union. Wife has a government job that involves us traveling quite a bit around the world, and so a little bit of a nomadic life. I'll just leave it at that. You know what? I feel like we need to ring the bell, because Jason, it's time to talk about BBB Foods again. Because you know what? That's what I love to do here. Ring the bell, baby. So besties, follow-up question 2. Can you speak more about TBBB? Have you been worried about valuation, and why not about this one? And this is a great, hey, why are you a hypocrite being such a value investor? And then you buy something that's got a valuation of 200 times for a price to earnings ratio. There are times to use certain tools, and I will admit that. And typically I will lean towards value, but every once in a while, if I do see a growth company that I like, I will throw valuation. I won't care as much about valuation. And this is a very, very young company.
Well, this is less about caring less about it, but using it more appropriately.
Yeah. I'm not too concerned about PE valuation for a couple of reasons. Number one, the growth component that I think is going to be robust enough that I'm not too concerned about it. And also, when it went public, the company had a lot of very high interest debt. And as a result, it had very depressed earnings. My part of the thesis on the very, very high valuation because of low earnings early was hey, if they refinance a lot of this debt, even at the current business, it's much more profitable. And, going to the public market, you can pay down some of that debt. And at the same time, you can issue corporate bonds that typically pay way lower interest than you can get from going from a business development company or a private credit company who charge 12 to 15% interest. And so, maybe you get a corporate credit rating, you can get 8-9%, which is way, way less. So refinance, pay down some debt. You can eliminate a lot of interest expenses and actually improve your profitability from day one on top of the growth component. And so that's part of the reason why I wasn't too concerned about valuation when I made the purchase at the time, because of that one-off, fix the earnings with that finance component. And then the growth story that I have covered many times here, double-digit sales growth for years, huge new store growth story that's available and seems quite replicable with a business that knows its customers, knows the demographic, and is gaining a lot of traction. So I think that's why I haven't been worried about valuation in the way that I normally would, where I freak out when a great company like Cintas has a PE of 50 and I go, how can anybody spend on it? It's like the Costco theory, right? It's like, it's a wonderful business. Who pays 60 times earnings for Costco?
Well, when you're buying Costco in 1994, right? And I think that, and if you can share the screen, Bart, looking at BBB Foods today, and I was hoping to keep my mouth shut because I'm looking to add to my position in BBB Foods, but
sucker.
we serve our viewers here, and I'm thinking long term. BBB Foods today is akin to buying a really high quality retailer 25 or 30 years sooner than you're looking at some of these other retailers right now. I think that's the important difference. So what I'm showing here, and this is exactly to your point, a lot of the things that we were looking at in terms of the pre-IPO evaluation were things that were operating results and financial results that were weighed on by the debt. What did they do? When they went public, they've already paid off a substantial amount of that debt. Now, what I expect will happen, Tyler, is they're going to lever up because they're going to use debt to fund growth. But because of the founder of this business and his financial and operating acumen, they're going to deliver per share value as they do it. They're not just going to build an empire. This is somebody that is deeply invested in the business, that is fairly aligned with common shareholders too, in terms of the risks and opportunities. I think we're going to see the balance sheet is going to go up. The debt's going to cost more to service, like you were saying, because now it's a publicly traded company and the debt markets are going to be more compelled to provide more accessible debt to it. But the use of leverage is going to be reasonable based on market conditions and opportunities to expand and grow earnings per share over the long term. That's what I think.
Now, we could be wrong.
Oh, yeah.
They could lever up and they could do a lot of like empire building stuff. And that is the downside and something that I will certainly be watching and being mindful of. If that's the path that they start going down, I will be willing to walk away.
But that's not going to be, if the downside from today is not because it trades for 271 times earnings. The downside today, if this fails, if this investment doesn't pan out, it's going to be because management doesn't execute on its strategy, or because what we see is the addressable market is not as big as our analysis says that it is, right? Not because you pay 271 times earnings. Chances are, if investors don't do well that own Costco today, it's probably because they're paying 50 times earnings, and the company's growth over the next few years is not high enough to offset what is almost certainly going to be a normalization of that price to earnings back to something that's more reasonable that we've seen over the majority of the past 15 years for the company, right? I think that's the reality, is that there's an execution risk and there's a valuation risk. The downside for BBB Foods is far more tied to if they don't execute.
Mm-hmm. So I'm gonna hit a double shot because we have 4 minutes left. So two questions at the same time, because Jeff M asked, do you buy sell cyclicals, i.e. market timing? And Bessie asked, talk about cyclicals and growth and stock returns over time span. Do you imply that you have to know when to buy and sell for such cyclicals? So I'm going to give what I have done with investing in cyclicals. I typically, unless I'm exiting a company because I don't necessarily believe in what they're doing anymore, I don't typically sell cyclicals. I am still in the accumulation of,
right.
Like, I still am contributing to retirement funds and brokerage funds and, putting more money to work. And so as a result of putting more money to work, I'm reticent to, sell stuff just to go buy something else. Right. So I will sit through the really bad times in in good cyclical businesses that I believe in, and I believe in management, I believe in the way they're incented, and I think they're doing a good job, I will continue to hold through the bad cycles. I probably won't add when things are doing great, because that's just
right.
like, hey, why start adding money when they're about to ring the bell before the cycle drops? But when the market starts to really hit the skids, that's when I want to start adding to those positions again. An
Right.
example of a cyclical one that I am really eyeing to add to my position right now, and I can't now because I'm going to say the name, for solar. Solar industry is hitting the skids really hard. They are going through a capital build cycle where they're adding new capacity. And so earnings, cash flow look a little depressed. Pricing's a little off, but management has done a spectacular job of keeping a clean balance sheet, investing when there is adequate growth ahead of them, like a large backlog of new stuff. They have, despite everyone saying like, oh, the technology they use is not as good, yada, 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 they have continued to improve. And they're some of the things that they're working on could be like game changing for the solar industry. So now is a time that despite how bad it looks for solar, I haven't sold a dime, and I am looking to add to my position.
Yeah, no, I mean, that's the key. And again, I want to say when we're talking about the market cycle of the industry, we're not talking about the cycle for the stock prices up and down. The stock prices do follow and sometimes lead the cycle for the market. The stock prices almost always peak before the market realizes that the cycle's already turned. But usually the cycle's already turned by the time the stocks do start to come down. And same as Tyler, I'm using this as an accumulation strategy right now. When we're talking large businesses in cyclical industries, right? Where valuation, paying and again, it's not just the PE multiple, but again, thinking about through the midpoint of the cycle, does this stock price based on the earnings power of this business through that healthy cycle, does it make sense, right? And accumulating. What I anticipate that I will do, I'm a little older than Tyler, I'm a little closer to retiring. What I will probably start doing.
They all know. They see your hair.
It's obvious. No, it's obvious. But no, my plan is that as I'm doing things like asset, you're managing not just position sizing, but managing asset allocation, cash and bonds. The closer I get to retirement and my son's time to pay for my son's education, the first stocks that I'll look at are mature cyclicals before I look to move more to cash or more into bonds. Those will be the first ones that I look at, thinking about where the cycle is and closing out those positions or reducing exposure to those positions, because those are the ones that can be the most painful when we do go through those cycles. And I never want to be caught in a position where I have to sell a cyclical stock because I need money. I always want to be in the position to be choosing when to allocate the assets across these different buckets. So again, it's not market timing, but it's understanding the cycles as you're accumulating and as you're approaching financial goals, having a plan of what to sell and when to sell it, which is maybe one of the hardest things that we all struggle at doing. So we're out of time, buddy.
Yeah, I think we hit it. Well, 1 minute over. That's not the worst.
That's okay. That's okay. I think Brian and Karl, you guys just talk a little faster. You can make up for time.
Hey, we can always do it. It's not a problem. Good to see you guys.
All right, see you fools.
Thanks, guys. Have a good one.
All right. Brian.
Hey.
We live in interesting times.
Yes. Woke up to news that FDA, a lot of staffers at the FDA are going to get cut, which it doesn't seem so good for the biotech industry. I guess it sort of depends on where the cuts actually come from. I heard some rumors that maybe they were more like redundant things that both the FDA and the CDC do, and so maybe the cuts would primarily become from there. I think it seems disingenuous to cut from from the staffers that are doing FDA reviews, because that's paid for primarily by Prescription Drug User Fee Act. So when drug companies submit their approval, their packet for approval, they also pay $1 million+ to get it to pay for it being reviewed.
Right.
So
Yeah.
it doesn't seem like they should be cutting those people who are getting paid by the indirectly by the pharmaceutical and biotech companies. It should be they're already getting paid. There's money there for those employees. So
yeah, I don't know if a lot of people know that, because it does, the first time you hear it, it sounds a little odd that you have a government agency that's taxpayer funded, but in fact, the companies that use the regulation are essentially paying for it themselves. That you paying for the reviews under the Prescription Drug User Fee Act, PDUFA.
I guess back, I don't know, before my time, because PDUFA has been around for a long time, but apparently it was taking years for the FDA to approve drugs. So basically the industry got together with their lawmakers and said, we're willing to pay more and fund the agency if you're willing to get these drugs out in a quicker fashion. And so that's where that PDUFA date comes from, is because there was an agreement that the FDA would try to get 90% of the drugs applications, make a decision on them, either positive or negative decision on them, by the time that they get by the PDUFA date. And the time for that has actually changed a little bit. It used to be 10 months, and now it's a year for the standard cycle. So
right, but I do remember back long enough where it was these days when they say it's a 10-month timeline for a decision. FDA is pretty good about hitting those dates, right? It's not 100%, but they generally, often are a little bit earlier and usually, at least hit the date. That used to not be true at all. They used to really let stuff drag out, and things got delayed. So, I haven't heard about exactly where those cuts were coming from. As you say, it wouldn't make any sense to cut the reviewers if you were worried about government waste. But hey, never say never. Not sure. All right. So while we get a few more questions kind of building up here, there's a couple of developments I know that from the last week or so that we wanted to talk about. One was you brought up, I thought was pretty interesting. Soleno. Do you want to just kind of mention that briefly?
Yeah, so they have a new drug that got approved, I guess, yesterday evening, for Prader-Willi syndrome. So this is a genetic disease, and the biggest issue with the patients is they never feel satisfied, and so they continue to eat because they just can't be satisfied with eating, and so that causes problems with their weight, and then obviously that causes other issues with the the obesity causes other issues with the drug. So this is a long-acting version of a drug that seems to affect the calcium channel or something. I couldn't quite figure out how that's causing you to not. It must be some sort of neuro thing that allows it to not.
Yeah, right. I looked at it super briefly, and now I've already forgotten because I also was not familiar. It's some sort of. They thought it
potassium.
Yeah, it was potassium channel, and it's they thought it was some kind of neurotransmitter change. I thought that was going on with it. I'm not sure exactly what the mechanism is, and I'm guessing that they don't know exactly the mechanism either. But yeah, it's a strange and really, really difficult disease because it shows up in kids typically.
Yeah, because it's genetic disease, right? So it's inherited.
Yeah. And so the main way that people deal with the disease is literally locking refrigerators, locking pantries, keeping cameras around, literally physically stopping people from eating, which, as you can imagine, leads to a lot of, there's a lot of also sort of frustration and behavioral problems that kind of go along with this. So anything that can relieve it. And this is one thing, by the way, that there has been a little bit of anecdotal evidence about whether GLP-1 drugs can help with this. And I think, from what I've heard, at least, it is a little, but this is not like GLP-1 drugs do not solve this. This is a genetic disorder. So, anything is really welcome. But I just wanted to ask you, because what do you think about when drugs like this, where it's basically an old drug, so there's no patent, there's no underlying patent on the molecule itself. There's no composition of matter patent because it's an old drug. What do you think about that? Do you consider that to be kind of like a higher risk launch and an investment?
Yeah, I mean, I think it's, I don't know exactly. It's an extended release version of that drug, right? So they must have some sort of patent on that. And then, of course, it's an orphan drug. So they get the exclusivity for the orphan indication, or, it's an orphan disease, and therefore they get exclusivity with as being an orphan drug. So that should help them a little bit. But yes, I think that's probably a consideration, that if you're going to invest in a company like this, that you have to feel a little bit more comfortable than I typically do with my, I'm not a patent lawyer. And so if I was going to invest in this, I would spend a lot of time looking at the patent issues and confirming when you thought that the generic was going to go on sale.
I mean, that said, it's an orphan disease, but it's not. They said something like 50,000 people in the U.S. I mean, that's not. There are orphan diseases that are a lot smaller than that. Certainly.
Yeah, and it seemed like maybe it's an underdiagnosed disease, right? So they had it's 1 in 15,000 live births, but then if you look at the claims record, it's only at about 12,000 patients. And then they think that of those 12,000, about 10,000 can actually they can use this drug because they don't have there's some comorbidities that exclude the use of this drug. And so they're looking for what they think there's 10,000 that don't have those comorbidities. So still a fairly large market, considering they're going to charge 200 and something thousand on average for each patient. So
yeah, I think they. Yeah, I mean, I thought it was like over 400,000.
400,000.
Yeah, I mean, it's a lot. It's really expensive, and it's charged because the dosing, I guess, is very exact. So it's you get a different dose depending on your weight, and so you get charged by weight, which I don't know. I worry that insurance companies could have a field day with that one.
Yeah, although 60% of the patients are either on Medicare or Medicaid, so. Yeah. That maybe helps a little bit in terms of getting it paid for.
That's interesting with Medicare. I mean, Medicare, because typically that's another thing about this disease. Typically, people don't live all that long. I mean, it's debilitating. I mean, people can literally kill themselves by not just from weight complications, but literally from the bursting their esophagus or something like that. But Medicare, you can be enrolled in Medicare. As a young person, if you have end-stage kidney disease. I wonder if that's the relationship.
Yeah, maybe.
I don't know. But the only other thing I just wanted to mention about them that I just thought was really interesting was how they did the trial. Like you would have thought that the endpoints for the trial would be weight stabilization or weight loss, but it's not, because it's hard to tell because these are kids and they're growing. And so actually what the endpoints of the study were questionnaire answers, not by the patients, but by their caregivers. So it was the caregivers basically reporting on changes in sort of food anxiety and food seeking behavior and things like that. Which it's an interesting study, but it's anyway.
And then they did a withdrawal study too, right? So they gave everybody they gave everyone the drug, saw that it worked. If it worked with the patients, then they switched half of them to placebo and half not, or whatever the ratio was. And then they looked at asked the patients caregivers whether they saw changes from it working. So that can be a good strategy when it's patient reported outcomes, or in this case caregiver reported outcomes. That can be a good strategy for making sure that less likely to get a placebo effect.
Right. Yeah, it's a legit study design. It's just interesting. But anyway, company thinks that they can have sales topping $2 billion a year on this. So this is a very significant product. And the ticker of the company is SLNO, since we've been talking about it. Do you want to, so now, do you want to, I know we had another just kind of few things that we wanted to maybe talk about that's going on in the news, but do you want to like do a question and then get back to some of that?
Yeah, we can do that. Why don't we do that?
Okay, that sounds great.
Let it ride 13 minutes ago. First question on the actually popped it in before we even actually got on. They said great Pfizer ticker is PFE, great valuation, dividend, lots of drugs in the pipeline, lots of cash. Why aren't more people pounding the table on this one? So what's the bear side of Pfizer? I think is one, it's got a patent cliff coming where they have loss of exclusivity for about four major blockbuster drugs, and so that's one of the reasons why the valuation is as what it is right now. I mean, yes, they've got pipeline drugs to make up for some of that, but it's gonna put a negative pressure on the year-over-year sales for the next couple of years, starting in 2026. And then the other thing is while they have a lot of cash, they also have a lot of debt. It's presumably low interest rate, but who knows when it's gonna. You have to look and see when it's gonna get. It's going to come due, and whether they're obviously going to be able to refinance it. It's not like they're not like they're going to go bankrupt because they can't pay their bills. They'll just refinance it, but it may be refinanced at a higher interest rate, which could potentially cause problems. So I remember they've taken on a lot of the debt was like 10-year debt, and it was fairly recently. Especially they took on extra debt when they acquired Seagen, and that closed at the end of 2023. That was just over a year ago. So they would have obviously quite a bit of time left on that debt that they took on.
Yeah. And yeah, they do have a great dividend. And I think that's certainly one compelling reason for them. And I do think I think it's a sensible, if you're trying to just diversify a broad portfolio, and I'm not talking just about healthcare stocks right now, but if you want some healthcare in there and you want some sort of large cap value in there, I do think Pfizer makes some sense as a nice dividend player at a reasonable valuation, where you're likely to see the dividend grow, and you're likely to see I think some stock appreciation on top of that. So I think that looks decent. I'll give another, couple of knocks on them just to explain maybe why they are where they are. I mean, I think also in addition to the patent cliff, they do have a lot of pipeline stuff, but I do think there's a lot of doubts about danuglipron, which is their kind of lead asset for obesity. They seem to be talking very confidently about it, but the data we've seen so far doesn't, to me, inspire that confidence that they seem to have. Obviously, they see a lot more than I do, so there might be good reasons for that. But from what we've seen so far, I'm not totally convinced that that's a major player for them, even though that's something they seem to be counting on to some extent. And I will also just say that there's a lot of pharma is cheap right now. I mean, pharma has just had a tough go of it. So Pfizer is cheap, but so are a lot of companies in this space. Let's see. So Luella's asking about ClearPoint Neuro. We've talked about them before. It's not a company I'm super familiar with, but do you have anything on ClearPoint?
Yeah, this is the one that they're doing a lot of delivery of gene therapies, right, to the brain and the neurostem. Is that correct? That's the sort of their main bread and butter, and the most of the drugs that they've been testing it on aren't actually approved yet, and so they can't get revenue from the company. I mean, they can't get revenue from the they're getting revenue from the delivery for clinical trials, but they can't get delivery approved. They can't get there's only like one that's approved, right? So there's a limited market until they do it. Yeah, so they have 60 partners in the biologics and drug delivery space. So obviously plenty of potential in the future, but right now their revenue is, if I remember correctly, is very, very small because there's only like one drug that's actually of those 60 partnerships that has actually been approved. And so they do, I think, so they do, it looks like they've done 7,000 procedures, but presumably most of those are in clinical trials, not in, and then I think they may also do a little bit in like stimulation or something, like they can use a catheter. They put a catheter up there and like stimulate or remove parts of your stem cell that may be your brain or spinal cord that are causing you problems. So I think there's some opportunity right now for that, which doesn't require any drug approval because it's literally just a medical procedure. But the main thing is they got to get these approvals, and they don't have any control over that. Their partners are responsible for getting the approvals, and then once their partners get approved, then they would presumably be training more doctors and getting more patients that would be using their delivery system.
Yeah. And I will say, I probably another factor that's weighing on the company somewhat, and they're not doing terribly by any means, but there is this kind of gene therapy nuclear winter out there right now where, commercial drugs that have been approved are not doing terribly well, and just a lot of investment has dried up. I mean, both from, I think, gene therapy companies that are committed to it are, trying to get along as best they can, but a lot of the partners they'd be looking to are less interested. A lot of the capital that you might seek early on is less interested, and hopefully that turns around. But right now, it's if it's a cycle, it's definitely in a very negative part of the cycle, and so I think that weighs on them. That said, I mean, ClearPoint itself, it's they've seen decent. Obviously, they're losing money, and I don't think they're anywhere near turning a profit, but they are seeing decent revenue growth. The thing I would look for is just their cash level, which is they've got like $20 million. Let's see, what was their burn last year? Sorry, bear with me for just a moment. So in 2024 they had negative cash flow from operations of about 9 million. So it's not like crazy burn, but also if you only have 20 million and you're more than 2 years from profitability, that raises a little bit of a concern. I think they would probably be able to finance and keep that going, but that's something to definitely look out for.
Yeah.
Let's see. Ed is asking, actually, I was going to ask, Ed has two questions, and I was going to ask the first one, but I'm going to do the second one because I just feel like talking about it right now. What is a better stock for the long term, BridgeBio or Genmab? I kind of want to talk about Genmab because this company is getting to be like stupid priced. I think it's been really beaten up, and talk about. I mean, what are they trading at? So this is a Danish company. It's an antibody specialist, and they have something like 8 products on the market that their technology is in. They started out, basically as a sort of antibody engineering house for partners. So a lot of their stuff carries royalties. And if and as is kind of typical, the further back you go, kind of the smaller royalties they're getting, and they make most of their money from a drug for multiple myeloma called Darzalex, which is sold by J&J Janssen, which I think is raised in another one of Ed's questions. that is a massive blockbuster drug. So the fact that Genmab only gets a royalty on it, it still amounts to a lot of money for them. But the company has, because they have such sort of broad antibody engineering capabilities, they have, broadened out their partnerships, and they've kind of moved over time into more like, hey, let's not just get royalties, let's do joint ventures. Hey, let's maybe not just do joint ventures, let's actually own some of these outright. And so they've gotten more. They have a partnership with Seagen, now Pfizer, on a drug called Tivdak, which I think it's for cervical cancer, right? Second line cervical cancer, I think. That I think, that could reach sort of 1.5 billion-ish in peak sales, maybe over the next 5 or 6 years. That's a 50-50 partnership, so that's really meaningful to them. They have a drug called Epkinly that I think is poised to do really, really well. That's partnered with AbbVie. And they're just exploring there's a ton of studies going on that with various indications. It's a CD3/CD20
bispecific.
And yeah, sorry, losing my mind. So there's a lot of potential. That's kind of a broadly applicable. There's CD20 is used on a number of different cancers, and so the idea that you're combining that with a CD3 could be, somewhat broadly applicable. And then they're trying to move forward more stuff that they own internally. Now, moving forward stuff that you just own internally is an expensive proposition, because all of a sudden your company starts to look different as you have more responsibility for manufacturing and for sales forces and stuff like that. So it's, you have to kind of get through that transition. And the other, I think the other real negative weighing on Genmab right now is that eventually Darzalex will face biosimilar competition. Ironically, the way, and I haven't looked at this, I hope I'm getting this right, because this is what I remember. Legally, it looks like even though J&J has exclusivity out to 2035, they don't have to keep paying Genmab the royalty past the expiration of the original composition of matter patents that are going to happen in like 2029 in the US. So in other words, while that's still a little ways out, that's closer on the horizon for Genmab, that they're going to lose this big chunk of their revenue. They have to get through that as well. Nevertheless, they've got a lot going on, a lot of lot stage stuff. I really like the company. I think it's trading at a very low PE multiple right now. I mean, they are profitable. They're quite profitable. So it's I think it's a great value here. I also really like BridgeBio. So, BridgeBio is obviously they have, they've launched Attruby. Every report I've heard so far keeps being sort of an upsized surprise in terms of how many people they've gotten on the drug. I think they've come up with their pricing strategy, I think, makes sense. I know some analysts were upset about it when they priced low, but I mean, they've priced cheaper than tafamidis, and they're way cheaper than Alnylam's Amvuttra. They're like almost half the price, I think, of Amvuttra on an annualized basis. And I think they're just getting a lot of people, part of the reason why almost everybody's been a winner in this market. I mean, Alnylam got approved and they went way up, but BridgeBio went up the same day. This is not at this point looking like a zero-sum game, because there's still just there's a lot of underdiagnosis of this disease. So there's a lot of opportunity. And I think BridgeBio is doing the right thing, grabbing as many patients as they can, as fast as they can, especially since there's an issue where it's possible that tafamidis is generic in 2028. And then once it's generic, all of a sudden the price might become compelling for people to move to a generic over using an expensive prescription drug. That said, BridgeBio's got bunch of other stuff going on, late stage stuff that I think also makes that company a compelling value. So I'd say, to me, BridgeBio probably has the more likely to have momentum behind it. I mean, the tape on Genmab looks terrible right now. But I mean, in terms of kind of safety, maybe Genmab's a little safer. I don't know. Any thoughts on either of those?
Yeah, no, I was just looking up the guidance for Genmab, and it's the 2024, they grew overall revenue 31%. Royalties was a 27% growth. Product sales and collaboration revenue was up 200%, from the launch of the I guess that's from Tivdak. And then they had milestone and reimbursement revenue that was down 2%. And then in 2025, they're going to go from 31% growth in 2024, only down to only 12% growth, year-over-year growth in 2025, with royalties, both royalties and the collaboration revenue dropping, from royalties from a 27% growth down to a 15% growth expected, and then net product sales and collaboration revenue from that 200% growth down to 39%, but it's a smaller percentage of the overalls compared to the revenue. So that results in the growth of the overall growth being at just 12%.
Mm-hmm.
So I don't know. I mean, maybe it is okay. I mean, so it's price to sales ratio is 4.1 and the PE is 11.5. So, I think that's probably okay valuation, but I don't know if it's super cheap. If, I guess it sort of depends on what you think 2026 and 2027 will look like.
Yeah, I think, yeah, well, I think just for comparison's sake, we were just talking about Pfizer, which I think has a PE of like 17 or 18. So this is even more pessimistically priced than that. But
right.
I do think, well, so what? Okay, so one thing I forgot to mention that I was going to mention with this, part of the reason that Genmab is on my mind is they just had new data on Rybrevant, which is another partnered molecule, which significantly, and this data is going to be presented this week, just significantly outperformed Tagrisso in first-line non-small cell lung cancer. So they're going to be doing a submission on Rybrevant for first-line non-small cell lung cancer, which again, I mean, this is another one where, yeah, this is an older partnership. They're only getting a royalty on it again, but this is another one where it's like this could be peaking out at like $4 or $5 billion in sales. So it becomes, again, quite significant for them. So yeah, I'm expecting actually growth to pick up again after this year. But yeah, this is not, I mean, nothing's without risk. I think it's pretty reasonably valued here.
Yeah, and apparently so does the board, because they just issued a stock buyback program to repurchase 2.2 million shares with an aggregate value of 4 billion Danish kur, which I'm trying to figure out exactly how much US dollars that is, and my Google is not telling me it very quickly. There we go. That's $580 million.
Okay.
So
okay.
US dollars. So approximately.
All right. Well, that does check one thing off my list, because I just wanted to mention I thought the Rybrevant news was interesting, and I wanted to bring that up anyway, whether somebody asked about Genmab or not. Let's see. Do you know anything about Natera?
No.
Okay. Maybe I can take a look at that and get back to that in a minute. Let's see. Well, the other question from Ed that I was going to talk about a little bit was, is Intuitive Surgical, Vertex Pharmaceuticals, and J&J keepers for a very long time? We talked a little bit. I think you and I, Brian, are on the same page about Intuitive Surgical, or pretty close to the same page. We talked about them a little before. which is both that I was pretty open about saying I thought Intuitive Surgical was overpriced a little while ago. I mean, I mean, with the caveat that I think it's an excellent company, that almost never messes anything up, but it was just really hard to justify their price based on any reasonable projection of how they were going to grow their cash flow. Which is not to say that meant the stock would necessarily go down. Lots of companies kind of, defy gravity for very long periods of time, especially when they keep executing and keep being excellent. And that's something that Intuitive Surgical generally does. Since then, the stock's come down quite a bit. So this is a case where, you can buy excellence for cheaper than you could recently. It's at $508 a share right now. It was at its peak of $616 a share just back in January. So that's a pretty recent, pretty sharp drop. That said, it's definitely still really, really expensive. I just
P 79 and the price of sales is 22. So.
Right.
Especially that PE is pretty high compared to historical averages. Sometimes it drops down substantially lower than that.
Yeah. So if you want to own it, and it's certainly been a great company to own, and like I said, I don't see any red flags in the business at all. I just wouldn't back up and buy it all at once in a huge tranche. It'd be one that I'd feel comfortable adding to. Certainly, if it dips down with the market overall, that to me I would look at that as an opportunity rather than a concern about the company itself, unless something happens. It does have some nice. I do think it has some decent drivers. I think the Da Vinci 5 is really at the very beginning of its rollout, and I think although that's actually going to hurt their margin somewhat initially, because it's just a more expensive, until they get some of their efficiency in manufacturing that system, it does actually hurt their margins a little bit, but it puts them further ahead of competition, and it's a great opportunity for them to get more data that can help them further improve things. And I think they've got, the Ion catheter lung biopsy platform, I think has got a good deal of promise to it. So it's a great company, kind of expensive, really expensive. If you want to be an owner, do it with a long-term mindset and move in slowly.
A decade ago, I said it was really expensive. I didn't buy it for a decade until 2020, and then I bought my first shares, and I would have been much better off if I had bought in 2015 versus 2020. Even though I got shares on sale during the pandemic, and finally moved in. But if I just ignored the valuation and bought some, I would be better off than having just bought 5 years ago.
Yeah, well, good for you getting it then. Do you want to start in on either J&J or Vertex?
I mean, I think Vertex is also looks a little expensive to me. I own shares and I'm not going to sell them, but at price to sales ratio of 11.5, it certainly has dropped down into the nines before, so that offers a little bit of potential downside if sales of the newest pain drug don't come to fruition, and the PE is at 30.42, which is, I guess, okay, but not I would it's certainly been in the low 20s before. So I think it's really whether it's overpriced or underpriced right now is going to be determined by whether it ends up doing really well on its new non-opioid pain drug. If that launch goes really well, then it's probably undervalued right now. And if it doesn't go so great, and it's there's a couple hundred $200 million in sales this year, then I think that would probably result in it in the shares trading sideways or potentially even down.
Yeah, and they've they've got a lot of other interesting, somewhat longer stage stuff going on in kidney. I mean, they invested $5 billion in Alpine to advance some stuff. The BRAF April drug. Yeah, I mean, I agree. I think, I mean, their valuation looks less stretched to me than Intuitive Surgical does.
Yeah, I agree.
And again, I mean, it's an excellent company. Their cystic fibrosis franchise looks incredibly safe for a long period of time. And so, yeah, I guess I'd be a little less. I mean, that would be another one where I would look at significant dips as being a good opportunity for that company.
Right. Yeah. I mean, I don't know. It's been on a tear since they got the approval, right? I mean, it was at 400,
right,
when they got the approval, and now it's at 503. So that's a 20% plus increase in valuation. So I don't know that I'm really excited about it at this valuation, but I'm excited because my portfolio looks a lot better. But
yeah,
but I'm not interested in adding right now. I mean, it's a large position. I think it may be my largest position, mostly because it's just done well, not because I've bought a whole lot of it. And so, I think I would be inclined. I mean, I'm not inclined to add to it, mostly because partially a lot because of the valuation, but also because it's a large position for me.
Yeah. They don't report until mid-May, so that's probably when we're going to hear a lot more about how the Journavex launch is going. And then J&J, another sort of big pharma stock, or really, I mean, they're a pretty diversified company, but obviously a significant pharma component to it. $390 billion company. Very, it's a slow grower. I guess, what is their dividend yield right now? Let's see. A little over a 3% dividend yield, which is decent. And, I think that dividend is going to be rock solid. I guess probably not my favorite company in the space, but I don't think it's a bad company. I don't know. You have any further thoughts on J&J?
No, I mean, I once wrote an article that looked at all the peaks and valleys of and then figured out the returns based on if you bought at the top, and you bought at the bottom of these peaks and valleys, and it beat the S&P 500 for basically all of them except for maybe the most recent one, the most recent high. It hadn't beat the S&P 500 for that one. I did that article quite a while ago, and that was actually before they spun off the consumer health division. So I don't know, the consumer health division, you could imagine, would probably smooth things out. So maybe that would make it more likely that, that there'd be less there's more volatility now than there was back then. But also presumably it's growing faster without the consumer health division. And so that should potentially help it grow, faster than the market. So I don't know. I mean, I think of the valuation of the three, the valuation looks the best there, but it's also going to be the slowest growing of the three. So, I mean, I think that there's a lot of reason that you would want to own Johnson & Johnson in your portfolio to, as a stabilizing factor. But it's not going to be grow as fast as biotechs or medical device companies that are growing, substantially.
Well, it's interesting. I don't have a sophisticated chart open here, but I just pulled it up. I mean, J&J has badly underperformed the S&P 500 over the last 5 years, but that underperformance really took off in kind of mid 2022, right? Where you saw, and that kind of corresponds with, we had a big peak in the NASDAQ back in and in biotech in particular back in 2021, and then everything started going down, and then tech and everything else started kind of recovering healthcare really didn't, and that's where you see this big divergence. And so even though Johnson & Johnson has been positive, it's really lagged the S&P 500 in that period. Yeah, it's interesting. Although, you pull back, if you're a lifetime owner of Johnson & Johnson, you've done much better. so what you're saying, it's as a really long-term investment, it's been great. And again, to me, that's an argument for it's not an argument that pharma stocks, just kind of large pharma, safer kind of dividend paying stocks are about to start outperforming. I mean, there's nothing about the cycle right now, but I mean, I do think it's a little bit of an argument that stuff is pretty cheap right now compared to the rest of the market. If you're just looking for a way to diversify out a portfolio, that's not a timing comment. I mean, that could continue to languish for a while, but I mean that these companies are, I think attractively valued compared to a lot of other stuff and paying dividends as well. Let's see. What else do we have here?
Yeah, so Natera is a cell-free DNA testing company. So they're developing, these non-invasive tests that are blood tests looking at cell-free DNA, mostly in oncology, although there's some organ health and women's health portions to it. I don't have a huge. I actually have looked at this company probably because where's the in need of input, I think, has asked about this company before, so I have looked at it in the past. I think that the main thing is just I don't have a good feeling for the potential of these. There's a lot of competition, and so I don't have a good feeling for how much of the market can Natera take over other companies that are also developing these cell-free DNA testing, assays, and then, whether they will be, is there going to be a one standard that everybody takes, or is it going to be multiple different tests for different diseases because you can't get one test to be able to identify every potential cancer? And so I think there's a lot of questions especially in the cancer realm on who's going to potentially be the winner here, or is there going to be multiple winners? And so I've sort of stayed out of the space and not invested in it and not spent a whole lot of time doing much, investigation, just because there's so many different products, and I'm not sure how, you can compare them on sensitivity and that sort of thing, but it becomes complicated because you're looking for something that's in the future. And so, how do you figure out whether they're missing cancers? You have to wait a certain amount of time before you can, you have to do the test and then wait obviously if you get a positive test, you can go and do a CT scan or whatever and try to see if you can find the cancer, and you may or may not be able to find the cancer, and it may or may not, even if you don't find it, that doesn't necessarily mean it doesn't exist. But if you get a negative test, now you have to actually follow these patients for a certain amount of time before you can conclude that negative test was correct, right? And so I think that's the big question that I have for these, or multiple questions that I have for these cell-free DNA testing companies.
I just want to say, I want to remember there was an earlier question from somebody who, I don't know if they're still on or not, but it was about several companies, and one of them was Viking Therapeutics. So I do want to get to them before we have to go. But Teddy asked about 10 minutes ago, he said, can one of you guys take a quick look at Tempest AI? Seems compelling, but I'm a novice at best. I want to be perfectly frank, I have never heard of this company, and I literally am just looking at it right now. So take everything I'm saying with a grain of salt. They are, so this idea is that they're supposed to use AI in order to advance precision medicine. I guess what I would want to look at with this company, and like I say, I really don't know anything about them, but I mean, just glancing at their website, I mean, it looks like a data company. I'm not exactly clear how they're leveraging AI, specifically, as opposed to just like offering up sort of basic data insights in a system that you record. But I could be totally missing something. So it's I think AI is it's going to be interesting to see. Obviously, it's going to have a big impact on healthcare, the way it's going to have a big impact on everything. It's interesting to see where it's going to find its biggest successes first. And so this is what I'll take a closer look at it. And if you're interested, next time that we're on, which should be Monday, ask again, and I'll hopefully have something more to say about it. But I don't know. Do you have anything, Brian?
No, I was just looking. Yeah, it does seem like it's more of a data company, and their customers would then be biotech companies. That does seem to be the what they're doing there. Is they have a they're using AI to better design clinical trials, and using AI to improve biomarker use of biomarkers to get readouts in trying to figure out whether your drug is working or not, and then even using AI for clinical trial execution, which would be, I guess, basically like trying to figure out how to find patients and that sort of thing. So, but I don't know. It's a $9 billion company, so
I was just looking at that like, wow.
I would definitely want to understand what the heck this, what the heck they're are they providing that much benefit to life science companies in order to be able to do that?
I mean, that said, it's they've seen, well, not, I was going to say accelerating revenue growth, but it's not exactly accelerating. It's been kind of uneven, but I mean, certainly projections are for pretty strong growth this year to like $1.2 billion in revenue. So that's pretty decent. And at least what looks like a shrinking loss. So it's interesting. I don't know. I'd like to take a look at it. And yeah, I don't think there's any more value in me just kind of guessing away at it right now. So let me, there's a question about Fractal Health, but let me get to Vertex Pharma, or I'm sorry, to Viking Therapeutics. It was a question, it's from several hours ago, it was from Butterfly, and they were interested in a couple of other ones. But Viking, I just wanted to give the sort of no update on them, just because the stock has obviously been, very volatile, mostly to the downside. There's probably no reason it's not going to continue to be fairly volatile. But I mean, the only sort of update with them is really just that they, I think just today, and finished enrolling their phase 2 study for their oral drug. And their oral drug is going to be a lot of what moves things, because I think that's where people see a strong differentiation for them, is just that based on very early data, their oral drug looked very effective, and probably more importantly than that, looked like it had a really favorable side effect profile. But, early enough that it's hard to say that with any confidence. That could turn out to be wrong. So we are, I think, on track to hear that data later in the year, and that will be a very important event for them. The only other thing I just want to say about Viking is, and actually ask you what you think, Brian, because I'm curious. I don't think we've talked about this, but they do have another program, another late stage program in what used to be called NASH, non-alcoholic steatohepatitis. Now it's called MASH. But this is a disease that, I mean, by itself was considered to be this massive, tens of billions of dollars addressable market opportunity. I think it's a disease that's somewhat helped by GLP-1 drugs, and therefore, as an independent indication, I think that projections on it have gone down somewhat, but not. I mean, it's still not a disease that's just addressed by GLP-1 drugs. There's still space for addressing it directly. And Viking's VK2809 has had some of the better data out there right now. And I guess why I wanted to ask you, Brian, in addition to what you think about that, is they have openly said, like, hey, we have this data, this is available for license, right? And they also have actually another drug for adrenoleukoencephalopathy, if I said that right, that is also available for license. This is not how they've talked about their main obesity asset. And I just wonder, everybody, part of the reason that Viking's been so volatile is because everybody wants it to be acquired. And they seem to keep making it clear, either they're driving a really, really hard bargain, or, they're actually going to try to go it alone on obesity. But obviously they're not trying to go it alone on these drugs. I don't know what kind of bargain they're driving, but I mean, it's possible if, anybody wants to acquire the company outright, as opposed to just acquiring the obesity assets, are going to have to pay, I'm imagining Viking would want quite a bit for 2809, because it's been a pretty successful program and it has a good deal of potential. So that, that may be another reason why acquisition talks have perhaps been complicated. I mean, that's speculation. We don't know what's going on behind the scenes, but I don't know. Any thoughts about that?
Yeah, I mean, I don't know. I kind of just assumed that they were trying to sell those off or license them out so that they could have, they would have be a cleaner balance sheet in terms of what exactly you're paying for,
right?
And that they potentially they'd have more cash so the valuation, for the pharmaceutical company, they would get the cash that's involved in the deal of selling that off, and they would not get that asset. But presumably, somebody going after the obesity drug doesn't necessarily want the MASH asset, and so the advantage there is that now you've got a clean balance sheet where you have lots of cash and have the ability to, and then you're only buying that one asset, and so maybe that would help.
Yeah. And I don't know, but they haven't reached a deal on 2809. So I don't know if you can read through to say if that tells you anything about either about maybe the data isn't as good as we think it is, or how they are as negotiators and what they're looking for. I don't really know.
So that oral drug is only a 28-day study. So
yes, exactly.
I don't know, so that's kind of crazy. I'm sorry. The phase 1 was a 28-day study. Sorry, I misread that. I don't know what the phase.
Oh, the current one. I think it's a 13-week.
Oh yeah, sorry. Yeah, sorry. Yeah, 13-week. You're right. Found it. Okay. So that's so that's like three months. So a little over 3 months, right? So not, so should have enough data from that to see substantial weight loss, but not, won't be that 20% that Zepbound has shown.
Let's see. There's a question here. I'm just going to go ahead and from Fergal Donnellan asking, any thoughts on fractal health? I'm going to guess that you do not have any, but maybe you do. I don't know. The reason I'm going to say that is because this is like a $48 million company. The ticker is GUTS. Do you know anything about it?
No, I don't know anything about it. And I would almost immediately, once I saw that valuation, just stop researching it. If somebody asked me,
Yeah. Oh, actually, I'm sorry. I was slightly unfair. It's a $62 million valuation. I was looking at the wrong thing, but yeah, it's they are, what are they doing? Or even, this is another one where it's like, the stock is down 91% over the last 5 years. Which, I mean, by itself, a lot of companies in this space have terrible looking charts, but I mean, this company had
how much cash do they have?
They have actually the cash could be worse. They have 67 million in cash, but they have 62 million in debt. So
weird. Okay.
And enterprise value is 57 million. But they had no revenue until 2023, and when they had $120,000 in revenue, and then that dropped in 2024. So I just like, that's so many red flags right away that I don't even know what they do at this point. It looks scary. I guess it's looking at. It's an endoscopic procedure to the duodenum, looking at an obesity. It's an obesity sort of aimed at endocrinology disorders, type 2 diabetes, or I don't know. I mean, it's like literally, given that this is a device, this is so it looks like it's trying to be a razor and blade model where you have a catheter and a device to do. I don't even know exactly what the procedure is, but I mean, they literally can't have sold more than one system last year. I don't think. They had like $93,000 in revenue. So yeah, that would be enough for me.
Yeah. Speaking of valuations, I saw this thing on X that maybe we can end with, if Bart can bring up my shared screen.
Oh yeah. That's right. Yeah, this was interesting, Brian. You showed this to me a little bit before we went on, and it was an interesting chart to look at.
Yeah. Bart, can you bring up my shared screen? There we go. Yeah, so this is from Buy Side Bio on Twitter, and you can see. So this is all the companies that have a market cap from $5 million to $2 billion. So small companies that have at least 40 million in cash, and then what's plotted here is the return. So this is 0, and this is negative, and this is positive, and on this axis, and then on this axis is the enterprise value. So this is the 0 here. So all of these companies are trading at less than cash and had a negative return, as much as greater than. There's a whole bunch right here that are trading at less than cash, and their stock was down more than 80% over the last over the last year, 1 year, because this is a 1 year chart. So I thought this was sort of interesting, so if you look at, let's see, this is the 0 and the 0. So, you got a whole bunch of companies on this side that are, obviously losing money, but at least they're trading at more than cash. This is probably the interesting results here, I think, right? Because they're the ones that have grown really well, as much as 140%, but they're actually trading at less than cash. So, I don't know exactly what you read into that. I don't, if this is a very small company, then maybe that, it's just volatility, and who knows, and then you've got, I think maybe these outliers are possibly interesting too, especially the ones that have grown quite a bit. Obviously there are some evaluations here, as you're going up, this is becoming more valuable company, the higher valuation. So therefore probably have some products that are on the market, or potentially on the market, or getting towards the market. And so therefore have a positive, positive value, have positive returns, and then positive valuations. Maybe this part is, I don't know, somewhat interesting in that they've companies that have dropped quite a bit, but have decent valuation. So at least companies are thinking that the investors are thinking that the companies are worth something, something like Beam Therapeutics right here.
Right. Yeah, I thought it was interesting that one company, it's gone up 140% and it's still trading under cash value. That is remarkable.
Yeah.
Right. So yeah, that is a graphic illustration of very negative sentiment, certainly among small caps in the sector. or I mean, yeah, small caps and particularly, you know, cash poor companies in the sector. And that, I mean, honestly, I think both of us have been, yeah, some of those companies hopefully will survive. I mean, some probably don't deserve to, some do, some are, you know, probably, there are probably going to be some cases where some companies with some really promising things get kind of choked off. But I mean, generally speaking, I have certainly for the last few years been avoiding, been very cautious about small cap companies altogether, and certainly avoiding any company that looks like it needs to raise cash anytime in the near future. You know, it's got to be commercial.
Look at Humacyte's 30% drop yesterday as an example. But we got to go because we're out of time. And coming up here, we've got Andy and Sanmeet who are interviewing Dr. Kashani. So I will let you guys come in and have at it.
Thanks, Brian. Thanks, Karl.
All right. Have a good one.
Hi, fools. Andy Cross, Sanmeet Deo here. Excited to bring you our interview with Dr. Ali Kashani, who is the co-founder of Serve Robotics, a really exciting robotics company that we're going to bring Dr. Kashani on here, and we'll welcome him to Fool 24 and the Motley Fool, because it's exciting to have him directly to be able to talk to him. Hello, Dr. Kashani. Andy Cross, Sanmeet Deo. Welcome to the Motley Fool.
Hi, guys. Thanks for having me.
Oh, we're excited, thrilled to have you here for a great conversation about your company, Serve Robotics, symbol SERV. And I want to kick things off with your explanation, because many of our viewers and members here at the Motley Fool and Fool 24, whether it's through our membership site or over on streaming on YouTube, might not really know about Serve Robotics. So I want to give you the opportunity to describe it in your own words. What are you doing, and in which markets are you serving?
Absolutely. What we're really doing is bringing a long overdue automation to last mile delivery. So if I can just take a step back to explain the root of this problem, if you order something from China, it costs about $2 to get it to your front door. But if you order it from Chinatown, it costs $10. So it's upside down, and that's because a human being has to be attached to every package that comes all the way to your front door. And that's obviously incredibly inefficient. We've gotten a lot of efficiency in long distance shipping. One person on one of these like giant cargo ships today is doing the work of about 5,000 people from a couple hundred years ago. But one male postal worker does the work of 2 people from the time of horses and buggies. So that's how much efficiency we have not been able to introduce to keep up with the rest of the logistic kind of layer. So we've started this inside one of the largest food delivery platforms in the country, Postmates. So this was a division of Postmates that I joined in 2017 to begin. So we've been at it about 8 years. If you followed Postmates' story, we were acquired by Uber. So we joined Uber. And in 2021, I took my team and spun it out into an independent company, which is now called Serve Robotics. And then last year, we listed on NASDAQ. So it's been quite a journey. Our focus is food delivery as a first market because it's the most expensive kind of last mile. And if you go to LA, where I am right now, or Miami, or very soon to Dallas and Atlanta, you can order right now in LA, you can open Uber Eats and place an order from more than 1,000 restaurants. And one of our hundreds of robots are going to bring you your food. Like right now, this is happening. It's real. And we are now bringing 2,000 more robots to the rest of the country by the end of this year.
And Dr. Kashani, very quickly, and then Sanmeet jump in. Just describe for a second, for those who might not have seen the robots or even gone to some of the videos and seen, just describe what are you talking about when you're talking about your robots, so people fully understand.
Yeah, imagine the robot size of a shopping cart. They have 4 wheels. They kind of look like a cart, but with eyes and personality, and they have the same type of sensors that you have in a self-driving car. They have a LiDAR on top. They have cameras, 6 cameras around them. They mostly operate on the sidewalk. I encourage folks to just look us up, or you can literally watch us on Netflix. If you know John Mulaney's show, Everybody's Live in LA. It broadcasts once a week. Our robot is his sidekick. So there's more than one way to see the robots. You can see them in the streets of LA, or you can see them on Netflix, but they're very cute. They're very fun, and they're out there doing deliveries.
And from a capacity perspective, it's like a few large pizzas, a couple dishes, right? Like just for some context.
Yeah, they're pretty spacious. They can fit 6 large pizzas, 4 extra large, and 2 large pizzas, like 50 plus pounds of weight for cargo. So there's more than enough for, again, most last mile orders.
And they're all battery powered?
Yes, they have battery to go basically all day on a single charge. So they leave our depots in the morning and they go to work. They work for, as I said, like 1,000 restaurants just in LA. And then at night, when they're done, they return home. They can stay out like 14 hours a day.
And my final question, then Sanmeet, jump in, please, is when someone does select a restaurant that utilizes your robots, is there an option to say, I do want the robots or I don't want the robots? Or is it just default that everybody gets the robots?
Yeah, so by default, you don't have to do anything. You get a notification up front that this restaurant offers robotic delivery. You could turn that off if you like, which very few people do, but the robots are assigned to you if one is available. And the experience is really similar to any other delivery. You see the notification, you see the robot on a map. The only thing is you don't have to tip the robots. So the customers generally like them.
Yeah, and the U.S. tipping inflation certainly has gotten a lot of publicity recently. Sanmeet.
Yeah. No, this is just fascinating stuff. And I think I saw a video from that was linked to your presentation, and I guess the robots come right to maybe the doorstep or the bottom of your stairs, wherever you are, depending, and then the customer can put in a code, I guess, and then just take the food and then kind of go. Do the robots talk, or do you plan on them ever talking?
They don't talk today. They do have some ways of expressing themselves with lights and with some sounds. They don't talk today, but I mean, look at where the technology has gotten in the last couple of years alone. I wouldn't be surprised if one day they do, but not today.
Yeah. And so just in terms of the business, because, the product is fascinating and wonderful, but, our members are stock investors. So, from a business perspective, what's your current business model and revenue streams? And then how do you get paid?
Yeah. So we have a few different revenue streams right now. But, again, from basic fundamentals, we are doing last mile logistics. So when we complete a delivery, we get paid for that. So that's called delivery as a service. It's similar to your contractor drivers that get paid per delivery. There are customers that we have been talking to that actually want a dedicated robot, in which case they pay it like having a dedicated personnel per hour. So those are the delivery as a service categories. What was interesting, I have a PhD in robotics, but I never thought I would be selling ads. But it turns out advertising is another really great revenue source. A lot of people reached out to us. Think about buses and billboards. It's the same thing called out-of-home advertising. So the robots have pretty robust advertising revenue. Anywhere from 25 to 50% of our revenue per quarter has come from advertising. And we also have a platform for building robots, the software and IP that we've developed. And we have our first customer, Magna, that has been licensing it. They're the largest automaker in North America. And through that, we have some software services revenue as well.
Awesome.
And Dr. Kashani, back to the depots, because I'm fascinated by this. So just from some scale perspective, 2,000 robots, how many depots would that require? I imagine you're leasing those spots, you're leasing those depots. You own the robots, so you're managing the robotic fleets for your clients, like Uber being a big client. Talk to us a little bit about managing the depots. What goes on into there for some scale?
Yeah, so first, there is a customer, there are folks that integrate with us to use the robots like Uber. We have a contract with Uber for 2,000 robots to deploy by the end of this year. That's kind of where that number comes from. And I mentioned Magna, they're actually building the robots for us as well. They assemble them right here in in the US in Michigan. Excuse me. And then the way we basically deploy them, they are very neighborhood oriented. So we have a depot usually that addresses or services a number of neighborhoods nearby. So the robots leave in the morning, they could go maybe 1 or 2 miles to get to their business district that they service. And right now in LA, for example, I believe we have 4 depots and we cover, a dozen neighborhoods. And same thing in Miami. We have our first depot. You could have anywhere, I don't know, 100 robots in a depot. So it really depends on the neighborhood. And that's the model today. In the future, there could be, smaller depots, maybe, imagine like container type deployments where you have them in a parking lot. So there are a lot of different ways of doing this, but right now we are very depot oriented.
So talk a little, and I'm so fascinated by this to think about the logistics behind this. So like, Sunset Boulevard and Mulholland Drive, like, I don't know if you deliver in those areas, but they're windy roads, right? Like I have double staircases that go to my house, right? So I imagine the robot right now cannot go up those stairs. So could it not deliver to me? How flexible, capable is the robot currently right now? And then where do you envision that going?
Yeah, so they're designed to do like 90-something% of deliveries really well, and they're getting more capable. For example, not every intersection has curb cuts. So we have designed the robots to be able to handle that. Like maybe they have to go down without a curb cut or even climb the sidewalk again when they're crossing an intersection. So, and the new generation robots, we just launched our 3rd generation. They're getting even better at it. They have bigger wheels and more power and more capability to deal with that. We don't do stairs today. It's something that can be addressed down the line, but again, 90-something% deliveries don't require that. When you come basically to the front of the house, maybe you can't go all the way to the front door, but as long as you're within 50 feet, people are generally fine with that. Again, knowing that no one's touching their food, knowing that this is actually more reliable than courier deliveries in terms of completion rate, in terms of not bringing you the wrong item or forgetting your drinks, and you don't have to tip at the end. So people have been very happy, and our churn on that side is very low. Merchants also really like them. The robots are very no-frill. They don't cause any issues. They wait where they're told. So all the parties are pretty happy with the quality of this experience today. And the robots' capabilities keep improving. While at the same time, by the way, their cost is coming down. So our 3rd generation robot we just launched has like 5 times more compute power, better sensors, more battery, faster, and it does all that while costing 1/3 of what our 2nd generation robots cost, because as we are scaling them up, we are improving the design. So this is like iPhone 3, and there's like 15 more iPhone generations to go. So we're constantly improving them.
Sanmeet, let me just quick ask a follow-up to Dr. Kashani, if I can. Just from that, Dr. Kashani, from the innovation, do you expect to have level 4 or 5? How rapidly do you expect to innovate on the technology of the
Autonomy
robots?
side, yeah. So what we have is level 4. This was always our thesis, that the level 5 may be both sci-fi a little bit right now, and also maybe not necessary, because to just explain the distinction here, your Tesla would be level 2. So you have to be engaged. Humans are in the loop all the time. They're responsible for safety. Level 5 is where no human is ever needed. It can just, the robots or vehicle can do anything by itself all the time in all conditions. Level 4 is where the robot can do a lot of things by itself, but when it needs help, a human can help. And that's the direction we took. If you actually look at it from an economics point of view, going from level 4 to level 5 is both extremely expensive and unnecessary, because humans can actually, like when you use an app today, it can't do everything. Sometimes you get stuck in an edge case and you need support. A human is the customer support that helps you out. It's kind of the same thing. Robots have their own customer support. When they get to those edge cases, it's actually cheaper relying on people than having to build models that are just not possible today with the AI we have. Now, what's nice about level 4 is you can always make it better. You can always reduce reliance on humans. And with the kind of advancement that's happening in AI right now, we are one of the biggest benefactors, because we've built the hardware, we have the sensors and the data, we have a lot of data. We actually, with the 2,000 robots that I mentioned, we would be collecting 4 times more images per day than ChatGPT was used to train on their vision model. So that's per day from the robot. So there's incredible amount of data and again, assets that have been built. Now we are plugging in the latest and greatest AI on top that just improves everything. But ultimately, level 4 is really where commercial deployment makes sense, which, by the way, 8 years ago, most people talked about level 5. Today, every autonomy company talks about level 4. That's what everybody has kind of realized is the holy grail.
Yeah, you know, your robots are out there in real life, unlike ChatGPT. So I can only imagine they're getting the kind of data that we get as humans, walking around and seeing things. So are you guys developing your own AI LLMs, and kind of how is all that data that you're collecting gonna serve you in the future, and what other uses could you foresee using all that data for?
Yeah, look, I actually believe there's a tremendous amount of value in the data. There are a lot of jokes in the past where people are like, you know, collected data ? Money.
Yeah.
I think this is one of those times where this question mark is getting solved, because the intelligence that we needed to turn those volumes of data into actionable things is finally here. In our case, for example, you kind of create this flywheel effect of the more data you have. We've already seen what LLMs were able to unlock with additional data to train them. So that really the biggest unlock when the transformers, this new architecture was made, was if you feed it more data, it's going to get better, and it's going to do things you didn't even expect. And now there's a race for both GPUs for the training part, but also for the data, so that you can actually feed the models that are so hungry for data, even more data. So if we can feed more data to our models, the models get more intelligent. And when the models get more intelligent, our operations becomes more efficient, our cost becomes better. And when you do that, you can deploy even more robots, therefore you collect even more data. So this flywheel kind of gets going, and that's just the application for us. If we can teach our robots to navigate complex human environments like sidewalks using our data and our AI, we can also make this accessible and as a platform to other applications, to other robots that may want to do other things in other environments where humans and other agents are roaming around freely. Because today, most mobile robots are in warehouses. They are very confined. You set the environment for the robots. And then there are folks that are spending all their energy on the streets. Where I think there's a really big blank space is all the uncontrolled environments, the real world, where humans and robots and machines have to interact. And that's the problem we're solving, which again, the data and the AI enables us to create a platform that can actually address all of that space.
Yeah, that's fascinating.
Dr. Kashani, on the investment side, you spend $20 to $30 million in R&D every year right now. Is most of your investing into, is it hardware? Are you buying Blackwell chips? Like how are you allocating the capital you have currently, still working through the profitability of the business model? But just talk to us a little bit about how you think about allocating capital inside Serve Robotics' team.
Yeah, so I mentioned the iPhone analogy. What was really powerful about the iPhone was it was an end-to-end product. Like no one said, Apple didn't say, I'm going to go make the hardware and somebody else please make the software for me, or vice versa. The vehicle that we needed, the form factor we needed, didn't exist. I think it's actually an unfortunate thing where so much investment into the autonomy space has gone into self-driving cars alone, which is just one form factor. Once you remove the driver out of the car, it doesn't need to be a car anymore. We like to say, why move a 2-pound burrito in a 2-ton car? That's been our vision, which is once the vehicle can move by itself, it doesn't need to look like a car. It can be, a smaller robot if you're moving smaller things over short distances. By the way, half of deliveries in the country, in the US, which is fairly sparse, are less than 2.5 miles. So you don't really need to have a big vehicle moving them. You can do them in these robots. So with the vision of having a different type of form factor, we were faced with the fact that that vehicle didn't exist. So we decided to make it ourselves. And of course, the autonomy and the AI for it didn't exist. So we had to make that ourselves. And the operation didn't exist. So we had to make that ourselves too. So we have an end-to-end product, which I think generally when you're introducing something new, you really need to make that killer application end-to-end. Now, food for us is the book to our Amazon. There's so many other things you can do once these robots are roaming around. But you do need to get this working from the hardware all the way to the software and operation and autonomy and AI. So our investment that you mentioned goes into all those layers. I think the hardware is a little bit more known quantity of a problem. You we've been building vehicles for 100 years as a species. We know how to build them for all the environmental conditions, etc. So that's not rocket science. The AI and autonomy side is where there's more uncertainty, and that's where we've kind of been able to show a lot of progress, and that's why the robots work as reliably as they do. So a lot of our investment has been going in that.
So, question. So with the robots, you talked a little bit about the level 4 to level 5 autonomy and all the different autonomies. What's kind of the human involvement in the whole process? Like, for example, I have 2 small kids, teenagers, and I have a birthday party for them, and I order a whole bunch of pizzas, and I'm just busy with the party. I can't like go out and go get them myself. And what's the process of the robot bringing that delivery to my house? At what point does a human need to be involved? At what point is a human just not going to be involved? And kind of give us a little bit of an example of how it might work.
Yeah, I can kind of walk you through the end-to-end experience. So as a customer, let's say you open Uber Eats and you pick a pizzeria from a few blocks away where you want to order for the party. You get like 4 boxes. So once you place that order, you get a notification that your delivery has been assigned to a robot. So at that point, you know that a robot is bringing your food, and you can track it just like any other delivery on a map in the same application. On the other side, the merchant, the pizzeria, would receive a notification on their tablet that says there's an order and a robot would be picking it up. Now, we already know where to wait. When we get to the restaurant, they usually tell us in advance. So once our robot arrives at the restaurant, the tablet informs them that the robot is now waiting outside. And that's usually about the time the pizza is ready. So a staff member, and this could be a new person who just started that day, there's no training required. They can just grab the pizza, they go out, they find the robot where it belongs, they see the order number on the screen, so they know they're loading the right robot. They can basically open the lid, put the pizza in. Once the lid closes, it's locked now, so nobody else can touch that food. You get notified that the robot is now on its way. You can, again, keep an eye on it. When it reaches your home, you get another notification that the robot is outside. There's actually a button in the app that you can press when you're in front of the robot to unlock the lid. You grab your food, and you're off. You go on your way.
Wow. And another, that's fascinating. And another follow-up question to that, which I kind of was thinking about earlier, right now you're focused mostly on dense urban environments, correct? I mean, you're like the big Los Angeles you're testing and some of the bigger cities that you're testing. I live in New York, but I live in the suburbs. So what are the different challenges and between an urban environment and a suburban environment? Because obviously an urban market in itself is a huge opportunity. They're like, you have plenty of opportunity there in itself, but for all of us, there's a lot of opportunity in the suburbs. And how does that work? Because a lot of suburbs are very different. Some don't have sidewalks, some do. A lot of different challenges there. How do you see that kind of opportunity and the challenges?
Yeah, it's a good question. I mean, if you think about how cities and communities are laid out, I think in the U.S. somewhere about 70% of the country has sidewalks, so 30% don't. But businesses, restaurants are usually in the denser environments. So even in a, you don't have to be downtown San Francisco. You could be in any one of the smaller cities, let's say in the Bay Area where I live, let's say Los Altos or Redwood City. These are smaller cities where there's like a few streets where all the restaurants and businesses are, the business districts. And usually within a couple of mile radius of them, you have the higher population density. So whether you're in downtown San Francisco or downtown Redwood City, you can have the robots take care of those couple of mile radius. And by the way, that's where the most congestion is. That's where the most parking challenges are. That's where the real estate is hardest to get. So the robots can actually reduce that congestion, take the cars off the road. By the way, they make the roads safer because we're getting the car off the road for doing that delivery. And our robot has 3,000 times less kinetic energy. It can't hurt people the way that a car can. So we make that city environment better for everybody. At the same time, if you wanted to go further out, there are other ways that the robot can help. So we actually have a partnership with Wing, which is a subsidiary of Alphabet. They do drones. And the problem for drones, they're really good for suburbs. They can come to your home, even if there's no sidewalk, obviously, if there's more distance, they can get there really fast. Their challenge is getting to the restaurant. Because as we talked, restaurants are in busy places. and drones need dedicated real estate. They can't just land in front of a restaurant on a sidewalk. So our robots actually pick up the goods and they bring it to a nearby loading area and automatically, without human involvement, hand it to a drone. There's a video of that on our website. You can look it up. This is a pilot we are going to launch actually soon, in a matter of weeks. And that's where we pick up the item, and then the drone can bring it miles away to the suburbs. So the robots can be in the mix, whether they complete the delivery all the way, or if it's further distance, they can hand it over to a drone or maybe to a self-driving car. Because ultimately, we get all the way to the front door of the restaurant, which is the hardest for the cars or drones to get to.
Fascinating.
Dr. Kashani, talk a little bit about insurance for the robots. How does that all work? Are each of the individual robots insured? How do you think? Because I imagine there have been times when there's been either little accidents or something tips over or some vandalism. How does that all work into the equation?
Yeah. So I guess let me tie that to regulation. So there are no necessarily licensing or permits required by default. These robots, if they go to a new city, they can generally operate like tomorrow. However, some cities have put permit programs in place. It's not per vehicle necessarily. So like we don't have a license plate or anything like that. And we don't have a per vehicle insurance concept. But our fleet as a whole has insurance under our kind of general company insurance. So when something happens, there's always, the backstop of insurance. But keeping in mind that, again, robots move much more slowly. The maximum speed of the new generation robots for us is about 11 miles an hour. The average is obviously less than that. So again, the amount of kinetic energy they generate when they move is so much less, which means they're less likely to hurt people. They're less likely to damage property. So overall, those costs are much less than what you see in vehicles. And then the additional advantage here is that we have cameras. So there has been instances when someone kind of comes in with a claim and they're like, oh, something happened. And I'm like, okay, just give us a little bit of detail. We look up the video. We're like, sorry, man, like this is, we have this on camera. So our insurance company loves us for that. Usually these kind of claims just go away. So those kind of interact together.
It's interesting. I was thinking more of like just someone driving, seeing a robot, hits the car in front of them because they've never seen it before.
Right.
This is the same question I have with autonomous driving and Tesla's FSD. It's like you're driving, you see a car beside you, no one's in the car.
Can be distracting, right?
And be distracting. So just, that's just more in general towards the autonomous world as that.
I'm not aware of that having happened, but maybe we wouldn't even know. So we
and
definitely
you have the
don't want to
cameras,
be distracted.
and you have the cameras even to see. But 11 miles an hour. The average human's between 3 miles an hour. So you're talking 3 times faster than the average human walk. So even I know you said that it's more at the high side, but that's still a pretty good clip. These things are not just like
they can move.
Yeah, they can move. They can move pretty quickly. It's on me.
How fast does a delivery person on a bike go? Because I would imagine that kind of closes the distance. A lot of the delivery people are either in a car or a bike, right?
90% of deliveries in the country, when we had access, so we were born inside Postmates, so we saw all the raw data. At the time, at least 90% of deliveries happened in cars. Only places where the congestion, like Manhattan, is just so bad is when bikes are used, because ultimately people want to make as much money as possible, and bikes are not the best mode for that unless you're just stuck in traffic all the time. So I think bikes can go 20 miles or even more. So this is like maybe half of that speed, but they also have to deal with, congestion sometimes. So you still have the traffic, stops or whatever. And generally they're often banned from the sidewalk. So there's some other restrictions there. But that's kind of a rough estimate. At the end of the day, in LA, for example, median delivery distance is less than 1.3 miles. And you need your food in about half an hour. So we can do well beyond a 1.3 mile delivery distance, which means half of deliveries can be done in robots. And if we can take those half of deliveries off the road, we make the roads less congested for everybody else. We reduce emissions. We make roads safer. And then we bring that $10 cost of delivery down, hopefully to $1 in a not too distant future.
Yeah, it's interesting that quote you said that why deliver a 2-pound burrito in a 2-ton vehicle, right? I was just thinking about it. And when I order food, you have this delivery driver in a car, and he brings me this small package of my lunch, and like that's all that's in there. He's spending all that time. Obviously, he has other deliveries, I'm sure, as well, but it seems inefficient.
It really is. And a person has to, like, again, walk all the way. I think it's better if that person is in charge of multiple robots that are doing this job out there and they're supporting the robots. So that's kind of the productivity gain that I was talking about earlier. That's how we are going to start to unlock that. And I think that actually creates so much more demand for delivery as well. A lot of people don't use delivery today because it's too expensive.
Dr. Kashani, is it a one-to-one relationship? Does a robot make a delivery, come back to the depot, or is it making a delivery, going back to pick up another delivery? Is it how much is one off versus multiple stops?
Yeah. So the robots, they kind of go to work in the morning. So they leave in the morning and they come home at night. So they don't return to depot halfway through. They go to the restaurant, they do the pickup, they complete the drop off at the customer location. And then they go to the nearest restaurant that has the next order. And as I said, like, we cover about 1,000 restaurants just in LA. So there are a lot of restaurants nearby that we could be getting the next order for. So that's the model. Now, today, they only move one package at a time. When we were inside Postmates, we actually had integrated batching, so we could do more than one order. And that worked just fine. We're not doing that today, but it could be done in the future.
One of the things sorry, Sanmeet, let me get this last point in, is, the scooter, the chime bikes, I see them like kind of discarded on the side of the road and that kind of thing. And so I like the depot idea, or like in the New York bikes, Sanmeet, when they're racked together.
Right.
And so I imagine that you have a similar situation with your robots, which is you're not just walking down the street and you find a robot like on the side of the road. It actually it has a purpose.
Exactly. This is a really important point, which is our robots are kind of active fleet rather than what we call scooters passive fleet, where people are moving the scooters. Our robots move by themselves. So that gives us some advantages. One is we need fewer robots. With scooters, you kind of have to throw them everywhere for people to find them at the right place and right time. We don't have that issue. The robots go where they need to go. So you generally need fewer robots. And also, we have standards, we have protocols for where the robots should wait. If we are waiting for the next job and we stay somewhere for more than like 20 minutes, we actually get the robot to move somewhere else. We don't want to be loitering around people. Maybe they don't like that. So we have all sorts of ways of making sure that we are good citizens in general. When the robot sees people coming, it tries to actually cede way to them. We try not to block intersection, kind of curb cuts. There's a lot of learnings we've had, and we make mistakes too. We always try to get better, but we're trying to be very thoughtful, having robots as this kind of new citizens around our cities.
Yeah, and that brings up a good point, is kind of, how's it, like, consumer acceptance is very critical for like these kinds of new technologies. And so, like, what kind of insights have you gathered from, like, your tests in Los Angeles and the ones that you're doing more of customer behavior towards these robots, or satisfaction levels? What's the kind of feedback you're getting from the robots and actual customers?
Yeah, this was something we spent a lot of time from the beginning of this effort back in 2017. Our thinking was, like, it was clear to us that we need this kind of automation to be introduced to last mile. But the one question was, is society going to accept that? Now, 8 years later, we have a good, clear answer. It's been very successful. You can see it in cities like LA. People basically don't even react anymore. They're so used. That's probably the most surprising part, is you're walking by, a robot passes, and nobody's even looking anymore. So at one point, they become like a mailbox. They're the most normal thing. But in that introduction phase, you really want to, again, be thoughtful and make sure that people want these things to be around them. And we have our work cut out for us because of maybe Hollywood and all the negative stereotypes about robots and the dystopian future. So we actually wanted our robots to be really friendly and fun, and in fact designed them to have personality. They have eyes, they blink, they have names. The result of all that, and also I should say on top of that, we consulted different communities, like disability communities, like someone who may be blind or deaf or have or be on a wheelchair. We wanted to know how to interact around all types of people that are out there on the sidewalk. And again, we can always do better. We are always working to do better, but I think we've, been off to a good start in LA as a city. We've been around for a few years. We are very well accepted, and people are generally very positive about the robots. When they see them, they want to interact with it, and they want more robots, not less.
Yeah. So we like to on these shows, we always have members kind of watching in and then sending us questions. So we like to take questions from members when we talk about different companies and things. So we do have some questions, and I wanted to take one that was pretty interesting. LY Winners Win is one of our members. Curious, what security measures are in place for serve robots to prevent theft or vandalization of the robots?
Yeah, that's a very good question. I think about it in three words. It's design, deterrence, and disinterest. So I'll walk through each. So design is make them friendly so that most people, normal people, don't want to mess with them. They actually, sometimes I walk with the robots just to see people's reactions, etc. And I've actually had interactions when someone who doesn't even know who I am just turns to me after seeing the robot. It's like, I feel so protective of this robot. So design is obviously important. So if it's pleasant and it doesn't invite that kind of behavior, that's one. Deterrence is the second. The robots obviously have cameras. I'll tell you a funny story of the only time in years of us operating in LA, we've done, many tens of thousands of deliveries. In years of operating here, there was only one time where someone actually organized individuals tried to steal a robot. They loaded it in the back of a truck. The robot actually jumped off and came home, jumped off the back of a truck and returned home by itself, unharmed. And the individuals were arrested within 30 minutes. One of them had an outstanding warrant. You could see in the video footage that we had, they had scooters lying around. They were clearly doing this as a business, unfortunately. So they were arrested very quickly. And we posted that video it's on Twitter if you actually look it up. So it's not a good idea to generally, steal a robot. So that's the deterrence element. And then the last one is disinterest. A lot of the times it's just curiosity. It's like kids, especially, they are very notorious for this. They're curious, they jump in front of the robot, they want to block it and see what it does. And one of the tricks is just play dead. You turn off the lights and you just pretend that the robot is broken, and they actually kind of think like they broke it and they walk away. So robots are more patient than humans. That's another kind of trick in our sleeve.
I have just a screen share here, Dr. Kashani, just this is of your website, just some of the open roles you have, but I just wanted to give a picture of the robot just so all the members see, and you can see the context versus these people, and just the eyes right there, which I imagine have some real purpose, maybe cameras and the LiDAR on top, and so just some context of what the robots look like.
Absolutely, they're very cute.
Yeah. Do they have names? Does each robot have a name?
Absolutely. Every robot has its own name.
Is any name Rosie or Tweaky from Buck Rogers?
Or Wally?
Sure Rosie is the name. Yeah.
Well,
yeah.
I probably maybe can't legally probably.
We have like hundreds, so I don't know all the robots off the top of my head, but yes, Rosie sounds familiar to me. We also have one named Samo, which is the one that's on Netflix every night. So there's even a celebrity robot with an IMDb page. So they're famous.
That's amazing. That's really amazing. Another member question, Sapand asks, can you discuss the underlying CapEx of your company? How much does it cost to make the robots, the pathway to profitability, what that looks like? So you very clearly, you're under your risk factors of your 10K, the very first risk factors. Hey, we are an early stage evolving company, stage company, and still trying to find the profitability curve. Just talk a little bit as you talk to investors about your investments. I mentioned earlier the CapEx, but just also as you're thinking about the balance between as an entrepreneur and a CEO between growth and profits.
Yeah, very, very good question. So basically, you can think of the cost of operating these robots in like maybe three buckets. There is the cost of hardware. There is the cost of people who have to help the robots. They clean them, they maintain them, they help them remotely when they need help. And then there's the cost of basically everything else, like real estate and data connectivity and that sort of thing. So what's interesting is a lot of these costs are coming down. for different reasons. So in fact, you want to contrast this to last mile as it exists today, which is cost of labor is going up. People know about tipping, for example, but just labor costs as a whole, hiring these drivers, finding them is getting more expensive, and regulation is putting additional pressure because of the labor laws and minimum wage requirements and all that stuff. So on one hand, you have that a number of inflationary factors that's increasing the cost of last mile. On the robotic side, that's kind of the thing about automation. So hardware, the first bucket I mentioned, the cost has been coming down steadily. I mentioned between the last generation and the current generation robot we launched, the cost has come down in 1/3. So like 65% or so cost reduction. And the robot is way more capable, has more battery, has more compute, has better sensors, has more cargo capacity, is faster. And this includes all the components, like the LiDAR cost has come down 90-something% in the last few years that we've been around. Again, battery cost, the cost of compute has come down significantly. And this is going to continue. Everybody obviously understands how that works as we scale up, but also the technology itself, as it gets cheaper, we are going to be benefiting from that. The cost of labor also goes down because the robots are getting smarter. They can do more things by themselves. They become more durable. And then the last one is the miscellaneous stuff. So we are getting smarter in terms of how we operate the robots, the depots, and all that stuff. So we are not profitable today, but we have a good line of sight into becoming profitable. And we haven't talked about this. We've raised since the IPO something like $270 million. So we're in a position where we can launch all of our 2,000 robots and more and get ourselves to that profitability without necessarily having to raise more money unless, I don't know, we want to scale a lot faster or something. And then the other thing I want to actually mention is this benefit of cost down is going to actually be eventually passed on to a lot of other folks, including the restaurants and the customers. And then one more interesting observation here is that with drivers, you only monetize the delivery. With robots, you're monetizing other things. So we don't just reduce the cost, we also increase the top line. For example, I mentioned advertising. Our robots have a whole other revenue source just from the ads that we place on them. And then there is the value of the data. So that could be monetized one day. There's the value of the platform. So these robots can actually be monetized in a number of ways beyond what you get from a traditional delivery, while at the same time you continue to bring the cost down. So I think the economics of this generally is going to be very attractive over time, but we are still an early company. This is like early days of Amazon, and we have 20 years ahead of us to go do amazing things.
Dr. Kashani, just because you mentioned you make the robots in Michigan, I'm a proud graduate of the University of Michigan. Just because it is so in the news with tariffs and all this, just the impact of as you're bringing in product or when you bring in technology to be able to manufacture your robots, how are you thinking about that? Just speak to our members and investors about that a little bit.
Yeah, we've been anticipating this. The fortunate, I guess, news is we have not been impacted by this. However, I expect, given how much uncertainty there is, that there would be some impact. But so far, again, because we are assembling in Michigan, and generally we had tried to stay away from, doing any work in China, for example, it has worked for us so far. But I would expect that there could be impact down the line. But we will keep our eyes on the ball and try to minimize that impact. And at the same time, we are bringing the cost of hardware down so quickly. Like between the last 2 quarters, we announced an additional 30% hardware cost down. We are negotiating with better suppliers. We are increasing our volume. So hopefully, if there are added costs, we can also offset them with the efforts we are already putting in.
And Sanmeet, if I can just one other follow-up for Dr. Kashani, just as you're talking to cities, considering that you are aiming to disrupt some kind of employment in some level with better efficiency, better tools, evolution, do you get pushback about, well, this is going to take jobs away from X amount of people who are relying on the income of delivery? Talk to us a little bit about what you hear from municipalities and cities as you're having that conversation with them.
Yeah, it's a good question. I actually want to first talk about the thesis here, which is the impact on jobs. Look, I think obviously automation and AI is going to have impact on jobs. We may have a bit of a skewed view about that impact. I think we've always been a little bit too fearful about there's this fixed pie fallacy of thinking that there's only X number of jobs, and if someone is twice more productive, you need half as many jobs. What we always forget is that when you reduce the cost, the pie gets bigger. So we talked about, cost of delivery being almost $10. There's a reason why people buy things on Amazon and have it shipped all the way from China. But what happens if the cost of delivery was $1? There would be so much more deliveries. I mean, like, I ordered shoes and climbing shoes for my daughter. After waiting a couple of days, it was the wrong size. Now I had to return this, which is a whole hassle, and then wait for the next one to show up. What if I could have just pressed the button and had it actually delivered from a local store within an hour, because the cost of delivery was so much lower, and it could show up in 3 sizes? I picked the one that fits and return the other 2 back into the same robot that returns it to the merchant. So if we actually change this cost structure, we can change the shopping behavior. We can bring so many more jobs to the local economy, including more delivery jobs, because people are going to be using a lot more delivery than they do today, while at the same time reducing dependence on cars, reducing the number of accidents. There's like 20 pedestrians get hit by cars every day and die in car crashes in this country. That's crazy that we accept that as a thing. And remember that about a quarter of those car trips that are happening that cause those accidents are usually last mile kind of errands and shopping. So cities, we found, to go to your other question, have been embracing this because they understand they want to make their cities safer, they want to reduce emissions, they want to reduce congestion, and they want to help their local economy, their merchants who want to reduce their cost of delivery. So for all those reasons, I think this is actually a net benefit to everybody. And I do think that in the near term, this is not going to be reducing jobs. It's going to actually create a lot more jobs than it reduces. If I just finished that thought, ATMs are a really good example of this. They're literally called automated tellers. Everybody thought ATMs are going to kill teller jobs. In reality, they reduce cost of banking. So banks opened more branches and hired more tellers. And I think this is an example of that.
Awesome. Thank you.
Yeah, that's amazing. So kind of going back to the profitability thing, when you think about it, like the future and the success of your company and the business model, what are some like key KPIs, key performance indicators, or critical inflection points that you're looking at that will kind of like demonstrate that you've achieved kind of sustainable profitability? Is it utilization rates per robot or average delivery cost reductions, new customer acquisitions? What are some of the things that you look at that you can say, all right, going forward and then looking back maybe 10 years from now, that we've become, sustainably profitable and successful?
Yeah, I mean, ultimately, we look at the cost on per delivery basis, and we, track the 3 buckets that I mentioned, and we're trying to kind of optimize every one of those. And I mentioned, the one that we've talked about publicly is the cost of the robots has come down in a third. And by the way, that's just on the cost of material, but there's also durability. So you amortize these robots as the durability improves. You get to amortize them over a longer period. So your cost per delivery goes down even faster. Obviously, improving the AI and autonomy would improve the economics as well, because you're going to require less human intervention. And then there's utilization. So everything we have in terms of cost ultimately gets divided by the number of deliveries the robot does every day. And that's why our partnership with Uber is so valuable. We get to actually have, again, 1,000 restaurants in LA onboarded. We don't sign one restaurant at a time. They receive an email that says, hey, these robots are now operating in your neighborhood and they're going to do deliveries for you. If you don't like it, go turn it off in this menu. But again, most restaurants don't. They actually really like the robots and they continue to use them. So we don't really have that customer acquisition cost problem. There's just infinite demand for these robots. So the focus is just reducing cost on those 3 layers that I mentioned. And it's going to be basically a lot of low-hanging fruit still ahead of us. And over time, we are going to get, incrementally better and better at it.
So this might be a wild question, but in terms of, because now we're going to have drones, your robots, autonomous vehicles at some point. Do you think that with like autonomous vehicles, maybe I'm off base here, but do you think autonomous vehicles could pose a risk to your company in the terms of you have the autonomous vehicle, it can carry a lot more packages and goods than just, you know, a small robot. And I'm like you said though, you can size up, scale up the form factor of your robots to whatever you feel is efficient and is profitable for you. But do you see that as a threat? Is it a threat?
No, I actually don't think it is. So, I mean, I love going back to the first principles for this. So, if a delivery can be done in a robot, you would always want it done in a robot. And here's why. Just think about it in terms of cost of hardware, cost of material. That vehicle is going to be much larger. It's going to need more sensors and technology to make sure that it's safe. It's going to use more energy. By the way, it also causes more congestion. It results in more emissions, over the life cycle. So there's actually going to be regulatory pressure. There are cities now that have banned vehicle deliveries, for example. But just purely from a business point of view, the cost per delivery on a robot will be cheaper. You don't, again, it goes back to why use a two-ton vehicle to move 2 pound burritos. Ultimately, from first principles, you want to use the right form factor for the right delivery, for every specific delivery. Delivery has always been multimodal. You don't use the same form factor for everything. If you want to go 5 or 10 miles, drones are the best way to do it. If you have a large item, vehicles are the best way to do it. But most deliveries happen to be in short distances and they're small. So robots are really, really good form factor for that. And maybe I add one more thing. This is kind of one of my favorite topics. Humanity has this funny problem of our imagination is very limited to what we know. So if you think about the first car, it looked like a carriage and it was called a horseless carriage. So we removed the horse and it still looked like a carriage. Now we have this thing called a driverless car. Again, we remove the driver, but it still looks like a car. In fact, we're naming it after the thing we remove. Even the word car comes from horseless carriage. So effectively it's driverless, horseless carriage. It's crazy. Like, we don't need to make it look like that. We need to get past that. I hate the fact that so much money has been invested in just removing the driver. We should have removed the car. And there are a lot of opportunities for that, which is, I think, ultimately we are one of the first to bring to market. And I expect there would be a lot of other examples for it.
It's like, when do we stop calling our phones?
Right.
Like, most of what we do is nothing to do with
has nothing to do with that. Yeah.
With talking. Exactly. A couple quick questions as we start to wrap up our time. Dr. Kashani, thank you so much for being with your generosity of time here at the Motley Fool. Lovely Lily says, how far can the robot go out in a delivery? What happens if there are no sidewalks or there's blockages? You talked a little bit about that, but maybe just reiterate what you had talked about earlier about that.
Yeah, so the drivetrain of these robots is one of those things we actually did a lot of work to make sure that it can manage all the unknowns of the city. Cities are very, very random places. We've had to deal with goats, literally, like a person with a pet goat walking next to a robot. So like the kind of thing you deal with city is completely unpredictable. So the drivetrain is capable of going up and down the curb. If it has to go into a different kind of texture, maybe it needs to go into the grass for a moment or get onto the street and kind of get past the block, it can do that. So, and it can also ask humans again remotely to help it when it doesn't know what to do. And then in terms of distance, as I mentioned, median delivery distance in LA is like 1.3 miles. I think we do up to 1.5 miles today, but we can do further. But generally, we benefit from doing the shortest distance deliveries that are in most congested areas.
Thank you.
So we have another question from Paco. He asks, do you have robot ambulances in case of unexpected failures? How many ambulances per 100 robots? And I love the way he posed that question too, but it's a great question. What happens if these unexpectedly in the middle of a delivery, the robots break down or tire comes off, something?
Yeah, so let me give you two answers. First of all, our delivery completion rate is something like 99.8%, which means once we pick up something, 99.8% of the time, we get it to the destination successfully. And just for comparison, that's almost an order of magnitude better than humans.
Yeah.
So it's phenomenally good. So that doesn't happen very often that we can't finish the order. Generally speaking, the robots leave in the morning and then come home at night. But we do have what we call a field operation team, but I like the terminology they use. Maybe we should use that. We have a field operation team. Their job is to help robots physically if ever necessary. But again, it's generally much more rare that would be needed.
Yeah, I could personally, anecdotally attest to the fact that I have to imagine they're much more successful at delivering than some of the delivery services with humans, because I've had many orders lost.
Right. Yeah, or they pick up the wrong thing. I mean, listen, humans are complex. They have their own priorities. Suddenly something comes up, their kid needs their help. Like it's reality, it's real life. Versus the robots, they do what they're told, and they're generally much more chill.
Dr. Kashani, what's a misconception about either your robots or robotics in general that you think we all have?
I have a few ideas. So I guess one is, I'm surprised often how people think this is not here yet. And I kind of, when I show them videos, social media, or whatever, that look, this is actually like a very normal thing in parts of the world. They're surprised by that. Of course, there are a lot of, again, fear or negative perceptions that we try to, educate. I think, that sentence about 2-pound burritos in 2-ton cars has opened a lot of doors for us. People have had maybe initial negative reaction. Oh, what is this tech bro talking about a robot delivering my food? And then we're like, listen, like, there is a bigger problem here we are trying to solve. It may not be obvious at first, and then the coin drops and the reaction and the attitude changes. So part of the job, I think, is also just educating folks. Why does this need to exist? Because, again, some problems are so big that we don't see it anymore, and the inefficiency of last mile is, to me, one of those problems. It's almost unlimited time. It's just a massive reality of our lives that we are completely we are tuning it out. And I think our job is to kind of remind people that it doesn't need to be this way.
What about the biggest misconception about being an entrepreneur, a CEO of an upstart company?
That's an interesting question. You know what? I don't often get asked questions I've never been asked before.
Well, if you want some time to think about it, I have another one that I could ask you that might be a little bit easier.
Sure.
How about what are some of the companies in robotics or technology that you really respect, that you follow and admire?
Yeah, I mean, look, the very first example in my mind is obviously Waymo. I'm a big fan of what they're doing. I've used their vehicles. In fact, we overlap in where we operate sometimes.
Yeah,
so
I bet.
I was right here where I'm calling you from, in one of our offices in LA, and ordered my own coffee. And when I walked out, as the robot was coming at me, a Waymo vehicle passed right behind it. So it was a very kind of futuristic moment.
I'm picturing like a showdown between one really big dog and like a small dog, the Waymo.
Absolutely. So I'm a big fan, obviously, NVIDIA. I'm a huge fan of NVIDIA. They were one of our largest investors as well. When we were a private company, we use their chips. We have had a very good relationship with them in terms of the technical partnership. So that's another company that I'm a huge fan of. I think they're really kind of the reason why a lot of the work we are doing is even possible. So those are a couple of companies that I have a lot of respect for.
And back to my question about just misconception, because Tom and David Gardner, who founded the Motley Fool, entrepreneurs at heart. Tom couldn't join us today, but so we've invested in so many companies that are founder led, and so it's a little bit of a soft spot for us. So I like when we have a founder on, I like to just understand the complexity between running and starting a business, taking investor money, trying to build a new technology and really create a new market. There's a question about competitive nature, but you really are trying to start a new market. So I just wanted to get a little context around how you think about running, your philosophy about running the business.
I think the most valuable thing that you need to have in a startup is perseverance, because the perception from outside is you only hear about me or other entrepreneurs when we are doing well. You never hear about the companies that are struggling to raise, right? And so from outside, it always looks like, there's money and everything is going great. But in reality, most founders are struggling. And somehow they need to, if they really have conviction that what they're doing is the future, and they need to they want to see their vision through, they need to find a way to survive. And it's kind of the rule number one for entrepreneurs. This is my maybe third company, depending on how you count. And I've been in situations where we have like weeks of runway or even less. And, what are you going to do? you have to absolutely, find a way to get through that moment. When SVB collapsed, all of our money was in SVB. We had one of those moments where we could be dead next week, and somehow we saw ourselves through. And just generally the crisis in the financial markets in the last few years, it was very challenging. So I think having perseverance is kind of the number one rule. And then I want to answer the misconception question as well. I would say, I think there's this concept that the most successful entrepreneurs are, jerks. Like they have this really rough personality and they're rude to everybody. And I really disagree with that. I think that, the best leaders I've ever interacted with are actually really good, decent people who are supporting everybody around them, and that idea of this kind of abrasive personality just doesn't bode well with me, and it's not the reality that I've seen. But I've seen some people emulate that, and some people kind of have that perception, which I really disagree with.
Well, I'm glad that you could share that, and thank you very much for enlightening and teaching so many of our members who are watching us, and Sanmeet and myself too, and me about your company, Serve Robotics. Dr. Ali Kashani, we wish you all the best in your endeavor and look forward to seeing more and more of your little robots with some fun names roaming around different cities around the U.S. and internationally. Best
thank you so much.
To you, and thank you for joining us here on the Motley Fool.
Thanks for having me.
So much.
Thank you. Sanmeet, outstanding. I really enjoyed that. I thought it's a very interesting technology, a very young, it's still a company finding its roots, right? It's still figuring out its business model as two key partners, like he mentioned in Uber and Marge, the other one. So, but there's so much sense of what he was saying about fulfilling that marketplace. Any quick reflections before we bring in the next group?
Yeah, no, I think it was amazing. The future really is here, and whether you want to embrace it or not, it's here, and might as well just embrace it and see where and see where it goes. But I like that he had a lot of great answers to questions about how they're gonna try to figure out certain things in their business and the challenges. He had very good explanations for all of that. So he seems like a very thoughtful entrepreneur with a lot of future challenges kind of in mind. So.
Yeah, and I appreciated his final comments about the difficulty of the perseverance, but then also just the fact that it isn't all just jerks out there, trying to start and run companies and push through their thing, but it takes a lot more to that. So but thank you for joining me on that, Sanmeet, and we can
that was great.
We can welcome Danny and Rachel who came in, and I don't know if you all had a chance to catch any of that interview we had with Dr. Kashani, but it was really very interesting about what he is trying to build. I mean, Serve Robotics is it's a micro cap company. It's a few $100 million in market cap. Like he said, he raised a few $100 million. So, it is still really trying to find its way.
Fascinating interview.
Yeah, I liked his comment about addressing the bigger problem than that last mile delivery. And that's truly the least efficient of all of the parts of the delivery process.
And least efficient and most, most complex, like flying, right? And costly, like finding an airplane, right? It's the takeoff and the landing that are by far the most complex. And that's where you have the human endeavor in there. Because of that complexity, he and his team are trying to solve that. So
the cost per delivery will be a huge, a very, very key indicator of their business going forward and how they're succeeding or not.
100%. 100%. Well, we look forward to talking more to him. Just his whole comments about perseverance. We could bring him on for a whole show about that.
Yeah,
talking about that. So
just on
Danny,
entrepreneurship.
Yeah, Sanmeet, thanks for joining me, and Danny and Rachel. We'll turn it over to you all.
Awesome.
Right,
have a great hour.
Thanks, Andy. Great
Thanks,
job.
Cheers.
Thanks so much, guys. Well, hello, Danny. How are you?
Rachel, it's like I haven't seen you in since this time yesterday.
I know. We're turning this into a regular habit these days.
The Danny and Rachel hour.
The Danny and Rachel hour with Danny's cool Hawaiian shirts.
This one has a Cajun Creole menu influence.
Oh my gosh. I am always
peppers and onions and yeah.
I come to these shows not to talk about stocks, but just to see what cool shirt you've decided to wear on any given day, Danny. That's why I'm here.
You know what? There are worse things for being known for. And oh, look, one of our moderators noted, you've made me want to get my little Jack Russell, a whole collection of Hawaiian shirts. Outstanding. I would pay to see that.
There we go. Well, fools, for the next roughly, say, 54 minutes that we have remaining of our hour-ish, we're going to be talking about earnings. We are, Danny and I were talking about this before we came on. We're really at the tail end here of earnings season, and there's just a few companies. One that's reporting today that we're going to get into later in the hour is Lululemon. That's one that's obviously widely followed by a lot of us in the full universe. But there's some others that we haven't had a chance to get to this earnings season that I think are worth talking about. But if you have any questions related to the companies we're going to be talking about, or just any questions that you would like for Danny and myself to answer related to different stocks, go ahead and get those in the Slido. The event code for that is Full24. SLI.do. Maybe to start off this earnings hour, I'll talk a bit about KB Homes. They reported the other day and wanted to take a little time to talk about the business and really how it operates. They reported on the 24th, so a few days ago now. And for those of you who don't follow this business, KB Home, they are a home builder. So obviously they are operating in a space that is facing some headwinds right now, to say the least. They make money in a few different ways, but primarily by selling new homes and also through some financial services like mortgage banking through their joint venture. The focus of KB Home is really on first-time home buyers and offering personalized home at attractive price points. So as I mentioned, home building is the crux of what the business is built around, building and selling new homes, primarily targeting first-time home buyers. They offer customized plans, so buyers can customize aspects like their floor plans, cabinets, countertops. Then they have their mortgage banking joint venture, which provides financing options for home buyers. They have seen some increased income from this joint venture driven by higher loan originations as well as interest rate locks. And then they also generate revenue through the sale of land and land development. They have a pretty long history of investing in land acquisition and development and returning capital as well to shareholders through share repurchases. This is a challenging time for a business like this. Obviously, we are in a market where home building is down. There's also very much the reality that the cost of construction is up. The cost of buying a new home, much less building to order one, which is what KB Home specializes in, is something for which we have seen a decline in demand the last few years, given the landscape of the housing market, the still elevated state of interest rates, and other macro factors involved. And so they are facing challenges to their business that have reduced margins and lowered some of the short-term outlook, at least, for the company. For example, high mortgage rates have made new homes less affordable. So that's led to a decrease in demand for KB Homes' products. There's also this dynamic where there are increased costs for materials like lumber and land, and that has really squeezed their profit margins. Supply chain disruptions, such as shortages of electrical infrastructure materials, have caused delays and some reduced production volumes. There's also been reports of issues with some of their vendors, such as siding problems that has caused some dissatisfaction among homeowners. KB Home is maybe not a household name, but they are one of the largest home builders in the U.S. They've been building homes for more than 65 years, with nearly 700,000 homes built since the company's founding in 1957. They build everything from attached and detached single-family residential homes to townhomes and condominiums, again, designed primarily for first-time and first move-up, as well as second move-up and adult home buyers. They have said that our home building operations represent the majority of our business, accounting for 99.6% of our total revenues in 2024. So they do have these other divisions I mentioned. They said our financial services operation, which accounted for the remaining 0.4%, of our total revenues in 2024 offers various insurance products to our home buyers in the markets where we build homes and provide title services in certain of those markets. And then their financial services operations also provide mortgage banking services, including residential consumer loan originations to our home buyers indirectly through KBHS Home Loans, which is an unconsolidated joint venture between them and a third party. But again, home building is really the core of the business. Their markets are organized in terms of reporting purposes into West Coast, Southwest, Central, and Southeast. And their core business strategy, which they refer to as KB Edge, is to expand their operations primarily within their current geographic footprint to achieve a top 5 position in each of their served markets. So they said, we seek to manage our working capital and reduce our operating risks by primarily acquiring entitled land parcels within attractive submarkets identified by our market research. They focus on investments that provide a 1 to 3 year supply of land or lots per product line per community, and individual assets that are generally between 50 and 300 lots in size. And then, as I noted, they offer their customers a wide variety of homes, and their built-to-order approach is something that they have been known for a very long time. Roughly 60 to 70% of their homes delivered are built to order, with the remainder consisting of homes started without a corresponding buyer and partially constructed homes where the initial buyer canceled their home sales contract with the company. So that's a bit of a background into the company as we head into their results here. Again, as I mentioned, this is a space that is struggling right now. And anyone that follows the home building space, would understand some of the dynamics at play. These were their results for their first quarter of their fiscal 2025. So they reported revenue of $1.39 billion in the first quarter period. That was a 5% decrease compared to the year ago quarter. They also reported that homes delivered decreased 9% year over year, while the average selling price of a home rose 4% year over year. They reported a lower home building operating income than 1 year ago. In their first quarter of fiscal 2024, their home building operating income was about $158 million. This most recent quarter, it was $127 million. They also saw a slight decline in their home building operating income margin, which was 9.2% compared to 10.8% a year ago. They also noted that their financial services pre-tax income declined 35% year over year, primarily due to decreased equity in the income from the company's mortgage banking joint venture, which I went into just a little bit ago. They are still profitable under GAAP, but again, all of these different factors that I mentioned have impacted the bottom line as well. Net income decreased about 21% year over year to $109.6 million. Net orders were down 17% year over year, which is not, again, surprising given the backdrop in which the company is operating in. That also contributed to a decrease in ending backlog homes. Ending backlog value declined 21% year over year. They also noted that monthly net orders per community decreased 3.6 compared to 4.6. Now, they do have solid liquidity on hand. They had about $1.3 billion on their balance sheet at the end of the quarter, and that included about $268 million of cash and cash equivalents and approximately $982 million of available capacity under their unsecured revolving credit facility. They are providing guidance for 2025. They're expecting housing revenues will be in the range of $6.6 billion to $7 billion for the full year, with an average selling price in the range of $480,000 to $495,000. This is a very difficult time for this type of a business. As I noted, they are still profitable, but they are really seeing the realities of the housing market play out in every core metric, from their operating income to their profit margins, to homes being delivered and ordered decreasing significantly. I do think that this is a business that, once we see some kind of recovery in the housing market, I do think this is a business that is primed to recover when that dynamic shifts. But at least in the short term, this is a very, very difficult market for the business. And because they derive essentially all of their revenue and profits from home building, there is really not a whole lot that they can do to minimize the impact of those headwinds. Unless and until this market improves, I would expect it to be a rough few quarters at least ahead still for the company. So that is KB Home. Wanted to talk about their earnings. It's a solid business. A lot of the headwinds they're facing are really outside of their control at this point.
Yeah, one of the things that I've talked about on previous shows and have read similar opinions from people that are smarter than I am is that, the housing market is frozen. Some of it has to do with inflationary pressures. Some of it has to do with availability. And some of it has to do with the fact that there are so many people over the past, a few years ago when we were in the pandemic era, when mortgage rates dropped so low, a lot of people refinanced their homes at below 3%, below 4%, below 5%. And now you've got, mortgage rates up around 7%. And I don't know if they've changed. I haven't looked in the past couple of weeks or so. But, I personally refinanced below 3%. And there is no way that I'm looking anytime soon to, change houses, because the mortgage rate that I have is just too compelling. It's not something I'm willing to give up. And there are a lot of people out there who feel the same way.
Yep. I've had the same conversation with people in my numerous people in my life, including my parents, who are, roughly around retirement age. And it's just a dynamic where supply is so low and interest rates are still so high that it is not worth it financially to move at this point. So yeah, it's a very tough dynamic for these types of businesses right now. And it's hard to say exactly when the ship is going to right itself. I mean, inevitably, if interest rates do get slashed more over the long run, that will have an impact. But we're seeing very, very modest changes where that's concerned. And so I think that this is a reality that, at least for, the near term, is here to stay for these types of businesses. And of course, for consumers.
Yeah, because I'm looking forward to inflation coming down someday.
One day it would be so nice.
So one of the companies that I wanted to talk about is one that I don't think many investors have heard of, and it's one that only came on my radar recently because they inked a deal with Shopify. The name of the company is Braze. That's BRAZE, and the ticker is BRZE. Now, for those who may not be familiar with Braze, like I was, they are a leading customer engagement platform that powers lasting connections between consumers and the brands they love. Braze allows marketers to collect and take action on any amount of data from any source so that they can creatively engage with customers in real time across channels from one place, from one platform. This cross-channel messaging and journey orchestration is powered by AI. It enables company to build and maintain engaging relationships with their customers. And if you have ever gone into a store and you were looking at their website online, looking at a particular item, I know I have gone into JCPenney and I've had my phone out and I'm flipping through to see what the sale is. And then all of a sudden, you might get a notification, you might get a text from the company or an email from the company that, gives you an intriguing offer. there's a chance that that was powered by Braze's technology. Just to give you a little bit of a backlog for the company, they've got over 2,300 customers. They've got 7.2 billion monthly active users, over 3.9 trillion messages and other actions when they reached out to consumer. And they had last year they had a net dollar-based net retention of 111%. And generally what that means, anything over 100 means that existing customers are increasing their spending. So in this case, their existing customer base increased their spending by more than 11% over the previous year. So this is just the information that I got off their website, just to kind of give you an idea of who Braze is. Now, the reason that they came on my radar is that earlier this month, Braze inked a partnership with Shopify. And as we know, Shopify is one of the leading platforms for e-commerce integration for merchants with existing businesses. And it provides all of the tools that merchants need, not only for their e-commerce store, but also to integrate their existing physical locations and basically integrate all of that information. So Shopify has made Braze the customer engagement platform for its merchants. Now, the company said in the press release that Braze customer engagement platform provides real-time, flexible, cross-channel solution for brands of all sizes. And they gave a list, which I thought was a pretty interesting list. They are used by Elf Beauty, Hugo Boss, Gymshark, The Gap, and Overstock. They all use Braze as the customer engagement platform for their e-commerce customers. And they had a testimonial on there from Elf and from Bridget Barron, who's their Senior Director, Global Customer Relations Management and Customer Growth, and said that at Elf Cosmetics, we know that truly understanding our consumers allows us to serve them better. It's not just about reaching them, it's about delivering value in ways that feel relevant and welcome. With Braze, you can create personalized, data-driven experiences that resonate with our community, ensuring every interaction is meaningful rather than just another message. And by just another message, I think they meant annoying message. Because I don't know about you, but there are a lot of messages that I get that I'm like, whatever, next, and move on. Braze is trying to make, excuse me, make these interactions with customers meaningful and relevant and therefore profitable. So Braze just announced, in fact, after the market closed today, they announced their, let's see here, their fourth quarter results for fiscal 2025. And that ended on January the 31st. So they're one of these customers where, their 2025 fiscal year actually ended in January. They talked a bit about, excuse me, about how, 2025 was something of a milestone year for them. Their revenue was $160 million, up from $131 million a year ago. That's 23% year-over-year growth. And they said that it was driven by new customers, by upsells, and by renewals. Those results were driven by subscription revenue that was $154 million compared to $126 million in the fourth quarter of the prior year. And as well as professional services revenue of $6.5 million, up from $5.1 million.
Oh, I think you're muted, Danny.
Still muted. You click the
We
button.
don't want to miss that.
No, don't want to miss that. So their remaining performance obligation, they closed out the quarter with 793 million, of which 505 million is current, which means they're going to recognize that over the course of the next year. I want to stop there for a minute. Whenever you're talking about remaining performance obligation, in that current portion, that gives you insight into revenue that the company is actually going to have over the course of the next 12 months. So you know that they already, excuse me. Yeah. So you know, based on that, they already have 505 million in current performance obligation, which means that's going to drive some significant revenue over the course of the coming year. And if you think about, their revenue is about 160 million. That's a run rate of about 640 million. They've already got 505 of that on the books. So I think that's pretty impressive, and it is worth noting. Their gross margins expanded from 67.2% to 69.3%. We always like to see gross margin expansion. Their dollar-based net retention for all customers for the preceding 12 months was 111%, down slightly from 117%. They also noted that their net retention for customers that had annual recurring revenue of 500,000 or more was 114%, was actually higher. So that means their most valuable customers are spending even more money. Total customer count increased to 2,296, up from 2,044. So that's pretty good growth there. Their operating loss under GAAP was 21.6 million, down from an operating loss of 32 million. So they're getting closer to profitability on a GAAP basis. On an adjusted basis, which excludes certain one-time charges and stock-based compensation, came in at about 7.9 million, compared to a loss of 7.5 million in the prior year quarter. So, as you go down the financial statement, it looks like all of the metrics that they are reporting are heading in the right direction. I took a look just to see what it was that analysts were expecting. The company delivered revenue of 160 million. Analyst consensus estimates were for 156 million. Their adjusted earnings per share of 12 cents was more than double the 5 cents that was expected by analysts. So again, not only did they exceed their own guidance, but they also surpassed what it was that Wall Street was expecting. Now, if there was one thing that may be weighing on the stock in after hours trading, I want to go back and look, because it was weighing on after hours trading here just a moment ago, and I want to see if that is still the case. Actually, I guess investors changed their mind. They're now looking at it like I did. The stock is currently up almost 17% in after hours trading, after initially being down a little bit. So the numbers certainly support a stock price increase. I think that we haven't yet seen the impact of the recent partnership that they had with Shopify. They announced that partnership on March the 18th, and these results only cover through January the 21st. So not only do you have already impressive results, but none of the partnership with Shopify is in those results yet. So I think investors are probably celebrating that the company's results were that good, and probably when we see what Shopify brings to the table, those results could even be better.
Yeah, this is an interesting business. I'm obviously very familiar with the type of technology that their business operates around, but I was not familiar with the business. So I was kind of excited when you said you were going to talk about this one, because this is one that is perhaps lesser known, might be a little bit more paid attention to by investors now, given its recently announced partnership with Shopify. But interesting business for sure.
I like it.
Lululemon has reported, and I know we both have thoughts on this business. No, it was from first glance, and I'll dive into the numbers here in a bit. From first glance, it was a pretty good report, and they had come out back in January, and I've talked about this a few times on the show. And at the ICR conference, I think it was, and management had essentially updated their guidance for Q4, and they had elevated their revenue guidance, elevated diluted earnings per share guidance, and where they had previously, I think, been looking at a potential decrease in their gross margin, they actually turned around that projection to reflect an increase. The stock is trading down after hours, and from what I can see, it's given the guidance that they are projecting for the upcoming year and or quarter, despite the fact that they beat what analysts have been projecting. But before I get into the numbers, I know this is also a company that you follow as well, Danny. So I'm curious if you have any specific thoughts that you wanted to share.
So, I think that this is an earnings report that you can't necessarily take in a vacuum. You kind of have to look at what's been going on in the space. And the short version is that, Lululemon stock was doing really well through the pandemic and towards the end. But then when we got to 2024, the stock lost more than half of its value. It dropped by, if memory serves, about 55%. And investors were concerned about the slowing sales growth, about the challenges that were going on across the industry in retail, and about the fact that while Lululemon is still growing its sales, it's doing so at a slower pace. And there were a few things driving that. I hate to beat a dead horse, but it's the inflation. People, when they have less discretionary income, they're much more choosy about how they spend that money. And so I think one of the things that Lululemon was seeing was that either consumers were deciding to not buy this athletic apparel or athleisure apparel, or they were trading down to a less. Lululemon is considered a premium brand, and they were trading down to what economists call a substitute, buying something that is less expensive, and while it's not exactly the same, it's close enough. So we've been seeing a lot of close enough shopping in 2024. And it's not just Lululemon. I mean, there's been a challenging retail environment that's been going on for more than a year now, probably a couple of years now. There's also market-specific challenges. Investors are concerned that, maybe the athleisure market is getting a bit saturated, and the increase in competition from other less premium athleisure brands. One of the other things, and this was kind of a company-specific issue, is they had what I read was a high-profile launch misfire in early 2024, which included they had to, pause the sales of their Breeze Through collection. There were some design adjustments. It was a big they publicly got some egg on their face, through the breeze through collection. And finally, the CEOs of Lululemon, Calvin McDonald, has announced plans to double the business, but investors are kind of taking a wait and see attitude. So, over the course of the last, let's say, year and a half, it's been a really challenging environment for Lululemon. So hopefully that teed that up nicely for the current earnings report.
Yeah, thank you for that, Danny, because I do think it's an important discussion to have, because this is a business that has been reporting pretty solid financial results and looks well on their way, including from this earnings report, which I'm about to dive into, to achieving their, Power of 3 × 2 growth initiative that they had announced a few years back, where they want to double their revenue to $12.5 billion by 2026. And a lot of that revolves around, sort of a multi-pronged approach: product innovation, expanding their men's revenue, doubling their men's revenue, actually doubling their digital revenue, quadrupling international revenue. I've talked a lot about how they've been expanding internationally, both through brick and mortar stores across Europe and Asia, as well as a specific concentration in the Chinese market, but also the ways in which they have launched e-commerce sites that are very specific to the country in which they're operating. For example, they launched a Spain-specific e-commerce platform. So there's been a lot of ways in which the company has been aggressively moving towards its growth goals. And as I mentioned, as we kind of go into the numbers here, the market seems to be, at least after hours, responding to the fact that while the company beat what analysts had been projecting, they issued guidance for the upcoming year that seems to not be what investors or the market were broadly hoping for. So let's take a look at their results. For 2024, net revenue increased 10% year over year to $10.6 billion. Now, bear in mind, their annual revenue figure that they're wanting to hit is, I believe, $12.5 billion by 2026. So in fiscal 2024, they delivered $10.6 billion in revenue. That was a 10% increase from the prior year, or on a constant dollar basis, that was an 11% increase. Net revenue in the Americas, which is their most mature market, increased 4% year over year. International net revenue increased 34% year over year, or on a constant dollar basis, that was a 36% year over year increase. If you exclude the net revenue from the 53rd week of 2024, the top line grew 8% rather than 10% in 2024 compared to 2023. That was a major, that end of the year period, right around the holiday sales, was a huge growth driver for the business. Comparable sales, which excludes net revenue from the 53rd week of 2024, increased 4% year over year. Now, you'll note how I mentioned that America's net revenue was up single digits, international net revenue grew double digits year over year. Comparable sales in the Americas actually saw a slight decrease of 1% in 2024 compared to 2023. However, international comparable sales grew 22%. So again, this is their fastest growing and least penetrated area is outside of North America. On a constant dollar basis, that was a 24% increase. Their gross margin expanded 90 basis points. Gross profit increased 12% to $6.3 billion. The company's operating margin increased 150 basis points to 23.7%. The company also added 56 net new company-operated stores during the year, including 14 company-operated stores from the acquisition of the Mexico operations. So they ended the year with 767 stores globally. They also had $2 billion in cash and cash equivalents on their balance sheet at the end of the year. I wanted to look up one other figure that they didn't flesh out in their initial reporting, but they listed it further down, so bear with me. Net income for 2024 was 1.8 billion. That was compared to about 1.55 billion in fiscal 2023. So a nice uptick there. Now, bringing it into the final quarter of the year, where again, you've got a strong period of shopping from the holiday season. Net revenue in Q4 grew 13% year over year to 3.6 billion. That was helped by a 7% increase in America's net revenue and international net revenue, which increased 38% year over year in Q4. Again, if you exclude net revenue from the 53rd week of 2024, net revenue in Q4 increased 8% rather than 13%. So that 53rd week was a huge boom for the business. Gross profits increased 15% in Q4. Income from operations, 14% year over year. And they opened 18 net new company-operated stores during the final quarter of the year alone. Now, as terms of guidance for fiscal 2025, the company breaks out its guidance for Q1 as well as the full year. So for Q1, they're expecting net revenue in the range of 2.335 billion to 2.355 billion. That would represent growth of 6% to 7% year over year. They're also targeting diluted earnings per share in the range of $2.53 to $2.58. Now for 2025, they are expecting net revenue to be in the range of 11.15 billion to 11.3 billion. That would be growth of 5% to 7% year over year, or actually, if you exclude the 53rd week that we just had in 2024, that's 7% to 8% year over year growth. So again, they just delivered 10% revenue growth, or 8% if you exclude the 53rd week of 2024 for their fiscal year. They are now projecting basically a similar growth rate for 2025, 7 to 8% on the top line. And diluted earnings per share in the range of $14.95 to $15.15 for the year. Honestly, this was I think this was a pretty solid report. There's nothing about this that really shocked or surprised me. It was broadly in line with what they had been projecting. But I'm curious, Danny, if there's anything that strikes you now that we've gone through some of the numbers.
You know, I think this is an issue that's going to take longer than 1 quarter to resolve. I don't know if you remember, but there were a number of years ago, there was a scandal at Lululemon because they released a product that when the wearers put them on, you could actually see through the pants. And there was a huge public outcry, and Lululemon stock fell like a rock, and there were, much wailing and gnashing of teeth and calls for the CEO to resign and et cetera, et cetera. Yeah, they blew it. And guess what? That happens sometimes. So I think that I am not a Lululemon investor, but I know lots of folks who are. And I would say that, if history is any indicator, what we will see is that Lululemon will come back from this. It might take a little while. Part of it is due to the economy. Part of it is a self-inflicted wound. But in all, I don't see the athleisure space going away.
Yeah.
And I certainly don't see Lululemon losing its premium place in that market. So, I generally don't do consumer retail because the space is a little bit too fickle for my taste. But that said, if you wanted to pin me down, I would say I think Lululemon is going to be fine. It's just going to take a little while for them to turn things around.
And the thing is, I mean, not only these are solid numbers, right? So they are forecasting for the fiscal 2025 growth that's pretty much in line with what they just reported, if you exclude the impact of this 53rd week of 2024.
Right.
And for the first quarter, right, they're looking at growth between 6 and 7%. And their Q1 of 2024 net revenue was about 10% year over year growth. I don't think that it is realistic to necessarily expect the level of growth that we saw, several years ago, for example. This is a much more mature business, but this is also a business that very much met the guidance that it had forecast, and it beat what analysts were forecasting, particularly when it comes to earnings per share. The biggest thing that seems to be shaking some investors' confidence after hours, which again, we take after hours stock movements with a grain of salt. But that has to do, I think, just with the forecast that they are sharing for the full year. And a lot of that is about, quote, ongoing macro uncertainties, the buzzword we're hearing from a lot of management these days when earnings are reported. I think that is important to factor into the equation. I'm glad management of these companies is not trying to skirt over that. That is a very real issue, but there's nothing fundamentally sticking out to me about this that is concerning or wrong with the business. It's also worth noting, looking at their supplement, their earnings supplement that they provide. They also, as I noted, that America's net revenue was up 7% year over year in Q4. China mainland net revenue increased 46% year over year. Their revenue from the rest of the world, though excluding the Americas and China, increased 30% year over year. And then America's net revenue increased about 7%. That is their most mature market, North America. A huge part of their growth strategy moving forward is all about expanding internationally. And that is where you are seeing the fastest growth rates in the, low to mid double digits, which I think is really excellent for where this business plans to go and the rate at which they are intentionally expanding. So there's nothing about this that is concerning to me. I think that expecting some moderated growth in 2025 is normal. And I think that is much more about the environment in which this business is operating more than anything fundamentally at issue with the business itself.
Fair enough. There's a question in the queue from Matt. And actually, Matt asked this question the other day, just as we were going off the air. And by the time it got through the process and made it to the queue, I was already gone. And I think I answered it once already during another show, but perhaps Matt wasn't available at the time. So I want to read Matt's question in total, which is, the reason Disney removed some of its content is because found many of their customers didn't like or want that content. He is referring to the fact that Disney took a $1.5 billion write-down of some shows on their streaming service in mid-2023. His comment goes on to say, because fewer consumers wanted that content, certain assets held less value for Disney, and it became necessary to record the massive content impairment charge. Hence, the underlying question, at least for me, is this: what happened or changed that made said content less desirable by Disney's consumers? Usually, when a brand loses power the way Disney's content assets did, it's because the holder of the brand has done something to screw it up. That's a fair assessment, Matt. And what I want to say, and I'll go back to what I said earlier, at that time, Disney was under a lot of pressure to cut expenses. There was a lot of pressure from outside investors. You may recall that they were going through a deal with, what is that guy's activist investor, Nelson something, I can't remember his name, but who at the time was trying to get a seat on Disney's board, getting Disney to cut costs. And Disney had already made taken a number of steps to do that. You may also recall that when they announced that they were going to launch Disney Plus, they scrambled to not only put on a lot of legacy content, but try to put together some content now, new content that consumers might be interested in. Now, that $1.5 billion might seem like a lot of money, but in the context of how much Disney spent on getting content together and getting it on the air for the launch of Disney Plus, that 1.5 billion was a drop in the bucket. So when they got to the point where they had to cut expenses and they were looking at this holistically, they stepped back and said, how can we do this? How can we save money? By taking some of those programs, and there weren't that many of them. Think about it. 1.5 million is maybe, half a dozen, maybe, no more than 10, I would think, programs, whether it was movies or series. This was something that they did for accounting reasons, and that's all it was. The accountants could say, hey, we pulled this stuff off the air. We're taking a tax loss on it, and they actually made more money on the tax loss than they made on these poorly performing shows. Now, remember, they had a lot of programs. They put a lot of new programming on on Disney Plus when it launched. These were the lower performing shows that they took a write-off on. So what happened was Disney took a lot of chances. They took a lot of ideas. They threw it at the wall. They were trying to get as much stuff on Disney Plus as they could. And then they took a write down on the worst performing ones of that. And that's all it was. It was a business decision. I don't think that this is any indication of the desirability of Disney's library of intellectual property overall. This was a specific instance for a specific purpose. And that's my take on it. Now, of course, and thanks to our viewer, Tim Jungles, who said the activist investor whose name I was trying to think of was Nelson Peltz. Tim, you're absolutely right. That's the name I was trying to think of. So I don't think this says anything about I don't think this has any broader implications for Disney's intellectual property. I think this was generally a one-time gig. And keep in mind, when you're creating original content, whether it's for Disney Plus or whether it's for the movies, you have some programming that is going to perform remarkably well. You have some performing okay, and you have some that is just not going to resonate with audiences. And that's the nature of the beast. I hope that answered your question, Matt. And thanks, Tim.
All right. Thanks for that, Danny. We just have about 7 minutes left in our earnings hour. And there's one more company I wanted to try to get to before the end of the hour. And then there's a couple questions directed at me that I'm here another hour that I will endeavor to answer in the next one. But one company, and you brought this one to my attention, Danny, that reported that we somehow kind of overlooked was Petco. So I did a whole, kind of dive into Chewy's earnings this week, which was a lot of fun. And that's a business that I'm, much more interested in personally speaking. But, Petco has been dealing with some struggles, although it's worth noting the stock has actually been on quite a tear over the last year. It's up almost 50% in the last year, despite the fact that shares are trading at about $3.21 each. This is a company, with a market cap of about $1 billion right now. But Petco is very much, this legacy pet store business. They generate revenue from the sale of a wide range of pet supplies, including food, toys, beds, and other essentials. They also have their own private label brands. They see strong growth in consumables such as pet food and medications. Those also tend to be some of the most resilient areas for pet owner spending, even in times of economic difficulty, as these are, essential for their pets. And they have also built a strong omni-channel presence through the years, which allows customers to shop and access resources both in store and online. They've really kind of tried to rebrand their business model the last few years around being a comprehensive health and wellness company for pets. With a real ecosystem of products, services, and resources. They've got in-store vet hospitals. They also have grooming and training services. They also sell a wide selection of pet supplies and food, both online and in their physical stores. They also have their own app, the Petco app. And they have partnered with various organizations to expand their services and reach through the years, including vet clinics, pet care service providers, animal welfare organizations. And they continue to actively expand their network of vet hospitals and clinics, while also focusing on digital platforms and services to reach more customers. Now, it's very easy to compare this business to Chewy. Petco is still primarily a brick and mortar store with a growing online presence. Chewy is primarily an online retailer with a strong focus on e-commerce and subscription services, and more recently has expanded to its own network of veterinary clinics. They had launched 8 of these locations as of the end of their fiscal 2024, and that's been going quite well for them. So Chewy was sort of always centered around its online flagship platform, while Petco has obviously been around for much longer and offers a wide range of services, still heavily reliant on the brick and mortar model. Petco has been facing some challenges in recent years. They've dealt with shifts in consumer spending habits. There's obviously intensified competition, not just from companies like Chewy, but also mass merchants like Walmart that offer convenient alternatives or better value, and is maybe drawing customers away from Petco. Petco has been forced to slow some of its plans for newer vet hospitals, and they've also seen declines in discretionary categories with growth, particularly in services and consumables. The CEO actually stepped down in March of 2024. I'm not sure if they have yet named a new one. Last I checked, they still had interim leadership, but I would have to check to have a real update on that. I think, as I'm looking here, that they had Joel Anderson step into the role at some point last year, and that was a more recent shift. So, talked a lot about a business like Chewy, right? And how they're growing and how they're increasing their profitability, and they're seeing, fairly strong single-digit growth and much more than that on the bottom line. Well, at Petco in 2024, they reported net revenue of about $6.1 billion. That was actually a 2.2% year-over-year decrease. They saw comparable sales book a slight increase, but just about 0.3% year over year. They had a GAAP net loss of $102 million in the 12-month period. They also recorded a net loss under GAAP of about $14 million in Q4. They did report positive operating cash flow of about $178 million. That was down from the $216 million that they generated in 2023. They also had reported negative free cash flow in 2023. They turned that into positive free cash flow of about $50 million in 2024. The CEO said, "I'm confident under our new leadership team, we're well positioned to build on this early momentum." They're hoping to deliver double-digit adjusted EBITDA improvement in 2025 and set the business up for sustainable profitable growth. They are targeting that net revenue will still see declining figures of down low single digits year over year in fiscal 2025. They are targeting up to $390 million in adjusted EBITDA, which would indicate that they are expecting to report another GAAP net loss in the coming year. So they're forecasting a decline in revenue, continued unprofitability under GAAP. A lot of the issues I mentioned continue to persist for the business between the competition they're facing, the headwinds with their old model, although they, again, have worked to diversify into a broader omni-channel experience, and the leadership shifts they've been going through. There's also been just a lot going on with the environment that they're operating in, and some of these newer players that are really eating up market share. So not the best report for this business. One I wanted to cover. It's interesting to see how their business is performing in light of some of these newer players that we talk about, much more frequently.
I thought it was interesting after, your pretty exhaustive coverage of Chewy's results yesterday.
Oh, yeah.
To take a look at Petco and the fact that, for instance, I just went back to look. So Chewy's net sales improved by 15% year over year in the fourth quarter, while Petco's net revenue declined by 7.23% year over year. Now, that's including the negative impact from the loss of the 53rd week in 2023. But still, their comp sales were flat, and Chewy's were positive. So I think when you look at the two side by side, it's really telling about how Chewy is outperforming, legacy players like Petco.
Absolutely. And with that, we are up to the end of our earnings hour. I'm sticking around for another hour, waiting for Will Healy to be ushered into the room here for our next hour of Full 24. Hey, Will.
Hey, how are you doing, Rachel?
Good. How are you?
Pretty good.
Well,
awesome.
I will leave you guys to it, and I will be joining Will again in an hour from now.
Thanks, Danny.
Co-host switch up here.
Right. All right, fools. Well, welcome to another hour of Full 24. This is it's sort of become an unintended recurring hour, consumer goods hour with Will and myself, because I think we both cover a lot of companies in this space. And there's a lot of interesting ones to talk about right now, even as we're at, sort of the tail end of earnings season here. So fools, if you have any questions related to our theme, go ahead and get those in the Slido. The event code for that is Full24. We also see some questions coming in from the last hour, and we'll do our best to whittle some of those down as well in the next 58 minutes or so. But Will, as we were kind of going to start off the hour talking about our theme today, I know we've talked about a lot of consumer-centric businesses throughout the last couple months in the thick of earnings season. We're seeing that period wind down for a few weeks before some companies start to report again. What are you, watching right now? What are some companies that you're paying particularly close attention to?
Well, I had a question come up yesterday about dividends, and I thought it might be appropriate to look at Target for one, pertaining to its dividend, because the stock has been hammered lately. That lower price has increased the dividend yield. So it's north of 4% now. And keep in mind the S&P 500 average, I think as of today, is approximately 1.3%. So you're talking more than triple the S&P 500 average. Once you get into levels like that, you kind of have to do a little bit more due diligence on the stock to figure out if they could pay it. And admittedly, with Target where it is right now, you don't want to assume that they can pay it, even though Target is a fairly stable company. They've had some struggles lately, competitive struggles. They've had to compete against Walmart, against Costco, against Amazon, and that's called into question. Maybe not their future, but how they're doing, especially with their sluggish same store sales. And bear with me while the slide comes up. But yes, the dividend pays about $4.48 per share annually. Like I said, 4.15%. But it is a little bit of above 4%. And if you look at the chart in the purple, it's not quite to the 10-year high because it had some times around, say, 2017 where it was trading at a higher yield. But as you can see over the next 2 to 3 years, the yield slid substantially to where I think at one point it was barely above 1%. So that if that were to repeat, obviously that would be great for Target shareholders who bought at a time like this. If the yield were to slide that much, that means the stock price is going up. So I can't guarantee that's going to happen, but I think there's some good reasons to treat this as an anomaly. For one, it has increased its dividend for 53 straight years. That makes it a dividend king. So that's not many stocks attain that designation by increasing their dividend every year for a half century or more. So that is pretty impressive. That also includes several economic cycles as well. So they've obviously had their struggles before. They've come out of those struggles. So you have to kind of take that with a grain of salt. But looking at dividend affordability, free cash flow almost $4.5 billion. They only spent excuse me. They spent just over $2 billion on the dividend over the last year. That does include an increase. They increase the dividend every year, or at least they have been around the middle of the year. So I think it was I want to say it was $1.10 per share, but before that, yeah, because they didn't increase. As you can see over the last few years, they've only increased that dividend very incrementally, whereas before 2021, the increases, as you can see on the orange line, were substantially higher. So yeah, they've gone to more modest dividend increases lately, but likely to keep that dividend king designation, because you back out of something like that, you stop paying dividend, you increase the dividend for more than half of a century, and then suddenly stop. That's going to undermine confidence in your stock. So even though they don't technically have to pay a dividend, and they certainly don't have to increase it, you can assume they probably will if they possibly can, just for that reason. So despite spending over $2 billion on dividends, they were still able to spend $1 billion on share repurchases. They reduced the long-term debt by over $1 billion. And the long-term debt's a bit high for a company like this, $14 billion. But the shareholders' investment, that's like stockholders' equity. That's just what they call it. That's pretty much the same level, just slightly higher. So that tells me that the Target has a relatively high amount of debt. Maybe not compared to the market cap, because the market cap's about $49 billion. But yeah, it's still a little concerning in my opinion. But you look at the PE ratio, it has fallen to 12. I know it has struggled with some sales and struggled with the economy. But if you're feeling risk tolerant enough to take a chance, and you're an income investor, you might want to consider Target stock at these levels, in my opinion.
Yeah, this is an interesting one that I've watched a bit from afar, and I like some of the things you highlight as well. I do think this is a business that's dealing with some major short-term challenges, but I still think the thesis for the company over the long term, is still intact, and they have really maintained an incredible commitment to their dividend through the decades that I think has enabled them to be a pretty resilient income stock for investors. So it's an interesting company to look at in this space for sure. And, they have been broadly underperforming peers like Walmart and Costco. But I think that some of that is related to some of the, macro factors at hand. We know that a lot of Target's sales are derived from more discretionary expenditures. Walmart, of course, is reliant on a lot of different sources of growth, but 60% of their sales come from their U.S. grocery business alone, which is a pretty consistent and resilient sector for them. Costco also, broadly seen as a robust consumer staple stock. And I think a lot of Target's business is much more discretionary. But some of the things that, stuck out to me is they're still seeing really strong growth in delivery. They're seeing really strong growth in their digital segment. I think that bodes well for the business over the long run, even if, the next several quarters might still be a bit bumpy for them.
Yeah, the growth is not going to blow you away. I expect the revenue growth to be in the single digits and rarely going into the double digits. But if you're looking for an income stock, 12 times earnings, I think most of its main competitors are still trading above 30 times earnings. So I know Target has some problems. I think the problems are more than figured into the stock price at this point. So yeah, if you're I said, if you're looking for income, I think this is a great choice, and you might get some stock appreciation as well if the valuation, if things improve and the valuation start to match companies like Walmart.
Well, I see we have some questions coming in, and I want to start hitting those in a minute. And real quick, though, I want to talk about a company that's been on my radar a bit more recently, and that is Instacart. We talk a lot about companies in the delivery space like DoorDash and Uber. Instacart is one that I have been just watching a bit more recently. Shares are up about 10% over the last year, so it hasn't really been a stunning performer in terms of share price perspective. But I thought it might be interesting to talk a little bit about the business and how it works as I'm tracking this one a little bit more closely on my watch list within the consumer goods space. So Instacart's business model really revolves around connecting customers with personal shoppers to fulfill grocery orders. And they generate revenue through delivery and service fees, commissions from retailers, and their subscription membership, like Instacart Plus. Instacart provides a platform where customers can order groceries, but increasingly other items besides groceries from various retailers. And personal shoppers, so independent contractors, non-employees, receive notifications to fulfill those orders. Instacart then charges customers delivery and service fees for each order, which can vary based on factors like order size, delivery time, membership status. And then Instacart partners with a wide network of grocery stores and other retailers, which allows them to sell their products through the platform. And Instacart earns commissions from retailers for each item that is sold through the platform, often negotiating a percentage of the sales price. Instacart does have its own subscription service that provides unlimited deliveries for a monthly or annual fee. And increasingly, Instacart has also been generating revenue through in-app advertising. Markups on grocery prices, they are another area for them, but a very small part of the business, and even some white label solutions for retailers who want to build their own online delivery services is also a part of their business. The advertising one is probably the revenue stream I'm watching more closely. So delivery fees, service fees, membership fees, and advertising are some of the bigger revenue streams for the business. Still, broadly speaking, their business revolves around delivery and service fees. This is a business that was only founded in 2012. Looking at their more recent 10K, they have about 6,000 brands that are using Instacart ads, which makes them, more easily discoverable as customers when people go online to fill their digital carts. They have said we enable more than 1,500 retail banners to grow by providing technology that can accelerate the digital transformation of their entire business. Through Instacart, they reach over 95% of households in North America. And Instacart has said we represent one of the largest and fastest growing e-commerce channels for brands. We provide discovery and attractive ROI for over 5,500 brands through our industry-leading advertising tools and insights that are purpose-built for the online grocery category. And I think it's a particularly interesting category to look at because it is one of the most undoubtedly resilient elements of the consumer spending space. People may scale back expenditures in difficult economic times, but people are still, broadly speaking, going to go out and buy groceries. And that is really what the Instacart marketplace revolves around, in connecting customers with stores and with personal shoppers who can fulfill those orders for them. And then with their growing advertising business, they have provided a way for more of these merchants to get their stores and products directly in front of customer eyeballs, so to speak. When you're there scrolling for whatever store that you want to request delivery from, you might find an ad that also resonates with you as an individual consumer. They have been continuing to grow at a really solid clip as a business. And there's a couple things I wanted to highlight. They said that in their most recent report, which was for their 2024 full year in Q4, they welcomed a range of new retailers to their marketplace in 2024, including the nation's largest beauty retailer, Ulta Beauty, with over 1,400 locations nationwide. They also launched Express Delivery, which is their fastest priority delivery option on Kroger, which is powered by their e-commerce fulfillment technology and service. They continue to expand into Canada, which is another market for them that they are rapidly working to expand into. They've also signed agreements and deployed carts at Coles in Australia, as well as other international retailers. So this is not just a US-based enterprise. And it's been interesting to see the momentum they're witnessing in some of these newer markets. Now, and I'm looking at this updated number, they have about actually 7,000 active brand partners through their platform. And they continue to launch new measurement tools for brands to analyze their share of the digital shelf on Instacart, as well as ways to optimize the ad delivery on the platform. They scale ad campaigns for a wide range of brands and companies, and not just grocery brands. But they also said that they debuted their first ad at the big game a couple months ago to drive brand awareness of and affinity for Instacart. In terms of how the company is doing financially, they reported that their platform facilitated gross transaction volume of about $33.4 billion in 2024. That was up 10% year over year. They also helped facilitate 294 million orders in 2024. That was a 9% year over year increase. Their total revenue was $3.4 billion. That was up 11% year over year. Of that $3.4 billion total, $2.4 billion was transaction revenue. So that was up 11% from 2023. Advertising revenue is almost $1 billion of the total business. That advertising and other revenue was $958 million in fiscal 2024, and that was also up 10% year over year. Now, they reported GAAP gross profits of $2.5 billion. That was a 12% increase. This is a company that I think they first turned a profit in 2020, and they have been working to deliver consistent profitability. For example, in 2022, they delivered a full year profit, I believe, of about $428 million. Then they reported a steep net loss last year. This year, they reported GAAP net income of $457 million. And that was partly because they had a major increase in stock-based compensation expense, which was significantly elevated in connection with the IPO the prior year. So a lot of their unprofitability in 2023 was in connection with stock-based comp related to their IPO, a period from which they have moved on, reduced that, and went back into profitability in 2024. So it's an interesting business. As I said, it's one that I've been watching. I often give more newly profitable businesses some time before I take a position. And this is also one where, because they've only been public a couple of years, I've also been watching from afar. But one on my watch list, thought it would be interesting to talk about briefly.
Yeah, I was a little skeptical of it because I remember, I was around in the 1990s when you had companies like this, like Webvan, that ended up crashing and burning in the dot-com bust. Certainly that could happen here. I think it's less likely, though. I was actually surprised to see they made a profit, and their price to earnings ratio is actually fairly reasonable. Looks like revenue's kind of in the high single digits. It is intriguing. I think maybe we need to see more and see them prove themselves a bit more, to Rachel's point. But it is a very interesting company, and one that definitely belongs on your watch list if you're a consumer goods investor.
Yeah, Shotgun Santa was saying, Instacart, I don't get it. The fees, the charges, and higher prices. Who is using this? It's got to be millennials with their parents' credit card. They'll never get me to do it. Well, they have a pretty wide-ranging customer base. And it's broken down across a wide range of consumers. It's, individuals, also families, a lot of families that are using Instacart, actually, family carts, which often also lead to much larger order values, is something that's been growing a lot and has been a very fast growing segment for Instacart's business. So individuals, families across the spectrum of ages. And there are a lot more stores that are increasingly being listed on Instacart and, on a global spectrum. So I think there's really a wide range based on what we see from them and the data they've provided, a really wide range of people that comprise the average Instacart customer. And that, I think, is where they're also seeing a really, diversified growth story as they continue to add new merchants to their platform.
Yeah, and I guess that it's not going to be for everybody. I mean, for example,
for sure.
I'm in my cubby hole here doing this type of work, so I kind of like to go out to the grocery store and get out a bit personally. I don't want to pay the fees. That's just me. And I think a lot of people feel that way, but then again, a lot of people don't feel that way and prefer to hire it out. So depending on your life circumstances, I think this could be a very beneficial service for people.
I think so. And, it's interesting. I think that it is a very personal thing. Some people really love to go and be able to have the experience of, shopping for themselves, or just would never maybe pay the cost of doing that. But it can be really a convenience factor, whether you are, a busy mom, a busy family, a busy single individual, maybe you have accessibility issues. This can also be an incredibly helpful service. There's a lot of different reasons that people use these apps. And I think we've seen that, despite maybe some of the mixed feelings about it among the consumer populace, people like the ease and convenience of delivery. We see that reflected in DoorDash's results. We see that reflected in Uber's, delivery segment. We see that in a lot of these other companies. We talk about Grab Holdings a lot, which is a Southeast Asian, app of apps with lots of different services, including delivery. This is very much a global phenomenon that I think is not going anywhere. And I think, not every player in this space will be a winner, most certainly. But the idea and the concept of it and the demand for it is absolutely there. So then it comes down to what are the players that really execute best on, providing those services to the end consumer.
Yes. Yeah. It's speaking of questions about our consumer goods spiel here. Phil asked about 11 minutes ago. I don't buy the S&P 500 for dividends. I feel comparing dividend stocks to it is meaningless. It makes more sense. More sense to compare to ETF, SCHD, or VYM. I don't follow those dividend ETFs too closely. I do notice they do pay higher dividends than certainly the 1.3% of the S&P 500. However, their distributions will vary. Some quarters are high, some they're not so high. A stock like Target will give you a consistent dividend, aside from that yearly increase. So I think that's going to appeal to a lot of people. But these are fairly high yielding ETFs, and a lot of people like the security of it being invested in numerous stocks instead of just one. So I think there is some appeal here. But if you like consistent payments, those are probably not for you.
There was a question that had come in the last hour from Eric, asking about Pfizer's pipeline and revenue growth drivers for the next 5 years. So I wanted to take some time to talk about that. I know it's not related to our theme, but it's something that I talk about this company a lot. So it's definitely what I wanted to address. This is a company, as I've said many times, that is going through a period of transformation and a shift for their business from the pandemic era. The success of the COVID-19 vaccine that they developed with BioNTech, as well as Pfizer's own oral antiviral drug, brought in record billions in profits and cash for the business. And this was instrumental for a few reasons. This is a business that prior to the pandemic was still and is one of the oldest and largest pharmaceutical enterprises in the world. This is a massive business with a long history of innovation and of having a range of blockbuster drugs in their portfolio. But one of the biggest things that Pfizer has known for a long time that it was going to be facing in the tail end of the 2020s and into the 2030s was not just the winding down of its COVID-19 business once that became a huge enterprise for the company, but also the fact that they were going to be facing loss of patent exclusivity on some of their key, oldest, and most profitable drugs. One example is Ibrance, which is a CDK4/6 inhibitor. This is a leading first-line treatment, as well as in combination with other drugs available for other lines of treatment for patients with metastatic breast cancer. That was a first-to-market drug for metastatic breast cancer patients and has been one of the top-selling drugs in Pfizer's portfolio. That is a drug, one of a few in the coming years, that is going to be experiencing loss of patent exclusivity. Now, that reality is something that pharmaceutical companies like Pfizer plan for years. And this is something that management has been planning for a long time. With the success of its COVID-19 products, Pfizer went into a period of a few years of massive M&A activity, mergers and acquisitions. They acquired, I think it was somewhere between 8 and 10 companies over a period of a couple years. One of the most notable acquisitions that they made was of an oncology company called Seagen. It was a $43 billion acquisition. Seagen is an oncology business that has specialized in antibody drug conjugates. And that acquisition is one of many that Pfizer made, and I'll talk about a few others, that had a major impact on its pipeline as well as its product portfolio and its future plans for growth as it moves on from the success of the COVID era, and also works to combat the loss of patent exclusivity on some of its key drugs. That acquisition alone of Seagen effectively doubled Pfizer's pipeline. It's also key to their plan to have at least 8 blockbuster cancer drugs in their portfolio by 2030. And this is a plan that involves Pfizer training in on 4 main cancer types. That includes genitourinary cancer, blood cancer, thoracic cancer, and breast cancer. These are all areas in which Pfizer has experience in and has successful commercialized products in, but they are continuing to focus even more keenly on this space. As I mentioned, Ibrance, one of their major cancer drugs. Another one is called Xtandi. Both of these drugs are expected to lose market exclusivity in the next few years. So the addition of Seagen is huge for the business, both now and in the long term. The other thing that was key about this acquisition is that they are working to increase the proportion of biologics in their revenue mix of oncology drugs from just around 6% a few years ago to 65% of their oncology portfolio by 2030. Pfizer is a company with an extensive manufacturing presence around the world. They are very well positioned to continue manufacturing and distributing these drugs as approvals come in. Now, back in 2023, Pfizer was the company that garnered more new drug approvals from the FDA than any other healthcare company that year. And that is something that a couple years ago they had said we were in a series of a period of time in which we're planning to launch something like 18 new drugs or indications within a 19-month period or so. And so this is something where they have been in a heavy period of launch as well as developing new products. And that's something that they say is not only going to be really key to stave off the impact of slowing sales from their COVID-19 products, but also the billions that they expect to lose in the coming years from loss of patent exclusivity. But as a result of the deal making that they entered into in recent years, they think they're going to be able to add 20 to 25 billion in risk adjusted revenues annually to their business, on the top line by the early 2030s. When they acquired Seagen, Pfizer also gained 4 new FDA approved cancer drugs. One is called Adcetris. It's indicated for certain CD30 expressing lymphomas. Another is called Padcev. This is indicated for metastatic urothelial cancer. Another cancer drug that they acquired as well is called Tidvac. That's for metastatic cervical cancer. And then another drug as well, which was commercialized for the treatment of certain HER2 positive metastatic breast and colorectal cancers. Another acquisition they made of Biohaven Pharmaceutical. This gave them access to Biohaven's migraine drug portfolio, including drugs both in clinical development as well as the already approved Nurtec, which is a migraine blockbuster drug. It's approved for the acute and preventative treatment of migraines. There's an intranasal spray that is in development that was part of that deal that's also designed for the acute treatment of migraines. And they had a portfolio of 5 preclinical assets that are called calcitonin gene-related peptide receptor antagonists. And they acquired 5 of those just in the acquisition of Biohaven. There are a range of other acquisitions they entered into. One was of Global Blood Therapeutics. That brought an oral therapy for sickle cell disease into Pfizer's wheelhouse. Their new ulcerative colitis drug, Vilsepity, was a function of the Arena Pharmaceuticals acquisition they made in 2022. In terms of what the company is working on now, they are continuing to focus really heavily on oncology, as I noted, and then specifically in the areas of breast, genitourinary, thoracic, and hematology oncology cancers. They are, again, working to increase the cohort of biologics in their portfolio. They are working on a new best-in-class CDK4/6 inhibitor, which could be a replacement in their portfolio in the future for Ibrance, which has for a long time been their top-selling one of their top-selling oncology drugs. They're studying Padcev, which I noted that they got in the Sequin acquisition, with Merck's Keytruda in urothelial cancer. Pfizer's also focusing on lung cancer. They're in phase 3 testing for a candidate for patients with specific types of non-small cell lung cancer. They're also continuing to launch and work on drugs focusing on blood cancers, as well as other tumor types. They're also developing drugs in other areas, for example, rare diseases like Duchenne muscular dystrophy. But their oncology franchise is really where I expect the leading growth for the business to be in the coming years. I think that's, broadly speaking, what management has indicated is a real key area of focus for them. And as I mentioned, a couple years ago, they had said they were planning 19 drug launches or label expansions over the following 18 months, so that by the early 2030s, that would be generating, roughly an additional $20 billion in sales annually. And then beyond those launches, they had a pipeline of drugs expected to reach the markets after the second half of last year. They're still working on an oral GLP-1 drug. They have their gene therapy portfolio, as well as several vaccines. This is a company that, prior to the pandemic, single-digit year-over-year revenue growth was common. Even if you cut out their COVID-19 products in 2024, revenue still grew 12% year-over-year compared to 2023. They also reported net income of about $8 billion in 2024. This is also a company that has been historically a very steady dividend payer, and they still have some of their legacy drugs in their portfolio that are pairing alongside newer drugs like Nurtec. They've got their older drug Eliquis. Sales of that drug were still up 13% in Q4. They've got their Vyndaqel, Vyndamax family of drugs that are seeing really strong demand. Sales of those were up 60% in Q4. And again, they're continuing to really just begin to see the fruits of these acquisitions that they made a few years ago. For example, the Sequin acquisition. The impact of these acquisitive efforts will really start to take shape in the company's balance sheet over the next few years. And I think that that's something that is going to be important to watch with this business. Like I mentioned, they have some of these newer oncology drugs that are in their portfolio that are starting to contribute some notable revenue, but is still very much in the early stages. They did say, though, that global revenues from drugs that they inherited from Sequin brought in about $915 million in revenue in Q4 alone. And that was compared with about $132 million the prior year in the Q4 period, which was right when they finished the acquisition of Sequin. So a lot to watch with this business. Their oncology franchise is, again, the area I think where they will probably derive the most growth from. And that also includes more newly approved drugs that are just now being incorporated into the Pfizer, family of products. So hopefully that provides a little bit of insight into this business and where they're going and how they're looking to get to that growth trajectory in the next 5 to 10 years.
Yeah, so I don't. It's been a while since I followed healthcare, so I haven't followed Pfizer lately, but I've been looking a little bit more into it since I've had been working with Rachel and with Brian Orelli. I noticed. I was speaking of dividends. I noticed their dividend yield is 6.75%.
Yeah, and the market has not been kind to this stock, despite the fact that they are witnessing a lot of these different types of improvements. But that sort of lackluster share price performance has pushed the yield up quite high. And, it's important to not, I think, be yield chasers when we talk about dividend paying businesses. Sometimes the yield is high and share prices are down for very good reasons. And that might tell you that you need to run. In the case of Pfizer, in my opinion, this is a fantastic business in a transitional phase. And I think the market is underestimating this company's ability over the long term. And this is a company with a really solid track record of paying and raising their dividend. So I do think they're also an intriguing dividend play.
Yes. So about 4 hours ago, Jeff M was asking, what's your thought on Mixu? Fast food Chinese stock just went public, ice cream and drinks under $1. Yeah, I honestly had not heard this, so I looked it up. It is a new stock. Unfortunately for us, it's a new stock on the Hong Kong exchange. So we're not able to buy it. I mean, in some cases, you can open up a brokerage account in that given country and buy stocks that way. However, Hong Kong is part of China now, and I know Hong Kong is part of a separate administrative district. I don't think that protects U.S. investors that want to buy Chinese stocks. In a technical sense, U.S. investors are barred from buying Chinese stocks. And I know you're going to say, but Will, Alibaba's trading. And yeah, Alibaba is trading, but when you buy Alibaba stock, you're not buying stock in Alibaba. You're buying stock in a holding company based in the Cayman Islands. It's called an American depository receipt. In most cases, there's nothing wrong with investing that way. However, U.S.-China relations are kind of tenuous right now. So I think there are some added risks to investing in these type of stocks. Now, other fools will disagree with me. I know other fools like Alibaba and other Chinese stocks, and that's fine. For me, though, in my opinion, I'm not really comfortable investing in such a under such circumstances. But Mixu is new in Hong Kong. I have no idea whether they're going to attempt to launch an ADR for U.S. investors. It does look intriguing, but unfortunately, I don't think we're able to invest in it, even if it is a great investment.
So there was a question that came in from Matt. Rachel, Will, what are your thoughts about the earnings reported by Winnebago this morning? I did not realize that this was a publicly traded company. But I wanted to look into their results a bit. Obviously, Winnebago is known for their RVs. They're a leading manufacturer of recreational vehicles, specifically motorhomes. So they make their money primarily by manufacturing and selling outdoor lifestyle products, including motorhomes, travel trailers, boats, under brands like Winnebago, but also their brands include Barletta, Chris Craft, and Grand Design. They more recently have been expanding into the marine industry with power boats and pontoons under the Barletta and Chris Craft brands. This is definitely a business that is prone to cyclicality. So, consumer demand, economic factors, market conditions heavily impact revenue and profits. In recent reporting periods, they have been facing numerous challenges, including lower unit sales, reduced average selling prices, and some of that's due to the macro environment and high interest rates. Consumers are less inclined to fund these bigger ticket purchases than in periods past. However, they have seen some resilience in their marine and towable RV markets, which has been interesting to note. But they have also been dealing with, the last few years, there's been a real decline in RV demand post-pandemic. So the RV industry had a huge surge in sales during the pandemic with people seeking, recreational travel with social distancing and all these other factors. But as those restrictions eased, demand for RVs has cooled off. And then, of course, in the period that's followed, macro challenges have continued to cause consumer uncertainty and overall slow the trajectory of RV sales. There's also been, I was reading some reports of quality issues with Winnebago's Grand Design RVs, like frame flex problems and concerns about some of their handling of customer complaints. They've been dealing with some declines in market share for a few of their brands. They also had to enact some layoffs. So there's been a lot going on with the business the last few years. But I went ahead and I pulled up their earnings report. This was for the second quarter of their fiscal 2025. So it looks like they reported net revenue of $620 million. And gross profits of $83 million. They are still operating at a net loss. They reported a net loss of about $400 million, or 2 cents per diluted share. They did report adjusted EBITDA of $22.8 million. They said that in our marine segment, Barletta continues to grow its share of the U.S. aluminum pontoon market and outperform this category. For the 12-month period ended February 28th, 2025, they achieved a market share of 9.5%, which was an improvement of 140 basis points over the prior year, and placed Barletta as the number 3 player in the aluminum pontoon market. The Newmar brand delivered its 4th straight year of increasing market share in the Class A diesel segment. They did also see margin growth in all of their segments as well. I'm trying to pull up. Let's see. They also gave an outlook for the next fiscal year, which was $2.8 billion to $3 billion that they are looking to bring in. Management was saying, this is a very dynamic environment, macroeconomic and sector challenges that our industry has been presented with. We're also seeing inconsistent consumer sentiment, stubborn interest rates, dealers that continue to push inventory levels lower, particularly in the motorhome, RV, and marine segments. So that net revenue figure of $620 million, that was down year over year. That was compared to about $704 million in net revenues in this same quarter in their prior fiscal year. And again, they reported a net loss for the 3-month period.
Well, actually, 2 of the 3 segments were up in revenue. Unfortunately, the motorhome segment revenue fell 30%. So that took the 17% gain in marine and the 1.2% gain in the towable RV. So that's what really.
Yeah, they saw these slight increases in these areas, which again are notable, and as you note, and they also are driving up their market share in areas like the aluminum pontoon market. But because their flagship business, in RVs has been struggling, this continues to be a real issue for them. And they're seeing that really weighed down, I think, by ongoing consumer sentiment. So I don't know if this is one you follow very closely or not, Will. It's an interesting business. I think that, for me, looking at this, the issues they're facing are not inherently because of problems with the company or their business model, but really just due to shifts in consumer sentiment. And it's hard to say if or when that's going to turn around. And, because of that, they're facing really continued hits to their balance sheet and remaining unprofitable, although I know they are working, to be more efficient where that's concerned. But yeah, 1.2% increase in their towable RV net revenues, 30.4% year over year decrease in net revenues in their motorhome RV segment. They did have a nice 17% increase in their marine segment. If you remember, I mentioned at the beginning, their marine segment has really been a newer but more fast growing area for the business. So that was still not enough to set revenue or earnings in a positive territory, but it is worth noting they are seeing a healthy mix of growth there. And they are burning cash at this point. Cash flow used in operations was $27 million. They had about total outstanding debt of $598.7 million and working capital of $438.4 million. This is a business that I probably would not be a buyer of at this point in time, just given all of these different issues that they're having in the environment in which they're operating in. I know they've been working to be efficient with their capital, and it is nice to see that bump in their towable RV and marine segment. But the cash burn, the unprofitability, the declines they're seeing, which again are really a function of consumers not spending and interest rates being quite high, are still issues that I think the company is going to have a long road ahead before they come out on the other side of.
Yeah, I basically agree with you here. The stock was up 8%, despite all that bad news. They even cut their outlook too, which didn't stop buyers from buying it. They were originally forecasting 2.9 to 3.2 billion in revenue for the upcoming fiscal year. Now that's down to 2.8 to 3 billion, which is a pretty significant pullback. So I'm kind of surprised the stock is up with all that bad news. But I guess maybe its investors are, have just are in such a negative place right now. That, the slight good news from the report, set shares rising.
Yeah, so that is Winnebago. Those are our Motley thoughts on that one. Stephen Jennings said, lived in a 2003 Newmar Country Star for 2.5 years with my family. It was a quality rig. Wow, that sounds like a grand adventure for sure. All right, let's see.
Yeah, I have a question. Frank Iryami from 7 hours ago. Can you remember a time when any of you have bought a stock at more than 25 times forward earnings and have it be a great performer from that entry price? Actually, I can remember a few times. Depending on the stock, that may not be all that high, and sometimes stocks will. I mean, you said more than 25 times forward earnings. A lot of stocks, even in their pullbacks, will not fall that far. I think I bought Shopify and Mercado Libre, for example, in 2022 and 2023, and I paid well over 25 times forward earnings for those. Mercado Libre I struggled with for a while, but I'm well over double what I paid for it now. And Shopify I bought as it was falling. Didn't quite catch the bottom, but I wasn't down for long in that one, despite a relatively higher earnings multiple, and that one worked out. So depending on the stock, a lot of these stocks just trade at high earnings multiples, and they will maintain those high PE ratios even on a forward basis for many years. So especially stocks in tech, so something with cutting edge technology, especially like Nvidia is an example that comes to mind. Although that might have fallen below. I know Nvidia's PE ratio has been really hammered because the PE ratio has been hammered. The stock has not been hammered because it's risen significantly, even with the more modest pullback recently. I don't know where that one trades right now exactly. Let me see. That one might be above 25 forward earnings. Oh, actually, Nvidia is at 24.6 times forward earnings right now. So I guess technically it is below, but it rarely gets to that level nowadays. The trailing PE ratio is at 38, so I guess that one is technically below. But there are a lot of stocks that will never fall below 25 times forward earnings and still be great buys. And like I said, that wasn't Nvidia until just recently, but it's not unusual to see that at all.
Okay, so there was a question that came in about AppLovin and a short report that went out about them today, and asking about that and the long-term outlook for the company. So I was trying to look into this because I had not yet seen the short report. It looks like it sent shares down about
20%.
20% today, although the stock is up and after hours trading a little bit, so that's interesting.
2%, so maybe it's recovering a little bit, but
just a hair. So there was a short report that came out from short seller Muddy Waters today, and I do not believe that as of yet AppLovin has responded based on what I could see from their press release section. I haven't seen any response from them. I would imagine one will be forthcoming. Although it is worth noting that across industries, from time to time, we tend to see these reports from short sellers, which inevitably benefit the short seller. And often, I think it's important to take these reports with a grain of salt. That has been my approach when looking at these. But essentially, the report is also coming on the heels of reports from a couple other short sellers, including Culper Research and Fuzzy Panda. And essentially, all of the reports from these companies have alleged that AppLovin is using fraudulent or deceptive, or in Muddy Waters' case, they said they alleged scammy practices. Shares lost significant ground today in the market, as we were talking about. However, the stock is still quadrupled in value over the last 12 months. Broadly speaking, I think related to expectations about how they are going to benefit from demand for AI-powered advertising tools. The short report from Motley included a few allegations. They alleged that AppLovin has been misappropriating data, violating key partner platforms' terms of service. They suggested that backlash could hold back their growth plans and lead to services being blocked and boycotted by partners and clients. And again, there has been a few other short sellers that have issued reports in recent weeks. I am always somewhat skeptical of these reports. I think that inevitably they benefit directly the short sellers that write and issue them. But sometimes, there are reports that turn out to have some legs to them. I don't think we've seen any evidence to that at this point. And I think that this is something that is somewhat of an inevitable part of the business cycle for some of these operations. So when this comes out on a company that I follow, I try to read and stay informed, but it's not something that fundamentally would make me take immediate action on a company if one that I owned happened to have a report come out about them. It's much more to me about what is the company's response, if any, what further evidence, if any, comes out. So I read these, but I take them with a bit of a moderate dose of wisdom and try to read them and then wait and see what happens. AppLovin is generating or leveraging, AI for their platform, particularly through their Axon engine, to optimize ad delivery and improve targeting and enhance their creative processes. Their Axon engine, which is now in its version 2.0, is essentially a core AI-powered platform. It optimizes ad delivery, helping ads reach the right audience at the right time by continuously learning and refining data. AppLovin has their own in-house creative agency, Spark Labs, that uses generative AI to improve workflows for performance ads. They also have seen significant gains in the use of generative AI tools, including Spark Labs specifically. This in-house creative agency of theirs has seen a 170% increase in the use of generative AI tools across all creatives, and a 118% jump in wins for creatives that are using generated speech. AI is also crucial for AppLovin because it powers their Axon 2.0 advertising platform. And this is really the key driver of their success over the long term. It does things like help identify which campaign types work best to achieve specific targets. It helps advertisers find high value users rather than focusing on just smaller regional markets. It also helps these models learn very quickly. They reduce the costs that are associated with learning phases, and it allows advertisers to run advanced campaign types almost immediately, which can help them hit their advertising goals faster. And of course, AppLovin's core business model is as a mobile advertising platform, connecting advertisers with app developers, enabling them to reach users and acquire new customers. And they generate revenue by charging advertisers for using their platform and by sharing in the revenue that's generated from ads displayed within the apps of their developer partners. A significant portion of their revenue comes from fees that are charged to developers for using their mobile marketing platform. And then they also earn, some miscellaneous revenue from other sources. But advertising revenue is the lifeblood of this business, right? Their total revenue of $4.7 billion in their last fiscal year, $3.2 billion of that was advertising revenue, and that ad revenue was up 75% year over year. So, AI-driven programmatic advertising is really the key for this business in the coming years. They are doing really well from a financial perspective. They reported a 343% increase in net income in 2024, about $1.6 billion. The stock itself has had quite a run up. One might say it's been rather richly valued and perhaps due for a come down at some point. I mean, the stock is still up about 300% over the last year, despite the impact that shares have taken today. And it's still trading at a pretty robust valuation on a price to earnings basis. So this is one that I'm watching. But if it was me and this was a company that I owned, I wouldn't be taking any immediate action based on this report. It's more of a read, file it away, and see if anything further comes of it. But at this point, the company is very much seems to be on track towards its long-term targets. We'll see if the company responds or has any further updates that materialize.
Yeah, I agree with Rachel here. You always have to take these reports with a grain of salt. It is interesting that the stock fell 20% today, so obviously it spooked a lot of investors. But
yeah,
I think you have to just watch it in the coming days to see how the company reacts and how the short seller reacts too. I don't remember the stock, but a couple of years ago there was one short seller that filed a report, and a month later you couldn't even find the report online, even though they published this extensive report to everyone the day they made the announcement. So yeah, a lot of these, I don't know. I don't know what to say about them, but there was the one about Supermicro. That Supermicro's trouble started with one of these reports last year, and then the company kind of, I don't know if I'd say confirmed it, but didn't really reassure investors with some of their behavior and some of their delaying SEC filings over questions about its accounting. So it could be something, but I think it's too early to tell right now. So we have about 4 minutes left. I was going to tackle this one question about Foot Locker. It was from a few hours ago. Good morning, team. Any updates on Foot Locker? Well, for those of you who don't know Foot Locker, it's a shoe store that's found in most malls. Of course, Americans are shopping in malls less and less. Unfortunately, that has hurt Foot Locker. So it's been it's been closing a lot of stores. Its sales continue to fall. I'm looking at this report. As of their last report, total sales down 5.8% year over year. Comparable sales, interestingly, were up 2.6%. So maybe they're getting a little bit more excuse me, doing a little bit better in some of their better performing stores. But the trend has been to close stores, and that's obviously led to falling sales. I'm not really sure what competitive advantage that a Foot Locker has, quite frankly, in a market like this. Like I said, we don't really shop in these stores anymore. There's no shortage of places where you can buy shoes. Look, even some of these bigger retailers like Academy Sports and Outdoors or Dick's Sporting Goods, they're not having exactly huge revenue growth, but they might be a better shoe retailer ultimately than is a diversified business than just a small store in a mall where the store does nothing but sell shoes. And just with less people shopping in these stores, again, this is apparel is a very competitive business, including the sales part of it. I just really don't see what kind of competitive advantage Foot Locker has in this market. So I know it looks cheap. The stock has been falling. It did cancel its dividend last year, which is also not a good sign. So it's a sign of its struggles. It's trading at about 10 times forward earnings, which may look cheap, but with all its troubles, I kind of look at that as cheap for a reason. This is not one I would want to touch at these levels personally.
Okay, we have a couple minutes left. I'll hit this question that was sent to me by Vihan. Rachel, in Robinhood, there are buy, sell, and hold ratings for each stock by some analysts. Do you weigh on it, cross-reference with Full Rex thoughts? I'm assuming he's meaning using Robinhood as a brokerage platform. Yeah, Robinhood is my brokerage platform. It depends. Yeah, it depends on the business. I tend to more often than not factor in different analysis from my own analysis from analyzing a business, as well as I love to use a lot of the information that we have accessible to us here at the Fool that enables me and helps me when I am researching a business that perhaps I don't know as well, and might want to be interested in for my portfolio in the future. I haven't necessarily used the analyst ratings specifically in the Robinhood platform. So that isn't something that has been as much of a tool for me. But I do factor some analyst ratings, broadly speaking, into stocks when I'm, evaluating them and investigating them for myself. But ultimately, I try to do a much more, holistic deep dive into any business that I'm considering as an eventual position for my portfolio to understand really whether it makes sense for the composition of my portfolio and what kind of performance I'm looking to have over the next 10 years. And I tend to put that type of weighting, much more heavily emphasized research versus analyst ratings per se. So that would be more my approach.
So with that, we are at the top of the hour. I want to thank Rachel for another great hour. And as promised, we're bringing back Danny Vena, who will be here momentarily in our co-host switch out.
All right.
Did you ever play musical chairs when you were a kid?
I did.
Musical hosts.
Yeah,
I know.
They're back in this case.
Well, thank you guys. I'll leave you to it for the next hour.
Thank you, Rachel.
Peace.
Hello and welcome to another hour of Full 24. Again, I'm your host, Will Healy, staying with you for another hour. I'm joined by Danny Vena. And how are you doing, Danny?
I am looking forward to the next hour because I think the topic that you and I came up with is a good one. We all have them. We all started somewhere in our investing journey. And over the course of that journey, we come up with what we deem to be our most important investing questions. Where do we go from here? How do we get there? How do we get started? What your important investing questions are depend on who you are and where you are in your journey. Will and I have come up with a few seed ones, but we would love to hear your most important investing questions. We can't give personalized investing advice, but if you have a question, please go to slido.com and enter the code #Fool24. And we will try to get to your question. So, Will, when we first came up with this, we came up with a few questions, and I thought, if it's okay with you, I'll go ahead and I will ask the questions that you came up with, and vice versa. And the first question that you came up with. So what is the first step? What's your first step, Will?
Well, I looked at this. If I was just interested in investing and starting out, it's not saying that Nvidia has been up, but at one point it was up tenfold in a little bit more than 2 years, and saying, oh my God, I got to buy Nvidia. Well, I think you really have to look at your own personal financial situation first. To invest, you're going to really have to not only get the money to invest, but you're going to have to clean up your own personal financial situation. So say you're looking to invest, but you have $10,000 in credit card debt at 18%. Well, you essentially have $10,000 that's making you a negative 18%. With that, any dollar that you pay off is going to take that money from negative 18% to zero. So that's an 18 percentage point improvement. And there are stocks that will return higher than that, but on average, the market does not really outperform 18% returns over the long term. So if you're in such a situation where you have high interest debt, I think that the first step is going to be to pay off all of that debt before you even begin to build up savings with which you want to invest. So I think that the first step is just getting your personal situation in order so you can be an investor.
Yeah, I was thinking back to when my wife and I first got married, and for the first several years, we ended up running up some credit card debt. I think we probably had about $14,000 in debt on various cards. And one of the things that we sat down and talked about was that we wanted to pay off our debt. And so, we sat down and devised a plan, and that plan was a very simple one. We picked the credit card that had the lowest balance, and we paid that one off as quickly as we could, doubled up on the payments. Once we got that credit card paid down, we took the money that we were using to pay that credit card and added that to the payments that we were making on the credit card that had the second lowest balance. And basically we did wash, rinse, repeat with that process until we had paid all of our credit cards down to zero. And actually, we even went further than that. Years later, we made the decision to pay off my student loans and paid that down. So the only debt that we have right now is the mortgage on our house. And that was, by design, because we're getting a better return from our investing than what we could get by paying off our mortgage, which currently has a rate that's like 2.75%. We refinance. So that was one of the steps that we took in order to, pay off our debts and give us extra cash flow every month, personal cash flow, so that we could use that for investing.
Yeah, if you look at the S&P 500, it averages, well, over 100 years, I guess 99 years, going back to 1926, it's returned about 10%. It might be a little bit higher than that over the last 10 years. But if you just figure in 10%, so if you have a mortgage debt of 2.75%, obviously it doesn't really pay to pay extra. You're probably going to be better off investing that cash more often than not. But again, per my previous example, if you have credit card debt that's approaching 20%, well, more than likely you're not going to beat that in the market unless you happen to get lucky. So yeah, it really just depends. But I think if you have a lot of this personal debt, you probably need to look at knocking that out first before you even think about being an investor.
And that's one of the reasons, because each one of these situations is so personal. That's why we can only give, broad suggestions and not any personalized advice, because we don't know your personal situation.
So I guess we'll just take turns asking questions. I guess the first question for Danny is, Danny, how can you invest on a tight budget? And I think that's a good question because most of us don't have unlimited resources to throw into the market. We have to budget, save, maybe defer some spending that we wanted to do in order to be an investor. So what are some of your suggestions on investing on tight budgets?
Well, one of the things that I did early in my investing journey was that, generally speaking, I knew that I was going to get a cost of living raise every year. And it wasn't really very much, 2%, 3%, something along those lines. But I knew that once, I had done, as we talked about, once I had, paid off my debt, and I wanted to have money for investing. One of the things that we did was every time that I got my raise, I knew what that amount was going to be. I figured out how much they were taking out in taxes, and whatever the remainder was month that I allocated to investing every month. And we did that with my pay. We did that with my wife's pay. And so that gave us a specific amount of money that we could say, okay, we haven't had this money before. We've lived without it up till now. So we can continue to live without this increase in our, paychecks by putting that money to work for us and putting that directly into our investing account. So that was one way. There were other ways. We have always tried to live below our means once we got through the initial, few years of our marriage. One of the ways that we did that is that we always saved for our vacations, so that we would have that money and we wouldn't have to go into debt to do it. Another thing that we did, to keep our spending manageable, was that we had a budget. We sat down and we made a budget. We knew what our credit card payments were going to be until we paid them off. We knew what our electric bill was going to be on average, what our gas bill was going to be on average. We looked at our grocery store purchases, and we tried to keep our spending at the grocery store to a specific dollar amount every week. And by learning to budget like that and keeping those, sticking to that budget, that allowed us to know when we had extra money. And when we had that extra money, we could then take that money and we could put that into our investing account. So, paying down your debt, living below your means, refinancing when it's appropriate. Now, I know right this minute with interest rates, mortgage rates, I don't know, last time I knew they were around 7% or something. But this is a case where, we have been really diligent about making sure that we only spent money that we had. When we got tax returns, that was another way. We would take the money from our tax return and we would put that into our investing account. And every once in a while, if it was a big one, if you get a tax refund that's, $2,000 or $3,000, we didn't want to completely deprive ourselves. So, we would take 10% off the top of that and spend it on something fun, whether it was, going out to eat or buying a new TV or something like that. And the rest of it, we put directly in the investing account. So, making sure you stick to a budget, having a budget that you can live with. And I should probably specify one of the things that we did to make sure that we could stick to our budget was we put in a line for fun money. And that fun money was, we would have something for every time we got paid. Excuse me. Every time we got paid, we had money where we could go out and do something, whether it was going to the movies or going out to eat or, going to an event, going to a concert or something. We knew that we had money that we could go out and splurge on having some fun so that for the rest of the time, we knew that we could stick to our budget. So I think having a budget and sticking to it, and then taking any excess that you can find and sticking that into your investing account. That was one of the ways that we were able to, over time, build up the amount of money that we had for investing.
Yeah, I take a slightly different approach. I will budget to some degree, but I think of myself as an entity. Like Nvidia, like Target, like any stock you might want to invest in. They all want to increase their profit margin. I make sure that Will Healy Inc. has at least a 15% net profit margin, and I take that 15% quote unquote profit and I put it into savings and or investing. So that I kind of take that approach, but I really want to have that minimum cushion. If I find myself falling below that, I'll work extra hours. I'll go more into the budgeting and cut back on spending. But I'm always very diligent about meeting that minimum net margin for myself. So that's one way I take care of that problem.
So let me make sure I understand this. It sounds to me like you're saying that you pay Will first, and you take the money that you want for investing, and you take that's a line item in your budget, and you make sure that you get that taken care of first. Is that right?
Kind of. I don't know if I do it that formally, but I look at what I'm bringing in versus what I'm spending, and if I find myself falling below that level, if I find myself like I can't make that margin, then I start finding ways to either increase income or decrease spending.
Okay, fair enough. So we're going to go to Will's second question here, and actually I'm going to switch this over. Okay, so Will's second question. First, what's your first step after building your savings out, which is your first step? What's the next step for you to on your path to investing?
Well, this may shock you, but it's not to buy Nvidia. I actually, I think before you start to buying, I think really you need to determine your risk tolerance. And really, more than your risk tolerance, your interest in investing, quite frankly. I guess you are interested in investing if you're watching our show, but I think it's very important to have an interest in investing if you're going to if you're going to invest in individual stocks. For example, if you find that you have a low risk tolerance, you're struggling to even take your money out of a bank account. I don't know that investing in individual stocks is for you. I do think you still need to be in the market in some form or fashion, because keeping your money in the bank account is going to basically conserve yourself into failure if you're trying to build the cash for retirement. I think you do have to be an investor on some level. So if you're not comfortable with investing in general, you don't want to learn about individual stocks, you probably want to look at index funds such as the S&P 500. In contrast, if you are comfortable, if you're willing to take the possibility that you make an investment and it might lose money, if you're okay with that risk, then you might want to look at individual stocks. In that case, I wouldn't necessarily buy a stock first. I think really to be a good investor, you need to watch programs like this for one thing. But I also think you need to at least learn the basic valuation metrics: price to earnings ratio, price to sales ratio, price to book value ratio. I also think you need to learn how to read basic financial statements. Now, you don't have to become a CPA or anything, but every earnings report, or at least almost all of them anyway, will include a balance sheet, an income statement, and a statement of cash flows. And I recommend learning those statements and what the numbers on those statements mean, because that will tell you a lot about the company. For example, I was looking at a company today where it made about $8 billion in profits for the year, but $5.8 billion of that was an income tax benefit. Well, that doesn't really. I think that was Uber, now that I think about it, but that doesn't really give you knowing there's that tax benefit, knows how much that income number is skewed. For example, you also want to look at things like how much debt a company has. I was down on the cruise line stocks for a while because they ran up a lot of debt during the pandemic. However, they are paying that down as it matures, and that's helping to stabilize their balance sheet. So, you want to look at, but you want to be able to determine these things when you read a balance sheet. Know how much how much cash a company has. How much is their inventory increasing? Are the current assets greater than the current liabilities? Because if they're not, that's called the current ratio. But if current assets are under current liabilities, that means, at least in theory, that a company can't pay its bills. Now, you see that occasionally in the real world. Some companies find a workaround, but that is a point of concern. So, and then on the statement of cash flows, you want to look at like stock-based compensation. That's always an impediment to a company, or that's often an impediment to a company earning a net profit, for example. And determine how to figure out its free cash flow, because free cash flow in a quarter or in a year will tell you how much optionality a company has. Is it generating enough cash flow to, say, pay its dividend, to repurchase shares, to invest in its company? Although, free cash flow is cash flow from operating activities minus capital expenditures, sometimes called spending on property and equipment. So, but you won't really want to really understand those things, I think. So you can read a balance sheet and maybe find something that other investors aren't discovering. That might lead to huge returns in the long run if you find the right opportunity through this knowledge. So I would be sure to determine your risk tolerance and learn as much as possible about investing. Now, there are some things about investing you're really only going to learn by doing it. So I don't encourage you to hold off for long, but get some basic knowledge about valuation metrics and financial statements, and then get into the game and figure out, see if you can win for one, and figure out how you're going to react when the market turns on you. If you invest long enough, the market will turn on you. So you're going to have some comfort level with volatility if you're going to be an individual stock investor.
Yeah, that kind of feeds right into one of my most important investing lessons, which was investor know thyself. And I highly encourage anybody who is an investor, make sure you know who you are. And by that, there's several points to that. The first is, what type of investor are you? Some people are extremely comfortable with volatility, and they're good with investing in companies that can lose 25 or 30 or 50% of their value in the course of a day or a week. And there are other investors who, that might cause them to not sleep at night. So, are you a growth investor, or can you deal with volatility? Are you more of an income investor? Are you interested in, working your way through companies that will pay you a consistent and growing dividend, for example, that you can use to fund your lifestyle or your retirement? Are you more interested in doing some detective work and digging in and trying to find, turnaround plays, or find, deep value stocks? There's so many different ways that, folks can approach investing. And the way that you approach investing probably should have a great deal to do with who you are as an investor, where you are in your investing journey, what you have to do to be able to sleep at night. And so for me, it was a case of knowing who I am, and actually who I am as an investor evolved over time. When I first started investing and I saw a 40% drop, I was pulling my hair out and I was ready to run screaming. And what is going on? And have I lost what was I thinking about this whole investing thing? And a lot of people on the Motley Fool discussion boards talked me back off of the ledge and said, settle down. This is normal. Happens all the time. Even to the best companies, this happens. And so as I got more comfortable with the realities of investing, excuse me, then I was able to figure out that I was a rule breaker type investor. I'm okay with investing in companies that I think, over the long time could be, to use a baseball analogy, home runs. Some people are more comfortable investing in companies that are consistently hit singles. Some people are better with companies that hit singles and occasionally can hit a double. And so this is, I think, one of the most important questions that an investor has to answer for themselves, is who am I as an investor? What are my goals? What are my resources? Can I, do I have enough money in savings that, if my investing returns are not, consistent, am I okay? Do I have plenty of funds in backup so that it doesn't impact my lifestyle? So all of that kind of feeds into that whole, determine your risk tolerance and decide who you are as an investor.
Yes, I sort of answered my third question a little bit, so I'll let Danny ask it again after I ask him this question, and I'll have some additional commentary. So Danny's second question is best practices for investing regularly. What are those for you?
So, we talked about this a little bit, but, specifically my best practices for investing regularly, making sure that I set aside a specific dollar amount or a specific percentage of my income, and I continue to invest at regular intervals in up markets, in down markets. Once I had a specific amount of money set aside in my what I call my walking away money, my WHAM portfolio, I put aside 12% of my gross paycheck goes right into my retirement fund, and it happens every time I get paid, come heck or high water. That money gets set aside. So my one best practice for investing regularly is making sure that you have the means. And once you have the means, making sure that you're consistent. One of the things that we tout a lot at the Motley Fool is dollar cost averaging. And that is, if whether you are investing regularly in an index fund like Will suggested, or investing regularly in individual companies, then one of the things that I think is invaluable is making sure that you have a system and you stick to your system. And my system was, once I paid off my debt and I had my budget. What I was saying that I was suggesting Will was talking about earlier was paying yourself first. So I know that I had an amount of money. Excuse me. I had an amount of money that was going into my savings account. I had an amount of money that was going in my retirement. I had an amount of money that was going into my investing account. And then I paid the bills. And whatever was left over, we could do with that whatever we wanted. Maybe increase the amount of money in savings, go out and blow it on, something fun. But making sure to pay yourself first, I think is an important part of investing. Another thing that I don't think investors should sleep on is that, my needs as an investor changed over time. My needs as a saver changed over time. As my pay increased, I have always tried to make sure that I had 6 months to a year's worth of my income in the bank, whether that's in a savings account, in laddered CDs, in not laddered CDs. But I know that if I lost my job, I have enough money that I can get by for an entire year without having to dip into my investing whatsoever. And luckily, I've never needed to use that. I think the longest that I have been without a job was probably 6 or 8 months. And even that was trying. But having money that you need set aside in a savings account, in CDs, so that you have the peace of mind so that you can continue investing at regular intervals. I think that is one of the most important things for me. Setting aside the amount of money that you want, whether it's a dollar amount or a percentage of your income. I can tell you that when I very first started investing back in late 2007, the amount of money that I could invest every month was $250. And that was it. That's all I had. And that's okay, because that amount of money gradually increased over time and got to the point where, what I invest now is 12% of whatever my total income is. And that is enough so that I feel like I won't have to eat cat food when I retire.
Yeah, there's not a worse feeling than buying this great stock. You're very optimistic about it, but then you lose your job, because you don't have any savings, you have to sell that stock and potentially miss out on huge returns. So you don't want to put yourself into that position. So I definitely echo your feelings on having that cash cushion. Yeah, I'd say a minimum of 6 months personally, but if you can do a year, do a year. But at some point, I know you got to get into the investing game. So, but have at least some cash that you can get through a trying time, like a bout of unemployment. You might have something go out in your house that forces you to spend several $1,000s. You want to have that cash there to take care of those things, especially ideally without having to touch your investment. So I do echo that, even though that might delay your entry into the investment field by a little bit. I think it's worth it.
Yeah, I think one of my favorites was when the water heater went out. You go downstairs and all of a sudden there's water all over the floor and like, oh my gosh, and then you can't wait.
Yeah.
You can't decide, oh, well, I'll just, save up for this. You can't. You got to take money out of the emergency fund, and glad that you have an emergency fund, because, the water heater goes out. I'm telling you, you don't necessarily really appreciate that hot water until you don't have it.
That's very true.
So Will's next question that I will put to him. So what prior knowledge should one acquire to invest?
Yeah, and I apologize. I got carried away on the last question and answered a lot of that. But yeah, it's learning those valuation metrics so you can have a better idea of when a stock is a bargain and when it's overpriced. Now, just because a PE ratio is 30, a 30 PE ratio is going to be very cheap for some stocks and very overpriced if it's a mature, very slow growth stock. So I think you have to learn the industry you're interested in and see what valuation metrics are like it in that industry and how they compare. But nonetheless, you need to know how those valuation metrics work, such as price to earnings ratio, price to sales ratio, and again, you need to learn those basic three financial statements: the balance sheet, the income statement, and the statement of cash flows. And there's a lot of literature to read up on that. It's also very accessible. I don't think people appreciate how accessible that is, because I went to the Berkshire Hathaway meeting last year, and Warren Buffett was talking about how he had to go through all these books from Moody's, look through thousands of stocks individually to see if he found an opportunity. Well, you can just go to a stock screener, put in certain criteria, and do in a few minutes what used to take Warren Buffett days. So all this information is out there. You can find it on Yahoo. You can find it on Motley Fool, for that matter, or you can look into the statements from the Securities and Exchange Commission, specifically the 10Q for the quarterly report, and the 10K that's published once a year and gives you the annual report. So I know those are the 10Q and the 10K may seem intimidating, and they were intimidating to me, and I do this for a living. But I pushed myself through it. And I really will I read one cover to cover, but I do at least look for those basic financial statements and other statements from management as well. So and any breakdowns too. It's like the revenue breakdowns are often what I'll look for in one of these statements that may or may not be in the quarterly reports you see published. And Danny had a point earlier I wanted to emphasize. It's what happens when a stock falls 40% and you want to panic. I'd like to be able to tell you I could teach that here, but you need to get in the game, because you're only going to know how you're going to react to that by experiencing it, and that's not something you teach. It's going to inspire certain feelings in you, specifically feelings that you want to buy high and sell low, which obviously you don't want to do. So, but you really need to know how you're going to react emotionally when these big drops happen, to really determine your mettle as an investor. Because again, it's one of those things that you just have to feel and go through to know what it's like. So, aside from just knowing the basics about valuation and about financial statements, I would just encourage you to get in there and learn. Learn from experience and learn from your mistakes, because that's going to be the best teacher in the long run.
So we had a question from one of the folks in our studio. How do you save a year's worth of income? Any tips? Absolutely. How I started saving for a year's worth of income was started off with what I talked about earlier about paying off debt. And I'm going to try to put some numbers to this just to, as an example. And I don't know that these numbers are accurate from, say, 15, 20 years ago, but they're directionally accurate. So I had, let's say I had probably 3 credit cards, and between the 3 of them, there was $14,000 balance on all of them. One credit card had a payment due of about $150 a month. One had a payment due of $75 a month. One of them had a payment due of $50 a month. So I made sure to pay all of the minimum balances. But on the little one, the $50 one, I would pay $100 on that. And gradually over time whittled that down till that card that had the lowest balance and the lowest minimum payment due was paid off. And we put that card aside. And then we took the same amount of money that we were paying, the $100 on that, and we added that to the amount that we were paying on the second card. So that one we were paying $75 on it. Now we're paying $175 on it. And we gradually whittled that one down and paid it off. And then finally, the one card that we were paying, I don't know, $100 or $150 on, we added the $175 to that, and we paid that down. Now, we had this chunk of money that we had been using to pay down debt, and I think it was probably in the neighborhood of $275 to $300. And then we started taking that money and putting that into savings every single month. I talked about the tax returns. When we got a tax return that we weren't, necessarily expecting, I always tried to make sure that I paid a little bit more than what the tax man was expecting over time. So, instead of having the maximum amount of exemptions, we put in the minimum number of exemptions so that we were pretty sure that we were going to get a refund at the end of the year. So when that refund came in, we'd take that refund, bam, that goes right into savings. And now you've gone from having a certain amount every month, plus you got that big, chunk right there. And here was another thing. So I had a job where I would get paid twice a month, on the 15th and on the 30th. And I got used to that. And my budget was built for that. And then I changed jobs and I would get paid bi-weekly, which was every other week. Well, it turns out when you get paid every other week, once a quarter, you have 1 month where you get paid 3 times instead of 2 times. So we would take that extra paycheck, bam, right into the savings account. Another way was we had a car payment and paid that car payment, paid the car payment, paid the car payment. When we paid the car off, we took that $300 a month that was going toward the car payment, that went into savings. So you can see that over time, these little things add up over time. And eventually we got to where we were putting a significant amount of money into savings. And that works equally well for savings or for investing. Now, I took a little different approach than what Will did. I set aside the amount of money that I was going to invest every month. And while I was doing that, I worked at paying down my credit cards. And then once I got done at paying down my credit cards, then I worked at building up my emergency fund. So I was doing this at the same time rather than focusing on one first and doing the other. Now, back to Will's point about what prior knowledge that you should acquire prior to investing. I took a little different approach to that too. I took my $99 and I invested in my Motley Fool subscription. And once I had that, I relied on the Motley Fool to do the heavy lifting. I had a subscription to Stock Advisor, which was the only newsletter that I got for a couple of years. And then I added Rule Breakers. And I use those two as the basis for my investing decisions. And I didn't invest in every single recommendation that came out every month. I read them and I invested in the ones that appealed to me. And over time, I got to recognize for myself what investments that I thought would generate more or better returns over time. And I was fortunate in that I realized for me one of the best ways to invest is in companies that have that are consumer facing and had a large addressable market. And so for me, that led me to companies like Apple and Netflix and Mercado Libre and Amazon. Some of the other more successful companies that were on the Motley Fool, because I kept reading these recommendations over and over again and trying to figure out what it was that made for a successful investment. And to me, the ones that ended up being the most successful were those that I just talked about. They faced the consumer market. They had large addressable markets, and they were, leaders in their field for one reason or another. So for me, I let the Motley Fool recommendations do the heavy lifting. And then from those, I picked out the ones that spoke the most to me as an investor. And that turned out to be a successful strategy for me.
Yeah, I will say, services like Rule Breakers, you can read the recommendations. It will give you a lot of good ideas as to why a stock might be successful or why it may not earn returns. And then you can take, if you have some of that background knowledge, you can take that and sort of confirm what you're reading for one thing, and then maybe you find other investment angles that maybe nobody else thought of, and that could lead to a potential opportunity. So it's good to read other people's stuff or ideas, and then be able to do some of your own due diligence. One to understand what you're reading in some of these articles, and then also to find opportunities. So with that, I think I'm going to ask you your last question, if that's okay, before we get into the other questions. So Danny, how do you handle the inevitable volatility?
Much better than I used to.
That's fair.
I remember back now, keep in mind, I want to give you a little context here. I started investing in mid to late 2007. That's when I found the Motley Fool. That's when I, subscribed to Stock Advisor. I started looking through all of the old recommendations, and I went, hey, Netflix, that's a company that I know, and I really like that company. And I read the recommendation and I invested in it. And then I, looked at Marvel. That was the other one that I thought was one that spoke to me, and I invested in it. Now I say that because if you look at what was happening in the world, in late 2007, we had the beginnings of a big recession. It had to do with banks and something called mortgage-backed securities. And the short version of that, banks were lending these mortgages, and then they were taking a bunch of them and bundling up them and selling them to outside investors. And so rather than having your mortgage at the bank where you started, your mortgage might end up in any number of places. This was a fairly profitable arrangement for the banks. And what they did at the same time, there was a prominent politician who was saying that essentially everybody who wants to should be able to own a house. And that mindset sent a lot of people to the banks, and the banks began lowering their standards. And as that happened, and getting everybody into a house, and getting all those mortgages into mortgage-backed securities, some of them began to fail. And then some of the banks got into trouble. And there was this domino effect that basically ran through the U.S. economy, and actually through the global economy, but through the U.S. economy primarily. And that led us to a recession. Now, that recession started in November of 2007, and it lasted all the way through March of 2009. Now, think about me as a young investor, never invested before, and what I'm seeing is the entirety of my portfolio falling. Every day I would look at the stock market, and every day the numbers were red. That's how it seemed. That's not the reality. The reality of it was you'd have some days where it was down and you'd have some days when it was up, but it was consistently falling. Now, to give you an idea, at the end of that period, the S&P 500 had fallen 47%. I had a bunch of stocks that were more volatile than that. So my portfolio fell by more than half. And I panicked part of the way through, and I started selling some of those holdings. I was not the seasoned investor that you see before you today. I was, Johnny Scaredy Cat, and I was selling stuff. But over time, the folks at the Motley Fool said, this is normal. This is what happens. There's going to be recessions. There's going to be market downturns. And the pace of my selling slowed. And then it stopped. And then I started actually adding back to these positions and buying new stocks because I realized that it wasn't me that had made a mistake. This was the normal movement of the market. This is just what happens. But I'll tell you, I was frightened at first. I thought I was throwing my money away. But because of that experience, over time, I learned that it's normal for a stock like Netflix, which I held and was my biggest investment for years, that it fell by 80% at one point, and I didn't sell it. The Trade Desk was a company that, we've recently seen that stock has fallen by 60%. I'm not selling it. So I think the volatility is a natural part of the investing experience. And it's something you have to, like Will said, you have to experience this for yourself. You can't understand how your emotions are going to fight with you until you experience this. And your brain can be telling you this is normal. And meanwhile, the same time your emotions are sell. Oh my God, get out before the sky falls. A little bit dramatic, but I mean, that's what actually was going on in my head.
Oh yeah.
So I would say experiencing it, but listen to the more seasoned investors around you who will say, this is normal. This is what happens. It's all going to be okay. Because it certainly doesn't feel like that at the time.
Yeah, not at all. So you talk about the end of 2007. The end of 2007, everything was looking hunky dory. You would have never known that a historic crash was coming in just a few months. So yeah, we talk like this now. I mean, for all I know, there could be a 50% drop in the next 6 months. I don't know that. You can't. I mean, you can only look back at the past. You cannot look at the future. None of us have crystal balls, and even some of the clues may not. Yeah, I think some of the clues may have caught the attention of professionals. But if you go back to 2007, 2008, you had the crash of Bear Stearns in March, and that rattled investors a little bit, maybe some investors. But the stock market was still going along until the fall of 2008 and Lehman, and the entire financial system basically crashing. You can't really predict that that's going to happen, especially if you're a beginning investor. So
at all,
yeah, you're going to have to. Like Danny and I said, you're just going to have to go through it. You're going to have to go through the emotions. That's how you know whether this game is really for you. But if it is, there is some potential if you can stay disciplined. And the way I stay disciplined nowadays, now that I've been through more than one of these times, I just look at the investment case for the stock. If I like the investment case, I hold come what may. I go back to learning football when I was a kid. To tackle someone, you have to look at the waist. And the runner will try to razzle dazzle you with all hand gestures to try and distract you from the waist. But you always have to look at the waist. And being a successful investor is looking at the waist, looking at the value proposition of the stock, and holding to that no matter what happens in the general market. I think that's how you succeeded at that ultimately.
Yeah, I think one of the other things I wanted to point out is that somebody that was much smarter than me said, when you don't know what to do, sometimes the best thing to do is nothing. And that is very true for investing. There's been a lot of times where, for me as an investor, panic wants to set in because you see something and, your body can sometimes have a visceral reaction to what you're seeing. If I see a stock that I own that represents, let's say, 10% of my portfolio, and all of a sudden that stock falls 30% over in a matter of weeks, I'm gonna have a reaction to that. My emotions are going to be there. And this has actually just happened with NVIDIA. NVIDIA represents 10% of my wealth for myself and my entire family. So to see that fall by 30%, even now, that's a little bit unnerving. However, I go back, I look at the financial statements, I look at the results, look at what the company did. Its revenue grew by 74% year over year in the most recent quarter. That is not the results of a company that's in trouble. So the company is doing just fine. It's the stock price that's not doing just fine. And that's one of the things that helps me keep that calm, knowing that the underlying business is solid, that the company is doing well, and the stock price is detached from reality. And that happens more often than you might think.
So, Foolis had a question, just asked just now. Between Stock Advisor and Rule Breaker, which service has better returns since inception? Had someone invested in every recommendation? Well, Stock Advisor came about in March of 2002. Its return since then is 844.5%. Rule Breakers has existed since 2004. The return of 304.6% since that time. So I guess even with the 2 extra years, Stock Advisor seems to have the lead. But I will say both of them significantly outperformed the S&P 500 by a huge mark. Even in Rule Breakers' case, it has more than doubled the S&P 500. And then in Stock Advisor, it looks like a little bit more than 4 times as much. So those are the results there. You're muted, Danny.
Thank you, sir. I really wish I had this data close at hand, but I don't. And that's a good reminder. I want to get this data where I can present it. But the Motley Fool did a study a few years back. And essentially what they did is they back tested if investors had bought a number of random stocks from the recommendations and held them during various time periods over the course of the Motley Fool's history. If you started buying the stocks at one particular year or another particular year or another particular year. And what they found was that if you bought those stocks and you held them, then you didn't lose money. And I don't want to put any figures to this because I'm sure I would mess it up. But I really want to get my hands on that data, and perhaps I can revisit that in a future show. But I think one of the things about the Motley Fool as a service is I really like the transparency. I really like the fact that they show you, here's all the recommendations that we have had in this service since the beginning, going all the way back to inception. And here are the stocks that we sold and when we sold them. And you know what the Motley Fool has done as a service going back. And you don't get that kind of transparency, I don't think, anywhere else. And please do not think that I am saying this as I am stumping for the Motley Fool as somebody who works for the Motley Fool. I do. But long before I ever got a TMF moniker, I was a Motley Fool subscriber. And I was a Motley Fool subscriber for Stock Advisor, for Rule Breakers for a number of years, even before I even became a ticker guy. And I eventually became a ticker guide, and then I eventually became a contributor to some of the services, and eventually started writing for the Motley Fool a number of years ago, and now appear on Fool 24. But my loyalty comes from the fact that I was a Motley Fool subscriber, and I did very well out of this.
Yeah, I will say I've learned so much by being in the Motley Fool environment. I did a lot of things on my own, which before that, which in retrospect was a mistake. Having the Fool, just both for the factual support in terms of the articles and even the emotional support, really. I think it's helped me tremendously as an investor. So I do recommend it, even though I'm being paid to be here. I recommend it despite that. So we have about 4 minutes left. I'm going to hit this question from Besties because I think it's one we need to address. Besties asked, sell when the market is highly valued and the stock market has increased by a lot in a short time. This is when you sell. Tell us about when you sell in your view. I'm going to disagree with that. I'm not really a big seller. I mean, and even if I do decide to sell, I sell when the investment thesis is broken. I had Booking Holdings way after the .com bust. I made a big profit in a short time and sold and never looked back. And basically, I would be a wealthy man if I either held the shares or at least kept watching it and then bought back in. After I had sold, but because I just abandoned the stock, I don't have it. I missed out on literally hundreds of thousands or maybe even millions in gains if I'd done it a certain way. So I'm not a big seller, but yeah, sometimes the investment thesis does get busted. I think at that time you might want to consider selling, or if the valuation just goes into the stratosphere, like I did back in the day. I had Cisco in 2000 when that somehow became the world's largest market cap when it shouldn't have been. That probably should have been a signal for me to sell, but I did not sell. And here we are 25 years later, it is not returned to that price. So bubbles are real. There is such a thing as a stock that goes too far, it goes up too far. But yeah, unless the investment thesis is busted or their valuation just becomes ridiculous, I'm not a seller.
And I wanted to throw my 2 cents in here. I identified myself as a rule breaker type investor earlier. And if you go back and look at the 6 traits of what identifies a rule breaker, one of them is the perception that a stock is overvalued by the financial media. My portfolio still to this day is built on stocks, many of which have high multiples.
Yeah.
And as a result of that, my portfolio overall tends to be much more volatile than the market at large. And that's something that I'm okay with. So even when the market is highly valued, and even when the stock value has increased by a lot in a short period of time, I do not sell. The reason I don't sell is because I am a long-term investor. I'm putting those stocks in there. I am holding them for the long term. There's been a number of times over the years where I could have tried to sell Netflix stock and time the peaks and valleys, sell when it was highly valued and buy after it fell precipitously. That's just not something I do. Now, there will be some point when I decide I need to raise money, and then I will probably pay more attention to selling stocks when they're near their all-time highs. But now is not that time for me.
Well, just as a fun fact, I just looked up Cisco. It's still 25% below its all-time high in 2000. So some of these could go a long time. And when I'm talking high valuation, I just talk about valuations where there's just no way the fundamentals justify this, even if you take the earnings 5 years out. If it is something like that, I might sell, but otherwise, I'm not really a seller. So with that, we are at the top of the hour. This is a great hour, Danny. Thank you for suggesting this topic.
Thank
I
you.
very much enjoyed this. So with that, we're going to bring up Jose and Toby for the next hour.
And are they going to be making some big, bold predictions?
I think so.
We are indeed.
Nice. Welcome back, Toby.
Thanks, Danny. Good to be back.
All right, full on, guys.
Full on.
All righty, Jose. How are you doing today?
Pretty good, Toby. Welcome back from your vacation. Even though you kind of destroyed the market by coming back home, Toby.
Yeah. It hasn't been great since I've been back in the country. So it is what it is.
So Toby, I mean, this is going to be your first time doing this bold prediction show. I would say I'm kind of an expert here. I think I've done 2 or 3 of these already. For the fools that are not familiar, this bold prediction is going to be an hour where Toby and I each make 3 predictions of various companies. I think it's going to be an interesting show. And here we're going to go about 8 minutes in each prediction. We're gonna go back and forth, and we're also looking for engagement from the fools watching right now. If you believe our predictions are gonna be true, try to explain why in Slido, or if you have maybe an opposite thought, feel free to share your reason in Slido as well. And like always, make sure to go to slido.com, passcode FOOL24. So, Toby, would you want to start off with your first prediction or want me to go in first?
Sure. Let me start off. I'll make my first bold prediction right here, Jose. Prediction number 1 from me. Berkshire Hathaway will announce a $100 billion plus acquisition by the end of the year. I think they have a record amount of cash on the balance sheet right now. I think it's about $325 billion that they've got sitting around there. And Warren Buffett, Jose, he doesn't like to keep cash forever, right? He likes to put that to work, making money. So I feel like with the amount they're sitting on, that's just an acquisition waiting to happen, right? And I think we're going to see a big one. I think we're going to see one by the end of the year. I wouldn't be shocked to see some announcement come by the annual meeting here in May. I think that may be a little too early. I think he's going to sit tight for a little bit, see how the market goes. But I expect to see a big acquisition from Berkshire here before the end of 2025.
So, Toby, 2 things here. First, I don't follow this investment and group too closely. Well, I don't know if you might know on top of your head, what has been their biggest acquisition? And how far is it from this $100 billion?
That's a good question, Jose. I think the biggest one to date might still be the Burlington Northern acquisition, which that was some time ago, though. That was back before the first meeting that I went to. I may have been about 10 years ago. I forget the actual year they did that. I could be mistaken on that, but that's the one that's coming to mind as the biggest one they had done. It was certainly the biggest one they had done to date then. And I'm not quite sure what the amount of that was, right? $100 billion would be big for them, though. That would be quite sizable. But again, like they're rolling with $300 billion in cash right now. So got a lot to spend, right? To give you an idea, right? If you were to, so let's put some context around this here. What if, say, just for instance, Warren Buffett's sitting there thinking, you know what I would like to do? I would like to buy a really big insurance company
to add to Geico, for instance. The one that comes to mind in that space is Progressive, right? Progressive, which is a nice car insurer. Progressive has a market cap of a little over 150 billion right now, I think. So it's bigger than 100 billion, but they could certainly do it with the cash they have on hand, right? But that is a sizable acquisition, and will that be the one they do? I don't know. That might have some regulatory issues on that side. But just as a general matter, yes, 100 billion is quite large, I think, in the grand scheme of things in terms of acquisitions. But it is but it is something that they could do if they chose to, if they wanted to.
Yeah. So because one of the first things that came into mind with the $100 billion, it's or 100 billion plus. I don't know many public companies that would kind of fit in this. So would you think it'd be like, do you most likely see it coming from a valuation based on like a private entity, or would it be something that you think is more likely to happen within the public market?
So when you're talking about something this big, I think it has to be a public company, right? Which limits which does limit the possibilities to some degree. There's not a lot of companies out there that you'd buy for 100 billion that aren't already public, right? I mean, at that point, you're probably public. And to go back to your last question, Jose, Burlington Northern was 34 billion. So we're talking 3 times the size. Like, this would be massive and substantial. And hey, this is bold, so I wanted to go bold. I could certainly be wrong with this one. But this would be, I think, a massive kick in the teeth to the M&A market too, if Berkshire rolled out with something this size.
Yeah, and for the fools watching, make sure to join us on Slido. We have a poll open, and Toby, feel free to also check in the poll as well. But right now, we got the poll is going to be open for about four more minutes or so, and then we're going to jump into the next bold prediction. But Toby, I think coming in for your first show, this is definitely a really, really bold prediction. And would you see any potential of maybe like a tech acquisition, or do you think it would be more of something in the that, like you mentioned originally with the insurance, something that it's more complementary to the vast portfolio the Berkshire has already?
So that's a good question, Jose. I actually could see a tech acquisition, right? I think that is something. There was a time, right, when Warren Buffett had said, "I don't invest in tech because I don't really, it's not that's outside my circle of competence." And then, Apple became their largest public company investment on the balance sheet, right? Now they've sold down that recently, but he's no longer afraid of tech out there. So you certainly could see something like that happening. And Jose, AMD, 200 billion in market cap, right? Is that about right? What's AMD's market cap right now?
Yeah, I think it's actually even a little bit less than 200, might be like 175.
I mean, not the craziest thing in the world. I mean, actually, it might be. No, they're crazier things, but hey, it's out there.
Who knows? Maybe they believe in the Intel turnaround story, and you can definitely get that for less than 100 billion right now.
You could. There you go. Right, Intel's sitting there. Intel's sitting there on the table for Berkshire to grab.
So we have we have about 2 more minutes, a little bit to go here on the poll, so make sure to kind of get your information on there. Toby, this is actually funny. A few days ago, I did an episode with Lou, and Lou actually made a prediction here for Berkshire as well, that Warren would actually step out or kind of step down as CEO within the next 2 years. So it's definitely a interesting play here, where we're seeing a lot of these predictions happening with this company.
Well, maybe we're both right, Jose, right? I mean, acquiring AMD would be one heck of a mic drop, right?
All right, Toby. So I think we are going to be closing the poll in 1 minute. With this kind of acquisition, like you mentioned, the previous one was like 36, definitely a bigger jump. Do you think it would be more of like a Warren decision, or kind of like the successors that have been kind of groomed at the moment for this acquisition base?
I think something of this size would have to be Warren Buffett. I think there's no way something like this happens without him not only signing off, but probably being the lead in making it happen.
All right, Toby. So the poll is closed, and we are 64% agree. Toby, 18% disagree, and 18 need more information. So Besties had a question, Toby. So Toby, that's likely with the disruption that is on now, there could be opportunities for Berkshire. What do you think they would buy? Okay, so we already talked that a little bit. All right, so Toby, I'm gonna jump in with my next prediction here, or my first prediction. My first prediction, Toby, is Micron will provide at least a 15% compounded annual growth rate during the next 5 years. So 15% during the next 5 years, it's this more than doubling its current stock price. And I think today it closed at around $90. And I forgot to mention, Toby, I actually voted for I disagree in that last one. I think $100 billion is a big jump, and I can't really see anything outside of the tech space. But again, that's probably me just limited to the tech industry right now. But I did vote I disagree on that one.
Fair enough.
Yeah. All right, so Toby, let me jump into mine. I believe, like I mentioned, I believe Micron will at least double within the next 5 years. The main reason is right now, Micron is sitting in a very great spot with the AI market. So with the AI market evolving, you need more demand for memory solutions. And these memory solutions are doing really well with AI accelerators like NVIDIA's chips, AMD chips, and all these big tech players developing their own AI chips. But one kind of industry or sector, Toby, that Micron can also benefit is in the consumer space. So I know there's some worries that, hey, look, is the AI market in data center coming to an end or slowing down? But we're still kind of in the bottom cycle for consumer tech, and the consumer tech is what drives a lot of volume and a lot of money for Micron Technologies. And in the next 5 years, I do believe we're going to have more needs for more memory inside your phone, inside your laptop, inside your automobiles, and whatever type of technology evolves within the next 5 years. So I think within the next 5 years, Micron is one that can benefit from the AI phase, either being data center phase or the consumer phase, and can provide great returns for long-term investors.
Nice. Let me think about this a second. Right now I'm leaning toward agreeing with you on this, Jose, but a couple of questions here. They're not the only player in this space, for sure. Over the next 5 years, do you see them being the biggest winner in the memory space?
So yeah, Toby, you're right. They're not the only player here. There's at least one leader so far in the memory space right now, at least for AI chips, and that is SK Hynix, which is a Korean-based company, and the other one is Samsung as well. But Samsung is like SK Hynix is first, Micron is second, and then kind of far behind the track as number 3 is Samsung. I do believe in the next 5 years, the competition is going to continue. I believe Samsung will kind of close the gap between that second and third, but still be third. I don't believe Micron will be the number 1. I think SK Hynix will still be number 1 in this prediction, but this AI market is going to grow at such high levels in forms of memory for the consumer products, for other types of measurements, that even a second player, and this is very different from some other second players, first and second players do kind of have a closer gap. So it's a little bit, I think the competition will be there. But historically, Toby, the memory market has been one that's been very heavily oversaturated with a lot of competitors. And I think the AI space, with the level of innovation that is needed, is reducing this market from tens of memory players to only 3. And I think for that reason, it's going to help allow Micron to have a better supply and demand balance than historically has been seen in the memory space.
So they're building some new facilities right now, I believe, right, in the U.S. And then and part of that's coming from the CHIP Act, right? The CHIPS Act. Do you, and look, let's be real here, right? There has been talk about maybe pulling some of that back, undoing some of that CHIPS Act stuff, perhaps. Would that hurt your thesis if we got kind of a cancellation or a reduction of the CHIP Act's funding? Do you think they need that to increase capacity enough to get to that 15% 50% returns that you're looking for from them, or could they do it regardless of what happens with government subsidies for new manufacturing capacity?
Yeah. So, Toby, if you would have asked me this question maybe a year ago, I would have said they need it, because about a year ago, we were still kind of in a very heavy memory down cycle. And I would say, hey, during this down cycle, you need all the help you can get. I think right now things have changed. We are hearing the memory space in the AI market is pretty strong, and we're hearing kind of a turnaround story in the consumer space. So it will be nice. Obviously, I'm never going to say free money is not nice for a company. It would be nice. But I think right now with the way things are going, it's not necessary for them to be able, they'll be able to invest their own money and still be able to run a business soundly, because the overall market will provide them that tailwind of positive free cash flow to be able to do these investments.
Nice. All right. And Jose, you know what Micron's market cap is right now?
I am actually not sure. I'm gonna guess it's less than 100 billion.
No, it's actually right around 100 billion. I bring that up. Only to say, after listening to you talk these last couple of minutes, I agree with you. I do think that Micron's got that 50% compound growth rate over the next 5 years going. With this caveat, if they get bought out by Berkshire, that's the one thing that would stop that from happening. So so let's go with that.
Yeah, that would be a very, very interesting topic, Toby. If 1 year from now we see one of these big chip players get acquired,
Well, you know what you need for AI growth, right? You need energy, you need power, right? Berkshire's got the power already. If they had a chip maker, they're like an all-in-one AI package, right? To kind of offer up to whoever needs both chip capacity and energy to go along with that.
So the poll does close in about 1 minute, Toby. So if one hasn't submitted their vote, feel free to do that before they close. And Toby, I mean, I think this is one thing that I should get more familiar with, but I didn't know Berkshire had like a lot of power companies. Maybe the more I knew about it, maybe my decision would have been different on that previous poll.
Yeah, it looks like we got a lot of people agreeing with you, Jose, on this one. So nice. All right, let's move on to my next one, shall we? My next prediction here. Next one for me, Jose. You're gonna love this one. Over the next 5 years, Nvidia loses to the S&P 500 total return index. What do you think of that? Well, here, let me lay out my idea for it. So I see you thinking.
I hate you already, Toby. I hate you already.
I see you thinking about it. But here's my thought, right, Jose, is that, look, this thing has been a massive winner for over the last year, over the last 2 years, 5 years, 10 years. It's been huge, right? At some point, you start to revert a little bit. I love the company. I think it's a well-run business, but they've just performed so dramatically and so drastically. And I think part of what that means is that there's a lot of expectation built in the stock price, a lot of very heavy and lofty expectations for what they're going to continue to do. That concerns me a little bit. I suspect what happens is that the business continues to perform reasonably well. But I think we're seeing early signs of this already with the DeepSeek stuff, with the idea that maybe there are ways to get efficiencies out of for AI without having to just go, all in on as much power from the GPU that you can possibly get. I think that's the next stage of this. The next iteration is let's do this more efficiently. Let's do this. Let's do this a little bit with less of a power drain on these things, right? And at that stage of development, I don't think NVIDIA is as critical to the solution, right? And so I think you're going to see a little bit of a pullback. I think you're going to see a one quarter they're going to not hit their marks, right? Or what's going to happen? They're going to say, "Hey, we met expectations," except not the real expectations that they had, right? The expectations of exceeding expectations, right? At some point they meet, and then when that happens, I think you see the stock come down. And I think overall, Jose, you're just going to see them lose to the S&P 500 over the next 5 years.
Yeah. So Toby, here, do you think it's going to be right now? NVIDIA's biggest revenue is the data center market, right? And you're kind of if we see kind of a slowdown in the need for this, you're most likely going to see kind of a slowdown or a decline in capital expenditure from these big tech players. Do you see how can I say this? Do you see like more of like big tech all stopping at once, or is it going to be more of like a trickle down effect where Microsoft will stop first, and then maybe not in that order, but one quarter maybe Microsoft may mention, "I'm slowing down on capital expenditure." Then the next quarter Amazon will say the same thing, and the quarter after that Google might say the same thing. Or do you see this more of a complete shutdown at once?
I think it's going to be more of a trickle effect, right? And I don't think you're going to see everyone pull back at once. I think you're going to see someone. You're going to have. I think you're going to see some of these companies say in their earnings call, right? Our capex spend is only going to increase by 1% next quarter instead of 6% or whatever. And then one quarter they say someone, I don't know who is going to be first, will come out one quarter and say, we expect to hold steady on capex because we're seeing increased efficiencies in our algorithms and our AI efforts that do not require as much growth, right? And so I think it's going to be slow. I think it's going to fall off the cliff. I think it's going to be a slow kind of reduction, right? And once that happens, I think what you see is an adjustment of expectations and analysts saying, oh, so this means we're not going to get 20% growth next quarter, right? And so I think that's the way it's going to play out, is my guess.
Toby, I wonder, OpenAI recently just announced a new image solution just a few days ago. And also, fools, the poll is open right now for NVIDIA will lose to the S&P 500 over the next 5 years. But Toby, OpenAI just released a new AI tool 2 days ago, and today Sam Altman mentions that they actually have to pull back a little bit on it because they didn't have enough compute capacity to be able to keep up with the demand. Does something like that maybe? When do we start hearing maybe the difference of? Because something when I hear that from Sam Altman, it tells me that they still need a lot of AI chips to continue to innovate in this AI push. What do you think? It's the final push that maybe turns it the other way around?
Yeah. And I think one post he made on X today, he actually used the phrase like our GPUs are melting, right? Which that's probably good news for NVIDIA in the short term because clearly they need more. I think what you're going to see is at some point someone's going to come out a different model perhaps, and their response is going to be to the effect of maybe you're not good at your algorithm, right? You're just wasting energy. You're wasting power on this, right? I feel like what you're going to see, whether it's going to be ChatGPT or someone else, is you're going to start to see them talk about, look at what we can do now with the same capacity that it took us to do, like, or there's something like, we can now do this task in half the time with the same GPU capacity that it took us to do it 6 months ago, right? So you're going to start to see those efficiencies increase, right? And I think it's going to be slow at first again, but I think the commentary is going to shift. Like, you won't hear Sam Altman saying, "Oh, we can't do this. Like, GPUs are melting." He's going to come out and saying more like, "Oh, isn't this so amazing? Like, this next iteration wasn't about this great new thing you got. It's about reduced resources, right? And that now we're actually able to offer this to everyone because we have the ability to do it. We have the power to do it." So I think the conversation changes slightly over time. But I will admit that the comments that we saw today from him do make me hesitate a little bit on this prediction here.
Yeah. So, Toby, just to maybe fully understand this, you believe there's going to be more improvements, maybe in like the software side, or kind of like these algorithms to create these AI workloads that we're going to say, hey, look, we've been doing this the wrong way. We can do this 50, 70% more efficient, which is going to reduce the capacity because we found that shortcut of how to make these algorithms work better. And let's just, on the top level view, it's more of a software-based improvement that is helping us our improvements in the power efficiency.
I think that's right, and maybe it's also on the hardware side too. There's some way, there's a different design that makes this better, right? If NVIDIA is the one who comes out with that, then this probably fails, right? If they say our next chip is not a more powerful chip, it's one that is optimized to AI, and it lets you do this with faster, with reduced power consumption, all that kind of stuff. Maybe that keeps them going for a while, right? And Besties I see here is one who disagrees with me, who's said I might be right over the longer term, but not in the next 5 years. It will beat the market in 5 years. So there's one disagreement. And Jeff asked me, do I own NVIDIA? I do not right now. So maybe that's some of my bias coming out here. For sure. I know, Jose, you're an owner, right? So you're loving the gains you see.
Yeah. I mean, this is a fun one, Toby, because I don't believe any company is a sure victory, right? Every company has a risk, but I agree with Besties. I think in the next 5 years is such a short term to improve the efficiencies so quickly, where if it does happen, I'm gonna go with Besties and believe it's most likely gonna happen in a longer time frame. We got the poll results, Toby. 30% agree with you, Toby. I actually think that's a lot. I thought that's a lot higher than I thought was going to be the number. So 31% agree with you, 69% disagree with you. I'm gonna guess, Toby, 31% don't own NVIDIA shares, and the other 69% do own NVIDIA shares. I think my biggest reason here, Toby, is even though we haven't seen much advancements in things like large language models, one thing that we've heard is with this new time of thinking, even though you're doing the same thing, in the back end, it's actually using a lot more compute power to get the better results as these AIs are thinking and thinking and thinking and thinking. And I think right now we are in a ball game where it's right now this position where we're just trying to find, we're bull rushing and trying to find the best ways to use AI. And we still haven't even gotten to the end of AI, that the best thing right now is to just invest as much as possible, get to the end of AI. Once we've kind of reached this end, or whatever the end of AI is, that's when we start to focus more on the efficiency side. And I feel like that's most technologies, right? When you get a new technology, first you try to make it as best as possible, and once you've created that, then you start to pull back and you start to make it more efficient as possible.
Yeah, I think that's right, and that's part of what I'm thinking here. But we'll see if NVIDIA can keep the party going. Do you agree? What about you, Jose? Are you yay or nay on this?
I completely 100,000% disagree
All
with
right.
this one, Toby. Yeah,
All right.
like I mentioned, I agree with Festies where if it is possible, it has to be longer than 5 years. But in the next 5 years, I think it could still at least outperform the S&P 500.
Fair enough. All right. What do you got next for us?
All right, Toby. So the next one, we'll keep it here in the data center market. So my next prediction is Microsoft's data center drama will turn out to be a nothing burger. And let me kind of just give a backstory to maybe those that might not know this Microsoft data center drama that's happening right now. A few days ago, Toby, there was kind of like a rehash of an old news we saw about a month ago that Microsoft is delaying or closing some or canceling some leases in data center. And that is kind of creating this kind of sentiment where if Microsoft is canceling these data centers leases is because they believe they overbuilt on AI infrastructure. So it kind of goes with that over bubble or that bubble market in the AI space. And it's all happening at the same time where a few days ago we kind of heard an Alibaba chairman mention that there is an AI bubble. So I believe this note and this drama is a lot more has kind of ballooned into something that it's really not. I think what's really happening here, Toby, and we're going to hear most likely from Microsoft during their upcoming earnings, which is, I want to say, maybe a little bit over a month away, so not too far off from earnings seasons already. But what I think we're going to hear from Microsoft is Microsoft used to spend a lot of money to, one, build their own AI infrastructures for their own cloud market solution, Azure, but also to help build infrastructure for a company that they're investing heavily in, OpenAI. But recently, OpenAI really kind of started to ask money from other players, and that kind of started this whole Stargate project. So this Stargate project is this massive AI supercomputers and data centers happening all over the United States to help OpenAI with its training facility or with its training of AI solutions. What I think it's most likely the case with this Microsoft drama, Toby, is Microsoft is no longer going to be helping OpenAI too much, or it's going to be helping less than intended. And it's more going to be a shift of hands. It's not like there's an overcapacity compute. Microsoft doesn't need that anymore because OpenAI has found kind of another sugar daddy to be able to fund its AI data center needs. So I think right now the market sees this as an AI bubble sign, where I think it's just a transfer of capacity to another player.
Do you think that that Microsoft will continue to rely heavily on OpenAI's models, ChatGPT, to underlie all of what they're doing, like with Copilot and all that thing, or do you see them moving more to an internally developed models, internally developed algorithms, like kind of completing that kind of break from OpenAI, if you will?
So I think the answer is yes. It's actually going to do both, Toby. I think right now we are seeing that the only ones that are really, and many people don't put Google on the top of this AI market, but Google is definitely one that is just the past month alone, Toby, has announced a lot of AI solutions. They announced a new image solution. They announced a new large language model solution that's pretty amazing. And the only one that's able to compete with that one, Toby, right now is OpenAI. So I think Microsoft sees that and it says, hey, look, right now, for our co-pilots to be anywhat competitive, we need to still be reliant on OpenAI. I think Microsoft, they've created a lot of internal AI solutions, and their hope is that they will eventually be able to provide something that can compete against OpenAI. and kind of just make it more of like an internal thing. And I think that's just going to be a race of who has the better talent and who has the better drive to do it. At the moment, I still believe OpenAI has a massive lead over Microsoft's internal solutions. But it can definitely change. It could, depending on talent. But right now, I think Microsoft is going to need that heavy reliance on OpenAI solution.
And do you, despite what we've seen recent, like just, as you've been talking about the data center stuff, do you think, let's say midterm, let's say 3 to 5 years out, do you expect to see Microsoft continuing to build out data center capacity, whether it's for OpenAI or not, right? Do you think that this might just be like, looking a couple years that they have some more plans they're announcing, right? Do you think that's going to happen soon?
I think, Toby, within the next 3 to 5 years, it's so weird to say, but it's going to be, excuse me, it's going to be so heavily dependent on how AI innovates. If we just stay in this large language model era of just texting back and forth and random image generation, then I think no. I think AI computers or AI spending will slow down. If we start to get into this kind of AI agentic push, which is kind of like AI's doing tasks for you, you tell it, hey, look, go do a research about this stock real quick, give me a full report, then go on and maybe create a script for me to be able to make an article or a YouTube video or whatever. If we start to get into that kind of fully automated system, I think yes. So it's all going to be dependent on the innovation of AI. I do believe we're going to continue to see innovation here, but it's all crucial on that technology shift.
I tend to think you're right on this, Jose. I think I tend to agree with you on this one. I think what we've seen with this issue here is really a response to, as you know, with OpenAI, it's response to a single customer and that customer's demands and a commitment they had made, right, to provide capacity. And then this is more. Their pullback in this case, I think, is more a statement on the changing of that specific relationship than it is on their longer term CapEx plans, right? And I think they look at this and saying, well, that commitment from OpenAI to purchase may not be there anymore. Therefore, we don't need to supply that. Therefore, this facility doesn't need to come online, at least as quickly as we thought it did. We're going to focus on but hey, we still have all these other customers, right? That are coming for our needs. So we're going to continue to grow, just not right now, right? Or not for this customer, because maybe they're not as good as we thought they were. Kind of thing here, right? So all right, it looks like we've got a poll close here. 91% agree with you, Jose, which is pretty solid. 9% disagree. Yeah, and as I said, with me, I agree on this one. I think that's right. So
and the main reason, Toby, I wanted
right?
to the main reason I wanted to bring this one up is I feel there's been a lot of fear in the market right now, and there was a lot of news coming out in that all at once. Like I mentioned, there's been a few discussions of AI bubble slowdown in data centers. So I think we'll get our answers, Toby, in the next earnings call. I do believe this is going to be a topic of discussion. So hopefully we don't have to wait too long for this prediction to be found true or not.
Yeah, I think you're right. I think this will come up for sure. And it'll come up in the context of other CapEx spending that they talk about, and they'll lay out their plans. And I think we'll see that it's not a huge deal in overall there. All right, so shall we go on to my next one, Jose? Here,
yes.
Let's go on to my next one. This one, and if knocking NVIDIA wasn't enough for one show, I feel like I'm going to stir the pot up a little bit more here for some of our viewers, perhaps, and maybe even some fool analysts here might disagree with me on this. My bold prediction number 3, Jose, is that over the next 5 years, BYD outperforms Tesla. BYD, of course, being the electric vehicle maker based in China that has had quite a solid performance recently. And for this one, what I want to do is I do want to show a chart as I'm talking about this. So I'm going to bring up a screen share, assuming I can find it here. So this is what I'm going to do. I'm going to share right now for our viewers this this chart of relative performance of Tesla and BYD over the last 5 years. And look at that, Jose. Over the last 5 years, BYD has outperformed Tesla. Now, the other takeaway you get when you look at this over the last 5 years is you think, damn, I'm happy if I owned either one of those companies, and I really wish I owned both, and probably I wish I owned a lot more than I did, right? So BYD outperforming Tesla over the last 5 years is in no way a knock at Tesla, because wouldn't you love to have a 680% return, Jose? I know
for
I
sure,
would.
Toby.
Yeah, like, you know, that's good stuff, right? But I think that this is that's gonna persist going forward. I think BYD has continued to be the winner here from where they are now. A couple reasons for that. They have more going on, I think, than Tesla in the here and now, right? A lot of the thesis around Tesla is robotics, it's AI, it's autonomous driving. It's things that are not commercially viable right now. It's in the future, right? BYD has they're making cars right now, electric cars, as is Tesla. They're selling them all over the world, but they also have buses, they have trucks, they have monorails. So they have a lot of commercial business that Tesla doesn't have. Tesla is much more reliant on the consumer automotive business, whereas BYD has a lot of commercial business out there. They make batteries. They make so many batteries, they sell some to Tesla for their vehicles in China, Jose, right? So BYD has a huge battery. They actually started, not many people know this, they started as a battery maker many years ago and shifted into electric vehicles. They also don't just do EVs, they do hybrids as well. So they have that to kind of backstop them. And if you look at the relative markets, China, the core markets, China versus the US, my expectation is that electric vehicles from where we are now grow more in China. Electrical vehicle adoption grows more in China over the next 5 years than it does domestically, right? I think in the US, you're going to see some hybrid action going on in the next couple of years here, but Tesla's not in that market, whereas BYD is. So if they were to make a push into the US, for instance, they haven't really made a big one yet, but if they did, they could potentially do that not just with EVs, but also with hybrids and maybe pick up some of that market as well. So there you go. That's my rationale here. I wonder what people think. I think I suspect what people think here. Oh, I'm getting some agreements so far. The poll is just up for you guys to go vote in with that. Any questions, Jose? Any thoughts?
Yeah. So, in five, you mentioned it perfectly, Toby. Right? A big portion of Tesla's valuation right now is based on a lot of future growth opportunities, like robotics being one of them. So, do you believe within the next 5 years, is this under the thesis that within the next 5 years, we really don't see a consumer robotic market take off?
I think that's right. I don't think we have a mass market consumer Tesla bot in the next 5 years. I don't think we have level 5 autonomous driving and robotaxis in the next 5 years. I think that comes. I think mass market robotaxis get here. All